Okay, let's unpack this. Welcome back to the deep dive. So, I want you to think about the last major economic headline you read. Maybe it was about inflation, maybe the latest jobs report, or, a big forecast for next year's GDP growth. Every single day, monumental decisions, billions of dollars in markets, policy changes from the Federal Reserve, the Treasury are made based on those numbers. But if we stripped away the headlines for a second, what are we really looking at? Where does that data actually come from? It's so easy to forget that these numbers, which seem so solid and authoritative, are often, well, kind of fragile. They're built on incomplete information, they're subject to bias, and they are constantly being rewritten. So today we are doing a really critical deep dive. We're going straight into the foundational architecture of economic data statistics. We're going to map out the entire complex ecosystem that produces the numbers that drive everything, moving right past the headlines to the sources themselves, and I think more importantly to their limitations. And our mission here is really for you, the learner. So we want you to understand not just the output of economics, but the inputs. I mean, how do professional economists actually measure activity or spot trends, test their theories, and build those really sophisticated predictive models? The truth is, the quality of any forecast hinges completely on the quality, the reliability, and the timeliness of the data you use. If that foundation is shaky, the skyscraper of your model is, well, it's just going to fall over.
That's the perfect framing. It really is, because understanding the sources is the absolute necessary prerequisite for any kind of critical thinking in economics. If you don't get the origin, the collection method, and the inherent caveats that are baked into, say, a consumer price index print or some manufacturing sentiment survey, you're just consuming the result. You can't critique the input. So we'll be looking not just at what the data is, that's the easy part, but who collects it, how they filter it, and the crucial strengths and, of course, the limitations that are inherent in every single source. It's really an exercise in informational quality control, which any serious analyst has to master before they even think about running a regression model.
Okay, so let's start at the very beginning. The most foundational split in how economic information is acquired. And this definition really sets the stage for everything else that follows. We've got primary data and we've got secondary data. Primary data it's the pure stuff. It's collected directly by researchers or institutions themselves for a very specific, often a very unique purpose. So you can think about a university maybe running a controlled economic experiment, to test how people respond to price changes.
Or, the ultimate example, a government conducting a full-scale decennial census. That's the ultimate ground-up data collection effort.
Right.
And the huge advantage, like you said, is customization. The data is perfectly tailored to answer whatever specific research question the collector has. If you need to know exactly how households in the 90th percentile of income spend their tax returns, you can design a primary survey that targets only those people.
It's custom-built information.
Exactly. It's bespoke.
But here's the catch, and it's a really big one. It explains why primary data is almost never the backbone of, big macroeconomic forecasting.
Yeah, that customization comes with a very, very steep price tag. I mean, often prohibitively so. Primary data collection is incredibly costly and time-consuming. Just try to imagine achieving a nationally representative sample for, say, quarterly capital expenditures across all 50 states.
Yeah.
The resources you'd need are they're massive.
Which brings us, naturally, to the real workhorse. The unsung hero of economic forecasting, secondary data. And this is just, information that was collected by someone else, usually a massive institution. And then it gets reused by analysts, by forecasters, by academics for their own work.
And here's the crucial insight we really have to establish right at the beginning. Most economic forecasting, and I mean certainly all the major macroeconomic modeling that affects policy, it relies almost entirely on secondary data.
So why is that? Is it purely a cost thing, or is there some kind of structural reason that we have to rely on information that was, gathered for a different purpose originally?
It's overwhelmingly structural. I mean, the cost is a factor, but the real reason is scale. What's fascinating here is that secondary data is the bedrock of modern forecasting, precisely because the sheer scope and the standardization required for national and global analysis are just too immense for any single entity to collect on their own. We're talking about data that needs to span industries and countries and decades.
Right.
Think about it like this. To really understand inflation in the U.S., you need consistent price data points from millions and millions of transactions collected from, 300 million people every single month. If you tried to do that yourself as a primary collection effort, you'd go bankrupt instantly. It's impossible. So we have to rely on this shared infrastructure provided by secondary sources.
Like the government statistical offices, central banks, international databases.
All of them. Yeah.
That makes perfect sense. These big institutions, they can achieve the standardization and the breadth that no one else can.
Exactly. And this secondary data infrastructure, that's what lets analysts do those core tasks we talked about. Measuring the sheer scale of activity, how big is the economy? Identifying long-term trends and short-term cycles. Are we in a boom or are we heading for a slowdown?
Testing the big theories.
Right. Testing whether our grand economic theories actually hold up in the real world. And then finally, building and evaluating those complex forecasting models that try to predict what happens next. The scale of the modern global economy demands this kind of centralized, shared infrastructure of secondary information. There's no other way.
Okay, so that structure you just laid out, it sets the stage perfectly for where the majority of this reliable, standardized secondary data comes from. When we talk about the foundation of economic stats, we're really talking about the official giants. Government agencies, central banks, and the major international organizations. They are, without a doubt, the most important providers of economic data on the planet. Hashtag 2.1. National statistical agencies, the domestic scorekeepers. Let's start at home then. With the national statistical agencies, or NSAs, these are the primary domestic collectors, the official scorekeepers of a nation's economy. And in the U.S., the two workhorses we hear about constantly are the Bureau of Economic Analysis, the BEA, and the Bureau of Labor Statistics, the BLS.
And they're responsible for tracking the big three metrics that dominate every single economic headline.
Right, the big ones.
These agencies collect the data on national income and output, which is most famously boiled down into gross domestic product, or GDP. They handle the employment and unemployment figures, which tell us about the health of the labor market. And of course, they track prices and inflation measures.
Let's dig into that a little deeper because how they calculate them is so critical. I mean, take inflation. It's constantly debated. How does the BLS, the Bureau of Labor Statistics, actually take millions and millions of prices and condense them into one number, the Consumer Price Index, or CPI?
It's a hugely complicated task. It's a sophisticated statistical exercise that requires constant methodological adjustment. I mean, the BLS doesn't just record prices. They have to decide what's even in the basket of goods that people buy, then how much weight each of those items gets. But there are two really critical methodological details that almost never make it into the headlines, and for forecasters, they are absolutely essential. So the first is seasonal adjustment, economic activity. It often follows these predictable annual patterns. Retail hiring spikes in December for the holidays, construction slows down in January in cold climates. If we didn't seasonally adjust the data, you would always think the economy was booming in December and then collapsing every single January.
Yeah, it would just be noise.
Complete noise. So the BLS uses these statistical filtering techniques to remove those regular seasonal variations, and that allows forecasters to see the underlying non-seasonal trend. It's about finding the signal.
That filtering sounds absolutely necessary. I mean, without it, you'd be making terrible policy decisions.
You would. And the second critical methodology is hedonic quality adjustment. This is a massive issue in an economy like ours, where technology is changing so fast. Think about it. If the price of a laptop goes up 10% this year, but the processing power, the storage, the screen resolution also got, say, 10% better, is that really inflation?
It's a better product for more money.
Exactly. So the BLS adjusts the price downward based on those measurable quality improvements. They are essentially asking, how much would last year's exact same model cost this year?
So if they didn't do that, if they didn't use these hedonic adjustments, our CPI numbers, especially in things like technology and cars and durable goods, they'd look much higher. It would give us a distorted view of our purchasing power. Precisely. And that's why the strengths of these agencies are so clear. They have this unparalleled large coverage, which guarantees representativeness, and they have these standardized methodologies like the ones we just discussed. That ensures that today's number is genuinely comparable to last year's number. And that consistency is the absolute bedrock of time series analysis.
Okay, but we have to talk about the limitations.
Oh, absolutely. And as you pointed out right at the start, forecasters need to obsess over these limitations. The first big one is publication lags. By the time the BEA releases its first or advanced estimate of quarterly GDP, the quarter it's measuring is already over. The economy's already moved on. You are always looking in the rearview mirror.
It must feel like you're trying to drive a car, but you're only allowed to look at a map of where you were 3 months ago.
It's a perfect analogy. It makes real-time policy adjustments incredibly difficult. And the second limitation is maybe the most critical challenge for anyone building a model. periodic revisions.
The numbers change.
The numbers always change. When the BEA releases that advance estimate of GDP, they might only have, say, 60% of the raw data they need, like survey responses or trade declarations. So they use sophisticated statistical models to fill in the missing 40%. It's an estimate.
So it's a model built on top of a partial data set.
Exactly. And then a month later, they release the second estimate with more complete data. Then a month after that, the third estimate. And that's not even the end of it. Once a year, they conduct these routine benchmark revisions where they integrate massive slow-moving data sets like the full economic census. And these revisions, they often change the story dramatically. An economy that looked like it was growing sluggishly at first might, after all the revisions are in, appear to have been booming all along.
So the headline number, the one that we all react to instantly, the one that moves markets, it's essentially an educated guess that the government itself expects to be wrong later on.
That's 100% correct. And the real sophistication required by a forecaster is understanding the pattern of those guesses. Does the BEA tend to overestimate the initial GDP or underestimate it? This is crucial information, and we'll definitely explore how forecasters cope with this moving target problem when we talk about real-time data later. Hashtag 2.2, central banks, the financial system's nerve center.
Okay, so moving beyond the national scorekeepers like the BLS, we have the central banks. So institutions like the U.S. Federal Reserve, the Bank of Japan, the ECB. And their role it's unique. It's driven by their mandate over monetary policy, which gives them this unparalleled insight into the financial mechanics of the economy. So what specific data flows only from central banks? Why is it distinct from the GDP and jobs reports that the statistical agencies give us?
Yeah, they are focused on the financial plumbing. The specific data they provide really revolves around the mechanics of money and credit. Things like monetary aggregates like M1 and M2, which measure the money supply, various interest rates, from the policy rate they set themselves to broader market rates, exchange rates, and detailed, often daily financial markets data on things like liquidity and banking activity.
Okay, let's just clarify M1 and M2. We hear those terms all the time, but what do they practically represent, and why does the Fed even track them?
Right, so M1 is the narrowest measure. It includes all the physical cash in circulation and then highly liquid checking account deposits. Basically, money that can be spent almost instantly.
Got it.
M2 is broader. It includes everything that's in M1, but it adds savings deposits, money market accounts, and smaller denomination time deposits like CDs.
Yeah.
It represents money that's slightly less liquid, but still very easily convertible into spending power.
And the Fed tracks these because?
Because if the money supply, the total amount of M1 or M2, is growing far, far faster than the production of actual goods and services in the economy, that can be a signal of future inflationary pressure. It's the old too much money chasing too few goods idea. And while the Fed has relied less on M2 as a direct policy target since the 1990s, movements in money aggregates still inform their background analysis on whether the economy is overheating or cooling down.
And beyond just the raw data, central banks also publish their own analysis and forecasts, right? And those often move markets just as much as the data itself.
Oh, correct. Absolutely. Their outputs go way beyond just raw numbers. They publish these sophisticated economic indicators, really detailed policy reports, and their own internal economic forecasts. These are often presented through famous models like the Fed's FRB-US model. These documents don't just report history, they provide an authoritative interpretation of that history and, crucially, signal future policy intentions.
Which brings up another key point. Central banks often prefer different data sets than the general public or the media focuses on.
Yes, and this is a huge one for forecasters. So while the BLS produces the Consumer Price Index, the CPI, which gets all the headlines, the Fed typically bases its policy targets on a different measure, the Personal Consumption Expenditures Price Index, or PCE, which is produced by the BEA.
Why the difference? I mean, if CPI is the big headline, why does the Fed use PCE?
There are two main reasons, and they're both really important. First, the PCE accounts for substitution effects. Meaning if the price of beef skyrockets, consumers buy more chicken, the CPI tends to use a fixed basket of goods for longer periods, which can exaggerate the impact of rising prices if consumers are actively substituting away from those items.
Yeah.
The PCE captures that real-world behavior more accurately.
Okay, that makes sense.
The second reason is that the PCE covers a broader range of expenditures. It includes costs that are paid on behalf of consumers, like employer-provided health insurance. That makes it a more comprehensive measure of economy-wide inflation. So for a forecaster, knowing the Fed's preference means the PCE is the number they need to watch most closely for policy signals, even if the CPI is the number the media reports first. Hashtag 2.3. International organizations, the global compilers.
All right, so the third major institutional source steps outside of national borders. These are the international organizations, and their essential function is compiling cross-country and really global economic data. We mentioned the IMF, the World Bank, the OECD. So why can't we just, download every country's national statistics and add them up ourselves? What's the specific value that these global compilers are offering?
Their key contribution is ensuring comparability. It's a huge deal. As you kind of noted earlier, comparing GDP growth in, say, Argentina versus Japan is a real apples and oranges problem. Each country measures income and spending and trade slightly differently based on its own specific laws and its own data collection infrastructure.
So it's not standardized at the national level.
Not at all. And that's where these international organizations impose structure. They use these globally agreed upon standards, most notably the System of National Accounts, or S&A, which provides this comprehensive, consistent framework for national accounting. The IMF and the World Bank basically mandate that their member countries report their raw data according to these international rules, and that allows for standardized comparisons.
So they're basically the global data translator. They're standardizing the vocabulary, so every country is speaking the same economic language.
Precisely. That's a perfect way to put it. And this standardization is absolutely crucial for international finance, for global trade analysis, for development economics. I mean, without it, assessing global investment risk would just be chaos. So these organizations house these vast, common data sets that focus on global metrics. Comparative GDP growth, synchronized inflation tracking, global trade flows, and detailed balance of payments data.
Okay, and what exactly does balance of payments data cover? Why is that so critical for global analysis?
The balance of payments is it's a sophisticated accounting record of all economic transactions between one country and the rest of the world over a certain period of time. It has two main parts. There's current account, which is trade in goods and services and international income flows. And then there's the capital and financial account, which tracks international investments.
And the two have to balance out.
They have to balance. So if a country is running a massive current account deficit, that means it's buying far more from the world than it's selling. And that gap has to be financed by the financial account, meaning foreign capital has to be flowing in to cover the difference. So for a forecaster who's analyzing currency risk or a country's debt stability, the balance of payments data, compiled and standardized by the IMF, is indispensable for understanding that country's vulnerability to global financial shocks.
Okay, so we've laid the foundation with the official heavyweights, the institutional giants that provide the standardized macroeconomic structure. But, as we move into short-term forecasting and high-frequency trading, relying only on these lagging official reports, it's just not enough. Forecasters need speed, they need granularity, and they need indicators of future intention.
That's exactly right. And that's where we move into the specialized and alternative data streams. While the official sources are robust and they're verified, they are slow. A lot of the speed and the granular detail that really moves modern markets and informs short-term strategy comes from these highly varied sources. They're invaluable, but they come with a high-risk profile. They often lack the transparency and the methodological rigor of the government agencies.
Right. And if we connect this to the bigger picture, this is where the cutting edge of economic analysis is right now. It's trying to integrate these high-speed, often noisy sources with the slow, reliable government numbers. Hashtag tag 3.1. Private sector data providers. The early indicators. Let's talk about the private sector providers. Their motivation is purely commercial, right? They're producing data for market intelligence, for trading strategies, corporate planning. They operate where the government agencies often can't, focusing on that forward-looking sentiment. And the examples are everywhere in the financial news. I mean, minute-by-minute stock prices, credit card transaction data, proprietary surveys like the Consumer Confidence Indices or that famous Purchasing Managers Index, the PMI.
The advantages of these indicators are immense for anyone who needs rapid insight. They're high frequency, sometimes daily, sometimes even intraday. And crucially, as you said, they're often explicitly forward-looking. They're designed to measure sentiment and intention and expectations rather than just historical output. Take the PMI, for example. It's published monthly by groups like the Institute for Supply Management, or ISM. It's not tracking output directly. It's asking manufacturing managers questions like, are your new orders higher, lower, or the same this month compared to last month?
And it's a diffusion index, right, where that number 50 is the critical threshold.
Exactly. It's calculated based on the net balance of managers who are reporting improvement versus those reporting a decline. So a reading above 50 suggests the manufacturing sector is expanding, and a reading below 50 means it's contracting. This gives you a hint about economic activity weeks or even months before the official industrial production or GDP numbers come out and confirm the trend.
It's an early warning system.
It's a very powerful early warning system. But there is a serious cost to this speed. The first is the literal high cost of access proprietary data can cost millions of dollars. But the second, and I think the more analytically challenging issue, is the lack of methodological transparency. Private firms don't have the same public disclosure mandate as the BLS. They don't have to show you the full list of companies they surveyed or exactly how they weighted the responses.
So forecasters have to take these fast numbers with a certain amount of faith, or at least with a lot of scrutiny, before they try to model them.
They absolutely do. And this reliance on early, noisy indicators forces a forecaster to face a really difficult trade-off regarding risk. It's the famous type I versus type 2 error problem from statistics.
A false positive versus a false negative.
Exactly. A type I error is reacting quickly to a PMI print that later turns out to be just a temporary blip, a false positive. A type 2 error is waiting for the reliable final GDP number and completely missing a major profitable market shift, a false negative. And traders, they often prefer risking a type I error, reacting wrongly, because the cost of a type 2 error of missing the turn is far greater in a fast-moving market. So analyzing these private indices demands a really sophisticated risk calculus. Tags 3.2 by survey-based data, measuring the mood.
Okay, shifting gears a bit. Let's look specifically at survey-based data. This is stuff designed purely to measure mood or expectations, often collected by academic institutions or specialized arms of the government. We're talking about questionnaires that target households, firms, or consumers.
Yeah, these surveys are designed to capture what the economist John Maynard Keynes famously called the animal spirits of the economy, that intangible element of confidence and expectation. If everyone expects a recession is coming, they stop spending, and by doing so, they actually cause the recession they were afraid of.
So the value proposition here is enormous. They can anticipate turning points. If consumer confidence suddenly collapses, that's a huge warning sign, even if the current hard data on jobs and spending still looks strong. They capture the inflection points.
Absolutely. They capture those inflection points better than any backward-looking hard data can. But these tools are inherently flawed. They rely entirely on self-reported human input, which means they are subject to error in two major ways.
Okay.
The first is sampling error. The people who actually answered the survey might not perfectly reflect the entire population, and that leads to skewed results. Maybe only highly optimistic people chose to fill out the questionnaire that month, which leads to a confidence spike that doesn't actually reflect what the majority of people are feeling.
And the second issue is much harder to filter out, I'd imagine, response bias.
Response bias is really tricky because it's not about who was surveyed, but how they answer. People might tell a surveyor they're planning a big purchase because, they want to appear optimistic. But when the time actually comes, they hoard cash because they're uncertain. Or, conversely, they might underreport negative feelings to maintain a professional front. The survey captures the expressed mood, not the guaranteed action. A forecaster has to constantly calibrate for the historical gap between what people say and what they do, the talk versus the economic walk. And that's a huge challenge when you're trying to model future spending. Hashtag 3.3, administrative and transactional data. Big data by accident.
Now here's where it gets really interesting and where modern economic measurement is evolving so rapidly. We're moving from these small, costly primary surveys to massive, cheap, automated data, administrative and transactional data. And this is information that's generated automatically as a byproduct of some other process, not collected for research purposes. So we're talking about tax records, social security data, customs, and trade records.
Credit card swipes, or even web scrape data from thousands of online retailers. It exists because it was legally or commercially necessary for some other reason. It's accidental data in a way. Yeah. And the strengths of this administrative data are formidable. They make it highly attractive. First, the sample size. You often get near census level coverage. Every taxpayer, every customs declaration, every credit card swipe that's captured by a payment processor. Second, high accuracy. Often higher than surveys because this data is based on mandatory legal reporting or verified financial transactions. The incentive to report accurately is just baked into the system.
Okay, but the limitations have to be equally strong, especially for a forecaster. I imagine accessibility is a massive hurdle, right? Because of privacy rules like HIPAA or GDPR.
That's the first huge hurdle, limited access due to regulatory and privacy constraints. But the second, and arguably the most crucial analytical limitation, is that this data was not originally designed for economic analysis. It was designed for tax collection, or law enforcement, or inventory management.
So it doesn't fit the economic definitions you need.
Exactly. This creates huge definitional mismatches. If an economist wants to measure, say, labor income, they have a very precise definition in their models. But the IRS's definition of income on a tax form might include depreciation schedules or capital gains that the economist wants to exclude. So to use this data, you have to invest a monumental amount of effort in restructuring it, cleaning it, and sometimes extrapolating to make it fit standard economic definitions. The cost of data cleaning can easily be more than the cost of acquiring the data itself.
So you have this perfect, massive data set, but it's written in a language your model can't immediately understand. And the process of translating it introduces a whole new set of methodological challenges.
Precisely. And if we look at the real cutting edge of this, think about web scrape data. You have firms like the Billion Prices Project or other price intelligence companies, and they scrape millions of product prices from thousands of online retailers every single day. This gives them near real-time inflation metrics, potentially far, far faster than the BLS.
But there has to be a catch.
The catch is selection bias. Which retailers do you scrape? If you only scrape the major online giants, you're completely missing small businesses, physical stores, and local services. If your data is skewed toward products sold on Amazon, you might miss supply chain bottlenecks that are affecting specialized industrial goods. The data is fast, it's massive, and it's accurate for what it measures. But its representativeness of the entire economy is constantly up for debate. This is the new frontier of data risk.
All right, so we've established the ecosystem where all this data comes from and its inherent biases. Now let's shift our focus to the practical realities. How do economists actually organize that data for modeling, and what are the critical issues of quality that every forecaster faces every single day? Hashtag TagShack 4.1. The 3 data dimensions for analysis. So when an economist downloads a massive data set, whether it's from the World Bank or a private vendor, it has to be structured in a way that lets the modeling software draw meaningful conclusions. And there are 3 common organizational dimensions. The first, and the most familiar one, especially when we're talking about predicting future macroeconomic outcomes, is time series data. This is your classic historical line graph. It's observations of a single variable, like the unemployment rate, measured sequentially over a long period, say, monthly since 1950. That continuity is absolutely essential for predictive modeling because it helps establish historical relationships between variables.
Then you have cross-sectional data. And this is a complete snapshot. It's observations across many different units, could be firms, individual people, or countries, but measured at only one specific point in time. For example, you could conduct a one-time survey in January of 2024 to compare the average income, education level, and savings rate of every household in Chicago. It's excellent for comparative analysis at a single moment.
A single slice in time.
Exactly. And finally, we have panel data. And this is the richest and often the most powerful form of data analytically because it combines both. It has both the time series and the cross-sectional dimensions. It tracks the same group of units, the same 50 countries, or the same 1,000 workers, or the same 500 companies, and it observes them repeatedly over many different time periods, often decades.
And why is that combination so powerful? What does it let you do?
Well, panel data allows economists to control for unit-specific factors that are constant over time. So, for example, if you're studying the impact of minimum wage hikes on firm hiring, you can use panel data to track a specific set of restaurants over 10 years. You can control for the fact that one restaurant is just inherently better managed than another, that's a firm's specific effect, while still analyzing how the change in the minimum wage over time impacted all of them. This allows for far cleaner causal inference than you could ever get from either time series or cross-sectional data alone. Hashtag tag 4.2, frequency, timeliness, and the noise trade-off.
So once the data is structured, we have to talk about frequency, which really defines the rhythm of economic reporting. Data frequency varies wildly. You have annual data, quarterly like GDP, monthly like CPI, and then you get into the much higher frequency stuff daily or even minute by minute in financial markets.
And this brings us to the central trade-off. This is the crunch point of every forecasting decision. Timeliness versus reliability.
The faster it is, the less reliable it is.
In a sense, yes. Higher frequency data is inherently more timely. You get market updates every second, giving you the quickest possible look at current conditions. But it tends to be far noisier. By that I mean it's more volatile, it's subject to these short-term spikes, trading corrections, market hysteria, things that are really difficult to interpret as underlying sustainable economic trends. A 5% drop in the stock market today might be because of a geopolitical shock that completely reverses tomorrow, but it registers as a huge piece of economic activity right now.
So you risk overreacting to these short-term spikes that don't really mean anything in the long run.
Exactly. And conversely, lower frequency data, like that quarterly GDP number, is much smoother. The noise is filtered out. It's far more reliable for identifying those long-term structural trends that we really want to model, but obviously it's much less responsive to current events. If a government passes a major stimulus package today, you won't see its full, smoothed-out effect on the quarterly GDP number for months or even years after the fact.
It's a balancing act.
It is a continuous high-wire act of balancing the need for timeliness against the need for reliability. And the right balance depends entirely on your goal. Are you predicting next month's employment number, or are you trying to predict next decade's economic potential? Those are two very different problems. Hashtag 4.3, data revisions and real-time reliability.
This brings us to what might be the absolute most important methodological question for any serious forecaster. How reliable is that first number we see? And in economics, the answer is usually unsettlingly low. And that's because of the critical issue of data revisions.
As we discussed earlier, those initial releases, the figures that dominate the news cycle and cause these immediate market reactions, are almost always just estimates. They're estimates because the agency has to report something quickly, but they might be working with only a partial data set, so they have to estimate the missing components.
And these revisions aren't just minor tweaks around the edges, are they? They can fundamentally change the entire narrative of economic history.
Oh, they absolutely can. Let me give you a really powerful example. So, following the 2008 financial crisis, many economists and policymakers viewed the subsequent economic recovery as painfully slow. There was this idea of a new normal of low growth. But then, in 2013, the BEA implemented a major methodological benchmark revision to GDP. They changed how things like research and development were counted as investment, among other things. And the result? The GDP growth rate for the previous 5 years was significantly revised upward.
Wow.
The entire historical narrative changed overnight. Suddenly, the post-2008 recovery wasn't quite as sluggish as everyone had thought. And this revision fundamentally altered how policymakers viewed the effectiveness of the fiscal and monetary policy they had used during that period.
That's a huge lesson. So if you had built a complex economic model based on those initial weak growth numbers, the revision basically proved that the historical premise of your model was flawed, even if all your math was correct.
That is the absolute core of the problem. Revisions can seriously affect historical analysis and, crucially, the evaluation of past forecasts. If a model predicted 3% growth in 2011 and the initial report came in at 2%, the model looked wrong. But if the final, fully revised data years later shows 3.1% growth, the model was actually highly accurate. It correctly saw the underlying economic reality, even though the data available at the time misled the forecaster.
So what do you do about that?
This leads to a very specific high-level requirement for modern forecasters. They have to track revision patterns and use what are called real-time data vintages.
Okay, what does using a real-time data vintage mean in practice?
It's intense historical bookkeeping. A data vintage is basically a snapshot of all the historical data that was available at one specific point in time. So if you made a forecast in January of 2020, to properly evaluate that forecast today, you must use the data set that was available in January 2020. That includes the preliminary 2019 numbers, the revised 2018 numbers, and so on. You cannot use the final, fully revised 2024 historical data set to grade your past performance.
Because that would be cheating. You'd be grading yourself with information you didn't have at the time.
Exactly. So forecasters need access to these specialized databases that store every single version of every historical data point. The original release, the first revision, the second, and on and on. Understanding when and why revisions happen, whether they are just routine seasonal adjustments or these massive benchmark shifts, is a prerequisite for judging the success or failure of a model. It's the difference between self-deception and true intellectual honesty in the profession.
It really speaks to the integrity of the profession, as you said. You are constantly grading your past performance against the fog of incomplete information that existed at the time, not against the perfect, clear history that eventually emerged years later. Hashtag tag outro.
So let's try to synthesize what we've talked about today. The foundation of all robust economic analysis, and therefore all reliable forecasts, it really requires two core principles. First, you have to identify and use consistent, robust data sources, whether they're the slow government agencies or the fast private vendors. And second, You have to maintain this unwavering awareness of the inherent measurement issues we've dissected, the publication lags, the sampling and response bias in surveys, and, maybe most critically, the reality of constant revisions.
Mm-hmm.
And we should always emphasize that symbiotic relationship between economic theory and the data. I mean, economic theory isn't just some abstract construct. It guides our interpretation of the data. It helps us understand the mechanisms at work and suggests which variables are the most crucial inputs, for instance, why M2 might signal inflation pressure down the road. And in turn, the data serves as the ultimate quantitative validation or invalidation of that theory. If the data, even after you account for all the revisions, consistently defies the theory, then the theory has to be adjusted.
The data is the final arbiter.
It is. So what does this all mean for you, the learner? It means that mastering economics isn't just about understanding the complex models. It's about understanding the inputs. It's about knowing the source, acknowledging the necessary quality control that's required, and recognizing that every single number that hits the wire, whether it's a flash estimate of GDP or the daily sentiment survey, is an estimate or a snapshot or a byproduct. And all of them. Welcome to the Deep Dive, where we take on the most complex subjects, stack up the foundational research, and build you a genuine shortcut to deep, thorough understanding.
Mm-hmm.
If you're here, it's because you want to move beyond the headlines and truly understand the machinery of the economy, the language, the metrics, and the frameworks that drive policy and financial markets.
Yeah, that's right.
This deep dive is really custom-tailored for you, focusing on the essential toolkit of macroeconomic data.
And that's the mission today. We are unpacking the source material focused on the principles and frameworks of macroeconomic indicators.
Right.
We are treating this as, your required reading for economic literacy. If you can master how this data is collected, interpreted, and adjusted, you stop being a passive observer.
You're not just listening to the news anymore.
Exactly. You start becoming an informed analyst of the global economic landscape. We are building the architecture first before we start installing the drywall.
I love that. We need the blueprint. So let's start with a foundational definition. When we talk about macroeconomic data, what's the real difference between this and, say, analyzing the quarterly earnings of a single company?
That distinction is, it's vital. Macroeconomic data measures the overall performance of an economy. It's not concerned with individual purchasing decisions or the success of a single business or even the price of one specific stock.
It's the big picture.
It describes aggregate outcomes, the big collective picture. It's really the difference between studying a single tree's growth rate and studying the health of the entire forest.
The forest, yeah.
We're looking at trends that affect millions of people and, trillions of dollars all at the same time.
The forest, indeed. And why is establishing this standardized way of measurement, this framework, so crucial? I mean, why dedicate serious intellectual and financial resources to calculating all these numbers?
Well, the documents we reviewed outline 4 critical uses that really justify the entire measurement system. The first is perhaps the most obvious, but it's constantly necessary. Monitoring economic conditions. This data is the primary instrument that governments, central banks, and businesses use to gauge the current health of the economy.
The temperature check.
The temperature check, exactly. Is unemployment rising or falling? Is inflation accelerating? It provides that daily, weekly, and quarterly check that determines policy urgency.
Right, that real-time feedback loop.
Precisely. The second related use is for analyzing business cycles. Economies don't just grow in a smooth line.
No, they go up and down.
They expand, they peak, they contract, and they trough. This data allows analysts to identify where we are in that cycle.
So are we in a boom that might lead to overheating? Or are we experiencing a slowdown that might tip into a recession?
Exactly. Without standardized measurements like GDP and employment figures, identifying those peaks and troughs is it's purely guesswork.
That makes a lot of sense. We need a clearly defined coordinate system to locate ourselves in the economic cycle. So what about the application side, beyond just observing?
The third and arguably most consequential use is guiding monetary and fiscal policy. These decisions have profound real-world consequences, and they absolutely have to be data-driven.
Okay.
Central banks, like the Federal Reserve, they look intensely at price indices and employment statistics to determine interest rates and control the money supply. That's monetary policy.
Mm-hmm.
And then governments use growth rates and budget forecasts derived from this data to determine spending plans and tax levels. That's fiscal policy.
So the data is the primary input for these, immensely consequential decisions.
So the numbers don't just describe the status quo, they directly inform the actions taken to alter the future. The stakes are massive.
Absolutely.
And the fourth major use, which ties directly back to anyone who is actively engaged in the financial world or just curious about the future, is to build and evaluate macroeconomic forecasts.
Okay, so the modeling part.
Yes. All sophisticated forecasting models, whether they're structural or time series, require reliable, consistent inputs, which are these indicators. And on top of that, the data provides the objective benchmark against which every one of those forecasts is judged for its accuracy.
So if the underlying data is flawed or incomplete or just misinterpreted, the resulting policy could be completely misdirected, and the forecast will almost certainly be wrong.
Yeah, it really is the foundational layer.
It's the bedrock.
It is the bedrock of modern economic analysis.
Okay, let's unpack this then. Before we drill down into specific indicators like interest rates or inflation, we have to understand the core architectural blueprint that holds this whole system together. And the documents emphasize the National Income and Product Accounts, or NIPA.
NIPA is the essential framework for measuring aggregate economic activity. You should think of it as the meticulous, required double-entry bookkeeping system for an entire nation.
Double-entry bookkeeping, I like that.
Just like a company's balance sheet, it ensures that every economic transaction is accounted for, and, most importantly, that the total value of what is produced must mathematically equal the total value of the income generated from that production.
And it must also equal the total amount spent on that production.
Exactly. It forces a complete, integrated view of the economy. Nothing gets left out.
So if NIPA is the framework, then its star player, the number we hear about constantly on the news, is gross domestic product, or GDP.
GDP is the primary aggregate measure within NIPA. It's the total market value of all final goods and services produced within a country's geographical borders during a specific period.
Usually a quarter or a year.
Typically a quarter a year, yes. But here's the fascinating part, the real aha moment that demonstrates the framework's intellectual elegance and its robustness.
What's that?
GDP is measured in three distinct, independent ways that must conceptually yield the identical final result.
3 ways to measure the exact same economic pie. We should probably go slowly through these 3 approaches because understanding how they converge gives you a truly comprehensive perspective.
I agree. The 3 approaches, production, expenditure, and income, they reflect the reality that a single transaction always has 3 sides to it.
Right.
Something is produced, someone spends money to buy it, and that money then becomes income for someone else.
Okay, so let's begin with approach number 1, the production approach.
The production approach focuses on supply and output. It sums up the value added across every single industry in the economy, from farming and mining to finance and software development.
And the goal here is strict accuracy by avoiding a major statistical trap, right? The trap of double counting.
That's the key. I think double counting is where people get confused.
Can you give us a detailed example of why value added is the critical phrase here?
Certainly. Let's imagine a loaf of bread. A farmer sells wheat to a miller for $1.
What?
The miller then grinds it into flour and sells that flour to a baker for $2. Then the baker makes bread and sells it to you, the consumer, for $4. Now, if we just added up the sales at each stage 1 plus 2 plus 4, we'd get $7.
Which is way too high.
It would grossly overestimate economic activity because the value of that initial wheat is included 3 times.
Right. It's in the flour and it's in the bread.
Exactly. So instead, the production approach only measures the new value that's created at each stage. The farmer added $1 of value. The miller added $1 of value. That's their $2 revenue minus their $1 input cost.
And the baker.
The baker added $2 of value, their $4 revenue, minus their $2 input of flour. So you sum the value added, 1 plus 1 plus 2, and you get the final GDP contribution of $4.
Which is the price of the final good.
Which is the price of the final good. By summing up the value added by every firm across every sector, we get the total GDP based on what was physically produced domestically.
It's a clean focus, looking strictly at the origination of output. I like that.
Precisely. Now, we pivot to approach number 2, which is the one most often cited in the news. It focuses on demand. The expenditure approach. This measures who ultimately bought all those final goods and services.
And this is the famous macroeconomic identity formula. C plus I plus G plus X TIM. So let's dissect the 4 main categories of demand, starting with C, consumption.
Consumption, or C, is the largest and steadiest component of GDP in most developed nations. It often accounts for, two-thirds or even more of the total economy.
Wow.
It includes all spending by households on final goods. That means both durable goods like automobiles, which last a long time.
And non-durable goods like groceries, which are consumed quickly.
Exactly. And services, which is a huge part of it. Everything from haircuts to healthcare. Consumption is the primary engine of demand, and its stability is crucial for economic health.
So if consumers stop feeling confident or, run out of seat butters, and the whole economy decelerates pretty rapidly.
Very rapidly. Next is I, investment. And this is where the definition is most distinct from how a typical person uses the word. It is not purchasing stocks or financial assets.
That is the biggest misconception, right?
It really is. Macroeconomic investment, the I, it refers specifically to the purchases made by businesses and certain household purchases that are intended to enhance future productive capacity.
Okay, so things that will help us produce more in the future.
Yes. This includes fixed investment, like new equipment, new factories, machinery, software development, and it crucially includes residential fixed investment, which is the building of new homes.
So new home construction is I, not C.
Correct. And it also accounts for the change in business inventories. So if firms produce goods and they don't sell them right away, they're counted as investment. The firm has essentially invested in its own inventory.
And why is I so important for understanding business cycles? The research indicates it's the most volatile component of GDP. Why is that?
It's so volatile because it is almost entirely driven by forward expectations and corporate confidence.
The psychology of it.
Absolutely. Consumption is relatively stable because, people still need to eat and heat their homes. But investment can be postponed immediately.
You don't have to build that new factory today.
Exactly. If a CEO is uncertain about the economy next year, they can delay building that new factory or buying that new software package. A small downturn in consumer spending can trigger a massive contraction in investment, which just exacerbates the business cycle. This sensitivity to interest rates and future demand makes it an excellent leading indicator.
Fascinating. Okay, moving on to G, government spending.
G includes all government purchases of final goods and services. This covers salaries for public employees, police, teachers, military, and spending on infrastructure projects like new bridges or defense equipment.
Now, the key distinction here, which is often missed, is what G excludes.
Yes, and this is important. It excludes transfer payments.
What are those?
This means things like Social Security benefits, welfare payments, unemployment insurance, food stamps. They are all excluded from G.
But why? That's government spending, isn't it?
It is. But those payments are just shifts of existing income. They don't represent a new demand for goods or services created in that period.
So the government isn't buying a bridge with a Social Security check?
Precisely. The recipient's eventual spending of that money will be captured under consumption, under C. We only count the direct governmental purchase of goods and labor under G.
That is a crucial distinction. Government purchases count. Cash handouts are accounted for later under consumer demand.
Exactly. And finally, we account for the global dimension, net exports, which is X.
Exports minus imports.
Right. When a domestically produced good, that's X, exports is sold overseas, that production must count toward our GDP, so it is added.
Makes sense.
Conversely, if a domestic consumer buys a foreign-made good, that's M, imports, that spending is already captured under their consumption, under C. But since the output wasn't domestic, we must subtract the import value out to ensure the GDP only reflects domestic production.
So net exports, therefore, reflects the balance of trade and the overall impact of the global economy on domestic demand.
That's right.
So the expenditure approach is demand-focused. Now for the third lens, the income approach. This measures the other side of the flow, where all that money ends up.
Yes. Once an item is produced and purchased, the money spent becomes income for someone. The income approach sums up the total income generated from that production process.
And what does that include?
This includes 4 primary categories of returns: wages paid to labor, profits earned by corporations, rents earned on property, and interest generated from capital investments.
So we have a closed loop. The value of production equals the value of spending, which then equals the value of the income generated.
Conceptually, yes, and this tripartite measurement structure is what makes NEPA so powerful. It acts as its own internal check, confirming that the measurement of the economy from the perspective of output, spending, and earnings should, at least in theory, converge on the exact same GDP number.
Here's where it gets really interesting, though, and where raw numbers can start to mislead people. If we measure all that activity, consumption, investment, wages in current dollars, we are capturing the effect of price changes, not just changes in volume. I mean, if the economy produces the exact same number of cars and services this year as last year, but everything costs 5% more, the nominal GDP grew by 5%, but the economy itself, it didn't grow at all.
And that necessity of adjustment is why we must factor out inflation. This leads us to the critical distinction between nominal and real variables. Without this step, we are just measuring noise, not true economic health.
Let's lock down that distinction, starting with nominal.
Okay. Nominal variables are measured in current market prices. They include the inflationary effect. So if the headline GDP number you see on the news is based on current dollars, that's nominal GDP.
And real variables are the ones that actually matter for measuring genuine growth and, change in living standards.
Precisely. Real variables are adjusted using a benchmark year's prices. These measures reflect the true change in output and purchasing power. When economists or central bankers discuss economic growth or try to determine if wages are truly keeping pace, they are almost always referring to the real adjusted figures.
And they use specific tools, the price indices, to perform this adjustment, which is called deflation.
That's right. The indices are the tools we use to strip away the price changes and isolate the volume changes. This allows us to compare economic performance across different time periods fairly.
So what are the three crucial indices we need to know, and how do they differ from each other?
We have three essential price indices, and each one measures changes in the general level of prices, but they focus on different areas of the economy, which gives analysts different strategic views.
Okay, let's start with the one that impacts our pocketbooks directly. The Consumer Price Index, or CPI.
The CPI is designed to measure the change over time in the cost of a fixed, representative consumer basket of goods and services.
What's in the basket?
Well, it's what's typically purchased by urban households. It includes everything from food and gasoline to medical care and education expenses.
Yeah.
Because its mandate is to track the change in the cost of living for the typical household, it's the index that's most often used for indexing private contracts, adjusting wages, and determining cost of living adjustments for government entitlements like Social Security.
So CPI is literally the household budget inflation tracker. But it has flaws, doesn't it? I've heard critics point out that if the price of beef goes way up, consumers might just switch to chicken, but the CPI basket might be slow to reflect that behavior.
That's a great point. It's called substitution bias, and it is a known limitation. Because the traditional CPI is based on a fixed basket of goods, it often overestimates the true increase in the cost of living.
Because it doesn't account for us being clever shoppers.
Exactly. It doesn't immediately account for consumers switching to relatively cheaper alternatives when prices rise. Now, statisticians constantly update the basket to try and mitigate this, but it's a constant challenge.
Okay. Next up, we have the Producer Price Index, or PPI. Why is this less consumer-facing index so important for analysts?
The PPI measures prices much earlier in the supply chain, specifically at the wholesale or production stage. It tracks the prices received by domestic producers for their output.
So it covers things like raw materials and intermediate goods.
Yes, raw materials, intermediate goods, and finished products before they ever hit the retail shelves.
So if the cost of energy or imported copper goes up, the PPI would probably capture that first.
Exactly. This makes the PPI a critical early warning system for consumer inflation. If producers are seeing their input costs rise significantly, eventually they have to pass those costs along to retailers and then to consumers.
So analysts watching the PPI can often forecast future CPI pressures, maybe 6 to 12 months down the line.
That's the idea. It captures the inflationary pressure before it reaches the final consumer shelf.
And finally, the broadest of the three, the GDP deflator.
The GDP deflator is the most comprehensive measure, really by definition, because it covers price changes across the entire GDP, all of consumption, investment, government spending, and net exports.
So it's not based on a fixed basket like the CPI.
No, it's not. Instead, it reflects the prices of all domestically produced goods and services that are currently being bought in the economy. It's much more flexible.
Can we use a specific scenario to highlight the functional difference? Let's say there's a huge spike in the global price of imported oil. How would these three indices react differently?
That's a great test case. Okay, first, the PPI. It would probably increase very quickly because energy is a key input for production and transport for almost every industry.
Right.
Second, the CPI. It will also increase, but potentially by less than the PPI and maybe a little slower. Oil directly impacts the price of gasoline for consumers and the cost of utility bills, so it's a big component.
Okay, so both would go up. What about the GDP deflator?
The GDP deflator might increase the least or could even show a different trend altogether.
Why is that?
Because the GDP deflator only tracks the prices of domestically produced goods. Since the cost increase in your scenario is driven by imported oil, that inflationary pressure is largely excluded from the deflator, while it hits the CPI and PPI hard.
Ah, so that makes the deflator the most accurate measure of inflation that's generated domestically.
Precisely. That distinction, domestically produced versus domestically consumed, is what makes checking all three indices so crucial. It stops us from mistaking an international price shock for deep internal inflation problems.
And this ability to separate real growth from nominal noise is the backbone of informed analysis.
It absolutely is. Now that we've established the overall structure, with NEPA and the adjustment mechanism with the price indices, we can pivot to the crucial specialized indicators.
Okay.
These are the detailed, often high-frequency measures that feed into short-term analysis and forecasting. They allow us to go beyond just the broad quarterly GDP number.
So let's start with what is arguably the most dynamic and socially significant data set: labor market data.
Yes. Labor data captures conditions in employment, unemployment, and the labor supply. It's vital because it connects directly to aggregate income, which then drives consumption, and also to the productive capacity of the economy.
We need to monitor not just the headline figures, but the nuances beneath them.
We do, and the headline is always the unemployment rate.
The one you see on the news.
Right. The U3 unemployment rate, which is the percentage of the labor force that is jobless and actively seeking work. But any sophisticated analysis has to look at broader measures. For instance, the U.S. Bureau of Labor Statistics actually publishes 6 different rates.
6 of them.
Yes, and the U6 unemployment rate is perhaps more comprehensive. It includes not only the unemployed, but also marginally attached workers.
Who are they?
Those are people who want a job and have looked recently, but they aren't currently counted as actively searching. And it also includes those employed part-time for economic reasons, people who want full-time work but can only find part-time jobs.
So wait, if the U3 rate is falling, but that U6 rate is stubbornly high, what does that tell an analyst?
It suggests the labor market might be healing on the surface, but there's still significant underlying slack. It means the economy is operating below its full potential.
I see.
We also have to monitor the labor force participation rate. That's the percentage of the total working age population that is either employed or actively looking for a job.
And that's a key distinction we noted earlier. If people get discouraged and they just stop looking for work, the unemployment rate, the U3, actually falls, even though the economy hasn't created a single new job.
That's the challenge. A falling participation rate means the potential workforce is shrinking, which has profound long-term implications for productivity and growth, regardless of what the headline unemployment number is doing.
So what else is in that labor pillar?
Finally, we scrutinize metrics for hours worked and wages. Are people working more overtime? That could indicate that demand is exceeding current capacity. And maybe most importantly, are real wages adjusted for inflation actually rising?
Because that's what really matters to households.
Real wage growth is the ultimate indicator of improved household economic health.
Now, the source material was really explicit about the technical challenges inherent in labor data. Why is this data so difficult for forecasters to manage?
Because it's often published monthly and it's based on surveys, it is extremely volatile, a phenomenon often called noise.
So a big headline miss one month could just be a blip.
It's often corrected the next. Furthermore, it is notoriously subject to subsequent revisions. The initial employment estimates are, they're quick and dirty. It takes months to compile the finalized administrative data.
I remember reading that the first non-farm payroll number is often based on preliminary data that can be dramatically shifted a month later. So should policymakers actually react to that noisy signal?
And that is the central policy dilemma. The data is high frequency, which gives us speed, but it has low reliability initially.
Tough trade-off.
It is. Policymakers have to react because of the need for speed, but experienced analysts will look for 3-month moving averages, or they'll wait for the subsequent revisions to confirm if there's a true change in the trend.
Because reacting too strongly to volatile, single-month numbers can lead to overshooting or undershooting your policy objectives.
Exactly.
Okay, moving on to the second pillar, monetary and financial data. This reflects monetary conditions, the cost of money, and the financial market's collective expectation about the future.
This is the domain that's monitored most obsessively by central banks, as it dictates the effectiveness of their policy actions. We look closely at variables related to the availability and the price of money.
So what are the main variables that central banks are watching?
First, money supply aggregates, basically how much currency and easily accessible funds are circulating in the economy. Second, and this is a big one, interest rates.
Right.
And this covers both very short-term rates, which the central bank directly influences, like the target federal funds rate,
And long-term rates, which are determined by market forces, like the yield on the 10-year Treasury bond.
Yes.
So what does the market-determined long-term rate tell us that the central bank's short-term rate doesn't?
The long-term rate is effectively the market's collective expectation of future inflation and future short-term rates.
Oh, it's a forecast.
It's a forecast embedded in a price. If the 10-year rate is much higher than the short-term rate, the market is anticipating strong economic growth and persistent inflation, which would require the central bank to keep policy tight for the foreseeable future.
Speaking of expectations, the research often highlights the importance of the yield curve. Can you explain why that specific indicator is such a crucial forecasting tool?
Of course. The yield curve plots interest rates on bonds of equal credit quality, but with varying maturities. Normally, longer-term bonds pay higher yields to compensate you for holding them longer. But when the yield curve inverts, meaning short-term rates are actually higher than long-term rates, it signals that the market is predicting a significant slowdown or even a recession in the near future.
And why does it do that? What's the logic?
It happens because investors start to pile into long-term bonds for safety, driving their yields down because they believe that future growth would be so weak that central banks will be forced to slash short-term rates dramatically.
So it's like a vote of no confidence from the bond market?
In a way, yes, it has historically been one of the most reliable predictors of recessions.
That's a fantastic, specific insight into how these variables are used for prediction. We also track credit growth and exchange rates.
Yes, credit growth is essential because access to credit fuels both investment and consumption. Is bank lending growing healthily? Too much growth can signal an asset bubble or overheating, while a contraction signals risk aversion and economic stress.
Exchange rates.
Exchange rates are the link between domestic monetary policy and international trade. They determine the competitiveness of our exports and the cost of our imports.
And finally, asset prices, stocks, and bonds. Why do financial prices count as a macroeconomic indicator when we said that GDP investment excludes financial assets?
They're critical because, unlike most backward-looking GDP components, asset prices are fundamentally forward-looking. They discount the future.
They're pricing in what they think will happen.
Exactly. High asset prices can boost consumer sentiment and wealth. It's called the wealth effect. If your stock portfolio is up, you feel richer and you might spend more, which boosts C.
And the reverse is true.
Conversely, sudden sharp drops in asset prices signal a massive loss of confidence and can immediately dampen investment and consumption. They serve as a high-frequency, albeit often volatile, barometer of collective economic sentiment.
That brings us to our third pillar, focusing on the actions of the one actor who can change the rules of the game instantly: the government. Fiscal data.
Fiscal data describes government economic activity and policy decisions, measuring the direct and indirect influence of the state on the aggregate economy.
And what are the essential components we're analyzing here?
We track government revenues, which is primarily taxes, government expenditures, so spending on services and those transfer payments we talked about, the resulting budget deficits or surpluses over a period, and the total accumulated public debt.
So those four components illustrate the government's overall fiscal stance and its ability to sustain current policies.
They do?
Now, analysts track the deficit closely, but what specific analytical questions does this data help us answer?
The first is fiscal sustainability. How large is the debt relative to the size of the economy? We call that the debt to GDP ratio. Is the government's spending trajectory sustainable over the long term?
And a high and rising ratio can signal problems.
It can signal long-term insolvency risks, or it may lead to future inflation if the debt has to be monetized.
And the second use is assessing the immediate impact of policy on growth, right?
Yes, assessing policy impacts. For instance, we track how specific elements, known as automatic stabilizers, affect the deficit.
Automatic stabilizers.
These are programs like unemployment benefits or progressive taxation that automatically increase government spending or decrease tax revenue during a recession. They provide a counter-cyclical stimulus without a new legislative act.
So they just kick in on their own.
They do, and analyzing their impact helps assess the economy's inherent resilience. We also model the effects of discretionary spending. Does a big government infrastructure package lead to crowding out of private investment, or does it stimulate growth? Fiscal data is the raw material for answering those complex questions.
So it's the direct measure of the government's footprint in the aggregate economy.
Exactly. And finally, the fourth pillar, which increasingly defines modern economies, external sector data. This captures how a nation interacts financially and commercially with the rest of the world.
This is where we see true global interconnectedness.
Yeah.
What are the key indicators showing our global linkages?
We start with the simple commercial measures, exports and imports, which determine the trade balance. If we sell more goods and services abroad than we buy, we run a trade surplus.
But the research emphasizes that the trade balance is only part of the story. We need to look at the current account balance.
That's right. Think of the current account as a nation's overall checking account balance, not just the trading activity. It includes the trade balance in goods and services, but it also includes net income from abroad.
What's that?
Things like interest and dividends earned by citizens on their foreign assets, minus the payments sent to foreigners who are holding our domestic assets. And it also includes net transfers, like foreign aid.
So if a U.S. company owns a factory in Germany and sends the profits home, that boosts the current account, even if it doesn't change the trade balance. It's the overall flow of national income.
Exactly. A current account deficit means the country is consuming more than it produces, and the difference is being financed by the rest of the world.
Which brings us to the other side of the ledger.
Complementary to the current account are the capital and financial accounts. These track international investment flows, the purchases and sales of financial assets like stocks and bonds, and real assets like factories and land across borders.
And why are these capital flows so critical?
They directly impact monetary policy and interest rates. If a country runs a persistent current account deficit, it has to run a corresponding capital account surplus. This means the country must attract sufficient foreign investment foreigners buying our debt or our stocks to finance that deficit.
And that foreign appetite for our assets influences our domestic interest rates and exchange rates.
It does. It effectively links the domestic economy to the global pool of capital.
That provides the four pillars: labor, monetary, fiscal, and external. It's a vast tapestry of measurements designed to give us that 360-degree view.
Mm-hmm.
So we have this vast, powerful data set. But as the research clearly shows, this data is not delivered perfectly. We need to confront the practical, real-world challenges of working with macroeconomic data, particularly its timing and reliability, because this is where forecast accuracy can often just collapse.
These practical realities are the primary source of difficulty for forecasters and policymakers. Knowing the conceptual definitions is the easy part. Navigating the fog of war created by incomplete, delayed, and frequently revised data. That's the real expertise.
Let's start with frequency and timing.
The data is published on different schedules. Comprehensive measures like GDP are quarterly, but high-frequency data like CPI and employment figures are monthly.
And that creates the immediate problem of publication lags and timing differences.
It does.
Could you elaborate on how that difference creates a dilemma for real-time interpretation?
Imagine this scenario. A monthly employment report providing data for last month suggests a sudden, sharp slowdown. But the last comprehensive GDP number, which came out 2 months ago, was strong.
So you have conflicting signals.
Exactly. Policymakers must decide today whether the fast monthly signal represents a true new trend or if it's just statistical noise that's going to be revised away next month.
And if you rely only on the lagging comprehensive data, your policies are enacted too late.
But if you react to the noisy, fast data, you risk basing massive decisions on an erroneous signal. It's a constant friction between timeliness and completeness.
It's like trying to navigate a ship where the steering wheel, the labor data, is highly responsive but shaky, and the depth sounder, GDP, is incredibly accurate, but it only updates every 10 minutes.
That's a perfect analogy, and adding immensely to that complexity is the issue of data revisions and measurement issues. The foundational texts are absolutely clear on this. Initial macroeconomic estimates are always subject to revision.
Why can't the statistical agencies just get it right the first time?
It's not incompetence, it's logistics. It boils down to two primary reasons: incomplete information and methodological updates.
Okay.
Initial estimates for employment and GDP rely on samples, preliminary surveys, and projections. It takes time, months, sometimes years to collect the definitive administrative records, the tax filings, and the final financial reports from every single business and government entity.
So the first reading of quarterly GDP, the one they call the advance estimate, is truly just a statistical approximation.
Precisely. We have the advance estimate, then a second estimate, a third estimate, and then a major benchmark revisions that happen annually or every 5 years, which can revise years of data simultaneously.
And these revisions can be seismic.
They can be. For example, an initial report might suggest the economy narrowly avoided a recession in Q3, only for the final revision 2 years later to show that a mild recession did, in fact, occur.
Wow. That means forecasters can't simply use the latest official data. They have to explicitly account for revision uncertainty.
This is a professional necessity. Serious economic analysts often rely on specialized real-time datasets when they're evaluating the accuracy of their past forecasts.
What does that mean, a real-time data set?
It means they judge their past prediction not against the final revised number we have today, but against the initial noisy data that they actually had at the moment they submitted their forecast. This rigorous process is necessary to accurately gauge a model's true predictive power, separate from the government's later data corrections.
Beyond revisions, the data has inherent limitations that encourage critical thinking, even when we have the final reconciled figures. What are some of these intrinsic shortcomings?
The first, and perhaps most misleading, is that aggregation may hide sectoral differences. GDP is a single number for a vast, complex national economy. You might have a perfectly healthy 3% national GDP growth figure.
But underneath, the residential construction sector could be collapsing due to high rates, while the defense sector is booming due to increased government spending.
Absolutely. The rising national tide can mask severe weaknesses in specific critical industries or regions. Think about the U.S. economy in the mid-2010s. The national numbers look steady, but regions that were dependent on oil and gas drilling were in a severe localized recession because of plunging commodity prices.
The aggregate number completely hid that regional disparity.
It did. Second, despite the rigor of NEPA, we have inevitable measurement errors, sampling errors, reporting mistakes, or just the simple difficulty in measuring new technologies or the quality improvements in modern services.
And the third limitation ties back to timing. Some core variables are fundamentally backward-looking.
Right. Many NEPA measures report what happened last quarter. And while that's essential for historical comparison, it provides very little direct insight into future trends.
Which is why those forward-looking indicators we discussed, asset prices, consumer confidence, manufacturing surveys, are so valuable, even if they are often more speculative and noisy.
They are. And the unavoidable reality that some variables are revised significantly over time just means that reliance on early readings for making large, immediate policy interventions is inherently risky. You have to adopt a stance of necessary skepticism toward any single preliminary number.
You have to triangulate across multiple, often conflicting signals. The slow but comprehensive, the fast but noisy, the backward-looking, and the forward-looking.
And this brings us to the conclusion. Synthesizing this complex, messy, but necessary data into the science of economic forecasting.
The data provides the raw fuel, but how is that fuel harnessed into actual predictions?
Well, the data provides the necessary inputs for sophisticated modeling, which generally falls into two large categories. We have structural macroeconomic models, which attempt to capture the fundamental theory-driven relationships in the economy.
Like how consumption responds to changes in taxes, or how investment reacts to interest rates.
Exactly. These require the comprehensive NEPA and price data as core inputs. Then we have time series forecasting models, which are often more short-term. They look for statistical momentum and patterns within the data itself, and they rely heavily on the high-frequency indicators like labor figures and CPI.
So the models are the engines, but they are useless without a map, and that map is economic theory.
That analogy holds up perfectly. Economic theory is essential. It guides the selection of variables. It tells the analyst why they should track the relationship between inventories and sales, for example, or why the shape of the yield curve matters.
And it dictates the interpretation.
Critically, theory dictates the interpretation of the dynamic relationships between these variables. The data tells us that unemployment is low. Theory tells us that low unemployment often leads to resource scarcity and eventual wage inflation.
So theory prevents analysts from mistaking a simple correlation for a true causal mechanism.
Precisely. And given all the limitations we just discussed, the volatility, the lags, the revisions, any successful forecasting has to adhere to the robustness principle.
What does that principle entail in practice?
It means the importance of combining and cross-checking multiple indicators to improve the overall robustness and reliability of any forecast. You simply cannot rely on a single headline number.
You have to build a mosaic.
You do. If labor looks strong, say the U3 unemployment rate is low, but the forward-looking indicators are flashing red, the yield curve is inverted, consumer confidence is plunging, and investment intentions are shrinking.
A robust forecast integrates all three of those things.
Yes, it weighs the known reliability and lag of each data pillar, and that leads to a much more nuanced and reliable outlook than just simply extrapolating from the last employment report.
That triangulation across different data types is the definition of a deep dive.
It really is.
This has been exactly the deep dive we needed. We started by establishing the core definition and the foundational NIPA framework, detailing the three ways GDP must balance production, expenditure, and income.
We then explored the critical necessity of adjustment using our three price indices, the targeted CPI for households, the preemptive PPI for supply chains, and the comprehensive GDP deflator, to strip away that nominal noise and find the true signal of real growth.
We dedicated significant time to detailing the four major data pillars: the high-frequency, volatile, but necessary labor data, monetary and financial data, reflecting the cost of money and future expectations through things like the yield curve, fiscal data, detailing government influence and debt sustainability, and external data, capturing our crucial global connectivity through trade and capital flows.
And we wrapped up by confronting the reality of measurement, the problem of publication lags, the perpetual challenge of data revisions, and the inherent limitations like aggregation bias, which demand constant critical evaluation.
A truly fantastic synthesis to leave you, the listener, with a final thought experiment that encapsulates the policy challenge of living with this data.
We established that labor data is high frequency, providing an immediate, albeit noisy, snapshot. Conversely, comprehensive data like GDP is quarterly, and it's subject to significant multi-year revisions that often recharacterize past economic periods long after a policy was set.
Right.
So how then does a central bank governor or a treasury secretary who has to make consequential, high-stakes decisions today about interest rates or spending, how do they balance the urgent, immediate, but volatile signal of noisy labor data against the known uncertainty and eventual correction of the comprehensive but significantly lagging core measures?
It's a constant real-time trade-off.
It is. It's a trade-off between the speed required for intervention and the accuracy demanded for good governance.
That tension between speed and accuracy is what makes macroeconomic management a challenge, not just an equation. Thank you for diving deep with us. We'll see you next time.
And forward on a chart.
Exactly. Anyone can do that. But robust analysis, it gives us the ability to identify the precise key economic relationships, to understand the causal mechanisms, the why behind the market movements. And critically, it lets us interpret the outputs of these incredibly complex statistical models. Because without this foundation, those models are just mathematical black boxes.
Right. You get an answer, but you have no idea how you got it.
Precisely. But with this foundation, they become powerful navigational tools.
Okay, so if we're building this entire framework, we have to start at the absolute ground floor. The single, unavoidable truth that governs all economic behavior.
The prime mover.
The prime mover. It doesn't matter if you're talking about a small family budget or the entire Federal Reserve. And that concept is scarcity.
It sounds so simple.
It sounds incredibly simple, and we often gloss over it. But it is so profound. The core challenge is that resources, I'm talking about time, money, land, energy, skilled labor, they are limited.
They are finite.
They are finite. But human wants are, for all intents and purposes, limitless. We always want more, better, faster, safer, newer.
Right. There's no upper bound on desire.
None. And that inherent gap, that tension between infinite desire and finite means, that is the stress point that forces every single economic decision. It is the universal constraint.
It's the engine of the entire field, honestly, because scarcity forces agents to make choices. And a choice isn't really a choice unless you have to give something up.
That's a great way to put it.
I mean, think about it. If you had infinite capital, you would never have to choose between two desirable outcomes. You could just pursue all paths simultaneously.
You do everything.
Do everything. But since resources are finite, every action, every investment you make, every piece of legislation that the government passes, it inherently involves a trade-off.
Something is always left on the table.
Always. And this brings us immediately to what I believe is the most misunderstood, yet most pervasive concept in all of economic analysis: opportunity cost. If you only remember one definition from this entire deep dive, make it this one. Opportunity cost is the value of the next best alternative foregone.
And this is where we really need to elevate the concept beyond, the textbook definition. People mistake opportunity cost for just the dollar amount they spent.
The sticker price.
The sticker price, exactly. But the true analytical value comes from forcing transparency on the benefit you gave up by choosing path A over path B.
Yes, what didn't you do?
Right, what didn't you do? Let's use a highly complex contemporary example, say a major tech firm, and they're facing a real scarcity in their top-tier engineering talent.
Which they all are.
All of them. So they decide to focus all of their resources for the next quarter on developing a new generative AI tool. That's option A. Now, the financial cost is clear. You can count the salaries, the infrastructure, the R&D budget.
That's the accounting cost.
Exactly. But what is the opportunity cost? It might be the launch of 2 new, potentially very profitable software updates that now won't happen.
Or a critical security overhaul that gets delayed.
A critical security overhaul, or even the loss of key talent who just didn't want to work on AI and preferred the other project. That's the real cost.
That is the critical point. Opportunity cost is not a historical accounting number. It's a forward-looking evaluation metric. It forces analysts and forecasters to consider the counterfactual.
The what if.
The what if. So when you're evaluating the impact of a government policy, say, a massive subsidy for electric vehicle manufacturing analysts must calculate not just the jobs created in that sector.
Which is what you always hear about in the headlines.
It's all you hear. But a real analysis has to ask, what was the value of the infrastructure repair, the educational funding, or maybe the lower taxation that was sacrificed by allocating those finite public funds to that one subsidy?
What else could that money have done?
Precisely. And we use opportunity cost as the fundamental yardstick of efficiency and viability. For a firm, think about it like this. If the marginal return on investment X does not exceed the potential return they could have gained by just putting that money into a safe index fund.
Their next best alternative.
Their next best alternative.
Yeah.
Then that firm's decision was economically irrational. And that's true regardless of whether they ultimately turned a small profit on investment X.
So even if they made money, they could have made more money with less risk somewhere else, so it was a bad decision.
Exactly. It's the measure of the true, comprehensive impact of a chosen path. And any sophisticated analysis has to incorporate that foregone benefit.
Okay, so we have the universal constraint scarcity, which forces the decision. Now, we have to identify who is making these choices under that pressure.
The actors on the stage.
The actors on the stage. And the economic universe really revolves around 3 primary agents that all analysis focuses on. These are households, firms, and the government.
The big 3.
Let's start with households. They're the foundation. They're the ultimate consumers of all the goods and services, and they are the fundamental suppliers of labor.
Right. They are both sides of that coin.
They are. Their specific goal is to maximize utility, which is this sort of amorphous concept we define as total satisfaction or well-being.
It's a tricky thing to measure.
Very tricky. And their decisions are governed by a severe constraint: their available income and their available time. So in forecasting, when you're analyzing household behavior, you're tracking consumption habits, savings rates, and crucially, labor supply, the willingness of people to work and the type of work they'll accept.
And if the household is driven by that fuzzy concept of utility, the firm is driven by cold, hard math. It is all about maximizing profit.
Pure and simple.
Pure and simple. Firms are the production engine of the economy. Their decisions are operational, they're complex, they involve setting production volume, managing these intricate global supply chains, and above all else, rigorous cost management.
So forecasting the behavior of a firm requires this really specialized analysis into the elasticity of demand for their products, their input costs.
Exactly. Things like energy, wages, raw materials,
Right.
and also their ability to innovate and capture market share. It's a very different set of variables than you'd use for a household.
Okay, so we have households and firms. Who's the third agent?
And finally, we have the government. Their role is unique because they are not primarily trying to maximize profit or utility in the same way.
They have a different objective function.
A very different one. They are the regulatory and fiscal interventionist. They influence the aggregate outcomes of the other 2 agents through 3 massive levers.
Which are?
Taxation, which is pulling money from the system, spending, which is injecting money and directing resources, and regulation, which is all about setting the rules of the game.
So any macro forecast has to heavily weight anticipated government policy.
Absolutely. Their actions serve as either the catalysts or the constraints for pretty much all other economic decisions.
What's fascinating here is how immediately interconnected they all become. It's a system.
It's a dynamic system, a feedback loop.
It really is. So, for example, if the government institutes a new regulatory fee on production, that directly increases the marginal cost for the firm.
Right, their cost for each new unit goes up.
So the firm, which is trying to maximize its profit, might pass that cost onto the household in the form of higher prices.
Which they almost always do.
Right. And that rise in prices then reduces the purchasing power of the household, which in turn constrains their ability to maximize their own utility. It's this dynamic interlocking system where a change in one agent's constraint immediately ripples through all the others.
And because this interaction is so vast, I mean, you're talking billions of households, millions of firms, hundreds of governments, we have to divide the field into two distinct branches just to analyze the scale.
To make it manageable.
To make it manageable. This is the classic distinction between microeconomics and macroeconomics, although I'll say that in modern forecasting, the lines between them are blurring quite a bit.
Okay, so let's define them. Let's start with micro.
Microeconomics is our zoomed-in granular focus. It studies the individual units, a specific consumer's buying habits, one particular firm's pricing strategy, or the specific market for a single good, like
The price of silicon chips.
the price of silicon chips, or the labor market for nurses. Perfect examples. The key concepts we study here are these specific market dynamics, how a price floor affects one market, or the calculation required to achieve equilibrium in one highly specific corner of the economy.
It's about deep dives into specific market mechanisms.
Exactly. It's the view through the microscope.
Okay, so then when we pull the lens all the way back, we move into macroeconomic.
Right. And this is where we study the economy as a whole. We start focusing on aggregate outcomes. We stop caring about the price of a single apple.
And we start worrying about the overall level of prices for everything.
That's it. We're analyzing the forest, not the individual trees.
And our sources really emphasize four major variables that serve as these indispensable barometers for the health of any national or regional economy. These are really the pillars of all macro forecasting.
They are the dashboard metrics. And first is gross domestic product, GDP.
The big one.
The big one. It's the total value of all finished goods and services produced within a country's borders in a specific time period. It's the ultimate measure of national output and economic activity.
But there's a key challenge with it in modern forecasting, isn't there? The sources point out that GDP, while it's foundational, it really struggles to accurately measure the value created by services and especially digital goods.
It's a huge problem. How do you value an open source software project that powers billions in commerce but has no price? Or a free social media platform? GDP was designed for a manufacturing economy, which makes it a challenging metric in our rapidly digitizing world.
Okay, so GDP is number one. What's the second barometer?
Second is inflation.
My favorite.
Everyone's favorite. This is the persistent overall change in the general price level. It's maybe the most sensitive indicator of economic stability. High, unpredictable inflation just destroys the ability of both firms and households to plan for the long term.
It destroys savings. It messes with investment.
It introduces severe uncertainty into any forecast. It's like trying to navigate in a fog.
Third pillar of macro.
Third is unemployment. This measures the health of the labor market, specifically the percentage of the labor force that is actively seeking work but can't find it. This is a crucial indicator of what we call capacity utilization.
How much of our potential workforce are we actually using?
Precisely. And low unemployment typically signals a tightening labor market, which often puts upward pressure on wages and then consequently on inflation. It's all connected.
It always is. And the final macro variable.
And finally, interest rates. Simply put, this is the cost of borrowing money.
But it's so much more than that.
No, it's so much more. Interest rates profoundly influence investment for firms. It's their cost of capital. And they influence major consumption decisions for households, things like mortgages or car loans. Central banks manage these rates to steer the entire macro economy, which makes their trajectory the single most vital forecast input.
So the integration of these two scales, micro and macro, that seems to be the key here. You can't predict these large-scale movements like GDP growth, the macro, without fundamentally understanding the aggregated behavior of millions of individual households all trying to maximize their utility, the micro.
You absolutely can't. If we connect this to the bigger picture, It's those millions of micro decisions. Your individual choice to buy an EV, a single firm's choice to automate a production line, a local government's choice to subsidize solar panels.
They all aggregate up.
They all aggregate up to form the macro trends, the inflation numbers, the GDP figures, the unemployment rates that define the entire economic cycle. A good forecaster has to be constantly moving between these two scales, from the microscope to the telescope and back again.
Okay, so with the players and the constraints now established, we can move to the first great analytical tool. This is the market engine itself.
The supply and demand framework.
The absolute bedrock.
It is. It's the simplest, but I think also the most powerful model for explaining how market prices and quantities are set and, more importantly, why they change. It's elegant in its simplicity. Let's start with demand. This captures the willingness and the ability of consumers to buy a product at various prices. And the fundamental law of demand is simple. Ceteris paribus.
All else equal.
Holding all else equal, as the price of a good falls, the quantity that people demand rises. It's intuitive. People buy more when it's cheaper.
But here's where the analysis gets complex and where the forecasting really begins. It's not about that one line. It's that the entire demand curve is constantly shifting.
Constantly. An analyst has to track the variables that are causing those shifts. These factors include things like consumer income. If you get a raise, your demand for normal goods shifts outward.
You buy more stuff.
You buy more stuff. It includes preferences. A shift in public perception, say, towards sustainable products will shift demand for those products.
Right, and it includes the prices of related goods. So if the price of a substitute, like pork, falls dramatically, the demand for beef is going to shift inward.
Absolutely. And then, crucially, expectations about the future. This is a huge one. If consumers expect a huge sale next month on TVs, the current demand for TVs shifts inward. They wait.
Okay, so that's the consumer side. Then we have supply, which represents the relationship between the price of a good and the quantity that producers are willing to offer for sale.
And unlike demand, the relationship here is typically positive. The higher the price a firm can get for its product, the more profitable it becomes to produce it, and so the higher the quantity they're willing to supply.
And just like demand, the entire supply curve is also being pushed and pulled by external factors, but on the production side. This is a key forecast challenge.
It is. These factors include input costs. If the cost of energy or raw materials skyrockets, the supply curve shifts inward. That means firms are willing to supply less at every single price point.
Right. And then there's technology. A breakthrough, like a new manufacturing process, shifts the supply curve outward by making production cheaper and more efficient.
And then, again, we have the firm's own expectations. If a firm expects the price of their product to double in 6 months, they might strategically hold back some of their current supply to maximize their future profit.
They'll store it in a warehouse and wait.
They'll wait for the higher price. So the market finds its balance when these two forces, supply and demand, meet. We call this the market equilibrium.
And this is that single price and quantity where the amount supplied exactly equals the amount demanded?
Exactly. There's no excess supply, no surplus, and there's no excess demand, no shortage. This equilibrium price is the natural resting point of the market. And unless some external factor shifts one of the curves, that price tends to prevail.
And this leads to what I think is the absolutely crucial distinction that separates a beginner's analysis from a sophisticated forecast. And that is the difference between a movement along a curve versus a shift of the entire curve.
This is fundamental. If you get this wrong, your whole forecast is wrong.
So let's use an example. If the price of gasoline rises because of some temporary supply chain disruption, consumers will buy less gas. That's a movement along the existing demand curve. The fundamental relationship hasn't changed.
People still want to drive, they just flinch at the higher price.
Exactly. But if the government mandates that all new cars must be electric by 2035 and consumer sentiment shifts massively toward EVs, that is a fundamental change in preferences that causes the entire gasoline demand curve to shift inward. It permanently changes the market equilibrium.
That is a structural change. And forecasting relies entirely on correctly identifying these shifts. If an analyst misinterprets a temporary price-driven movement as a permanent structural shift in market fundamentals, they will grossly misallocate resources.
Can you give an example of that?
Sure. Think about the pandemic. There was a sudden temporary demand spike for things like home exercise equipment. If a firm treated that as a permanent shift in preferences, they might have overinvested in building new factory capacity.
And they'd be stuck with it now. And they'd be stuck with massive sunk costs when the demand curve inevitably shifted back toward its original position as gins reopened. Mastering this distinction is absolutely fundamental to interpreting market behavior and avoiding spurious trend predictions.
Okay, let's move from that market-wide mechanism to the individual decision-making calculus. This brings us to the second great tool analysis, which is marginal analysis.
My personal favorite.
It's a powerful one. This isn't just a concept, it's the secret, universally applied formula for economic rationality. It dictates that all decisions are made at the margin.
What do we mean by at the margin?
We mean focusing on the incremental costs and benefits of the next unit of something, not on the total historical investment. It's the ultimate optimization hack.
And this is often very counterintuitive to how people make non-economic decisions, right? We tend to focus on the money we've already spent, what economists call the sunk costs.
The sunk cost fallacy. I've already put so much into it, I can't stop now. Exactly. Economic analysis demands that we ignore the past and focus purely on the future incremental changes. So we define two key terms. Marginal cost, MC, which is the cost of producing or consuming one more unit.
And marginal benefit, MB, the additional utility or revenue you get from that one more unit.
That's it. And the rational decision rule is what ties these two concepts together. An agent, whether it's a household, a firm, or a government, should continue an activity only as long as the marginal benefit, MB, is greater than or equal to the marginal cost, MC.
MB is greater than or equal to MC.
The moment the cost of the next action exceeds the benefit of that next action, you stop, because that next unit is actively making you worse off.
This applies to these huge, high-stakes corporate strategies. Let's consider a major pharmaceutical company. They're investing billions into a new drug development program.
A very common scenario.
So once they've already spent, say, $5 billion, they're told that running one more, smaller clinical trial will cost them an additional $50 million. That's their marginal cost.
$50 million.
And that trial has a 60% chance of yielding the data they need to secure regulatory approval, which would then generate an estimated $50 billion in new revenue. That's their marginal benefit weighted by probability.
So the fact that they've already spent $5 billion is?
It's completely irrelevant to the decision. It's a sunk cost. They must only ask, does the incremental forward-looking benefit of this $50 million trial exceed the $50 million cost? If the answer is yes, the previous $5 billion should not stop them from proceeding.
And if the answer is no, the $5 billion they already spent shouldn't convince them to throw good money after bad.
Precisely. And we see the applications of this thinking absolutely everywhere. In pricing decisions, firms use their marginal cost curves to determine the floor price they can afford to charge and still maximize their profit across their entire production output.
Right, it tells them how much they can discount a product to sell one more unit without losing money on that specific unit.
And in production planning, marginal analysis determines the optimal size of a factory or even the optimal length of an employee's shift.
And for policy? Oh, for policy, marginal thinking is absolutely vital. When a government evaluates whether to implement tougher pollution standards, they aren't looking at the total cost of cleaning up the entire environment. That's an impossible number.
It's overwhelming.
It is. Instead, they are asking a marginal question.
Yeah.
What is the marginal cost to industry of reducing pollution by one additional unit, one more ton of carbon, say? That's the MC. And what is the marginal societal benefit in? Reduced healthcare costs, longer lives, cleaner air of that same additional unit. That's the MV.
So the rational government pursues the regulation up to that point.
Up to the point where the cost of the next unit of clean air equals the benefit derived from it. If they go any further, they are sacrificing economic efficiency without an equivalent societal gain. It's an optimization problem.
Okay, we now enter the territory where economics, I think, transitions from pure theory to a predictive science. To apply these powerful tools, marginal analysis, supply, demand, to the incredibly messy, complex real world, we need to simplify.
We have no choice.
We have no choice. So economic analysis relies necessarily on simplified models.
And it's important to stress what a model is.
Yes. These models are approximations. They're conceptual representations of economic processes that we use for prediction and for analysis. And as our sources rightly note, they are essential because without them, the complexity is just paralyzing.
You'd have analysis paralysis. You couldn't make any decision.
Exactly. The purpose of making assumptions is not to pretend that reality is simple, but to isolate key variables so we can study the relationship between, say, A and B without the interference of C through Z.
And this is the critical vulnerability point in any analysis, and it's something you as a listener must always be aware of. A forecast is only as robust as the assumptions that are built into the model that produced it.
Garbage in, garbage out.
Garbage in, garbage out. And the source material highlights two assumptions that really underpin most classical and neoclassical economic models.
Okay, what's the first one?
The first is rational behavior. We assume that economic agents consistently and systematically act to maximize their goals. So, utility for the household, profit for the firm.
Which means we're assuming they are calculating, logical, and they possess perfect or at least functional information.
Yes. And we need this assumption to predict their reaction to something like a price change or a new tax.
But isn't that assumption exactly where models tend to break down during moments of extreme volatility? I mean, we're seeing more and more insights from behavioral economics showing that when people are scared or excited or panicked-like during a market bubble or a crash, they act irrationally.
They absolutely do.
So isn't rational behavior a really dangerous simplification when you're doing real-time forecasting?
It is a profound vulnerability. And it's exactly why the field of behavioral economics exists, to analyze when and why that assumption of rationality breaks down. But for the core foundational models, we have to start with the assumption of rationality.
Why?
Because without it, the system becomes completely unpredictable. If you don't assume a firm will try to maximize its profit, you have absolutely no basis to predict how they will react to a sudden rise in their labor costs. Do they raise prices? Do they cut staff? Do they absorb the cost? It's chaos. So we start with the rational assumption, and then we try to refine it later using those behavioral insights.
Okay, so rationality is the first big assumption. What's the second?
The second, and perhaps the most powerful analytical tool we have, is ceteris paribus.
The famous Latin phrase.
All else equal. This is the intellectual safety cone that analysts place around the variable they want to study.
So when a forecaster predicts a new technological breakthrough will reduce production costs, leading to a massive outward shift in supply, ceteris paribus.
What they're doing is analytically freezing everything else. The price of labor, the regulatory environment, consumer preferences, global trade stability, they were holding all of that constant.
To isolate the one variable they want to study, the impact of the new technology.
Precisely. And in forecasting, these simplified models allow for crucial scenario analysis. We can simulate what happens if the central bank raises interest rates by 50 basis points while holding everything else constant.
Even though we know in reality nothing is ever held constant.
We know that. But this gives policymakers a clear, structured prediction of the likely, isolated impact of their action. The model provides a predictable structure for prediction, even if we all know reality is far more chaotic. #B, positive versus normative analysis. And this leads us to a crucial methodological line that every rigorous analyst must respect. This is the distinction between positive and normative analysis.
And this is essential for maintaining objectivity and the integrity of a forecast.
It's everything. Positive economics is the objective realm. It describes, it explains, and it predicts economic phenomena. It focuses on what is or what will happen.
And the statements here are testable.
They are testable, even if they end up being proven false. For example, a positive statement is, if the current housing shortage persists, rents in metropolitan areas will rise by 10% next year. That is a claim. It's a forecast that can be tested against future data. This is the domain of pure forecasting.
Okay, so that's positive. What's the other side?
The other side is normative economics, and this is where subjective value judgments come in. It focuses on what should be.
So it's about opinion.
It's about opinions, ethical frameworks, and policy goals. For example, the government should implement rent control measures to prevent a 10% rent increase. That statement rests on a value judgment, the belief that housing affordability should be prioritized over market efficiency. There's no right or wrong answer there. It's a statement of values.
And the challenge for the forecaster must be immense. How do you psychologically manage that critical line when your own personal beliefs, your normative views, are constantly being challenged by the positive data your model is spitting out?
It's the core challenge of the profession.
I mean, if a forecaster personally believes the minimum wage should be higher, that's their normative view. But their model positively predicts that a higher wage will cause significant job losses in a certain sector. They have to report the model's negative prediction accurately.
They must. Forecasting requires this incredible intellectual discipline to report what is likely, even if it completely contradicts what you wish would happen.
So the rule is that forecasting relies exclusively on positive analysis.
Exclusively, allowing normative bias to influence a positive prediction corrupts the output, and it renders the forecast completely useless to decision makers. The best analysis rigorously separates these two. Analysts might use their positive forecasts.
Like our model predicts a recession is coming.
Exactly. They use that to inform their normative advice, like, therefore, the government should implement a massive infrastructure spending package to mitigate the damage. But the core prediction itself has to remain strictly empirical and testable. Tag 6. Time and the power of expectations.
Okay, here's where it gets really interesting, I think. Economics is pretty unique among the social sciences because its outcomes are so inherently driven by our perceptions of the future.
It's a forward-looking discipline.
It really is. The source material emphasizes that economic outcomes are not just a result of past behavior and current conditions. They are fundamentally driven by our expectations about the future.
And this can become a self-fulfilling prophecy.
Absolutely. If firms expect a major trade war is coming, they halt their expansion plans and their investments. That action, in turn, slows down GDP growth, which fulfills the original expectation of economic stagnation.
So it's this powerful, non-physical input variable that forecasters have to somehow try to quantify.
How do they do that?
Well, economists categorize expectations into two crucial models for analysis. The first one is the simpler backward-looking model. It's called adaptive expectations.
Adaptive.
An adaptive agent forms their expectation based primarily on looking at past data. They assume the future will closely resemble the recent past.
So if a firm saw its input costs rise by 5% last year, they adaptively just assume their input costs will rise by 5% again next year.
Exactly.
Right.
It's simple to model, but this approach assumes that people keep making the same mistakes until new data forces them to shift their view. The classic example of this model failing spectacularly was the stagflation crisis of the 1970s.
Right. That's the key historical failure point. In the 70s, as inflation kept accelerating year after year, policymakers kept assuming that people would base their expectations on the previous lower year's inflation. They failed to realize that people were starting to anticipate policy itself.
They were getting smarter.
They were getting smarter. And this brings us to the more advanced forward-looking model, rational expectations.
Right. This model assumes that economic agents, especially those with access to sophisticated information, like financial traders or large corporate treasuries, utilize all available information to form their views.
They're not just looking in the rearview mirror.
Not at all. They understand how the economy works, they watch policy signals from the central bank, and they anticipate the consequences of government or central bank actions before they even happen. A rational agent wouldn't just look at last year's 3% inflation.
No, they look at the central bank's announced quantitative easing program,
The current geopolitical conflict that's affecting energy prices.
the government's latest deficit spending plans.
They integrate all of these factors to form a comprehensive, forward-looking view of what inflation is likely to be.
And rational expectations are transformative in policy analysis, right? Because if agents are truly rational, they can anticipate and even neutralize the effects of predictable policy actions.
That's the Lucas critique in a nutshell. If the central bank signals a predictable move to curb inflation, rational financial markets will immediately price that move in. The reaction happens instantly, meaning the desired long-term impact of the policy might be mitigated before the policy is even fully implemented.
This concept of expectations is so critical in high-stakes areas. In inflation forecasting, for example, if firms and workers rationally expect high inflation, what happens?
Well, firms raise their prices preemptively to get ahead of rising costs, and workers demand higher wages to protect their purchasing power.
Which reinforces and accelerates the inflation cycle.
It becomes a feedback loop. And in financial markets, expectations about corporate earnings or geopolitical stability fundamentally are the market. They drive massive trading volumes and determine asset prices far more than current earnings reports do. Analyzing policy effectiveness means gauging not just the mechanical impact of the policy, but how rational agents will adapt their behavior in anticipation of it. So we've outlined the theoretical structures, the rules of the game, the players, the models. But the final product, the forecast, is only as good as the raw material we feed into it.
And that raw material is data.
And that raw material is data. Economic analysis is fundamentally dependent on the quality and the reliability of this bedrock data.
And unlike, say, physics, where experiments can be perfectly controlled in a lab,
Economic data is the opposite. It is often messy, it's delayed, and it's subject to inherent bias. Forecasters have to maintain a really high level of skepticism regarding their own inputs.
so what's the first major hurdle, the one that's often invisible to the casual observer?
I would say measurement error. It is just incredibly difficult to capture complex real-world activity with precision. How accurately do government statisticians capture the value created by digital services that are free to the consumer but generate massive advertising revenue?
Or how do you accurately measure the shadow economy? Or even consumer confidence, which is a qualitative sentiment that somehow has to be quantified into a hard number.
These are incredibly complex tasks, and the inevitable errors in that primary data then ripple through every single subsequent calculation in the model.
You can think of the example of the inflation basket, the CPI. If the calculation for inflation overweights, say, gasoline and underweights housing costs for a specific demographic, then the measurement error means the reported inflation rate doesn't truly reflect the economic reality for millions of people.
Which fundamentally skews any analysis you do on their purchasing power.
Okay, so measurement error is a big one. What's the second challenge?
The second challenge is the issue of data revisions. This is a massive headache for any real-time forecaster.
Ah, yes. The numbers are never final.
They are never final. When a major economic figure is released, GDP, quarterly output, even the monthly unemployment rate, that first number you see is a preliminary estimate based on incomplete sampling.
The first draft.
It's the first draft. And as more comprehensive data flows in over the following weeks and months, these figures are frequently revised, and often they're revised substantially.
So an analyst working in real time might see an initial report suggesting, say, robust 3% GDP growth.
Right. And based on that, they predict the central bank will pursue tight monetary policy.
But then 6 months later, the revised data comes out and shows that initial growth was actually a sluggish 0.5%.
And that completely changes the economic landscape. But it's after key policy and investment decisions may have already been made based on that faulty initial information.
So this demands that the analyst always treat those initial data releases with a healthy level of skepticism. They're not facts. They're the best available estimates at that moment.
That's exactly right.
And the third data issue.
The third issue is frequency. Economic data is available at drastically different intervals, and this influences the type of analysis you can even do.
So stock prices are available second by second.
Right. Consumer sentiment surveys might be weekly. Inflation and employment reports are typically monthly, but the foundational measure of output, GDP, is only released quarterly.
And you can't build a high-frequency trading algorithm based on quarterly data.
You can't. And you can't gauge the deep structural health of the economy solely by watching high-frequency daily stock movements. This difference in frequency means forecasters have to continuously aggregate, disaggregate, and interpolate data, which introduces even more layers of estimation and potential error.
So in the end, forecast accuracy is heavily contingent upon the quality, the timeliness, and the reliability of this incredibly complex input data.
It's the foundation of the entire structure.
Okay. We've established the 11 pillars, from the scarcity constraint all the way to the messiness of the data. Now we have to bring it all together. How does this comprehensive body of economic theory synthesize to aid the final product? A useful, accurate forecast.
The first, and I would say the most critical role of theory, is that it provides structure. A complex statistical model can ingest massive data sets, but theory provides the intellectual discipline to choose the relevant data.
So you don't just throw every number at the wall and see what sticks.
Please don't do that. You use the supply and demand framework, you use marginal analysis, you use these agent behavior models to select only those variables that have a proven causal relationship with the outcome you were trying to predict. Theory limits the scope of investigation to the truly meaningful inputs.
And what else does it do?
Furthermore, theory acts as the essential reality check on the output of these complex statistical models. Sometimes, advanced machine learning or econometric models will spit out correlations that are utterly spurious.
They're illogical.
Completely illogical, according to established economic intuition. There's a famous example that high butter production in Bangladesh correlates statistically with the movement of the S&P 500.
There's a correlation, but no causation.
The math may show a correlation, but economic theory grounded in agent behavior, profit maximization, and the function of markets tells the analyst be skeptical. Theory helps the analyst avoid being misled by these spurious, these false correlations, and it forces them to search for a meaningful economic mechanism that explains the observed relationship.
So the theory provides the necessary intuition to differentiate between correlation and causation, which is really the ultimate goal of any sophisticated analysis.
That is the holy grail.
So when all these elements are combined, the final recipe for successful forecasting seems to be this potent three-part synthesis.
That's a great way to put it. First, we have economic intuition. This is the judgment that's developed by internalizing these foundational principles, understanding scarcity, seeing every decision through that MB is greater than or equal to MC lens, and recognizing the power of expectations. This intuition allows the analyst to make rapid judgments and select the appropriate model for the job.
Then second, we layer in the math, statistical techniques. These are the econometric models, the time series analysis, the quantitative methods that actually quantify the relationships between the variables, identify the patterns, and project the trends based on that filtered, theory-informed data.
And finally, the indispensable reality check. Empirical validation.
Checking your work.
Always checking your work. This means constantly testing your forecast results against what actually happens in the real world. Successful forecasting is a continuous feedback loop. If your model consistently overpredicts inflation, the analyst has to return to the initial foundations, the assumptions, the data inputs, the theoretical relationships, and refine the process until the model aligns more closely with reality.
So it's a constant, humbling interaction between theory, math, and the messy economy.
It is exactly that. Hashtag tag outro. This deep dive has spanned the entire methodological spectrum. We began with the core constraint of existence, scarcity, and opportunity costs, and we built the structure layer by layer.
We defined the agents, detailed the workhorse models of supply and demand and marginal analysis.
And we concluded with these crucial methodological elements: the necessary evil of assumptions, the integrity check of positive versus normative analysis, and the incredible predictive power of expectations.
So what does this all mean for you, the listener?
I think it means that being well-informed requires demanding more than just a headline number. It requires understanding the fundamental logic behind economic predictions. If you can grasp that the language of the economy is defined by these agents maximizing their utility under the pressure of scarcity, and that every successful choice is made at the margin, you possess the key.
You have the tool for decoding any analysis that's presented to you.
Whether it's a government budget or a corporate earnings call, you can see the architecture behind it.
And let's end on that core assumption we challenged a bit earlier, the concept of rational behavior. We assume agents act consistently to maximize their goals based on the information they have.
The cornerstone assumption.
It is. But if forecasting success relies so heavily on agents acting rationally based on their calculated expectations, what happens to the accuracy of a forecast during periods of extreme, unpredictable societal panic or excitement?
The moments when rationality breaks down.
Exactly. Think about the wild fluctuations of a market bubble right before it bursts, or the sudden collective fear that paralyzes spending during a sudden shock event. This is where behavioral economics takes over, and people act on herd instinct rather than maximizing utility.
So doesn't the entire scaffolding of positive economic analysis face a temporary but profound collapse in those moments?
That is the thought for you to mull over. What are the ultimate limits of even the most sophisticated positive analysis when human behavior deviates from the model?
A great question to end on.
And next time you're facing a major life decision, or even just deciding whether to spend an extra hour on a task, try applying that rule. Marginal benefit is greater than or equal to marginal cost. It might just simplify everything. Until next time, we've completed the deep dive. Welcome back to the deep dive. Today, we are moving beyond the headline numbers, past the quarterly GDP announcements and the month-over-month inflation reports, and we're diving deep.
Really deep.
Yeah, deep into the microscopic core of economic analysis. We are strapping on our statistical magnifying glasses today because we're looking at the foundational unit that constructs, well, pretty much all modern policy.
Right. We're talking about microeconomic data.
Exactly.
It's necessary work. I think if you think of the big macro data as a satellite image, these sweeping views of continents and large systems.
Okay, I like that.
Then microeconomic data is the street view. It's the individual house, the single person walking down the street, that specific factory production line.
The pixel instead of the whole picture.
The pixel. That's a perfect way to put it. It is the atomic building block that allows economists to test theories that, at their heart, focus on human behavior.
So our mission statement for this deep dive is to really define those core building blocks of modern economic research. I mean, the individual observations that shape everything you see, from how tax policy is designed to how health insurance subsidies are calculated. We are working through some foundational research that outlines the definition, the characteristics, the critical assumptions, and I think most importantly, the common challenges of working with data focused on these distinct individual units.
And this is so far from just being, academic esoterica.
Yeah.
The validity of every single estimate of a new policy's impact,
Right.
whether it's, say, the expected drop in unemployment from a new job training program or the estimated revenue from a small business tax cut, all of it hinges on the assumptions we make about the data we're using, particularly this idea of its individual independence.
So let's frame the big question right at the top here. What makes data collected on individuals, on households, and on firms fundamentally different from other economic data? And maybe even more critically, what are the crucial, and as we'll find out, often fragile assumptions that economists have to rely on to make any sense of it?
That's the whole game right there.
Let's unpack this, starting with the absolute ground floor definition.
Let's do it.
Okay, let's set the parameters. When we say microeconomic data, we are intentionally limiting our scope. So what is the fundamental, the non-negotiable definition of this data structure?
Microeconomic data, at its heart, consists of observations on individual economic units. The distinguishing characteristic is really just scale.
Okay.
We were focusing on discrete, singular entities. And crucially, each observation point, each row in the spreadsheet, if you want to visualize it, represents a unique entity acting within the economy.
And the foundational research we are working through details several different types of these economic units. I think it's really important to detail exactly who we are talking about here.
Yeah, absolutely. We can categorize them broadly into four main types. The most basic one is the individual.
Right, person by person.
Person by person. This is the absolute core of labor economics, of health economics. We're tracking characteristics like a person's precise wage, their level of formal education, their years of work experience, or specific self-reported consumption data. It's a one-to-one relationship between the data point and the person.
So if I'm filling out a survey, that's me. I'm one row in that data set.
Your row 7,342, exactly.
Okay. Then we scale slightly to the household. This feels particularly vital for studying consumer behavior and, how families respond to government transfers or new taxes.
It is. Here, the observation unit isn't just one earner. It's the combined economic activity of everyone living under one roof.
So it's a collective unit.
It's a collective. For instance, we might be tracking a household's total expenditures on necessities like food or the total monthly spending on housing or healthcare. A single policy, like a tax credit, applies to the household, and we get to observe the collective response of that unit.
And that matters because a decision to, say, spend more on housing isn't made by one person in a vacuum. It's a household-level decision.
Precisely. The trade-offs happen within that unit. Then we enter the realm of production, which is really dominated by firms and a related concept, establishments.
Okay.
For a firm, we might be tracking its total annual output, maybe its R&D spending or its corporate investment decisions. This is what gives us insight into things like market power and competitive dynamics in an industry.
Hold on, because the sources we're looking at make a real point of distinguishing between a firm and an establishment. Now, that sounds like a very technical detail, but why is that distinction so crucial for policy analysts?
Oh, it's a critical nuance. It's not just semantics.
Yeah.
Especially for regional economics and industrial organization. A firm is the legally defined parent company. Think of a major national retailer, for example.
So the big corporate entity.
The big corporate HQ. An establishment, on the other hand, is a single physical location that belongs to that firm. So one specific retail store in downtown Chicago or one manufacturing plant in rural Ohio.
Ah, I see.
And that distinction matters immensely because regional policies, like local tax breaks or zoning laws, they affect the establishment locally. But the parent firm's overall investment decision is made nationally at the firm level.
Okay, so if you're analyzing the impact of, say, a local property tax on employment.
Right. You need establishment-level data. You have to be able to isolate the effects on that single store rather than using firm-level data, which would just average the effect across all 5,000 of their locations and probably show you nothing.
That immediately gives you much, much finer resolution for policy evaluation. You can see the direct local impact.
Exactly. And then finally, the unit can be cities or regions. Now, this is where people sometimes get confused because cities sound like these huge aggregate entities.
Yeah, city doesn't feel very micro.
It doesn't. But they are treated as microdata only when each city or region is analyzed as a single distinct observation unit.
So let me get this straight. If I have a data set where each row is a city, say one row for Chicago, one for Miami, one for Phoenix, and the columns are things like that city's tax rate or its average commute time, that's microdata.
It is. Because you're not analyzing the entire U.S. economy's time trend. You're analyzing how different discrete units, the cities, relate to each other at a single moment in time.
So each city is treated as a unique individual in the data set.
A unique individual independent of the next. The core definition really just boils down to one question. Are we looking at discrete, singular entities that function as the unit of analysis, regardless of their physical size?
Okay, that makes sense. And that leads directly to the final pillar of the definition, the time element.
Yes, this is fundamental. Every single observation in microeconomic data represents that singular unit at a specific point in time. It's a static photograph.
A snapshot.
A single snapshot. Person A's recorded income in the third quarter of 2024. Firm X's total investment capital on December 31st, 2023. This single snapshot characteristic is the foundation of what we call the cross-sectional data structure.
Okay, so now that we've defined the units, let's get into the DNA of this data. What are the defining characteristics that really separate microdata from other forms of statistical evidence, like, the massive time series data that central banks use to track inflation?
Right. So the first defining feature, which we just touched on, is its cross-sectional nature.
Okay, let's unpack that a bit more.
To reiterate, this means the data is collected at one point in time or over a very short specified period, like a single month or a single year. The sources we've reviewed really emphasize that the timing of the observation itself is fundamentally not essential for the subsequent analysis.
So why does the timing not matter in microdata, but it is literally everything when you're tracking, say, the price of oil?
It all comes down to the principle of dependence. When you look at time series data, like that oil price, the price yesterday is highly, highly correlated with the price today.
Sure.
If the price jumps in the morning, that jump is statistically dependent on the price observed just minutes before. That's called temporal dependence, or autocorrelation.
Okay.
In cross-sectional microdata, we're focused on these fundamental underlying behavioral relationships, like the return to education, or a household's marginal propensity to save. When we survey 10,000 individuals about their income, we assume that individual number 5's reported income was not influenced by individual number 4's reported income, even if they were surveyed just minutes apart.
And that difference in dependence leads directly into the second core characteristic, which is no natural ordering.
Precisely. If you visualize the raw data as a massive spreadsheet, the order of the rows is statistically irrelevant. It just doesn't matter.
Really? So you could just hit a randomize button on the whole list of people?
You could literally shuffle the entire data set. If we collected data on 10,000 households and then randomly shuffled those 10,000 rows, the result of any econometric test you perform on that data, any regression you run, would be identical.
Wow.
Rearranging the data does not affect the estimates of the average relationship between, say, education and wages. And this is a massive, massive simplification compared to temporally or spatially linked data, where the ordering is everything.
That simplicity, I imagine, allows researchers to move into modeling much more quickly, but it all rests upon what seems to be the most foundational pillar of this whole field of research, the independence assumption.
This is the bedrock. It's the whole foundation of the house. The core econometric framework assumes that the observations are independently drawn from a larger, well-defined population.
In simple terms, this is the concept of random sampling we all learned about in stats class.
It's random sampling. When we build our models, we are forced to assume that the behavior of one unit, one person, one firm, is not statistically influencing the behavior of the next unit in our sample.
Okay, so if I'm trying to study the effect of a specific health insurance policy rollout in California, I have to assume that the decision of one individual to sign up is totally independent of the enrollment decision of the next person I survey.
That's the ideal, yes.
Yeah.
And the expert analysis here is crucial. This assumption massively simplifies the initial statistical framework. If independence holds, researchers can use straightforward mathematical tools because they don't have to account for these complex interdependence structures.
What kind of structures?
Like, for example, the spatial correlation that might exist if neighbors influence each other's spending habits, or the clustering that occurs if all the individuals in your sample happen to come from the same 5 high schools.
But wait a minute, if we're sampling people who, often live in the same geographic area, they shop at the same stores, they're subject to the same local economic shocks, isn't that independence assumption inherently fragile?
It's incredibly fragile in practice, and this is why data collection methods are so heavily scrutinized by economists.
I can imagine.
If you run a survey where 80% of your respondents are clustered in just 3 neighborhoods, well, the observations are no longer perfectly independent. They can't be. They're correlated due to all those shared local conditions. We call this clustering, or a lack of independence.
And what happens if that assumption fails and we just ignore it?
That's the danger. If this assumption fails and we ignore it, our estimates for the average effect might still be unbiased, meaning they point in the right general direction. But the standard errors...
The measure of our certainty.
Exactly. Our measure of certainty will be completely incorrect. They'll be wrong. It often leads us to believe our results are much more precise than they actually are. So, checking this assumption is the first critical checkpoint in any serious microeconomic study.
Okay, so we've defined the units, we understand the sort of ideal simplicity of the cross-sectional structure. Now let's unpack this a bit more. Where does this highly individualized single snapshot data get applied? This is where the abstract definitions translate into real-world policy decisions.
Right. And this data is central to the entire universe of what we call applied microeconomics. The sources we're looking at list specific fields that would essentially collapse without this continuous stream of individual and firm-level data.
Okay, let's start with the big one, labor economics. This field, it lives and breathes microdata.
It absolutely does. Labor economists use microdata to figure out fundamental behavioral parameters, like the elasticity of labor supply.
Which is basically the question, if the government changes wages, how much do people change their work habits?
Exactly. If the government increases the minimum wage or cuts income taxes, how much more or less does the average person decide to work? You need individual wage data, skill levels, employment status, demographic data. You need all of it to figure out that precise relationship. Without it, you are literally just guessing at how humans will respond.
Okay, then there is health economics, which feels like it requires even more extreme granularity.
Oh, absolutely. Policy questions here are so often about efficiency and access. We have to be able to track individual household expenditures on different types of healthcare, preventative care versus emergency room visits, and then link those expenses to specific patient outcomes.
So you could see if a policy actually makes people healthier, not just if it makes them spend more or less.
Precisely. Economists might use this data to evaluate, for example, whether increasing the copay for a certain medication changes patient compliance, and by how much, which in turn affects their overall health status. This requires observing thousands, sometimes millions, of individual patient journeys.
And crucially, public finance, the study of government taxing and spending, seems entirely dependent on this micro-level view.
It is. Public finance economists need to know how individual taxpayers respond to marginal tax rate changes. If the government raises the top income tax bracket by, say, 2%, do high earners reduce their reported income by working less, or do they just accept the higher tax, or do they find loopholes? Microdata is absolutely required to estimate what's called the elasticity of taxable income, a key parameter for designing revenue-neutral tax systems. If you don't use microdata for that, you might base your revenue projections on some aggregate theory and end up wildly off target, which can create massive, unexpected budget deficits.
The list in our sources also includes industrial organization, focusing on the structure of industries, and urban and regional economics.
Yeah, and they're great examples. Industrial organization uses firm-level data, often confidential data, on pricing, R&D, and market share to analyze competition. For example, studying what happens to the output and prices of individual establishments after 2 large companies merge.
And urban economics brings us back to our city example.
It does. They might use city-level data to study something like congestion pricing. So how does changing the toll in one specific urban corridor affect traffic patterns and housing prices in that specific region?
So if we boil it down, the central role is defined by 3 core objectives: testing specific microeconomic theories, estimating behavioral relationships, the quantitative how much, and then the highest stakes application, evaluating public policy.
Exactly. And let's use the concrete examples from the source material to really ground this. Consider the individual level data we track. Wages, education, and work experience of individuals in a given year.
Okay.
If a state proposes a new policy to subsidize community college tuition, they need this data to run a counterfactual analysis. They need to ask, what would the wages of the students who utilize the subsidy be if the policy had never existed?
And you need that individual level data to build a convincing comparison group.
You do. Now, scaling up, we look at the household level. For instance, household expenditures on food, housing, or healthcare. This data is absolutely fundamental for understanding the real-world effects of welfare programs.
Housing.
Well, if a food assistance program is launched, economists use household expenditure data to test whether the recipient households actually increase their total food consumption, or if they simply divert the assistance money to pay for other goods, like rent or utilities.
Which is a huge question for policymakers.
It's a critical one. It allows them to assess whether the program is actually achieving its intended goal of improving nutritional intake, or if it's acting more like a general income supplement.
Okay, and then at the firm level, we have that firm level output, employment, or investment data.
An excellent application here is assessing environmental policy. If the Environmental Protection Agency imposes stricter emissions standards, economists use firm-level data, or better yet, establishment-level data, to see which individual factories respond by investing in cleaner technology and which ones respond by cutting output or employment.
This detailed view prevents policymakers from making assumptions based on just industry averages, which I imagine can mask huge variation among firms.
Exactly. Some firms adapt, others don't. The average can be very misleading.
And finally, revisiting cities, we look at things like city-level crime rates, housing prices, or tax rates at a specific time.
This is often used for what are called spatial equilibrium studies. If a city cuts its corporate tax rate, economists treat that city as one unique data point and observe whether the influx of new business investment and the corresponding change in housing demand outweighs the loss of tax revenue from the cut. Each city's experience is a distinct, independent observation contributing to the overall analysis.
So all these examples, they really illustrate that the power of microdata lies in its ability to isolate these individual responses to very specific stimuli.
That's the core of it. So we've established the structure and the application. Now we have to transition to the statistical how. The sheer volume and the complexity of these thousands of independent observations require a powerful analytical tool. And that tool is the cross-sectional regression model.
Right. Regression analysis is the absolute workhorse here. It's an attempt to formalize the relationship between cause and effect using math. The basic equation tries to relate a dependent variable,
which is the outcome we're interested in explaining.
Right. The outcome to one or more independent variables, which are the explanatory factors.
Precisely. Let's just return to the source's simple, classic example to make this concrete. Explaining wages as a function of education and experience.
Okay.
Our dependent variable is the wage we are trying to predict or understand. Our independent variables, our explanatory factors, are the observable characteristics that we hypothesize influence that wage. Years of education, years of experience.
And the model then tries to calculate, with some level of statistical certainty, the precise marginal impact of, say, one additional year of education on the wage outcome, while holding everything else like experience constant.
That is the objective. But we have to remember, the model never perfectly predicts a wage for any single individual. Some people will earn more than the model predicts, some will earn less. That difference is captured by what we call the error term.
And the error term is everything else.
It's everything else. It encompasses everything the model doesn't capture. Things like innate ability, the specific quality of your school, pure luck, your professional connections, your personal motivation, all the unobserved idiosyncrasies that make you you.
So for the relationships the model does calculate to be reliable, we have to make several critical assumptions used in modeling?
Yes, these are the rules of the road.
Okay, assumption number 1 ties directly back to what we established earlier. Random sampling from a well-defined population.
We have to be certain that our sample actually represents the larger population we want to draw conclusions about. And, as we said, that the observations were independently drawn.
Right.
If we're studying the effect of a policy on all working adults in the U.S., and our sample is drawn exclusively from, say, university research staff,
Right.
our results will not generalize. The estimate will be biased toward that specific, very narrow population.
Okay, that was pretty intuitive. But the second assumption, and maybe the most difficult one to satisfy in observational data, is the exogeneity of explanatory variables. So this means the explanatory factors, like education and experience, are not themselves determined by the outcome variable, wages.
This is the causality hurdle. It's often referred to as avoiding endogeneity. Endogeneity occurs when the causality is bidirectional, when it goes both ways.
So the arrow points in two directions.
Exactly.
Yeah.
If we model, education leads to wages, but in reality, the prospect of higher future wages encourages someone to pursue more schooling.
So wages also leads to education.
Right. The relationship is circular. And when endogeneity is present, our coefficient estimate for education is severely biased. It cannot be interpreted as a true causal effect. It's a massive statistical lie.
So if the host, who is the skeptic in the room, asks, how on earth do economists repair this lethal failure of exogeneity when they suspect reverse causality?
That's when the advanced econometric toolkit comes out. They often have to turn to methods like instrumental variables, or IV.
Okay, what's an instrumental variable?
An instrumental variable is a third factor that influences your explanatory variable, in this case education, but is entirely disconnected from the error term and the outcome variable, wages, except through its effect on education.
That sounds complicated to find.
It is. A famous V-link used in this field is the distance an individual lived from a college campus when they were growing up.
Okay.
The logic is living closer to a college influences whether you attend. It affects education, but presumably it doesn't directly influence your innate earning potential, which is part of that error term. Using these clever instruments helps purge the endogeneity from the model, restoring the required exogeneity assumption so we can get closer to a true causal estimate.
So it's a way to find a clean source of variation that makes the modeling significantly more complex, but I guess it's necessary for reliable conclusions.
Absolutely necessary.
Moving on, the third assumption is a bit more mechanical. No perfect multicollinearity.
This is a practical constraint of the math. It just means that your explanatory variables shouldn't be perfectly redundant. They can't tell you the exact same information.
What's an example of that?
Imagine a scenario where, in your specific data set, just by sheer coincidence, everyone with 16 years of education also has exactly 10 years of work experience, and vice versa.
So they move in perfect lockstep.
Perfect lockstep. If this correlation is perfect, or equal to 1, the regression model cannot mechanically calculate two separate, unique coefficients. It can't distinguish the effect of education from the effect of experience because they always move together. You need sufficient independent variation among your predictors to isolate their unique effects.
Okay, and finally, we have the assumption of homoscedasticity, which is the ideal state where the variance of that error term is constant across all observations.
Right. As we discussed, the error term is all that unobserved luck, ability, or just random noise. Homoscedasticity says that the spread or the volatility of that unobserved luck is the same regardless of where you are on the income or education spectrum.
So if we look at two people, one with a high school diploma and one with a PhD, the homoscedastic ideal assumes that the factors we didn't measure, the error, they vary to the same degree for both people.
Correct. The range of luck is the same for everyone.
And here is the expert insight. The sources we're looking at note that this idealization is rarely, if ever, true in real-world microdata. So the assumption is often relaxed later in the analysis.
It almost never holds up. I mean, just think about individual investment decisions at the firm level. A small local dry cleaner has a very constrained range of unobserved factors affecting its annual investment. The error term might range from, say, plus $1,000 to minus $1,000.
Okay, a pretty tight range.
But a massive multinational corporation has a vastly wider potential range of unobserved factors. A sudden geopolitical shift, an unexpected patent victory, a high-stakes merger that falls through. So its error term might range from plus $100 million to minus $100 million.
A much, much bigger spread.
The variance in the unobserved factors is systematically much larger for the larger unit. And this violation leads us directly into the problem section, because when this assumption of equal variance fails, our statistical certainty is badly damaged.
Okay, so we've established this fragile ideal. Now we introduce the real-world hazards, the fundamental flaws in the data collection process itself that, if we ignore them, can completely invalidate our policy conclusions. These problems are often the central focus of modern microeconomic research.
Right. This is where we move from the clean theory of statistics to the difficult reality of social science. We are dealing with messy human data.
The first major hurdle, which speaks directly to the failure of that random sampling assumption we talked about, is sample selection bias.
This is a critical issue. It occurs when the observations we actually manage to collect are not truly randomly selected. Instead, they are systematically excluded or missing due to a factor that is related to the very outcome we are trying to study.
So the sample is fundamentally unrepresentative.
It is. It's skewed from the start.
The source provides that specific, classic example. Missing income data for high earners. Let's explore the real-world policy consequence of that particular failure.
Yeah, this is often called attrition bias or sometimes selection on the dependent variable. If researchers are using voluntary surveys to collect data,
They often are.
almost always, they will systematically miss a slice of the population. The very wealthy, people experiencing extreme poverty, or individuals working multiple informal jobs, all of whom have unique income characteristics. If richer individuals are less likely to respond to a government income survey, which they are, the average income calculated from the sample is systematically biased downward.
And the policy consequence of that. If government estimates of wealth distribution or tax revenue are based on a downward biased sample,
The distortion is massive. I mean, if you underestimate the true tax base, any calculation of the potential revenue from a progressive income tax or a wealth tax will be far too low.
you'll leave money on the table.
A lot of money. Or think of it this way. If you're a policymaker designing public services, like calculating the necessary funding for schools or infrastructure, and your projections for the local property tax base are systematically understated by just 10% due to sample selection bias.
That's a huge budget shortfall.
That tiny data flaw translates directly into shortfalls in critical public services funding. This bias doesn't just skew academic research, it starves public budgets.
So how do researchers even begin to deal with this?
It's very difficult. They sometimes employ advanced techniques like something called the Heckman correction to mathematically model and then reverse engineer the probability of non-response to try and mitigate this bias. But it's an ongoing battle.
But even if we could somehow successfully select our sample perfectly, our trouble isn't over. Let's talk about the data we do get, which is often riddled with measurement error.
Yeah, measurement error is endemic to survey data. It's almost unavoidable. It happens when reported values are imprecise or just plain inaccurate.
Like someone lying about their income.
It could be intentional, like misreporting income out of embarrassment or to avoid taxes, or it could be totally unintentional. Someone might simply misremember the exact date they started their first job, or guess at their monthly utility spending. This error is just noise in the system.
What's the consequence of all that noise in the regression model? Does it just make the results fuzzier?
It does more than just make them fuzzy. It systematically biases the coefficient towards zero. This is a very specific problem known as attenuation bias.
Attenuation bias, so it weakens the result.
It weakens it. If you're studying the return to education and 20% of your sample inaccurately reports their years of schooling, the true relationship between education and wages gets muffled or attenuated. You will underestimate the true causal impact of education. In essence, measurement error makes real, strong effects look weaker than they actually are, or sometimes disappear entirely.
And then we reach what the literature seems to confirm is the silent killer of causality in observational studies. Omitted variable bias, or OVB.
OVB is insidious. It's so difficult because it's caused by factors that are truly unobserved or unmeasured in the data. You don't even see them. But they are correlated both with your outcome, like wages, and your explanatory variable, like education.
And when you leave this crucial factor out of your model,
its influence is incorrectly absorbed by the variables you did manage to include. Your included variables get credit or blame for something they didn't do.
let's use the classic critique of early cross-sectional labor studies. They found a very high return to schooling, but critics immediately argued they failed to account for a massive, unobserved variable, innate ability or intelligence.
That is the perfect illustration of OVB. If people who are inherently more intelligent are more likely to pursue higher education, and they're also more likely to earn higher wages regardless of their degree,
And you don't have a variable for intelligence in your data set.
which you never do, then your coefficient for education will be too high. It will be biased upward. Education is wrongly credited for the earning power that should have been attributed to that missing innate ability.
So understanding OVB requires recognizing both the direction and the magnitude of the bias. In this specific case, early cross-sectional studies were almost universally biased upward in estimating the true return to schooling.
Exactly. And this forces researchers to adopt incredibly clever strategies. If they can't measure the variable, they might try to use data structures that help control for it, like panel data, which we should discuss later, or they use proxies, other variables they hope are correlated with the missing one. But OVB fundamentally reminds us that observational microdata can only ever prove correlation. Establishing causation requires constantly anticipating and mathematically correcting for those powerful, unseen drivers.
Okay, finally, let's revisit the assumption failure we noted earlier. Heteroscedasticity. This is where the variance of the error term differs across individuals or firms, failing that ideal of homoscedasticity.
Right. When you're analyzing large cross-sections, especially across different income levels or different firm sizes, the variance of the error is almost always larger for the larger units.
Let's use that savings example again.
Okay. Your model predicts that everyone should save 10% of their income. For a low-income family, the absolute dollar error in that prediction might be small. Maybe they save $100 more or less than predicted. For a billionaire, the absolute dollar error is massive. They might save $100 million more or less than predicted.
So the variation in the error term is clearly not constant. It is systematically related to the size of the observation.
Exactly.
But if heteroscedasticity doesn't strictly bias the estimated coefficient itself, so the average return to education is still correctly estimated, why is it considered such a major problem?
Because it completely invalidates the statistical inference. It makes your statistical tests unreliable.
Oh, so?
Specifically, it makes your calculated standard errors, which, again, are the formal measure of your certainty, incorrect. You might conclude that the effect of education on wages is statistically significant, meaning you are 99% sure it's a real effect, when in reality, because your error terms are so volatile for high-income earners, you should only be 70% sure you become overconfident in your findings.
So what's the fix for that?
Researchers have to use specialized methods, such as robust standard error calculations. The most famous one is called White's correction. These methods mathematically allow for the error term to have unequal variances, thereby restoring the validity of the hypothesis testing. It's a standard fix in any modern microeconomic analysis. So if we connect all this to the bigger picture, the structure of microdata is only really fully appreciated when we place it in context with the other massive types of data that economists wield. It helps explain why this particular structure is the natural starting point for analyzing human behavior.
Okay, let's do a quick comparison with the other major data structures. First, the contrast with time series data.
Right. Time series data tracks one aggregate quantity over many periods of time. Think of the monthly inflation rate since 1950, or daily stock market prices. Its defining trait is temporal dependence.
The value today depends on the value yesterday.
Heavily. The observation at time t is heavily correlated with time t1. And this dependence introduces a whole host of econometric challenges, like autocorrelation and non-stationarity, which means the statistical properties of the series change over time.
Whereas microdata.
Microdata has that beautiful simplifying quality. None of this temporal dependence. Each observation is independent of the others, which makes the initial modeling far, far simpler.
Okay, and the contrast with panel data seems crucial, especially since it sounds like panel data was developed specifically to address some of the central flaws of the simple cross-section.
It was, in many ways. Panel data is the middle ground. It combines both dimensions. It observes the same individual units, the same households, the same firms, multiple times over a series of years.
So you're tracking person A's wage in 2018, then again in 2019, 2020, and 2021.
Precisely. Whereas microdata, by definition, observes each unit only once. The difference is profound.
So what exactly is the major advantage of being able to observe the same unit over time? And how does it help solve one of our biggest cross-sectional problems, omitted variable bias?
That is the superpower of panel data. It helps handle unobserved heterogeneity. Think back to our OVB problem with innate intelligence skewing the return to education.
Right, the factor we couldn't measure.
Panel data allows researchers to use a technique called fixed effects. The logic is that since innate intelligence or family background is often constant over time for an individual, it's time invariant, a fixed effects analysis can mathematically subtract out the influence of all those time invariant, unobserved characteristics.
Hold on, run that back for me. You're saying that by observing the same person multiple times, economists can essentially control for the unobserved intelligence and family resources that we couldn't even measure in the cross-section.
That's exactly what I'm saying. If we see a person's wage jump in 2020, and we also observe they got a new degree that year, we are only comparing their 2020 outcome to their own previous 2019 outcome. By doing that, we are implicitly removing the confounding influence of their fixed, innate ability because that ability was present in both years.
So you're comparing the person to themselves.
To themselves. panel data allows us to isolate change over time for an individual, giving us much more robust causal inference than a single snapshot cross-section ever could.
The takeaway then seems pretty clear. The inherent simplicity of the cross-sectional single observation structure makes microdata the natural starting point for initial analysis, but its limitations, specifically that omitted variable bias and selection bias, are what pushed economists to develop more complex and powerful structures like panel data.
Absolutely. And yet, cross-sectional microdata retains immense importance for policy evaluation.
Why? If panel data is so much better, why not just use that for everything?
Because of its reach and the lower cost and time of collection. Collecting good panel data is incredibly expensive and time-consuming. Cross-sectional data provides the initial landscape. It's often the first best look we can get at a problem.
And the ultimate goal is still to allow researchers to identify causal effects at the individual or firm level. We want to be able to answer the what-if question.
And that level of granularity is essential for targeted policy. We rely on microdata to evaluate the impact of highly specific policy levers. For example, if a state implements a new tax credit for first-time homebuyers, but only in certain counties.
A natural experiment.
A classic natural experiment. Microdata allows us to use quasi-experimental designs like difference in differences to compare the outcome for those specific households in the treated counties versus very similar households in the untreated counties both before and after the policy.
So because the data is cross-sectional and independent, we can isolate the individual responses to that specific policy shock in one location versus the other, despite the data just being observational.
Exactly. It provides the high-resolution context that's needed for robust analysis. The strength of microdata is that it forces economists to confront the reality of human behavior at its most fundamental level, making the statistical techniques we use a direct response to the complexity of the observed world.
This has been a necessary, I think, and very deep dive into the statistical bedrock of a lot of modern economics. We started with the simple definition of the individual economic unit, and we ended up confronting the statistical gymnastics required to derive causation from those simple snapshots. Let's try to synthesize the key takeaways.
I think the first is that microdata is defined by its focus on the discrete, singular unit at a single point in time. Its initial analytical power really lies in that independence assumption, which allows for clean modeling.
But it's a fragile assumption.
It is. And its sheer necessity ensures it's the engine for all applied fields, from labor economics to public finance.
And I think the second big takeaway is that the power of microdata, its ability to isolate individual behaviors, is inextricably linked to the complexity of the challenges it presents. We have to constantly fight against these statistical pitfalls, like sample selection bias, where our data is fundamentally unrepresentative.
Right, and measurement error, which systematically muzzles the true strength of the effects we're trying to find.
And most significantly, we have to wrestle with omitted variable bias, where these unseen, unmeasured factors completely skew our conclusions about the factors we did manage to observe.
And this persistent challenge, this fear of OVB, is what forces researchers to adopt increasingly clever and complex modeling techniques to try and isolate true causal effects in an imperfect observational world.
So, what does this all mean for you, the learner? This deep dive has shown how the accuracy and the fairness of real-world policy evaluation, the stuff that affects everything from your tax burden to whether your child's school gets adequate funding, it ultimately hinges on how successfully economists navigate and correct for those primary biases that are just inherent in these single snapshot data sets.
We are betting public funds and public well-being on our ability to account for the unseen.
Yeah.
And that leads us to our final provocative thought for you to mull over. If we acknowledge that economists routinely miss powerful, unobserved variables when they're analyzing things like income or success, consider your own personal life. What unseen factor in your own career or your own success, whether it's something internal like sheer unmeasured grit or an external boost like a crucial mentor you had or a family connection that is impossible to quantify on a standard survey, what might be the omitted variable that is currently skewing someone else's conclusions about your behavior or your achievements?
Something to explore on your own. Thank you for joining us for the deep dive.
We hope this analysis helps you look past the headlines and appreciate the immense complexity that's required to turn simple observation into reliable knowledge.
Until next time.
Welcome back to the Deep Dive. You gave us a massive stack of sources, articles, research papers, notes, all dedicated to, well, one of the most intellectually challenging fields out there. economic forecasting.
It's a huge topic.
It is. So our mission today is a deep, comprehensive review of this material. We want to give you a complete classified overview of how the future of the economy is, predicted.
And it's such a critical subject because the entire world really operates on these predictions. We don't just want to list the models, we want to get into the philosophical trenches, I guess.
Right. What are the assumptions baked into these equations?
Exactly. What are the fundamental trade-offs between, say, precision and just being able to understand the thing? And when is the right time to use a gut feeling instead of 1,000 lines of code?
Absolutely. We're trying to provide a shortcut to being well-informed about a topic that far too often stays trapped behind academic paywalls or, this complex statistical jargon. We are going to classify every method you sent us, explain its mechanism, and most importantly, identify its specific real-world strengths and weaknesses.
Okay, so let's unpack this. The core goal of economic forecasting is, on the surface, pretty straightforward.
It is. It's about reducing the fog around future outcomes.
Right. Using the tools you have, history, established economic theory, and statistical rigor. But we have to remember, this isn't just an intellectual exercise.
No, not at all. This drives trillions of dollars in decision-making every single year.
And that's where the high stakes come in. I mean, think about who is relying on these figures. We can generally categorize the users into 3 massive groups.
Okay.
First, you have governments and central banks. They use forecasts to make these monumental decisions about monetary policy.
Like raising or lowering interest rates, changing reserve requirements.
Exactly. And fiscal policy, too. Deciding the scale of infrastructure spending or tax cuts. They need to see years ahead. It's fundamental to what they do.
And then on a different level, you have firms.
Yes, this is micro-level planning, but with macro-level data. A multinational corporation is using forecasts to decide where to put a new factory, how much inventory to order,
Whether to hire or lay off thousands of workers.
and what level of risk to take on in their supply chain financing. All of it is based on a view of the future.
And the third group.
And finally, the vast machinery of financial institutions. They rely on these projections for everything. From portfolio management and sophisticated asset allocation, all the way to determining the overall health of their lending book and managing systemic risk. If a bank forecasts a deep recession, you can bet their lending standards will tighten up almost immediately.
It really sounds like they're betting the house on these predictions.
Yeah.
But there's a crucial disclaimer we have to issue right at the top here. It frames the limits of this entire field.
Precisely. Forecasts are powerful, no doubt. They reduce uncertainty by quantifying various possibilities. However, and this is the key point, they categorically do not eliminate risk.
That distinction is vital.
It is. Uncertainty is a lack of knowledge. Risk is the quantifiable possibility of loss. A good forecast makes that risk measurable, but because structural breaks and, completely unpredictable events are always possible.
Black swans.
Black swans, exactly. No forecast is a guarantee. And those who treat them as such often pay a very, very heavy price.
That sets the stage beautifully. To make this huge volume of information manageable for you, we're going to divide the landscape into 3 distinct conceptual families. We'll move from the subjective to the highly theoretical.
Right. We'll begin with the least mathematical. Number 1, qualitative or judgmental methods.
Okay.
Then we get into the data-driven models. Number 2, quantitative methods, which covers both statistical and econometric approaches.
And
finally, the really big theoretical frameworks. Number 3, structural or theme-based models.
Perfect. Let's start at the human end of the spectrum then. Let's look at the role of judgment in prediction. So when we talk about qualitative forecasting, we are, in a sense, stepping away from the spreadsheet and into the conference room. This is the domain of human insight, professional experience.
Accumulated knowledge.
Exactly. The definition is simple. It relies on expert judgment, not on a formal statistical model.
And this is often the first tool you reach for when you face a completely novel situation. I mean, think about trying to predict the adoption rate of an entirely new technology that has 0 historical sales data.
Or the geopolitical fallout from an unprecedented trade war.
Exactly. The data is either non-existent or it's just plain irrelevant. So you have to trust the people who understand the complex, institutional nuances.
So what are the specific techniques that let us formalize this gut feeling? Let's start with the simplest one, expert opinion.
Expert opinion is about as straightforward as it sounds. You gather informed individuals in a sector, ask for their predictions, and then you either average them out or, maybe just take the most persuasive case.
But the problem there is pretty obvious.
Oh, yeah. It's highly susceptible to biases, especially the bias of the loudest or maybe the most senior voice in the room completely dominating the consensus.
And that's why we move on to a technique that was designed specifically to eliminate that exact bias.
Yeah.
The Delphi method. This is such a clever way to blend individual knowledge without the pressure of groupthink.
The Delphi method is a structured, iterative process. It involves a panel of experts who are asked to provide their predictions and their justifications completely anonymously, usually through questionnaires.
Right, so the coordinator collects all these responses, synthesizes the result, maybe the median forecast, the range of opinions, and then shares that aggregated feedback back to the whole panel.
And the key is that this happens in rounds, right?
Exactly.
The experts then get to revise their forecasts in light of what the collective thinks, but they still do it privately. And you repeat this process until you get a consensus or at least a stable prediction.
The power is in the anonymity. It allows a junior expert to stand by a really contrarian view without, fearing reprisal.
Which leads to a much more honest and potentially a much more accurate consensus than you'd get from a traditional brainstorming meeting.
Okay, and the third major technique is scenario analysis. This is arguably one of the most essential tools for long-term strategic planning. It's less about predicting the future and more about defining a set of plausible futures.
And that's invaluable because it forces an organization to look beyond just the most likely outcome. You might map out, say, 3 to 5 distinctly different environments.
Like a high-growth, low-inflation Goldilocks scenario.
Right, or a stagflation scenario with low growth and high inflation. And then maybe a worst-case scenario involving a major global conflict or a supply shock.
And the goal isn't to bet on one of them. The goal is to design policies or business strategies that are robust enough to withstand the stress of any of those defined futures.
It incorporates that institutional knowledge about human behavior and policy responses that a purely mathematical model just can't capture.
So the strength of these qualitative approaches, as you said, is their ability to handle these unique, never-before-seen situations.
And to incorporate that deep, nuanced institutional knowledge.
But their Achilles heel is that they are purely subjective, which makes them notoriously difficult to evaluate statistically. You can't really calculate a confidence interval for an expert's gut feeling.
You can't. And that philosophical limitation brings us straight to the most important foundational concept in all of forecasting, the necessary benchmark.
Right. If we're going to use all this complicated math, we first have to prove that the complexity is actually worth the effort.
What's fascinating here is just the sheer humility that's demanded by the simplest methods. Before any company or government commits millions to building some sophisticated econometric model, that model has to pass a basic sniff test.
It has to beat the simplest, cheapest prediction possible.
Exactly. We call these naive or benchmark forecasts.
This is a concept that you, the learner, need to grasp fully. A $10 million model running on a supercomputer is objectively worthless if it consistently loses to a forecast you could generate on the back of a napkin.
It's true. And there are two main types of naive forecasts that serve as this indispensable baseline. The first is the no-change forecast.
Also called the random walk model.
Right. It just assumes that the variable's value tomorrow will be identical to its value today. If oil is $80 today, the no-change forecast for tomorrow is $80. It assumes no momentum, no change, just persistence.
And the second is the historical average forecast. This one takes a tiny bit more effort.
Just a little. It simply averages the variable's value over some past period, say the last 10 years for GDP growth, and uses that smooth average as the prediction for the future.
The utility of these benchmarks isn't their inherent accuracy, it's their role as the measuring stick.
Absolutely. In series forecasting, we often look at measures like Files U statistic, which explicitly compares the accuracy of a complex model against the accuracy of a naive forecast. If that U is greater than 1,
then your complex model is literally worse than just assuming nothing changes.
it is. The lesson here is clear. Complexity for complexity's sake is not just inefficient. It's a sign of a bad model. And if we're moving on to quantitative methods, they have to perform above and beyond these simple rules.
That sets the stage perfectly for our second major family, the quantitative models. We'll start with the simplest statistical approach, which is time series.
Right, so now we're shifting from subjective judgment to objective pattern recognition.
And the foundation of time series forecasting rests on one philosophical assumption, right?
It does. That historical patterns, trends, seasonality, cycles, volatility will persist into the future. It's the ultimate extrapolation machine.
So define the scope for us. What kind of data are we talking about here?
Time series models use only the past values of a single variable. It could be the monthly inflation rate, daily stock returns, quarterly sales figures, whatever. The point is, it's just one variable being used to predict its own future.
And crucially, they ignore any external economic factors.
Totally. They don't care about interest rates or government spending. They only look inward at the variable's own history.
The advantage of that approach is pretty obvious: speed and efficiency.
Oh, yeah. They are simple to implement, requiring only that historical data stream, and they often perform exceptionally well, especially in short-term forecasting.
So if you need to predict inventory demand for the next 2 weeks or electricity load for the next hour, these are your workhorses.
Definitely. Now, we can get into the mechanics of these models because they sort of build on each other in sophistication. We can start with the smoothing techniques.
Okay.
Moving averages simply smooth out the noise in the data to identify the underlying trend. It treats every point in that average equally.
And then you have exponential smoothing, which is a bit more clever.
It is. It's an acknowledgement that economic data often has a memory, but that memory fades pretty quickly. So this method assigns exponentially decreasing weights to observations as they get older.
Meaning the most recent data points carry the most predictive power.
Right. It's essentially a continuously updated average that's heavily biased toward the present.
Okay, so then we move from those smoothing techniques to the more formal statistical models. They start to sound more technical, but they're built on the same core ideas.
Correct. The autoregressive, or AR models, assume that a variable's current value is a function of its own past values. It's all about momentum. If a stock's return was positive for the last 3 days, an AR model would estimate the probability of another positive return based on that exact pattern.
And then conversely, you have the moving average, or MA models. They look at a different kind of pattern.
They do. They look at the past forecast errors. They model the short-term memory of a series based on its shocks. So if our forecast systematically missed the mark last month, an MA component tries to capture that persistent error pattern in the current prediction.
Which brings us to the crowning achievement of this family of models, and maybe the most widely used tool in statistical forecasting, the ARMA framework.
It really is the workhorse.
This is where we need to dive a little deeper, because the complexity does require it. So ARMA combines the autoregressive component,
The dependency on past values,
and the moving average component.
the dependency on past errors.
Right, but what about the I in ARMA? That's the key addition.
The I stands for integrated, and this is critical because most economic data, like GDP or prices, is what we call non-stationary.
Meaning its statistical properties, like the mean or variance change over time.
Exactly. And if you use a non-stationary series in a basic IRMA model, you get all these spurious nonsense correlations. The I component fixes this by mathematically differencing the data until it becomes stationary.
So instead of predicting the level of GDP, we're predicting the change in GDP.
Which is much more predictable. So the practitioner's challenge here isn't just running the software, it's identifying the correct orders for the model, the P, D, and Q.
P is the number of past lags for the AR part, Q for the MA part,
Right.
and D is the number of times we have to difference the data.
That's where the art and the science really meet. Practitioners use statistical tools like the autocorrelation function and the partial autocorrelation function plots to figure out these optimal orders. It's an iterative process of identification, estimation, and then diagnostics.
But they all maintain that same focus, predicting X solely from the past of X.
We do.
But this laser focus on history creates a colossal blind spot when things fundamentally change.
Here's where it gets really interesting. The core limitation of all time series models is that they are structurally blind to economic theory and causality.
What does that mean in practice?
Well, if the model sees that high interest rates in the past correlated with high inflation, it will just keep projecting that correlation, even if the underlying economic mechanism, the Y, has completely flipped.
This vulnerability just explodes when we encounter a structural break.
It does. A structural break is a sudden fundamental change in the relationship between variables or in the overall economy. I mean, think about the oil crises of the 1970s or the widespread adoption of the internet.
Or, most obviously, the COVID-19 pandemic.
The perfect example. An RMA model trained exclusively on pre-COVID data would have been catastrophically inaccurate in predicting supply chain dynamics in 2020.
Because the fundamental relationship between consumer demand and logistics capacity just broke entirely.
The model simply extrapolates a trend that no longer exists in reality. They are brilliant when the economy is stable and predictable, but they are incredibly fragile when the economy pivots.
And that fragility dictates the need for our next family of models, the ones built not just on patterns, but explicitly on the economic relationships we hypothesize and believe to be true. We need causality.
Exactly. We need the why.
So that necessity of understanding the why brings us to the more theoretical end of the spectrum. We are moving beyond simple patterns and incorporating economic relationships between variables.
Which allows us to ask those what-if questions that time series models just can't answer.
We're now in the territory of econometric or causal forecasting models. These models use explanatory variables that are based on established theory.
Right. So instead of just predicting GDP from last quarter's GDP, we're now trying to predict GDP from, say, investment spending, government consumption, and net exports. This is the realm where we can actually test hypotheses.
And the simplest, most foundational example is the single equation regression model.
Correct. This is where we hypothesize a simple directional relationship. For instance, we might model how consumer spending, that's the dependent variable, is influenced by disposable income, the current interest rate, and consumer confidence.
Yeah, independent variable.
Yeah, exactly. And we use statistical techniques to quantify the direction and the magnitude of those influences.
An important variation on that, which you see a lot in policy settings, is the distributed lag model.
This recognizes a key economic reality. Policies don't have an instantaneous effect.
Right. If the government passes a huge infrastructure bill, the impact on employment and output might take quarters, even years, to fully filter through the economy.
The distributed lag model accounts for this by including not just the current value of the explanatory variable, like the stimulus, but also its lagged values from previous periods. It lets us map out the time path of a policy shock.
It's a critical tool for modeling that momentum and friction in the economic system.
It is.
And then we scale up from there to one of the most powerful tools in contemporary macroeconomics, the vector autoregression, or VAR model.
The VAR model is a fascinating compromise. It treats all variables in the system, let's say inflation, interest rates, and unemployment, as mutually influencing one another.
So every equation in the system includes lagged values of every variable in the system.
Right. It models this complex dynamic feedback loop, but it does so without imposing overly strict theoretical constraints on how those relationships have to work.
Wait, hold on a second. If the VAR model treats everything as mutually influencing, doesn't that make it incredibly difficult to isolate the true source of a shock?
It does.
If interest rates affect inflation and inflation affects interest rates, how do we know where the movement started?
That is the precise challenge. And it's the reason VAR models are often called a theoretical or reduced form. They excel at capturing empirical correlations and dynamics, but they can fall short on deep structural explanation.
So how do practitioners deal with that?
They rely on techniques like impulse response functions, or IRFs. These allow them to trace the effects of a specific shock, like an unexpected rate hike, through the entire system over time, even if they haven't explicitly modeled the behavioral foundation of that shock.
So the strengths of all these causal models, particularly for people working in central banks, seem massive.
They are. They allow for genuine causal interpretation and are therefore ideal for running policy analysis. You can simulate counterfactuals.
Like if we had only raised rates 2 months sooner, what would inflation look like now?
Precisely. But this power comes with a significant liability. They require very strong assumptions. You have to choose the right variables, and you have to assume the functional form of the relationship is correct. Is it linear? Exponential?
So if the economic theory you base the model on is just wrong, or if you miss a critical explanatory variable,
then that flaw is baked into every single forecast. They are incredibly sensitive to what we call model misspecification.
And that brings us to the ultimate end of the theoretical line. Models where economic theory isn't just an input, it is the model.
We move now to structural economic models. These are the theoretical blueprints of the economy, designed explicitly from deep first principles theory. Their complexity is immense, and they often form the backbone of long-term strategic analysis for governments.
Historically, what was the primary type of structural model that economists used?
Traditionally, we had these vast macroeconometric models. Huge complex systems, sometimes hundreds or even thousands of simultaneous equations. They were designed to capture the behavior of every major sector.
Consumption, investment, labor markets, monetary policy.
All of it. They were very detailed, but they often struggled with internal consistency and a solid microeconomic grounding.
And that struggle with grounding led to the revolution in modeling that really dominates today, right? The micro-founded approach.
Exactly. The DSGE models. That stands for Dynamic Stochastic General Equilibrium. These are the true behemoths of modern central banking.
How are they built?
They're built from the bottom up. They're based on the optimizing behavior of representative agents. So you have rational consumers maximizing their utility and profit-maximizing firms, all operating under uncertainty.
And the goal is to make sure all elements of the economy are in simultaneous equilibrium, making the model theoretically consistent.
It is.
What was the critical intellectual problem DSGE models were designed to solve? This is a key insight for you, the learner.
They were designed to address the infamous Lucas critique. Before DSGE, traditional models used parameters that were just derived from historical data. But Robert Lucas argued that these parameters are not stable. They change when policy changes, because rational people anticipate the new policy and adjust their behavior.
So the old relationships break down.
Exactly. DSGE models, by building their parameters from fundamental things like preferences and technology, the micro-foundations, they aim to make those parameters robust to policy changes. They model expectations and behavior explicitly.
That's the critical trade-off, isn't it? DSGE models are not primarily designed for short-term accuracy. Their strength is in simulating policy.
Correct. Their primary use is analyzing long-term economic dynamics, simulating how a fundamental change, like a new tax regime or a massive demographic shift, will ripple through the economy over the next decade.
They offer high interpretability.
Yeah.
You know why the forecast works, because it's derived step by step from your theoretical framework.
But compared to the pattern-spotting ARIMA models we talked about, DSGE often delivers weaker short-term forecast accuracy.
Which raises a profound question for policymakers. Which is more valuable? A model that's statistically precise for the next 6 months, but theoretically flimsy.
Or a model that provides a coherent, robust explanation for the next 5 years, even if it's slightly less accurate next quarter.
It's the constant tension in the field.
It is. If you're managing inventory for next week, take the ARIMA model. If you're setting the national retirement age, you absolutely must use the DSGE. The context dictates the value.
We've established the full spectrum of models. Now let's look at how professional forecasters combine these tools and, critically, how they evaluate their success and failure in the messy real world.
One of the most practical real-world applications of data correlation is through leading indicator models. These offer a pragmatic way to predict the turns in the economic road without needing a full structural theory.
Right. A leading indicator is essentially a variable that moves before the general economy does. They're the market's early warning system. What are some classic examples that forecasters watch religiously?
The gold standard is often the interest rate spread. Specifically, the difference between long-term Treasury yields, like the 10-year, and short-term yields, like the 3-month or 2-year.
And when this curve inverts, meaning short-term rates are higher than long-term rates, it has this incredible track record.
It has. It has historically preceded nearly every U.S. recession.
Can you give us a concrete example of that predictive power?
Certainly. The 3-month, 10-year Treasury yield curve inverted pretty meaningfully about 9 months before the official start of the Great Recession in 2007. It's a very compelling signal.
And what does it show? What's the logic?
It shows that market participants are anticipating lower economic growth and lower inflation in the future. That's why they demand less yield compensation for locking up their money long term.
We also look at things like stock market indices and specific surveys like business confidence indicators. Why are those considered leading?
Well, the stock market is forward-looking by definition. Investors are pricing in expected earnings and economic conditions 6 to 12 months out, so a sustained market decline often anticipates a broader economic slowdown.
And business confidence.
Business confidence surveys are leading because they capture planned activity. If firms are suddenly pessimistic, they're going to scale back investment and hiring immediately, which only shows up in GDP later on.
So the key utility here is predicting turning points. But what's the major limitation? Why can't we just rely on these?
The limitation is volatility and the false positive problem. The relationship between these indicators and the economy may change over time.
They aren't permanent laws.
Not at all. Just because the yield curve inverted before the last 5 recessions doesn't guarantee it will for the 6th. Changes in central bank policy or global capital flows can alter that fundamental relationship, leading to misfires.
So if we have qualitative judgments, multiple time series models, several econometric models, and a host of leading indicators, all providing slightly different numbers, the professional solution is often not to pick one.
No, it's to synthesize them all. This is the philosophy of the wisdom of crowds applied through what we call combination forecasts.
And the rationale is pretty robust, right?
It is. Every single model has built-in biases, assumptions, and specific weaknesses. By combining multiple forecasts, you often succeed in diversifying away or averaging out those individual errors and weaknesses.
And the empirical evidence strongly supports this. Combination forecasts almost always outperform single model forecasts over long periods.
They do, especially during volatile or transitional times. The methods can be incredibly simple, like just taking a simple average of all the competing predictions where everyone gets an equal vote.
Or they can be more complex.
Right. You could use weighted averages, which assign greater influence to models that have demonstrated superior accuracy in the immediate past. You're effectively betting more heavily on the historically reliable sources.
Speaking of reliability, let's talk about accountability. If you can't measure the performance of a forecast, you can't trust it or improve it. So we need to explain exactly how success is measured.
Forecast evaluation is absolutely mission critical. When a forecast is wrong, how do we know if it was just a little wrong or epically wrong? We use statistical tools that quantify the magnitude of that prediction error.
Let's start with the most intuitive one, the one that makes the most sense to, say, a business manager, mean absolute error, or MAE.
MAE is easy to calculate and interpret. You take the difference between the forecast and the actual outcome, you ignore the sign, the direction of the error doesn't matter, and you just average those differences over time.
So if you were managing inventory, MAE tells you how much extra stock you needed to keep, on average, just because your forecast is off.
Exactly. But then we introduce metrics that punish big mistakes far more severely. Mean squared error, MSE, and the root mean squared error, RMSE.
Why introduce the complexity of squaring the errors?
Because squaring the errors before you average them just amplifies the impact of outliers. A small error, say 0.5, gets squared to a tiny value, 0.25, but a large error, say 10, gets squared to a huge value of 100.
So if you're a risk manager, you don't care about a lot of small misses. You care about avoiding 1 or 2 catastrophic miscalculations.
And that's it. RMSE, which brings the squared value back to the original units, is the metric that holds forecasters accountable for those catastrophic screw-ups.
So that's the philosophical choice.
Yeah.
MAE tells you the average magnitude of your errors. RMSE tells you how much your biggest screw-ups are costing you.
Exactly. But simply looking at the error rate isn't sufficient. There are 2 critical real-world evaluation considerations that separate academic models from professional forecasts. The first is out-of-sample performance.
This means testing the model on data it has never been trained or exposed to. So if you train a model on data from 1950 to 2000, you have to reserve the data from 2001 onward purely for testing its predictive ability.
Right, because if a model performs spectacularly on the data it was trained on, which we call in-sample, it's probably just memorizing history, not predicting the future.
It's overfitted to the noise.
Exactly. A rigorous forecast must demonstrate robust out-of-sample performance. It has to prove it has captured genuine, stable economic relationships.
And the second consideration brings us back to the reality of the decision maker, real-time data availability.
This is a massive issue. When we look back historically, we use final revised data. But when a central bank makes a forecast in January, they are using preliminary, noisy, often heavily revised estimates of GDP, employment, and inflation from the previous quarter.
So the best forecasters are evaluated on how well they perform with that initial, messy, real-time data handicap.
Because that's the data the decision maker actually had in their hand at the time.
Okay, finally, let's connect all these different methods back to the most fundamental constraint in forecasting time.
The appropriate model is entirely dependent on the forecast horizon. It's the universal organizing principle.
So for short-term forecasts, anything from a few days to, say, 2 quarters out, the immediate patterns are crucial.
And this is where the sheer statistical efficiency and pattern recognition of time series methods often dominate. They are fast, they're reliable for the short term, and they don't require deep, time-consuming structural modeling.
But as you move to long-term forecasts over multiple years, relying on that pattern extrapolation becomes, well, negligent. The risk of a structural break is just too high.
Absolutely. This is where theory-based and structural models like DSGE become not just relevant, but absolutely necessary. You need an underlying economic framework based on behavioral assumptions to navigate deep into that uncertain future.
And the grim, universal truth that binds all of these methods, regardless of their complexity or theoretical elegance,
Is that accuracy generally decreases as the horizon increases.
every bit of uncertainty just compounds over time, making a 10-year forecast more of a probabilistic exercise, not a precise prediction.
Couldn't have said it better.
So what does this all mean? We have mapped the full landscape, from the simple, indispensable, naive benchmarks and expert judgment,
Through the high-powered statistical tools like AREMA and VAR,
all the way to the theoretical monoliths like DSGE. The sheer variety shows that forecasting is less about finding a single truth and more about choosing the right tool for the job.
and that choice is complicated by persistent real-world challenges that plague every single model. Beyond the dreaded structural breaks, forecasters are constantly battling with official data revisions, which can change the historical record even after a forecast is finalized.
They struggle with model instability, where a relationship that held for decades suddenly just degrades.
And through it all, they are managing that fundamental forecast uncertainty, the ever-present risk that can never be fully quantified.
So the ultimate takeaway for you, the learner, is that there is no method that is universally superior in all situations. The choice depends on the specific question you are asking, the data you have available, and, most crucially, how far into the future you are trying to peer.
And that leads to a final provocative thought for you to explore. Given that all models are sensitive to these fundamental shifts in economic behavior, and considering the inherent uncertainty of long-term predictions, we face a critical tension in policy circles.
A tension between what?
How much weight should governments and large firms place on those long-term forecasts from models that are highly interpretable and structurally clean, like the DSGE models?
Versus relying on the agility and demonstrated statistical accuracy of the short-term pattern spotting models, like VA or AREMA, that are theoretically blind.
Right. The debate over interpretability versus short-term precision is not resolved, and it continues to shape global economic policy today.
That is the perfect question to keep this deep dive churning in your mind. We'll catch you next time.
Welcome back to the deep dive. This is where we take that stack of sources you've gathered, the dense articles, the research papers, and we really just extract the core insights. We're here for you, the learner, to distill it all down to a powerful, actionable understanding.
And today we are tackling a big one.
The huge one. It's a topic that often feels a little shrouded in Greek letters and complex stats, but it is absolutely essential to modern knowledge.
It really is.
Okay, let's just unpack this. Our mission today is pretty ambitious, but also straightforward. We are taking a deep dive into economic regression analysis. If you read any research seriously, whether it's about climate change and GDP or education reform, or whether some tax cut actually worked, this is the machine that produced those numbers.
It's the engine room.
Okay.
I like that analogy. It's the statistical workhorse that economists rely on more than any other tool.
Right.
It truly is. If you think of economic theory as the map of how the world should work, supply and demand, incentives, all that.
Right.
Then regression analysis is the surveyor's tool.
Yeah.
It's the thing that lets us move from pure theory into quantifiable, testable, empirical evidence.
So our goal is to get past that abstract idea of, X affects Y. We want to understand the mechanics of how economists isolate and measure and actually quantify that relationship.
And when we study economic behavior, we are constantly dealing with these incredibly complex dependencies.
Right.
Does more experience cause a person to be more productive? Does a new tariff cause inflation? These things aren't just simple one-to-one correlations. They're tangled in a massive web of other factors.
And that's the key, isn't it? This deep dive is really meant to provide you with a powerful intellectual shortcut. Because if you understand the structure of regression, how it's built, what it assumes, and crucially what its limitations are, you gain the ability to critically evaluate almost every major piece of economic research out there.
Exactly. We're going to look at the relationship between what we call the dependent variable, that's the outcome we care about.
The thing we're trying to explain.
Right. And the independent variables, which are all the factors we think are doing the explaining. And we'll learn how to interpret just how precise that connection really is.
Let's get started.
All right.
So why use this tool in the first place? Why do economists reach for regression analysis instead of, just comparing simple averages or looking at basic correlations? That seems a lot easier.
It does seem easier, but it doesn't get you to the answers you really need.
Okay.
Our sources are very clear on this. The central objective isn't just observation. It's about rigorous explanation and precise quantification of these economic relationships.
Can you break that down? What's the difference?
Well, it's the difference between saying people with more education tend to earn more, which is an observation.
Right, a correlation.
Exactly. And saying an additional year of schooling is associated with an 8% increase in wages, holding all other measurable factors constant.
Okay. That's explanation and precise quantification.
That's it. And that precision unlocks the three main uses that really define modern empirical economics.
So what's the first one?
The first, and maybe the most academically pure, is testing economic theories.
Right.
Economists don't just take a theory on faith. They develop a formal hypothesis, for example, that higher interest rates reduce investment, and regression gives them the framework to use real-world data to test the direction and the strength of that relationship.
So does the data actually back up the theory? Or does it refute it and send you back to the drawing board?
Precisely. The second use moves into the predictive realm, forecasting future outcomes.
Okay, so this is where you hear about models predicting GDP growth or inflation.
Exactly. If we can quantify the relationship between, say, consumer confidence and future spending, we can use today's confidence numbers to predict retail sales next quarter.
Mm-hmm.
These models are, never perfect, but they provide the structured predictions that businesses and governments need for planning.
And the third use?
And this is the one that has the most immediate, tangible impact on your life. It's evaluating public policies.
So did the policy actually work?
Did that huge infrastructure bill actually boost regional employment by the amount they said it would? Did a new carbon tax actually change consumer behavior? Regression gives us the quantitative evidence to look past the political rhetoric and determine, in a statistically robust way, if a policy achieved its goal.
Without it, you're just left with anecdotes or, partisan finger-pointing.
You are. It becomes a battle of stories instead of a battle of evidence.
I really want to focus on the example our sources keep coming back to because it seems so fundamental. It's this idea that wages depend on education, experience, and other factors.
A classic example, and for good reason.
Right. If you just looked at the average income of college grads versus non-grads, you'd see a huge difference. But that simple average, it hides everything.
It hides all the nuance.
Yeah, it doesn't tell you why that difference is there. Is it really just the degree? Or is it that people who get degrees also tend to come from wealthier families or have better networks or are just more motivated to begin with?
Exactly. And this is where we introduce the unique power of regression analysis, the thing that separates it from simple correlation. And that is the ability to isolate the effect of one single variable.
Okay, isolate.
We are trying to get beyond correlation to something much, much closer to causation.
So how does that work? Because in the real world, like you said, everything moves together.
It does. Education, experience, motivation, where you live, what industry you're in, they're all correlated.
Yeah.
If we see a higher wage for someone with a degree, how much of that is the degree itself, and how much is just the fact that people who can get a degree probably already have other characteristics that lead to higher wages anyway?
So regression is sort of like a statistical controlled experiment.
That is the perfect analogy.
Yes.
It allows us to statistically impose this vital concept of ceteris paribus,
The old Latin phrase.
all other things being held constant. The model essentially sorts through the chaos of the real world and runs a kind of mental experiment for us.
So in that wage equation, what is the model actually doing?
We're basically telling the model, hey, I want you to compare two individuals. One has 16 years of education, the other has 15. But, and this is the key, we are statistically forcing them to have the exact same amount of work experience, the same level of training, the same industry, and so on.
You're controlling for all those other factors.
We're controlling for all the measured factors. And by doing that, any difference in wages we still observe between them can be attributed solely to that 1 year difference in education.
That feels like a massive leap. You're using a computer program to mimic what would take decades of controlled lab work. How reliable is that really?
Well, its reliability depends entirely on the quality of your data and, most importantly, the rigor of the economic model you build.
Meaning?
If we fail to include an important factor, let's say we forget to control for the industry someone works in, then that factor isn't being held constant. and its influence will sneak into the relationship we're trying to measure, and that will give us a biased result. But the core methodological strength is still there. Regression is really the only tool that lets an economist rigorously try to isolate the effect of one lever, while simultaneously controlling for a dozen or more other confounding factors. And that isolation, that is the foundation of modern empirical economics.
Okay, so let's transition from that conceptual idea to the formal mathematical framework. And this is where, for a lot of people, the jargon starts to hit. So let's try to slow down and really map out the architecture of this model.
Sounds good.
So when economists talk about the true, perfect relationship that exists out there in the world, they're talking about something called the population regression function, or PRF.
Right. This is the theoretical ideal, the relationship that governs every single economic actor in existence, even if we can never, ever perfectly observe it.
And it has this symbolic representation that you see everywhere. Y beta plus beta 1 by 1 plus dots plus beta xk plus u1.
It looks a bit intimidating, but let's just take it apart piece by piece, starting with the stuff we can actually see. So Euler's is the dependent variable. This is the outcome we're trying to explain. The thing that, well, depends on everything else. If we're studying consumer spending, is the dollar amount spent.
And then you have the $6 variables,
Right.
$6 about $2, all the way to 6 These are the explanatory or independent variables.
Right. These are all the factors we hypothesize might influence dollars.
Yeah.
In our wage example, this is where you put education, years of experience, marital status, industry, all the things we can measure and control for in our statistical experiment.
Okay, so that's the known stuff.
Exactly. And now we get to the core of the whole inquiry, the parameters we are trying to discover. And those are the betas, beta dollars, and so on. These are the unknown population parameters.
What's beta the intercept?
Beta is the intercept, yeah. It represents the baseline value of Yale when all of your explanatory $6 are zero. So if you could somehow have zero education and zero experience, beta dollars would be your predicted baseline wage.
But the real action, the stuff we really care about, is in those other betas, beta 1 through beta tank.
Absolutely. Those are the slope coefficients, and they are the central objects of interest because they quantify the exact magnitude of the isolated effect. If we knew the true value of beta dollar B, the coefficient on education, we would know the absolute, true, isolated effect of 1 extra year of schooling on wages for the entire human population. That's what we're hoping to estimate.
Okay, which brings us to the final term in that equation, the letter U. And this is the letter that I think keeps economists humble, the unobserved error term.
It is. It's the acknowledgement that even if we had a model with 1,000 explanatory variables, we still couldn't perfectly explain the economy.
It's basically everything we missed.
It is the single most important and most honest component of the model. To ignore would just be intellectual hubris. It's the recognition that economic reality is always messier than our equations.
And our sources break down what's inside into 3 distinct things.
They do. And for you, the learner, understanding these 3 points is the difference between just reading an output table and truly understanding the vulnerability of the entire analysis.
So what's the first one?
The first and the most notorious element hiding in you are the omitted variables. These are factors that genuinely influence your outcome, but which we didn't include in our measured 6 PRIA variables.
And why would they be omitted?
Could be anything. Maybe we just didn't think of them. Maybe we couldn't measure them accurately. Things like motivation or creativity or raw talent. Or maybe the data just wasn't available, like detailed information on parental support during your childhood.
Okay, give me a concrete example of an omitted variable and how it can, corrupt the results.
Let's go back to our wage equation.
Yeah.
Y is wage, Y1 is education. Let's say we omit innate ability or IQ from our model.
Right, because that's really hard to measure for a big population.
Exactly. So innate ability is a strong predictor of higher wages. So it belongs in the X section of the model, but because we can't easily measure it, it gets shunted into the error term.
Okay, so what's the problem?
Here's the corruption. Innate ability is also strongly correlated with our by 1 variable, education. Highly able people tend to seek out and complete more years of schooling.
Right.
So because ability is correlated with education, by 1, and it affects the outcome, Y, the statistical process will mistakenly attribute the wage increase that's actually caused by high ability to the education variable, I1.
So the education coefficient, beta $1, ends up looking bigger than it really is.
It gets artificially inflated.
Yep.
Exactly. It looks like education has a stronger isolated effect than it truly does because it's secretly carrying the weight of that omitted ability variable.
And that has a name, right?
It does. This is the definition of omitted variable bias, or OVB, and it is the bane of empirical economics. It's why researchers spend 90% of their time agonizing over which variables to include and whether they've successfully accounted for the key unobservables.
Wow. Okay, so that's the first thing. And what's the second?
The second is measurement errors. Even when we try to measure something concrete, like income, our data is imperfect. Surveys rely on people's self-reporting, government agencies use sampling, definitions change.
Someone might just remember their income incorrectly.
Right. Or round it up. If a respondent misreports their annual income by a few $1,000s, that inaccuracy introduces noise into the data. All that noise goes straight into us. The error term is basically a statistical trash can for all the imperfections of real-world data collection.
That makes a lot of sense. No data set is perfect. And the third element?
The third is simply random influences. These are the truly unpredictable factors. You can think of it as sheer luck or idiosyncratic shocks.
Like what?
Think of the unique job offer that came purely by chance, or a sudden burst of market optimism after some unexpected news, or the timing of a technological breakthrough that just happened to benefit one company over another. These are real economic forces, but they're too varied, too unpredictable, and too specific to ever be included as a formal X variable. It makes room for the sheer randomness of life.
So the error term isn't just some afterthought. It's a structural necessity. It's carrying the burden of our incomplete models, our imperfect data, and the unpredictable nature of human decisions.
That's a perfect way to put it.
Okay, so we've built the theoretical model, the PRF. Now let's assume we've somehow managed to estimate those beta parameters. What do those numbers, the coefficients, actually tell an economist?
They tell us the partial effect, and that is the crucial distinction. When we look at, say, beta jaw, the coefficient attached to the explanatory variable 6G8OS, we are looking at the partial effect of $1,000 on.
Okay, so it's not the total effect.
No. This is the operational realization of that ceteris paribus condition we talk about. It answers the question, how much does YD change, holding everything else in the model constant, when 6G8 increases by exactly 1 unit?
And if the model is well specified...
If the model is good, this is our best available estimate of the isolated impact of that single factor.
Let's use our running example, wages and education. But let's dig into a specific way economists often model it, because it can be a bit tricky for a newcomer. The log transformation.
An excellent point. Yeah. Very often, the dependent variable, y, isn't just wage in dollars. It's transformed into the natural logarithm of the hourly wage.
Why do that?
Well, there are a few statistical reasons,
Sure.
but one of the big benefits is that it makes interpreting the coefficient very intuitive. It lets us talk in percentages.
Okay, so walk me through it.
So if y equals log of hourly wage and by 1 equals years of education, and we run our regression and estimate that beta 1 is at 8 cents, that's a very tangible result.
Right.
If we were using a simple linear model, 0.08 would mean an 8-cent increase for every extra year of school, which is just economically implausible.
Right. Nobody would go to school for an extra 8 cents an hour. But because y is in logs, the interpretation changes.
Precisely. The rule of thumb is, if x is in levels and y is in logs, the coefficient multiplied by 100 is approximately the percentage change in y.
So beta 1 equals 0.08 means...
It means that one additional year of education increases wages by 8% on average.
Wow. Okay. That's a much more meaningful number.
It is. That 8% figure is the quantified answer to our economic question. It tells us the expected return on investment for that year of schooling. But you have to remember the caveat.
Which is?
That 8% figure only holds true under the condition that we are comparing two hypothetical people who are otherwise perfectly identical in terms of their measured experience, training, age, and everything else in the model. That statistical control is what makes the number so powerful.
Okay, let's circle back to that error term, because you said its necessity really defines the nature of economics itself. Why can't we just get rid of it? Why can't we force the model to be deterministic with u equals 0?
Well, if we did that, if the model were perfect, what would that imply?
I guess it would mean that for any given set of X values, education, experience, etc., we could predict a person's wage exactly, down to the penny.
Exactly, and that is just fundamentally impossible in any human science. Contrast economics with, say, classical physics. If you know the velocity, mass, and trajectory of a projectile, you can predict where it will land with near-perfect accuracy. That system is governed by a very small number of observable, unchanging forces.
Like gravity and friction.
Right. But economic behavior is influenced by hundreds, maybe thousands of variables, many of which are internal, psychological, or context-dependent. Things like consumer confidence, individual motivation, the specific personality of a hiring manager. These are real economic sources, but you can't systematically quantify and include them as an X variable in a large-scale model.
Right. Those are the things happening inside people's heads, or these tiny little shocks that are inherently unmeasurable when you're looking at millions of data points.
Because of all those pervasive, unobservable factors, the error term ensures that the regression output is inherently probabilistic, not deterministic.
Okay, so the model isn't predicting my exact wage.
No. It's predicting the average wage of millions of people who happen to possess the exact same combination of measured characteristics that you do.
I see.
The error term is what allows the model to state the likelihood or the average effect across a population. If we forced you to be zero, we'd be claiming an unrealistically exact level of predictive power that simply doesn't exist in the messy reality of human economics. So that probabilistic framework is a necessary strength. It's what makes the analysis honest.
All right, so we've set up the theoretical ideal, the population regression function, the PRF, with its true but unknown beta parameters. But here's the reality check. We don't have access to the entire population.
Never.
We can't interview every worker on the planet or track every single dollar spent.
Right, so the fundamental problem is that those true population parameters, the beta Cs, are unknown and effectively unknowable.
So what's the solution? How do economists deal with that?
The solution is to move from the theoretical population to the practical data we actually have. We use sample data, a limited, hopefully representative subset of the population, like a government survey of 60,000 households, to generate estimates of those true parameters.
So this is the leap from theory to actual computation.
It is. And when we use sample data, we are no longer talking about the PRF. We are now working with the sample regression function, or SRF. The SRS is our best empirical guess based on our available data of what that true underlying relationship looks like.
And the notation changes.
Right. The notation is key. We stop using the Greek letter beta, and we start using beta. It's pronounced beta hat.
Beta hat.
And that hat is crucial. It signifies that this is an estimate. It's derived from a finite sample, and therefore it is inherently subject to sampling error and uncertainty. Our entire goal is to find a method that makes our sample estimates, our beta hats, as close as possible to the true population values, the betas.
And the standard method for finding these estimates, the absolute workhorse of econometrics, is ordinary least squares, or OLS.
That's the one.
Can we walk through the mechanics of OLS in simple terms? What is it actually doing?
Okay, let's visualize it. Imagine you plot your data. On one axis, you have income. On the other, you have years of experience. You're going to get a scatter of dots, right?
Yeah, a cloud of points.
And those dots do not form a perfect line. They scatter all over the place because of the influence of that error term, UOLS, is just an algebraic procedure designed to draw the single optimal straight line right through that cloud of scattered data points.
Okay, but how does OLS define optimal? What makes it the best line?
It defines optimal in a very specific way. It chooses the parameter estimates, the specific beta hats for the intercept and the slope, that minimize the sum of squared residuals.
Okay, you just used a key term there. Let's define it precisely. Residual.
A residual is the difference between the actual value you observed in your sample data and the fitted value, which is the value that the OLS line predicted for that point.
Give me an example.
Okay. The actual data might show that John Doe, with 12 years of education, earns $30,000. The OLS line, based on its best fit slope, might predict that someone with 12 years of education should earn $28,000.
So the model made a mistake.
Right. The residual for John Doe is that mistake. It's $30,000 minus $28,000, which is $2,000. That residual, which we call E, is the sample's manifestation of the unobserved population error. It's the error the model made for that one specific person.
And why the squaring? You said least squares, not just least errors.
There's a fundamental question. We have to square the residuals for two main reasons. First, if we just summed up the errors, the positive residuals where we underpredicted would cancel out the negative residuals where we overpredicted.
I see.
You could have a line that's wildly inaccurate, making huge errors on both sides, but the sum of the simple errors could be zero. By squaring them, all the errors become positive, which ensures that the minimization process is driven by the total magnitude of the mistake.
Okay, that makes sense. What's the second reason?
Second, and this is mathematically crucial, squaring the errors penalizes large errors disproportionately. If the model misses a point by a factor of 10, squaring that error makes it 100. This pulls the line much harder toward the bulk of the data and makes it less sensitive to just a few small errors. OLS is very sensitive to outliers, which helps ensure the final line is the absolute tightest fit possible to the main cluster of your sample.
So OLS is basically finding the line that minimizes the total collective mistake made by the model. And once it finds this line of best fit, what do we get out of it?
The output of OLS gives us two absolutely crucial things. First, we get the specific point estimates of a coefficients, the beta hats, our best numerical guess.
Right.
TOLA 1 equals 0.081 is our point estimate for the effect of education.
Okay, that's our main number.
Right. But second, and this is critical because we're only using a sample, OLS provides the basis for statistical inference. Meaning, since we know the true value beta is probably not exactly 0.08, we need to quantify our uncertainty. OLS gives us the tools, things like standard errors and confidence intervals, to say something like, based on our sample, we estimate the effect is 8%, and we are 95% confident that the true effect is somewhere between, say, 6.5% and 9.5%.
This is where statistical rigor meets that practical uncertainty.
It is. And the power of OLS is that under certain key assumptions we need to talk about, the estimates it produces are what's known as the best linear unbiased estimators.
That sounds extremely technical. What does unbiased mean for us?
Unbiasedness is the holy grail. It means that while the specific beta hat we get from our sample might be a little bit off the true value, if we could somehow repeat the sampling process millions of times and run the regression each time, the average of all those millions of beta hats would converge exactly to the true population value. Beta levers.
So on average, OLS gets the right answer.
On average, it provides the correct answer, which is why it's the default choice for almost everyone.
Okay, we've arrived at what feels like a really critical analysis section. If you are going to evaluate economic research, you have to internalize this distinction. Do not confuse statistical significance with economic importance.
This is where good researchers are separated from people who just know how to click a button in the software.
Right. So let's start with a clear definition. What is statistical significance?
Statistical significance is a purely statistical determination. It answers one and only one specific question. Is the effect we observed in our sample reliably non-zero?
So did this relationship just happen by random chance in our data? Or is the underlying beta parameter likely different from zero in the real world?
Exactly. We use tools like p-values or t-statistics to make that call. If a result is statistically significant, we're confident the effect is real, not just a fluke of our sample. But here's the massive caveat, especially today in the era of big data. With modern computing power, economists can analyze data sets with millions of observations. And when your sample size is huge, you can detect effects that are minuscule in magnitude, but are still, technically, reliably non-zero.
Okay, give me an example of that.
Imagine a regression that links the number of times you walk past a specific brand's billboard to your annual income. A vast data set might actually reveal a statistically significant positive coefficient. The relationship is real, not due to chance.
Okay.
But if the magnitude of that coefficient suggests that for every 100 extra times you see the billboard, your annual income increases by, say, 50 cents.
Then the effect is statistically significant, but it's completely economically irrelevant. Nobody cares about 50 cents. It's too small to change anyone's behavior or inform any policy.
Precisely. This is why economists must move beyond the statistics and evaluate the results based on economic intuition. Our sources identify 4 non-statistical aspects you have to consider.
What's the first one?
First is the magnitude of the coefficients.
No.
You have to ask, is the effect size big enough to matter? In our wage example, an 8% return on education is hugely economically significant. It shapes career choices, government funding, everything.
But a 0.001% return
Is statistically interesting if your sample's big enough, but economically, it's a non-issue. The coefficient size has to pass a common sense threshold of relevance.
Okay, what's second?
Second is economic plausibility. Does the finding align with, or at least coherently challenge, established economic theory? If your model found that consumer demand for, say, gasoline increases drastically when its price goes up.
Which is a massive positive beta on price.
Right. That finding completely contradicts the fundamental law of demand. And while statistics can find strange correlations, a finding that defies basic theoretical understanding needs to be treated with intense skepticism. It requires overwhelming evidence to be believed.
And third,
Third is policy relevance. Does the magnitude of the finding justify the political and monetary cost of intervention? Let's say a regression finds a statistically significant result suggesting a new regulation will reduce pollution by a tiny fraction of a percent. If implementing that regulation costs billions of dollars and disrupts an industry, the result, despite being statistically real, is not policy relevant.
The cost-benefit analysis, which is driven by the size of that beta, is the true measure.
It is.
So the conclusion here is clear. Regression is a synthesis. The statistician finds the number, but the economist has to determine if the number actually matters.
You need both statistical rigor and deep economic reasoning. Otherwise, you draw misleading conclusions.
And this leads us to the ultimate caveat, the one that governs the intellectual honesty of the whole field.
The big one.
Regression identifies associations, but it does not automatically prove causal relationships. We have to repeat the mantra. Correlation is not causation.
Cannot say it enough.
But wait a second. We spent the first section talking about how regression isolates the effect using ceteris paribus, which sounds a lot like what you need to claim causation. So why is it still so hard to make that leap?
Because that statistical isolation is only as good as the model you build. We can only hold constant the variables we actually included in the model, from bio 1 through xk. The problem of causality arises when one of the critical statistical assumptions required for OLS to work properly is violated.
And which assumption is that?
It's called the zero conditional mean assumption, or ZCM.
Okay.
The ZCM assumption simply states that the unobserved error term, Ju, must be uncorrelated with every single one of the explanatory variables, the x, in the model. If U and by 1 are correlated, we have that omitted variable bias we talked about, and the effect we measure is biased. And if the effect is biased, we cannot claim it as the isolated causal effect.
So the entire quest for causality is really the quest to eliminate omitted variable bias.
In a huge way, yes. To claim a true causal interpretation, you need to meet some incredibly demanding requirements that go way beyond simple statistical significance.
Such as?
First, you need proper model specification. This means not just including the right variables, but using the right mathematical form. Is the relationship truly a straight line, or does the effect of education diminish as people get older? Should you use that log transformation? If the model is misspecified, the beta hats are inherently biased and misleading, no matter how good your data is.
Okay, what's another requirement?
Second, and this is often the most challenging, is ensuring the exogeneity of your explanatory variables.
Exogeneity.
It means we have to be sure that the independent variable, x, is truly exogenous, that its value is determined outside of the system we're modeling and is in itself influenced by the dependent variable y.
Okay, that sounds a little circular. Give me an example.
Let's go back to the wage and education example. Our causal claim is education y1 causes higher wages.
Right.
But what if it also works the other way? What if coming from a high-income family allows a person to afford more years of high-quality education? Or what if people who anticipate having high future wages are the ones who are most motivated to seek more education in the first place?
Ah, so that creates a feedback loop. Y is influencing X. That's what you call reverse causality.
Exactly. And if that reverse causality exists, if people are strategically choosing more education because they expect high wages, then our OLS estimate of the education coefficient, beta hat 1, is corrupted. It's no longer measuring just the isolated effect of education. It's measuring a mix of the education effect and that ambition and expectation effect all bundled together.
And you can't untangle them.
Not with simple OLS. Econometricians spend their entire careers trying to find unique situations, like natural experiments or instrumental variables, that allow them to prove that their X variable is truly exogenous.
Wow. Okay, what else do you need for causality?
Finally, you need strong support from economic theory. When the data alone can't definitively tell you the direction of influence, theory has to provide the intellectual grounding for your causal claim. You have to be able to argue logically, based on established knowledge, why the causal chain you're proposing, that education precedes and affects wages and not the other way around, is sound.
The warning is constant, then.
The warning is constant. Poorly specified models can and will lead to fundamentally biased conclusions. The computer will always give you an output, but that output is meaningless if the economic thinking behind the model structure is flawed.
Okay, let's ground all of this knowledge in the real world. Where does this complex tool actually meet policy and governance?
This is where the rubber meets the road.
Regression analysis is absolutely central to assessing the effectiveness of major economic and social policies. Policymakers have to rely on it because it provides the evidence base they need to justify spending billions of taxpayer dollars or enacting sweeping new laws.
They need to know what works and, Just as importantly, by how much.
Right. Think about the huge persistent debates in policy. Regression is used to analyze the effects of education reforms.
If a state spends $1 billion to reduce class sizes, regression models are used years later to see if that policy actually yielded a quantifiable increase in the average long-term earnings for the students who benefited from it.
It's also used to evaluate the impact of different tax structures.
All the time. Does cutting corporate taxes actually stimulate domestic investment? Or does that money just flow to shareholders? Regression analysis, by controlling for things like global demand and interest rates, attempts to isolate the specific effect of that one tax change.
And the most contentious debate of all, minimum wage changes. This is where that ceteris paribus idea is just essential.
Absolutely. Studies use regression to estimate the precise relationship between a minimum wage hike and employment levels for low-skilled workers. They have to control for regional economic growth, industry seasonality, national employment trends, everything they can think of, so that the final measured effect is, at least in theory, just the isolated impact of the wage change itself.
And it extends beyond pure economics, right, into social policy.
Definitely. It's used to assess the efficacy of healthcare policies. Does expanding Medicaid access lead to quantifiable reductions in emergency room visits, or better long-term health outcomes? Regression provides the quantitative proof needed to shift those massive healthcare resources effectively.
So the outcome for policymakers is transformative. It helps them understand not just if a policy works, but critically, by how much and for whom.
Right. It allows governments to ideally make evidence-based decisions rather than just relying on political assumptions.
Okay, so to synthesize everything we've talked about, let's lay out a balanced view, the great strengths and the persistent limitations of regression analysis.
That sounds good. The strengths are profound. First, its flexibility and wide applicability. From microeconomics like individual consumer choice to macroeconomics like national inflation, the structure adapts to almost any quantifiable economic relationship.
And second, the big one.
The big one. Its ability to control for multiple factors simultaneously. This is the ceteris paribus feature. Without the ability to statistically untangle that web of correlation, rigorous quantitative analysis of economic behavior would be pretty much impossible. This is what makes regression central, maybe indispensable to all of empirical economics.
But we have to be just as upfront about the limitations, which, as we've seen, often come from those unavoidable statistical assumptions OLS has to make.
Indeed. The first major constraint is that OLS is sensitive to model assumptions. We talked about the ZCM assumption, which, if you violate it, leads to bias coefficients. But OLS also requires other assumptions to guarantee that the estimates are the best, meaning they have the minimum variance among all unbiased estimators.
And one of those is called homoscedasticity.
Homoscedasticity. It's a terrifying word,
Right.
but the concept is simple. It just means that the variance of the error term it has to be constant across all levels of your explanatory variables.
So whether we're looking at low-income workers or high-income workers, the amount of unexplained messiness, the variance of U, should be about the same.
Exactly. But what if it's not? What if the error variance is not constant? That situation is called heteroscedasticity.
And what would that look like?
It would mean the amount of messiness increases as your X variable increases. For instance, low-wage workers might cluster very tightly around the OLS line, a low error variance. But high-wage workers might scatter wildly above and below the line, a high error variance, because things like luck and individual talent play a much bigger role at the very high end of the income spectrum.
Okay, so if you have that, what does it do to your results?
Well, the good news is that when heteroscedasticity happens, our beta hat estimates are still unbiased. On average, they're still right.
But there's bad news.
The bad news is that our statistical inference is compromised. The OLS software will incorrectly calculate the standard errors, which means we might claim an effect is statistically significant when it's not, or vice versa. This forces researchers to use specialized, robust standard errors to correct for the problem.
So the beta hat is still a good guess, but our confidence interval around that guess is wrong. That feels like a massive vulnerability.
It is. The second limitation, which we stressed earlier, is the vulnerability to omitted variable bias.
Right.
When a critical explanatory variable is missing from the X's, its influence gets dumped into the error term UJ. And if that omitted variable is correlated with an included X variable, the coefficient we measure is biased. It's a constant threat that requires the researcher to be an expert in the theory behind what they're studying.
And finally,
And finally, the limitation we can never escape. regression requires careful interpretation, especially about causality. OLS only measures association. The researcher has to bring theory, context, and good design to the table to justify a causal claim. Relying solely on a statistically significant result without satisfying those tough requirements of exogeneity and sound specification is the single most frequent misuse of this powerful tool.
This has been an incredibly detailed exploration. We've moved from defining the need for statistical isolation to building the theoretical model, the PRF, and then learning how we estimate it using OLS, that line of best fit over sample data. And most critically, we've learned how to evaluate the results by distinguishing economic importance from statistical significance and recognizing that constant threat of bias.
Right.
You now possess the key conceptual framework for evaluating virtually any empirical economic data you encounter. You know what those beta coefficients mean in terms of partial effects, and you understand the severe limitations imposed by all those unobservable factors hiding in the error term.
And the deepest, most persistent challenge in all of regression analysis really lies in that tension. The tension between what the statistical technique is actually designed to do, which is simply to fit the data optimally, and what the economist wants it to do, which is to reflect a true, isolated causal mechanism.
And getting there is the hard part.
Getting there requires satisfying those demanding conditions of exogeneity and having an ironclad foundation in economic theory.
Okay.
So let me leave you with a final thought, building on that ever-present and essential error term, U. If all rigorous economic theories rely so heavily on the principle of ceteris paribus, holding all other things constant, to make their valid causal claims, then how much true unshakable confidence should we place in a policy recommendation that's based on a model that we know, because of the presence of the error term, can never fully observe and control for all the possible factors influencing human behavior? This invites you to consider that essential tension, that balance between statistical certainty and the inherent unavoidable uncertainty that defines our messy economic reality. And finding that balance, that's the true art of empirical economics. Welcome back to the Deep Dive. This is where we take some of the most complex economic and financial sources out there, we strip out all the jargon, and we try to give you the essential map you need to understand the systems that really govern our world.
And today, we are going deep on a really fundamental topic. It's the basic rhythm of the entire global economy. We're talking about the economic cycle.
That's right. We've gone through that whole stack of research you sent over academic articles, some historical analysis, a few macro models, all of them trying to get at the core mechanics of these cycles. So our mission today for you is to pull all that together and give you a clear, structured map of how, and more importantly, why economies seem to expand and contract over and over again.
It's really about getting past the headlines. You always hear, the economy is good or the economy is bad. We want to show that it's always in motion, following a pattern.
Exactly.
Yeah.
This isn't just about what happened in, say, 2008 or the Great Depression. It's about understanding the engine, the feedback loops that made those events almost inevitable parts of a cycle.
And if you can grasp those core mechanisms, every piece of economic news you hear from now on will have so much more context. You'll see where it fits in the larger pattern.
Which brings us to the central question for today, the real paradox. We know that over the long run, decades, centuries, human ingenuity, technology, all of it pushes the economy upwards. It gets bigger. So why isn't that growth just a smooth, straight line up?
Right. Why do we constantly have to deal with these painful booms and busts?
That's the hook, that tension between the long-term upward trend and the short-term volatility. It's what defines modern market economies.
Yeah, and the sources are really clear on one thing. These cycles aren't predictable like clockwork. You can't just, mark your calendar for the next recession.
No, but they absolutely follow a recognizable pattern. There's a sequence of growth and decline that just repeats itself around that long-term trend. And it's that variability, the fact that we don't know how long each phase will last, that makes it so incredibly difficult for governments and central banks to manage. Okay, let's start with the absolute basics. When economists talk about economic cycles, what are they actually measuring? What is that?
The formal definition, the one you'll see in textbooks, is that an economic cycle or a business cycle is a recurring fluctuation in aggregate economic activity over time.
Aggregate economic activity. Okay, that's a mouthful. Let's break that down.
Yeah.
What does that actually look like in the real world?
Think of it as the total health of the entire system. It's the sum of everything. So we're talking about how many new businesses are opening up on your main street, how many cargo ships are leaving the ports.
How many people are getting mortgages or how much everyone's spending at restaurants, that kind of thing.
Exactly. It's all of it together. And when we say the cycle is fluctuating, we mean all of those big indicators are, for the most part, moving in the same direction, either up or down, together.
So it's GDP, it's employment, it's spending power, all the big pieces moving in concert.
Correct. And that brings us to what is maybe the most important idea in all of macroeconomics: the difference between the long-run trend and the short-term cycle.
I always think of this with an analogy.
Yeah.
I picture the economy as a rising escalator. The escalator itself, that's the long-run growth trend. It's always slowly but surely moving upward.
That's a great way to put it. That upward movement, the trend, is driven by the big, powerful forces: innovation, new technology, a growing and more skilled population. You know, the things that guarantee that, barring a catastrophe, the economy in 50 years will be much larger than it is today.
That's the baseline. But the cycle, the boom and bust, that's like the escalator itself shaking.
Yeah.
Or maybe it suddenly speeds up for a bit and then lurches to a stop before starting again.
Yes. It's the volatility that's happening on top of that steady upward path. It's the difference between our potential for growth and the growth we actually get in any given year.
So you could be growing at, say, 3%, but if your potential is 5%, you're actually in a cyclical slump.
You're underperforming. And ignoring the cycle is it's like trying to pilot a ship by only looking at a map of the sea level and completely ignoring the massive waves that could actually sink you.
And at its simplest, the cycle itself is really just two states, right?
A binary, yes.
Wow.
You have periods of expansion where things are generally getting better and periods of contraction where things are getting worse. The whole conversation today is about the movement between those two states.
Okay, so let's go back to that unpredictability you mentioned. If this pattern repeats, why can't we model it with precision? Why can't we predict it like we predict, I don't know, an eclipse?
Because the forces driving it are human. They're systemic, not mechanical. Natural cycles, like seasons, have a fixed duration. Physics dictates them. The economic cycle is defined by its non-regularity.
Meaning an expansion could last 2 years or it could last 10.
Precisely. An expansion might get cut short by a sudden financial crisis, or it could go on for a decade if you have a huge technological breakthrough that provides smooth, sustainable growth.
And I guess that's what makes the job of a central banker so incredibly hard.
It creates enormous uncertainty. If you knew for a fact that a recession would last exactly 18 months, you could plan your response perfectly. But you don't. You're constantly trying to figure out, is this just a small dip? Or is this the start of a huge, multi-year contraction?
And if you act too soon, you might cause the very problem you're trying to prevent.
But if you wait too long, you let the downturn get much deeper than it needed to be. This lack of a fixed timeline turns economic forecasting from a science into, well, something much more like an art.
So the volatility, the choppiness, is sort of the price of admission for a dynamic market economy.
It is. It's the constant push and pull between our expectations and what actually happens. And that takes us from the what to the how, the actual phases of the cycle.
All right, so our sources describe this cycle as a kind of 4-act play. It's a continuous journey moving from positive momentum to strain, then decline, and finally to a renewal.
And we always start with Act 1, expansion. This is the good part. This is when things are getting better for most people, and there's a general feeling of optimism.
So when you look at the data, what are the key metrics that are just flashing green, screaming expansion?
You're looking for positive numbers across the board. So GDP growth is consistently positive quarter after quarter. Unemployment is falling because companies are hiring, which means incomes are rising.
And crucially, confidence is up, both for consumers and for businesses.
That's the key. And it feeds on itself. It creates what we call a virtuous cycle. And the mechanics of this are really important to understand.
Yeah, let's dig into that loop because it feels like that's the real engine of the expansion.
It all starts with confidence. When a CEO feels good about the future, when she believes demand is going to be strong for the next year, she invests. And not just small investments. She'll build a new factory or upgrade an entire fleet of trucks.
Big, long-term commitment.
Exactly. And to do that, you have to hire people. You need construction workers, engineers, factory staff. So employment goes up. And as millions of people get new jobs or raises, they start to feel financially secure.
And then they start spending. They buy the new car they've been waiting on, or they finally do that kitchen renovation.
And that spending flows directly to other businesses as revenue, which in turn makes those CEOs feel confident, and it validates their decision to invest in the first place, maybe even encouraging them to invest more.
It's a powerful feedback loop. Belief drives action, and the results of that action reinforce the original belief.
It's beautiful when it's working, but it can't go on forever. And that, of course, brings us to Act 2, the peak. This is the moment where the expansion tops out.
It's the height of the boom. But the sources are clear that this moment is also incredibly fragile. Why?
Because the economy is now running too hot. It's straining against its physical limits. And there are two big warning signs here: capacity constraints and inflation.
Okay, capacity constraints. What does that mean? How does an economy hit a wall?
Think about it this way. Imagine every factory is already running 3 shifts. Every truck is on the road. Companies want to produce more, but they just can't. They try to hire more skilled workers, but there's nobody left to hire.
The unemployment rate is already rock bottom.
Exactly. You've run out of the basic ingredients of production labor, capital, raw materials. You've hit your maximum efficient output. Any attempt to push past that point just creates bottlenecks and chaos.
And if you have all this demand from confident consumers, but supply physically can't keep up, that sounds like a recipe for inflation.
That is the textbook definition. Inflationary pressures start to build because too much money is chasing too few goods. So businesses, who can't just magically produce more, do the only thing they can. They raise prices.
You also see wages go up, right? As companies fight over the few available workers.
Yes, you get wage inflation, which pushes costs up for everyone. And suddenly those price hikes start to eat away at profits, and more importantly, they eat away at the purchasing power of the very people who are driving the boom.
And this is the psychological shift. This is the turning point. The question changes from how much better can things get to, oh boy, how bad is the correction going to be?
The optimism sours into worry, and that anxiety is the trigger for Act 3, recession or contraction.
Which is officially defined as a significant, broad-based decline in economic activity that lasts for more than a few months. So what does that actually look like on the ground?
It's the virtuous cycle thrown into reverse. It becomes a vicious cycle. First, you see output fall. Usually the rule of thumb is 2 straight quarters of negative GDP growth.
And businesses see this happening. They see their demand shrinking and their costs are still high, so they slam the brakes on investment.
They do. They cancel projects, and they start looking to cut costs immediately. And the first and biggest cost for most companies is labor. So layoffs begin.
And as soon as layoff announcements hit the news, that fear just spreads like wildfire.
It does. Even if your job is safe, you see your neighbors getting laid off and you immediately pull back on your own spending. You decide not to buy the new TV. You cancel the vacation.
And that just makes things worse. That lack of consumer spending hits businesses' sales, which forces them to cut back even more, leading to more layoffs.
The fear becomes a self-fulfilling prophecy. It's what makes recessions so deep and painful. It's the system trying to correct for the excesses of the boom, the bad investments, the risky bets, the high prices.
It's a painful but necessary cleansing process.
In a way, yes. And eventually, after all that pain, you hit bottom. And that's Act 4, the trough.
The lowest point of the slump, but also the most important point for what comes next.
Because the trough is the turning point. It's the transition from contraction back to expansion. And a couple of things are usually happening down there. First, things have gotten cheap again.
How so?
While prices have fallen, wages have come down, businesses have sold off all their excess inventory. The cost of doing business is low enough that someone, somewhere, sees an opportunity to make a small profit by hiring one person or buying one machine.
So the market starts to correct itself.
It does. But second, and this is usually much more powerful, you have intervention. By the time you hit the trough, the central bank has almost certainly slashed interest rates to near zero, and the government is probably rolling out big stimulus programs.
Pumping money into the system to try and get it started again.
Exactly. So the combination of things being cheap and a flood of stimulus money means the seeds of the next expansion are sown. The trough isn't an endpoint, it's just the starting line for the next lap.
Okay, so we have the 4 acts of the play. We know the structure, but what's the force that actually pushes the economy from one act to the next? The sources talk about these things called shocks.
Yeah, shocks are the triggers. They're the disruptive events that knock the economy off its current path. And they can come from inside the system, like from the financial world, or from outside, like a new technology or a war.
Let's start with the first category, demand-side shocks. This is all about sudden changes in our collective willingness or ability to buy stuff.
Right. It could be consumers, businesses, or the government suddenly changing their spending patterns. A classic negative demand shock is when everyone gets scared at once.
And decides to save their money instead of spend it.
Exactly. If millions of households suddenly decide to dramatically increase their savings rate, that's a massive amount of spending that just vanishes from the economy overnight. That can easily tip an economy into a contraction.
We saw the opposite of that during the pandemic, didn't we? With the stimulus checks.
A perfect example of a positive demand shock. The government suddenly gave households a lot more money to spend. That created a huge artificial boost in aggregate demand, which helped accelerate the recovery.
And what about businesses? Their investment decisions are a big part of demand, too.
A huge part. And it's very volatile. Imagine if a bunch of companies suddenly decide that AI is the future and they all start a massive spending spree on new servers and software. That's a powerful positive demand shock.
But if there's, say, a big geopolitical crisis and they all decide to pause their expansion plans.
That's a sharp negative shock. It pulls growth backward. The same goes for government spending. A huge infrastructure bill is a positive demand shock. A sudden turn to austerity with big spending cuts and tax hikes is a powerful negative one.
Okay, that all makes sense. Now let's shift gears to the second driver. Supply-side shocks. This is different, right? It's not about whether we want to buy things, it's about our ability to make things.
That is the critical distinction. Demand shocks tend to push output and prices in the same direction. More demand means more output and higher prices. Supply shocks are different. They often create a conflict for policymakers.
Let's use a classic example from the sources, the negative one. The oil crisis in the 1970s?
The textbook negative supply shock. Oil is a fundamental cost for almost every business on the planet. Transportation, manufacturing, heating, it's everywhere.
So when the supply of oil was suddenly cut, the price shot through the roof.
It skyrocketed. And businesses had no choice but to pay it, so their costs went way up. This forced them to raise their own prices, even as the economy was slowing down because production had become so expensive.
So you get rising prices, inflation, at the same time as you get falling growth. That's stagflation.
The dreaded stagflation, it's a nightmare for central banks because the normal tools don't work. You can't cut interest rates to fight the recession because that will just make the inflation worse.
But there are also positive supply shocks, right? Often driven by technology.
Absolutely. Think about the late 1990s with the rise of the internet and globalization. That was a massive positive supply shock.
How so?
Well, suddenly businesses could manage their supply chains more efficiently, they could automate processes, they could access cheaper labor and materials from around the world. All of this meant they could produce more stuff at a lower cost.
So that's the dream scenario.
Yeah.
You get high growth without high inflation.
It is the economic holy grail. A positive supply shock can fuel a long, healthy, and stable expansion. So you can see how important it is to know which kind of shock you're dealing with.
Now for the third driver, and this is the one that seems to cause the really big dramatic swings.
Financial factors.
Yeah, the financial system is like an amplifier. It can take a small shock and turn it into a massive crisis. The sources really focus on two things here: credit cycles and asset bubbles.
Let's start with credit. In an expansion, it becomes really easy to borrow money, right? The credit boom. It does. Banks are optimistic. They have lots of money to lend, so they lower their standards. They start giving out loans to riskier borrowers or accepting shakier collateral.
And all that easy money just pours fuel on the fire of the expansion.
It turbocharges it, especially for big-ticket items like houses. But because it's built on a weak foundation, it eventually leads to a credit bust.
When all those risky loans start going bad.
Yep. As defaults start to rise, the banks panic. They slam the brakes on lending. They tighten their standards overnight. And that sudden cutoff of credit is called a credit crunch. And it can choke the life out of an otherwise healthy economy.
And this is directly linked to asset bubbles, like we saw with the housing market before 2008.
They feed each other. An asset bubble is when the price of something, it could be houses, could be stocks, could be anything, gets totally disconnected from its real value.
People are buying it not because they think it's worth the price, but just because they think they can sell it to someone else for a higher price later.
Pure speculation, often fueled by all that easy credit we just talked about. And when the bubble bursts, the crash is devastating. It triggers something called the wealth effect in reverse.
Meaning, when your house or your stock portfolio was worth a lot, you felt rich, so you spent more. When it crashes, you suddenly feel poor, and you stop spending.
Instantly. And because the entire financial system is interconnected with banks holding all these assets that are now worthless, the crisis spreads everywhere. It takes what might have been a normal, mild recession and turns it into a catastrophic one.
The 2008 crisis really was the perfect storm of all of these financial factors working together.
It was the financial amplifier at full volume, a textbook case study.
Okay, so our final driver is a bit of a strange one. Policy actions. These are the things governments and central banks do on purpose, but their actions can become shocks themselves.
That's right. Policy is usually a reaction to what's happening in the cycle, but the tools they use are so powerful that the reaction itself becomes a major force, driving the next phase.
Let's start with monetary policy. That's the central bank mostly using interest rates.
Right. So if the economy is overheating at a peak and inflation is getting out of control, the central bank will step in and start raising interest rates. We call that monetary tightening.
The idea is to make borrowing more expensive, to cool down spending and investment, and hopefully bring the economy in for a soft landing.
That's the goal. But the very act of raising interest rates can be the shock that tips the economy from that peak right into a recession. It's a huge risk.
Why is it so risky?
Because of what economists call the lag effect. The full impact of an interest rate hike isn't felt in the economy for maybe 12 or even 18 months. So the central bank is always kind of flying blind.
They're making decisions today based on data from months ago to affect the economy a year from now.
Exactly. So there's a huge risk that they overdo it, they tighten too much and cause a much deeper recession than was necessary. And then you have the other side, fiscal policy. That's the government, with taxes and spending.
Right, so things like stimulus packages or big tax cuts.
Those are usually used during a recession to try and boost demand and pull the economy out of a trough. And they can work. But if you use them at the wrong time, say during an expansion that's already running hot, you can just pour gasoline on the inflationary fire.
Which then forces the central bank to come in and raise interest rates even more aggressively to clean up the mess.
So you see the dilemma. Policymakers are constantly walking this tightrope. If they act too slowly, the problem gets worse. But if they act too aggressively, their solution becomes the next problem. Their actions, necessary as they are, become powerful drivers of the cycle itself.
So we have the phases, we have the drivers. But how do we know where we actually are in the cycle at any given moment? Measurement seems absolutely critical.
It is. You can't manage what you can't measure. And to do that, we rely on a handful of really big, high-level indicators. The sources point to three main groups: GDP, industrial production, and employment.
And we need all three because they each tell a slightly different story and they move at different speeds.
That's the key. GDP, gross domestic product, is the big one. It's the broadest measure of everything we produce. But the problem is, it only comes out every 3 months, and it often gets revised later. So it tells you where you were, not where you are.
Industrial production's a bit faster, right?
It is. It measures the actual physical output of factories and mines. It comes out monthly, so it gives you a much more current read on what businesses are doing. And then there's employment.
Which is what most people feel directly. But you said it's a lagging indicator. What does that mean?
It means it's the last thing to change. When a recession starts, companies don't fire everyone on day one. They'll cut hours, freeze hiring, sell off their inventory first. They only resort to layoffs when they're sure things are bad.
And the same on the way up.
Yeah.
They don't start hiring again until they're really confident the recovery is real.
Exactly. So the unemployment rate is great for confirming that a trend is underway, but it's terrible at telling you when the trend is about to start or stop.
Which is why economists look at leading indicators to try and see around the corner.
Yes, leading indicators are things that tend to change before the rest of the economy does. Things like new orders for big-ticket manufactured goods or the number of new houses being built. Even consumer confidence surveys can be a really powerful leading indicator.
But even with all this data, there's a big statistical problem, right? You have to separate the short-term wobbles of the cycle from that long-term upward trend we talked about.
This is where it gets really technical, but the core idea is simple. You have to isolate the cycle, the interesting part, from the boring, predictable long-term growth.
You had a good analogy for this, for the detrending techniques they use.
Right. Imagine you're watching a speedboat on a river. The river itself is flowing steadily at 5 miles per hour. That's the trend. If the boat's engine pushes it forward, its total speed might be 13 miles per hour.
Yeah.
Detrending is like statistically subtracting the 5-mile-per-hour current of the river, so you can see what the boat's engine, the cycle, is actually doing on its own.
So if the economy grew by 1% this year, but the long-term trend is 2%, detrending shows us that we're actually shrinking relative to our potential.
Precisely. You're looking at the deviation from the trend. And there are various statistical tools, these filtering methods, that help smooth out the noisy data and give us a clear picture of that cycle.
And once all this math is done, who makes the official call? Who decides, okay, we were officially in a recession from this month to that month?
In the U.S., that job falls to a nonpartisan academic group called the National Bureau of Economic Research, or NBER. They're the official scorekeepers. They look at all the data in hindsight and pinpoint the exact months of the peaks and troughs.
So they're historians, not forecasters.
Correct. Which brings us to the really big challenge, forecasting. We know these cycles have a huge impact on any economic prediction.
If you don't know what phase of the cycle you're in, your forecast is going to be systematically wrong.
Consistently wrong. If you miss that the economy is about to hit a peak, you will completely underestimate future inflation. If you don't see that a trough is forming, you'll underestimate the power of a rebound. You have to account for the cycle's dynamics.
But, and we keep coming back to this, the turning points, the peaks and troughs, are almost impossible to predict with any accuracy. After all this sophisticated modeling, why is that?
Because at the end of the day, the models are based on data, but the actual turn is often driven by something you can't quantify. Human psychology.
Animal spirit.
John Maynard Keynes' famous term, animal spirits. That spontaneous urge to action rather than inaction. That sudden collective wave of optimism. Or, conversely, that sudden irrational panic that can grip millions of people at once.
You can't put that in a spreadsheet.
You can't. It's easy to model momentum. It's almost impossible to model the precise moment that confidence shatters. That psychological shift doesn't show up in the employment data for months.
So while the numbers eventually confirm what happened, the trigger for what happened was something fundamentally non-mathematical. A collective failure of nerve, or a sudden burst of irrational exuberance.
Exactly, and that's why this is still as much an art as it is a science. The real skill isn't just reading the data we have, but trying to sense those shifts in psychology before they ever become a statistic. Hashtag tech tag outro.
This has been a really useful deep dive. We started by defining the economic cycle not as some random event, but as these recurring ups and downs that happen on top of the economy's long-run upward trend.
We then mapped out the 4 acts of that journey. We had the virtuous cycle of expansion, the overheating and strain of the peak, the fear-driven downward spiral of a recession, and then the renewal that begins at the trough.
And most importantly, we looked at the 4 big drivers that push us between those phases. We had demand shocks, supply shocks, the huge amplifying effect of financial factors like credit and bubbles, and finally, the role that policy itself plays in driving the cycle.
And understanding that framework, it really changes how you consume the news.
Well.
You know, when you hear the Fed is raising interest rates again, you can now see that as a policy action, trying to cool down demand during an expansion to avoid an inflationary peak.
It gives you a mental model to place all the headlines. It turns all that noise into structured knowledge, which is so valuable for making your own financial decisions.
Absolutely.
So let's end by circling back to that last point we made about forecasting. We said that the most critical moments, the turning points, are the hardest to predict because they seem to depend on something we can't really measure, that fragile thing we call collective confidence, Keynes's animal spirits.
Which leaves us with a final question for you to think about this week. If the exact moment the whole system shifts from growth to collapse or from collapse back to revival really depends on the collective beliefs and the sudden non-mathematical fears of millions of us, what does that say about stability? Does it mean that economic stability is ultimately dependent on sentiment and is therefore always inherently fragile?
Is confidence itself the most important and the most unpredictable asset in the entire economy?
A good thought to chew on.
You've handed us a stack of source material that is, frankly, the key to unlocking how economic predictions actually work.
It really is.
We're talking about the foundational concepts of trend analysis and forecasting. And this isn't about, what the market did yesterday.
No, not at all.
This is about where the entire economy is headed over the next generation.
It's the perfect deep dive for anyone who wants to quickly become well-informed about the true backbone of economic prediction.
Right.
When you filter out all that daily noise, the hot takes, the quarterly earnings reports, what you're left with is the trend. And that is where structural wealth is either created or, well, destroyed.
Absolutely. So the mission here for you is to use these foundational texts on the theory and practice of trend analysis to identify the core components of these economic time series and to understand the different personalities of economic trends, and that is a huge point we'll get into, and crucially appreciate why predicting the future is just so difficult, even when you're armed with all this sophisticated math.
We're really giving you a systematic shortcut. Our sources are incredibly precise, and they show how forecasters literally decompose time itself.
Yeah, that's a great way to put it.
They're isolating these long-term structural forces from the short-term market chaos. And if you understand this decomposition, you understand the language of serious economics.
Okay, let's unpack this then. We are diving into excerpts that lay out the systematic approach to understanding these long-term forces. So let's start right at the very beginning. Let's define the core concept. What exactly is a trend in this context?
So section 6 in the source material, this definition is really the starting line for everything else. A trend represents the long-term movement in an economic time series.
And we have to emphasize long-term.
We absolutely have to. This is not the growth rate from last quarter or even last year. This is the persistent underlying direction over decades.
That's such a crucial distinction. You hear on the news, the U.S. economy grew by 3% last year. And you think, okay, great. But that's just one data point.
Just one.
The trend is the slow, steady arc of the country's economic potential over the last 50 years. It's almost like the maximum speed limit the economy can maintain over the long haul.
That's a great analogy. The trend must reflect persistent growth or decline over time, and critically, it must be independent of short-term fluctuations. We are looking for that permanent systemic slope.
So it's an active process of ignoring things.
It is. It requires looking past recessions, past sudden booms, past, policy shifts that only last a few years. It's the geological movement versus the daily tide.
I always thought trend analysis was just, you open up a spreadsheet and draw a straight line through the data. It sounds like there's an active, very deliberate effort to ignore certain parts of the data to find that underlying signal.
There is, and that is why trend analysis is so laborious but so necessary. And this leads directly to section 7 in the texts. The actual purpose of this whole exercise. Why even bother separating the long view?
Yeah, and this is where it gets really interesting.
Yeah.
Because the sources are so clear. The primary goal is diagnostic.
Yes.
It's about separating that long-term fundamental behavior from all the noise that's generated by markets, by seasons, by cycles. If you don't do that, you run the risk of mistaking temporary excitement for enduring prosperity.
Or a minor cyclical dip for a fundamental economic failure. You see it all the time. And this capability to separate signal from noise, it leads to 3 key areas where our understanding of the economy improves dramatically. The first, and maybe the most fundamental, is understanding structural economic growth.
We hear that term thrown around a lot. What does structural growth actually break down into?
It's the deep underlying capacity of the economy to grow. And it's really determined by 3 main factors. First, you have growth that comes from labor force expansion. That's simply having more people working.
More hands on deck.
Exactly. Then you have growth from capital accumulation. So more machines, better infrastructure, more private investment.
The tools those hands have to work with.
Right. And then, most mysteriously and honestly, most importantly, you have technological progress. Economists often measure this as a residual called TFP, or total factor productivity. It's the magic ingredient.
So if the labor force is shrinking because of demographics, or if businesses stop investing in new equipment, the structural growth trend has to fall, no matter how aggressively the central bank tries to stimulate short-term demand.
Precisely. You can't print your way to a higher trend. And that connects perfectly to the second area of improved understanding from the sources, productivity changes.
Right.
As the source material implies, productivity, which is just how efficiently we turn inputs like labor and capital into outputs like goods and services, is the ultimate long-term driver of our living standards. Nothing else matters as much in the long run.
So if productivity accelerates because of a new invention, like AI or something, the trend line curves upward. If it stagnates for a decade, the trend line flattens and everyone just feels poorer, even if the economy isn't technically in a recession.
That's the power of the trend. Changes in productivity are usually slow, they're gradual, and often they're only visible in hindsight looking back across decades. But they define the slope of that trend line, and policymakers are obsessed with finding ways to tilt that line just a little bit higher.
And the third major area, which I think we often overlook, is demographic effects.
Demography is destiny in economic forecasting. It's the slowest moving, most predictable variable we have.
Yeah.
Population shifts, the massive entry or exit of cohorts from the workforce, aging populations, migration patterns, these are forces that move in 20, 30, even 50-year cycles. They are the purest definition of a long-term trend because once a generation ages, you can't reverse it with a quick policy fix.
The baby boom is the classic example.
It profoundly affected the trend of labor force expansion for half a century, and now its retirement is doing the same in reverse.
So trend analysis is absolutely essential, specifically for medium and long-term forecasting. This isn't just some academic theory. It's the anchor for all serious planning.
Think about it from a government perspective. Pension planning, climate change infrastructure investments, planning for national debt sustainability. These all rely on knowing that long-term trend.
Right.
If a government plans its budget assuming a 3% structural growth trend, when the reality is closer to 1.5% because of aging demographics,
They're in big trouble.
they are planning to collect trillions of dollars in taxes that will simply never materialize. The forecast is worthless if the trend is wrong. It's not just a little off, it's fundamentally broken.
Which brings us neatly to how economists handle all the rest of the chaos. So if the trend is this slow, deep current, how do they categorize all the waves and the ripples on the surface?
This is where the systematic blueprint comes in. Section 10 of the source material introduces this idea that economic time series are not monolithic. They're a jumbled mess of different components, and the forecaster's job is to systematically break that mess down.
It sounds a bit like a statistician's version of forensic accounting.
I like that.
You're trying to pull apart all these layers of noise to see the tree transaction that happened underneath.
Exactly. And the decomposition model is standard practice for this. We break the raw data down into 4 distinct parts that, when you add them or multiply them together, they equal the original data series you started with.
And we know the first one already? The trend component. That's the fundamental multi-decade direction we just spent time defining. The bedrock.
Right. Next up is the cyclical component. These are the medium-term swings, the classic waves of expansion and contraction that define the business cycle.
Okay.
Critically, these movements operate over years, not decades. They typically peak and trough every 4 to 8 years, although they can be highly variable in how long they last and how intense they are.
The cycle is what most people are actually talking about when they discuss the economy on the news.
Mm-hmm.
Are we heading toward a recession? Are we in an expansion phase? This component represents the health of the economy relative to its long-term potential, to its trend.
That's the key. If the economy is growing above its structural trend, we are in the expansion phase of the cycle. If we dip below that trend line, we might be heading into or already be in a recession.
So it's the gap between the actual data and the trend line.
It is. The challenge is they are not perfectly regular, which makes them inherently harder to model than the next component. The seasonal component.
The seasonal component is probably the easiest one to wrap your head around, right? Because it's just pure calendar math.
It is. It's the predictable repeating pattern tied directly to the calendar. Every single year, you can predict with high confidence that retail sales will spike around the holidays.
Or that housing starts will dip in colder climates in the winter.
Exactly.
Right.
Or agricultural output patterns. This component is highly predictable and, crucially, it must be removed from the data before you can properly analyze the trend or the cycle.
Because if you don't remove seasonality, you are comparing apples to bowling balls. You might think the unemployment rate suddenly dropped a lot in December.
But really, that's just temporary retail hiring for the holidays. It happens every year.
So you have to adjust for it. Once it's removed, you can compare this December's job numbers to last December's job numbers without that calendar distortion getting in the way.
And finally, after all that, we have the statistical mop-up crew, the irregular or random component. This is the genuine randomness, the unpredictable short-term volatility that remains when you've stripped away the trend, the cycle, and the season.
So a sudden political event, an unseasonal hurricane hitting a major port.
A big factory fire, or just sampling error in the statistics themselves.
It's the part of the data that modelers cannot and really should not even try to predict. It is the purest form of noise.
Exactly.
So we have these 4 buckets: the trend, the cycle, the seasonal, the irregular. Why does this systematic decomposition matter so much? It feels like we're creating complexity where we could just try to fit one massive model to the raw data.
Well, it's incredibly practical, and the sources highlight 2 major reasons why. First, it allows forecasters to identify the underlying economic forces that are driving each component.
Okay.
So if you see volatility in the data, decomposition lets you diagnose the cause. Is it a short-term random shock? That's the irregular part. Is it just predictable calendar behavior? That's seasonal.
Yeah.
Or is it something much more serious, like a structural failure of productivity? That's the trend.
So if you see a dip in aggregate demand, you need to know why.
Huh.
Is it because people are just postponing purchases until after the new year, which is seasonal? Or is it because the central bank hiked interest rates too high, which is cyclical? Without decomposition, you can't know the proper policy response.
Absolutely. You'd be guessing. The second major benefit is that it allows them to improve model specification. You can't use a demographic model. It's optimized for 30 years of population change to predict next quarter's inventory cycle.
You need different tools for different jobs.
You need separate statistical tools tailored for each component. You might use sophisticated time series analysis for the cycle, a simple index for the seasonal data, and a long-term growth regression for the trend. By addressing each force individually with the right methodology, the overall forecasting model becomes far more accurate and robust.
So it's the difference between trying to fix a complex machine with just one wrench versus having a tailored tool for every single moving part.
That's a perfect analogy.
Okay, so we've isolated the trend, we've separated it from the other noise, but now we hit what is, I think, arguably the most crucial and philosophically challenging section in your source material. This is section 8. It's the debate over the inherent nature of the economic path, deterministic versus stochastic.
It is.
This is the debate that defines whether shocks, crises, booms matter permanently or just temporarily.
What's fascinating here is that this is about the underlying sort of metaphysical assumption you make about how the economy works. Are we on rails, destined to get to a certain point? Or are we constantly making tiny random adjustments that change our destination forever? The answer changes everything about how you react to a crisis.
Let's look at the sort of optimistic view first. Deterministic trends. The source defines these as possessing a fixed functional form. The economy is bound to a predetermined path, whether that path is a straight line, which is linear, or a gentle curve, which is exponential.
The key behavioral implication in this model is that external shocks, a sudden, unexpected event like a financial crisis, a natural disaster, or a temporary policy error, they have only temporary effects.
Okay.
The series will eventually, inevitably, revert back to its predetermined trend path.
This is your boat on a fixed track analogy. A big wave can knock it off course for a bit, but the track is still there, and the boat will eventually get back on it.
Exactly. And for much of the post-World War II era, many mainstream economists believed the U.S. economy was deterministic in this way. A recession was seen as a temporary deviation. The underlying forces of technological progress and labor growth were so strong that the economy would always naturally return to its steady 3 or 4% growth track.
So the shock, the recession, it might cause a lot of pain for a couple of years, but the long-term forecast isn't fundamentally damaged.
Right. When the shock is removed or fades, market forces or just inherent capacity will quickly pull the economy back onto the rails. So you forecast based on that fixed line, assuming we'll eventually catch up to it.
An assumption like that, though, it tends to breed a certain kind of policy complacency during slowdowns. If you truly believe the economy will just fix itself, you might delay intervention.
Precisely.
Yeah.
Now contrast that with the second personality, which gained immense traction after the persistent economic crises of the 1970s and, of course, the 2000s, stochastic trends.
This is the idea of the random walk with drift. The trend is not fixed. It actually evolves randomly over time, continuously taking input from past events.
And this is where the implications become truly profound. With a stochastic trend, shocks can have, and often do have, permanent effects. An unexpected event doesn't just knock you off course temporarily, it shifts the entire baseline. It creates a new, permanently lower or higher path for all future predictions.
The economy has memory.
The economy has memory. That's the perfect way to put it. The path you've walked determines where you can go next.
So if a major shock, let's say the financial crisis of 2008, leads to 5 years of really high unemployment,
Right.
those years might permanently reduce the skill level of the workforce. People's skills atrophy. They cause workers to drop out of the labor force permanently, and it reduces the rate of capital investment because companies are scared.
And that damage is structural. It is permanent relative to the old trend line. The economy doesn't just bounce back to where it should have been if you extrapolate it from 2007. It establishes a new, permanently lower growth trajectory starting from the low point of the crisis. The shock itself changed the underlying structural capacity of the economy.
We hear this called hysteresis sometimes.
That's the term, yes. The idea that the short-term cyclical event leaves permanent long-term scars on the trend.
This is where the distinction stops being academic and starts driving national policy. The forecasting implication is just immense. If you assume a trend is deterministic, but it's actually stochastic.
You will consistently, year after year, underestimate the persistence of negative shocks. You keep predicting that the economy will catch up to the old trend line, and you will be wrong every single time.
This was a major criticism leveled against forecasters in the 2010s, wasn't it?
It was a huge debate. Many models, especially institutional ones, assumed the trend was deterministic. They were expecting this rapid V-shaped recovery post-2008 that would quickly get us back to the pre-crisis growth path.
And it just never happened.
It never happened. The economy settled into a much slower new trend. And analysts had to eventually realize they had fundamentally misidentified the trend as deterministic when the crisis had, in fact, caused a permanent stochastic shift downwards.
And I guess the reverse is also true. If you assume a trend is stochastic when it's really deterministic, you might overreact to temporary events.
Yes, you might implement massive unnecessary policy interventions when the economy was actually already on track to self-correct, causing inflation or other distortions.
So getting this right is the difference between temporary and permanent prediction errors. And it informs everything from monetary policy, how aggressive should stimulus be, to government spending decisions. It's not just about drawing a line, it's about understanding the underlying mechanism that dictates how the economy recovers from external hits. So the analysis requires this deep, almost philosophical judgment call before you even start running the numbers. But okay, once that judgment is made, how do we actually pull this theoretical, often invisible trend line out of all the messy economic data?
So Section 9 of the sources introduces the practical toolkit. Since we know the trend is the signal we're looking for, we need sophisticated mathematical filters to isolate it from the cyclical and irregular noise. The methods, they range from the highly simple to the mathematically quite intricate.
Let's start with the most obvious one, the baseline assumption. Method 1, linear trend models.
This is your straight line. The simple least squares regression of the economic variable, let's say real GDP, against a time index. Its value proposition is its simplicity and its crystal clear interpretability.
Right.
It gives you a single average rate of growth over the entire period you're looking at. It's incredibly useful for quick analysis and for setting a parsimonious, a simple baseline.
But economic growth is rarely a perfect straight line. New technologies or periods of high investment tend to lead to accelerating growth, or periods of stagnation lead to decelerating growth. A straight line just misses those fundamental shifts in the rate of change.
It does, which is why we often have to move to method 2, polynomial trends. These use higher order equations, quadratic, which creates a U or an inverted U shape, cubic, and so on. They capture these nonlinear growth patterns, allowing the rate of growth itself to change over time.
So, for example, if you were modeling the adoption curve of a major technology, like computing power or broadband penetration.
The S-curve.
Exactly. The initial growth is slow, then it accelerates rapidly, and then it eventually levels off as the market gets saturated. A linear model would be terrible for that, but a polynomial trend could fit that S-curve perfectly.
It could. However, we have to introduce a warning here, and this foreshadows the challenges section we'll get to later. Using a polynomial of very high order, say an 8th degree polynomial, can fit the historical data too perfectly.
It starts tracing the wiggles.
It starts tracing the wiggles. It essentially incorporates the cyclical and even the irregular noise into the trend itself. This is a classic source of a problem called overfitting.
Okay, we'll definitely come back to that.
Yeah.
But that brings us to a much older, simpler smoothing technique. Method 3, moving averages.
Right. A moving average, or MA, just calculates the average of the series over a specified window of time, say 12 months or 200 days for stocks, and it constantly updates that average period by period. The core function is to aggressively smooth out short-term fluctuations.
It's excellent for revealing the underlying path of highly volatile data, like stock prices or commodity costs. The 200-day moving average is famous for acting as a stabilizing anchor, ignoring all the day-to-day noise.
But there's a critical limitation here, which you have to understand, and that's the lag. A moving average always lags the current movement.
Right, because it's still averaging in old data.
Exactly. If the true trend shifts fundamentally today, a 12-month moving average will take many months to fully reflect that shift because it's still incorporating 12 months of old, now irrelevant data. So for real-time analysis, moving averages are often just too slow to be useful.
So if the trend is subtle, or if the analyst needs to separate the trend from the cycle with more precision than a simple average can provide, we move to the statistical heavy hitters. Method 4. Filtering techniques.
This is where we get into advanced statistical processes, often called high-pass or low-pass filters, much like the ones used in audio or signal processing. The most famous example in macroeconomics is the Hodrick-Prescott filter, or the HP filter.
I often hear the HP filter mentioned in policy papers and academic work. How does it work conceptually without getting as too deep into the math?
Conceptually, it views the observed economic data as a combination of a smooth trend and a noisy cycle. The filter then mathematically minimizes the sum of two conflicting pressures. First, it tries to minimize the volatility of the cyclical component. It's trying to keep the cycle small. But second, it tries to minimize the volatility of the trend component itself. It's trying to keep the trend line very, very smooth.
So it's a balancing act. It's a trade-off between making the cycle volatile and making the trend smooth.
Precisely. And this is the crux of the judgment call. The analyst has to choose a smoothing parameter, which is often called lambda. If the analyst sets lambda very high, they're placing a huge penalty on a non-smooth trend.
So it forces the trend line to be almost perfectly straight.
Right. And this results in the cyclical component becoming extremely volatile because all the wiggles get assigned to the cycle. But if they set lambda very low, they allow the trend to be much less smooth, absorbing much of the historical volatility into the trend line itself.
So the output, the perceived growth trend of the entire economy, is fundamentally dependent on a single choice the analyst makes about how much smoothing is appropriate. This connects the abstract math directly back to that human element we talked about in Part 3. The choice of lambda determines whether they believe the volatility they see in the data is temporary noise, the cycle, or a permanent structural change in the trend.
It's a powerful illustration that these tools don't generate objective truth. They generate estimates based on pre-programmed analytical assumptions.
So we've decomposed time, we've debated the nature of the trend, and we have the toolkit to isolate it. Now, let's tie it all back to the essential goal: predicting the future. Section 11 in the sources clarifies what's called the dominance principle.
Right. And this principle simply states that these different components are not equally important across all time horizons. Their importance shifts dramatically depending on how far out you're looking.
For the long run, the rule is crystal clear. Trend dominates long-run forecasts. We're talking beyond 5 and certainly beyond 10 years. Over that kind of horizon, the trend is the forecast.
Think about a public pension fund trying to forecast its necessary funding levels for the year 2060.
A huge long-term problem.
Huge. They have to assume a rate of return on their investments based on long-term economic growth. Do they care if there's a recession in the year 2035? Minimally. Over 3 or 4 decades, the effects of a 2-year recession are just statistical noise.
What they care about is the average rate of productivity growth and demographic change over that entire period.
That's it. If the trend is structurally 2%, the pension plan has to be fundamentally different than if the trend is structurally 4%. The trend provides the anchor, the baseline expectation for all long-term planning, whether it's government debt, climate adaptation, or corporate strategic investment.
Conversely, the rule changes dramatically for the immediate future. Cycles dominate short-run fluctuations. Day-to-day, month-to-month, or year-to-year predictions rely heavily, almost exclusively, on modeling business cycles.
Right.
If you're a CFO at a company and you're forecasting your inventory requirements or capital expenditure for the next 18 months, you need to know exactly where the economy is in its expansion or contraction phase.
The cycle dictates the near-term velocity and, crucially, the turning points. Is the economy running hot, above capacity, signaling inflation and a possible correction? Are credit conditions tightening, indicating a slowdown is coming? These cyclical dynamics are what determine short-term corporate profitability and dictate the immediate direction of monetary policy.
And if you miss the cyclical turn, if you think an expansion is going to last another 3 years when it's actually about to turn into a contraction, your short-term forecast will be completely and disastrously wrong.
Utterly wrong.
So, accurate forecasting is never a single mathematical output. It's a required 2-part process.
Precisely. Part 1 is the foundational work, the correct identification of the trend. This determines the long-term anchor. And getting this wrong, well, it poisons the well for everything that follows.
And part two is the active, constantly updated modeling. The proper modeling of cyclical dynamics. This determines the short-term movement around that anchor. A strong forecast successfully integrates both of these.
And it has to understand that these forces are driven by separate mechanisms. Productivity for the trend, monetary policy, and inventory for the cycle. And they must be modeled accordingly.
Right.
If your trend analysis is wrong, let's say you believe the economy can grow at 3% when it can only structurally sustain 1.5%, then your cyclical model will systematically predict runaway inflation and unsustainable conditions. It will think the economy is operating far above capacity when it's merely operating normally.
So the forecast is only as good as its anchor.
It really is. It's the difference between knowing the average altitude of an entire continent, which is the trend, and knowing whether you're climbing or descending a particular hill today, which is the cycle. You need both pieces of information to navigate. But even with all these sophisticated tools, these filters, and these decomposition models, trend analysis is notoriously difficult. Section 12 provides a necessary dose of reality. It highlights the inherent fragility of long-term prediction. This is where the clean world of statistics meets human error and just completely unpredictable events.
This is a critical section for you, the learner. Because if you understand these pitfalls, you can spot the weaknesses in any economic forecast you read. So let's start with the largest potential destabilizer, the event that can instantly render all previous modeling obsolete. Challenge 1, structural breaks.
Structural breaks are major fundamental shifts. These are events like deep technological revolutions, permanent changes in trade policy, catastrophic wars, or even a sudden pervasive shift in societal preferences, like the move toward remote work we saw recently.
They fundamentally change the slope or the intercept of the existing trend. They break the model.
They break the model. The implication is massive. If a forecaster misses a structural break, their entire long-term prediction is anchored to obsolete data. They are using the old 3% growth trend when the economy's new structural reality is perhaps 1.5% because of an aging workforce or lasting productivity stagnation.
What's a classic historical example?
Think of the 1973 oil crisis. That fundamentally changed energy costs, which then permeated through the entire global economy, leading to a long period of lower productivity growth. That was a structural break. If you continued using a pre-1973 trend line for your forecasts, you would have wildly overestimated economic capacity for the next 2 decades.
And the sources imply that recognizing a break like that is incredibly difficult because it just looks like a temporary but very severe recession in real time.
It does. It's only years later when the economy fails to revert to the old trend that the analysts can finally confirm that a break has occurred.
So you can only be sure long after the damage from the bad forecast is done.
Confirmation often requires statistical tests, like the Chow test, which checks whether the coefficients of a model have significantly changed before and after a suspected date. But by the time the break is confirmed, trillions of dollars may have been misallocated based on that phantom growth trajectory.
Okay, moving on to a purely mathematical pitfall. Challenge 2, overfitting trends. This relates directly back to those powerful polynomial models we discussed earlier.
Right. Overfitting is the statistical sin of creating a trend model that fits the historical data too perfectly. It does this by incorporating the short-term noise, the irregular and the cyclical components into what is supposed to be the fundamental long-term signal.
So if the model uses a high-order polynomial to hug every tiny wiggle in the historical data, it's confusing temporary market volatility with fundamental economic forces.
It's essentially modeling the shadows on the cave wall instead of the object casting the shadow.
And the risk here?
The risk is severe. Overfitting guarantees poor out-of-sample forecasting. The model might look brilliant historically, but when you project it forward, it will wildly extrapolate based on noise that has no bearing on the future whatsoever. A simple, robust, linear model that explains 90% of the long-term movement is almost always better than a complex, overfitted polynomial that explains 99.9% of the past.
Simpler is better.
Parsimony triumphs over complexity in forecasting, every time.
Finally, let's look at the human element again and the choices analysts make. Challenge 3, sensitivity to data decisions. Trend estimates are surprisingly fragile and sensitive to choices made by the analyst before they even touch the model.
The first and most important of these is the sample period. The choice of starting and ending dates for your analysis can profoundly change the estimated trend slope.
How so?
Well, if you choose a sample period that starts after 1982, a period known in economics as the Great Moderation, which was characterized by low volatility and high stable growth, your estimated trend will look highly stable and robust.
But if you start your analysis in 1965, you're capturing the volatility of the late 60s and the high inflation and sluggish growth of the 70s.
And your average trend will look much lower, and the volatility around that trend will be much higher. The analyst's choice of data window effectively defines their reality of what normal economic growth and volatility even look like.
So if you only look at the last 10 years, which featured historically low interest rates and massive government stimulus, you might mistakenly assume that slow, debt-fueled growth is the new long-term trend, rather than an aberration from a much longer historical average that included periods of more rapid, structurally driven growth.
It's a huge problem. And tied directly to that are data revisions.
Right. The numbers themselves change.
The numbers change. Economic data, particularly for key metrics like GDP and productivity, are just estimates. The initial prints are often revised months or even years later as more information comes in.
And trend estimates are highly sensitive to these official revisions.
Very sensitive. A slight upward revision to historical productivity figures can slightly increase the entire slope of the long-term trend line. This slow correction, which often goes unnoticed by the public, can fundamentally shift the perception of structural growth capacity, sometimes enough to change a major policy conclusion or an investment thesis.
So this deep dive really reveals that even after using the most sophisticated mathematical filters, the quality and accuracy of the forecast ultimately hinges on the analyst's careful judgment regarding the relevant historical period, the possibility of structural breaks, and the discipline to avoid overfitting the historical data.
It's as much art as it is science. Hashtag outro. We've covered a vast amount of complex ground here, moving from the conceptual basis of long-term movement to the practical minefield of applied statistics in forecasting.
So to summarize the essential insights for you, the learner. First, remember, the fundamental task is separating the long-term trend, which is driven by structural capacity, capital, and productivity, from the short-term noise.
That's the cycle, the season, and the irregular components.
Second, the single most crucial analytical distinction for predictive accuracy lies in identifying the trend's personality. Is it deterministic, meaning shocks are temporary and the system reverts to a fixed path?
Or is it stochastic, where shocks are permanent, setting a new, lasting baseline? Your entire policy response depends on getting that answer right.
And finally, remember that the accuracy of medium and long-run forecasts hinges almost entirely on accurate trend identification. If an analyst misses a structural break or overfits their model, their long-term view of the economy is fundamentally flawed, no matter how accurate their short-term cyclical model is.
Which brings us to our final provocative thought, building on the source's emphasis on structural breaks and sample period sensitivity. We've seen that trend analysis is highly sensitive to the historical data used. So consider the implication of our current environment.
Okay.
If globally disruptive events, such as the massive acceleration of AI adoption, the permanent reshaping of global supply chains due to geopolitical conflicts, or a lasting post-pandemic shift in labor participation, if these represent not temporary blips, but confirmed structural breaks.
Is the current body of economic trend analysis relying too much on data from the previous era? Are we still subtly, maybe unconsciously, assuming a deterministic trend from the post-Cold War globalization period?
When the world has actually entered a permanent, new, possibly slower, or maybe far more volatile stochastic growth regime, a regime defined by deglobalization and rapid, unequal technological disruption.
That is the core question facing forecasters today.
It is, distorting our long-term outlook for the next decade because we haven't acknowledged that a structural rupture has occurred is the biggest risk in economics right now. The past may no longer be a good predictor of the future, and identifying that boundary is the current frontier of economic analysis.
Thank you for submitting this absolutely fascinating source material. We hope this deep dive into the foundations of economic trend analysis gives you a real shortcut to understanding the forces shaping the next few decades and helps you scrutinize the forecasts you see every day.
Until next time. Welcome back to the deep dive. You've shared your sources, a fantastic collection of articles, research papers, even some internal notes on a topic that really sits at this wild intersection of, well, psychology, finance, and just physical reality, real estate.
It really does.
And today we are going to try and cut straight through all the noise, all the headlines, to deliver the crucial and I think often surprising insights.
Absolutely, because real estate is, it's often seen as just another asset class, something you watch from the sidelines.
Right, like stocks or bonds.
Exactly. But as our sources today clearly demonstrate, it is so much more than a passive barometer of economic health.
Yeah.
It is, and this is the key word, an engine. It actively builds the economic booms and, well, it fuels the most destructive busts.
An engine. I like that framing.
Yeah.
So our mission today is to use all this material you provided to really dissect the dynamics of these real estate cycles and to move way beyond just looking at a price chart going up or down.
We have to.
We need to understand the fundamental drivers, and I think we'll spend a lot of time on the crucial and often toxic role of credit, and most importantly for you listening, how to identify the more sophisticated signs that can distinguish a genuinely healthy, sustainable market from one that's, teetering right on the brink of collapse.
And if there's one core insight, just one thing we want you to internalize right from the get-go, it is this. Property markets do not simply reflect the economic cycles that are already happening.
Okay.
They possess a unique structural mechanism that allows them to amplify those cycles. They take a normal, cyclical swing in GDP and they can turn it into a deep systemic event.
Okay, so let's unpack that exact mechanism. Over the course of this deep dive, we're going to structure our exploration into 5 core segments, just to keep it logical. First, we'll establish that unique amplifying link between property and the wider economy.
Why it matters so much.
Exactly. Second, we will meticulously map the cycle, walking through the characteristics of the 4 very distinct phases. Third, we'll zoom in on the true engines of change. We're talking money, credit, and of course, psychology.
The human element.
The human element, always. Fourth, we'll detail the key indicators and analysis that professionals actually use to gauge the market. And finally, we'll explore the intrinsic challenges of prediction in what is, let's face it, a uniquely volatile sector. So let's start right there with that fundamental truth that's established in all the material. Real estate is a highly cyclical sector. It moves, it swings, and those movements are, they're intrinsically tied to the overall health of the economy.
You can't separate them.
You can't. But before we get to that amplification piece, what are the intrinsic economic factors that our sources identify as the primary inputs? The foundational elements we absolutely have to monitor.
The material is really consistently clear on this. It identifies 4 core factors that exert the strongest, most measurable influence on the property cycle. These are the inputs that analysts use to anchor their models.
The big 4.
The big 4. First is household income growth.
Okay, that's intuitive.
Right. Then, employment levels. Third, interest rates. And fourth, and maybe the most important, credit availability.
So income growth and employment, those feel like the obvious, almost organic demand drivers. If I feel secure in my job, my salary's going up, I'm much more likely to think about upgrading my house or maybe buying an investment property.
That's precisely correct. That's healthy demand.
Yeah.
Those first 2, they really reflect the capacity and the confidence of the consumer. But the next 2, interest rates and credit, that's where the sector's unique volatility, its amplifying power, really originates.
So how do you separate those 2, interest rates and credit? They sound similar.
It's a great question. Think of it this way. Interest rates determines the nominal cost of the capital. It basically sets the price for the debt, what your monthly payment will be.
Okay.
But credit availability, that determines the possibility of the transaction happening at all. If the gates are just thrown wide open, we're talking low down payments, easy qualification, stated income loans, that easy money accelerates the cycle dramatically. It invites in speculative behavior.
Right. It's not about the price anymore. It's about whether you can get the loan in the first place.
Exactly. It's about access.
So let's pivot now to that core concept, the amplification effect. This is where we go from real estate as a barometer to real estate as an engine. Why does this specific sector have this unique, just outsized power to take a standard economic contraction, like a temporary dip in GDP, and make it so much deeper and longer lasting?
It comes down almost entirely to the financial structure of the asset class itself. Specifically, 2 things: high leverage and the immobility or illiquidity of the investment.
Let's really dig into that leverage mechanism, because I think it is the absolute key to understanding the volatility here.
It is. So just consider the math for a second. Let's say you buy a $500,000 property with a 10% down payment. So that's $50,000 of your own equity.
Okay, 50 grand in.
You are now 10 to 1 leveraged. So when prices rise by 10%, which is a $50,000 gain on the property, your initial $50,000 in equity has now doubled.
That's a 100% return on your cash.
100% return. And this is exactly what fuels the initial euphoria in what we'll call Phase A, the expansion. Everyone feels like a genius.
Of course. But the knife cuts both ways.
And it cuts deep. When prices fall by just that same 10%, a $50,000 loss in value, your entire initial equity is instantly wiped out. Your loss is 100% of your invested capital, and now you're often trapped by the debt because you're underwater.
So it's the financial structure itself that guarantees the volatility is going to be higher than, say, the consumer goods sector. I mean, I might see a 10% drop in my stock portfolio and feel disappointed, but it's just numbers on a screen. But if I'm heavily leveraged in my home, my biggest asset, and its value drops below my mortgage balance, I don't just feel poor. I am financially immobilized. I can't move, I can't sell, I can't refinance.
Exactly. And that immobilization is the very mechanism that freezes consumer behavior across the entire economy. And that's the crux of the macroeconomic relevance.
The ripple effect.
The ripple effect.
Yeah.
The sources are very clear that these real estate cycles influence general consumption and investment spending everywhere because for most people, their home is the primary source of household wealth and savings.
So if people are suddenly underwater on their mortgages, or they've just lost access to their home equity lines of credit.
They stop upgrading their cars, they put off major renovations, they delay investment decisions for their small business. That ripple effect compounds the economic slowdown. It spreads from housing into every other sector.
But I want to push back on that a little. Doesn't that high leverage stabilize the market in a certain way too, by locking people into these long-term mortgage contracts? Why is leverage always presented as purely detrimental to stability?
That's a powerful distinction, and it really touches on the psychological inertia. And you're right, in a way. The debt theoretically locks people in, making them less likely to panic sell during a minor dip.
Because they can't. Or it's just too painful to crystallize the loss.
Correct. But the systemic danger of that leverage just completely outweighs that stabilizing effect. The real risk isn't necessarily the individual selling at a loss. The real systemic risk is the individual defaulting. When a large segment of the population loses all their equity because of that 10% drop we talked about, they have much less incentive to keep paying a mortgage for an asset that's worth less than the debt, especially if they also lose their job in the ensuing recession.
And that's when the second half of the amplification kicks in.
That's the threat to the financial system.
Banking stability. If the asset class that represents the vast majority of bank balance sheets, which is mortgages, starts collapsing because of mass defaults, then the entire financial sector is immediately jeopardized.
Absolutely. Real estate cycles fundamentally affect banking sector stability. When a boom turns to a bust, the ensuing wave of defaults and foreclosures threatens the solvency of the lenders themselves.
What do? They circle the wagons.
Immediately. This forces them to swiftly tighten credit, and not just for housing, but for businesses, for car loans, for everything, which in turn exacerbates the recession because the flow of economic blood has just been cut off. It creates this brutal, self-reinforcing negative feedback loop.
This leads us to, I think, a crucial implication for anyone trying to analyze the economy. If real estate has this profound amplifying and even triggering effect, what does that mean for our standard economic forecasting methodologies?
The material really stresses this point. Ignoring real estate cycles leads directly to systematic forecast errors in macroeconomic analysis. It's almost a guarantee you'll be wrong.
How so?
Well, if you're relying on traditional models based on, say, manufacturing output or business inventory cycles, but you completely miss a massive underlying contraction in housing and credit, your GDP forecast will be fundamentally and often wildly wrong. The housing sector isn't just another component, it's a structural pillar holding the whole thing up.
So the mandate for accurate macroeconomic forecasts is clear then. They must incorporate housing market indicators and credit conditions as primary variables, not as secondary footnotes. You can't just look at the economy and treat housing as some kind of outlier.
Correct. Understanding where we are in the property cycle, the level of leverage in the system, the pace of price growth relative to incomes is absolutely essential for understanding where the general economy is headed in the next 12 to 24 months.
Okay, so now that we've established the structural power of the real estate sector, let's get practical. Let's map out the 4 distinct phases of the cycle. This is the toolkit the listener needs to identify exactly what phase they are observing, which, as the sources point out, is often far more complex than just looking at a price chart.
It is. So we begin with phase A, which we'll call the expansion phase. This is the initial recovery, the foundation building stage, and it's often built on a bedrock of cautious optimism.
And the economic context here is characterized by solid fundamentals, right? We're talking rising GDP, strong corporate earnings, and crucially, rising household incomes. People are just doing better.
Exactly. And that translates into increased demand for housing, both for utility, needing a bigger place, and as a conservative investment.
So what specific observable characteristics define this phase? What should we be looking for on the ground?
We look for 4 reinforcing signals. First, you'll see stable but accelerating property price growth. It's not frantic, it's solid. Second, you see the beginning of rising construction activity.
Permits and housing starts.
Exactly. Those start to increase, which signals developer confidence in future demand. Third, you see an increasing mortgage lending volume. But, and this is key often with relatively conservative lending standards, the banks are still cautious after the last bust.
They remember the pain.
They remember the pain. And fourth, you have strong but rational investor confidence. Investors in this phase are typically buying based on things like rental yield and solid long-term fundamentals, not on the hope of making a quick flip.
That rise in construction activity point is fascinating because it's such a clear leading indicator. It's a physical manifestation of optimism. Someone is literally digging a hole in the ground today because they project healthy prices and demand well into the future. It's a huge long-term bet.
It is, and that very long time lag is what creates the cyclical risk later on. During the expansion, the forecasting implication is that price growth is primarily demand-driven. It's stemming from actual measurable income increases and demographic shifts.
It's real.
It's real. But as this phase matures, there is an inherent psychological risk. Success breeds hubris. Over-optimistic projections inevitably start to creep into the market view, and they start eroding those cautious fundamentals. And that sets the stage perfectly for the next phase.
Which transitions us to phase B, the peak. This is the warning phase, the transition point where that rational, demand-driven growth starts sliding into a speculation-driven frenzy.
Exactly. The defining feature of the peak is that real estate prices begin rising significantly faster than the underlying fundamentals can possibly support them.
They decouple.
They completely decouple from metrics like average wage growth or sustainable rental returns. This is the point where the market price ceases to reflect intrinsic value and instead just reflects pure momentum.
So what are the 3 critical red flags that our sources identify? The signals that just scream, this is fundamentally unsustainable. We need to be specific for the listener here.
The material points to an unholy trinity. First, significant overvaluation. Prices are just too high relative to historical norms, to affordability metrics like the price-to-rent ratio, and to income levels.
Okay, that's number 1.
Second, high, often extreme, leverage across the market. The prevalence of 95% or even 100% loan-to-value mortgages. This indicates that marginal, highly vulnerable buyers are entering the system, and they're being powered by that easy credit we talked about.
And the third?
A surge in speculative buying. Investors are no longer buying for long-term cash flow. They're chasing rapid, short-term appreciation, often relying on a quick resale to the next person in line.
That speculative element is almost entirely psychological, isn't it? It's driven by this collective belief that prices will always go up faster than anything else. You start hearing the anecdotes.
Oh, yeah.
People quitting their day jobs to flip houses, or barbers and taxi drivers buying 3 pre-construction condos. That feeling that everyone is getting rich, that's the psychological fuel for the fire.
It is pure momentum and herd mentality. And this psychological frenzy has a very real physical consequence. The physical supply overhang.
Right, the buildings that were started back in the expansion phase?
Exactly. By the time the market hits the peak, that massive construction activity that was started during the more ambitious part of the expansion phase begins to mature. Construction supply often begins to exceed the long-run structural demand, flooding the market with new units right as underlying demand starts to weaken.
The timing is just perfect in the worst possible way.
It couldn't be worse.
The peak is so tricky because that feeling of wealth and success is still so pervasive. So what is the main forecasting challenge in that moment?
Well, the difficulty is identifying exactly when the price dynamics become truly unsustainable. The momentum is just so strong that the market can appear to be rationally correcting even when it's not.
So forecasters struggle to pinpoint that inflection point.
They do, because speculative belief, the sheer force of confidence, can keep prices levitating much longer than any rational model would predict. That belief, not economics, is controlling the short-term trajectory.
And when that momentum finally breaks, which is often triggered by something like a rate hike or a sudden credit tightening, we enter phase C, the recession or contraction phase. This is where that structural amplification effect really makes its presence felt.
It really does. The decline in overall economic activity, a recession or a slowdown, it reduces housing demand significantly, often because financing dries up at the exact same time. People pull back on major purchases, or worse, they start losing their jobs, often in those same highly levered sectors like construction.
And what are the typical observable effects we see on the ground during this contraction, the things that reflect both the financial distress and that physical supply overhang we mentioned?
You see a sharp acceleration in falling property prices,
Yeah.
often starting with the most speculative, highly leveraged segments of the market first. Crucially, you observe a dramatic rise in vacancy rates, reflecting that glut of supply that came online just as demand vanished.
The new apartment buildings sit empty.
They sit empty. You also see reduced construction activity, which is pervasive. Permits dry up completely because developers are now facing steep losses. And finally, the lifeblood is cut off. Credit tightening becomes severe as banks, now facing high defaults, become incredibly cautious and raise their lending standards dramatically.
Our sources stress that real estate downturns are often deeper and longer lasting than the general GDP recession. I mean, this is the ultimate proof of that amplification effect, isn't it?
It is. The sources point out that property is illiquid and sticky. It takes time for sellers who are psychologically resistant to accepting a lower price than their neighbor got 6 months ago to adjust their expectations.
Nobody wants to be the first to sell for less.
Nobody. And more importantly, it takes years for that excess supply, those massive speculative apartment blocks or suburban developments, to be fully absorbed by the market. This long adjustment period means the downturn drags on, continuing to pressure household balance sheets and consumption long after the manufacturing sector, for instance, might have already begun to stabilize.
Which brings us, finally, to phase D, the trough. The market hits bottom, characterized by maximum pessimism.
This is the quiet phase. It's the moment of painful price discovery and very slow stabilization. The market reaches its lowest point in terms of transactional volume, but also, critically, in terms of sentiment. The good news is the healing process has begun. It's just often unnoticed by the wider public.
So what are the stabilizing features that signal the trough is truly in place, that the risk of a further collapse has really subsided?
Okay, first, the key stabilizing feature is that the rate of price decline begins to slow down. Prices might not be rising yet, but the frantic, panicked falling slows or stops completely.
It finds a floor.
Finds a floor. Second, because of that severe lack of construction permits during the contraction phase, new supply has been significantly reduced. This allows the slow, organic return of demand, which is driven by underlying demographic need, to start catching up to the existing, now fixed supply.
And a third signal.
You see the gradual, quiet return of investor confidence. And this is often highly sophisticated contrarian capital. These are the people who see the suppressed valuations as genuine long-term opportunities.
So while the trough feels absolutely terrible for anyone caught in it, it actually creates the best, lowest risk opportunities for recovery-based forecasts, anticipating that next expansion phase. It's the cycle resetting itself because all the excess has finally been purged.
Absolutely. Understanding these phases allows you to analyze the underlying dynamics of supply, demand, and sentiment, which is far, far more useful than simply watching a nominal price trend on a chart.
Okay, so we've mapped the journey. Now let's shift our focus entirely to the engines that actually drive us through those volatile phases. Because if we know what fuels the volatility, we can better predict the movement. And the sources, they focus heavily on one element above all others: money and the conditions around it.
That's right. Driver number one is the central role of interest rates and credit conditions. This is the most sensitive lever in the entire system.
Let's break that down. Let's talk about the direct correlation with benchmark interest rates first. How precisely do central bank movements influence the real estate market? And what are the dual mechanisms at play?
Well, lower rates act as a massive stimulus. They do two things at once. They increase affordability and they increase investment returns simultaneously.
Okay, let's take affordability first.
On the affordability side, lower rates mean lower mortgage payments for the same principal amount. It's simple math. This immediately expands the pool of eligible buyers, and it increases the amount of money people can afford to borrow while keeping their debt-to-income ratio, or DTI, within the bank's limits.
So more people can afford to buy, and the people who could already afford to buy can now afford to buy more.
Precisely. And what about the investment side? For an investor, lower rates increase the potential return on their investment. Real estate, especially commercial or rental property, is often valued based on its capitalization rate relative to the cost of borrowing. When borrowing costs are low, property starts to look highly attractive compared to other low-yield assets like government bonds.
So capital floods into the sector.
It floods in, driving prices up.
And the reverse effect, higher rates, is obviously just as powerful in suppressing demand.
Dramatically so. And the effect is almost instant. Higher rates increase borrowing costs, which immediately shrinks the amount people can afford to borrow under those standard DTI calculations. This immediate shock to affordability translates directly into a drop in transactional volume and eventually a reduction in prices as sellers have to adjust to a much smaller pool of qualified buyers.
But rates, as you said, aren't the sole mechanism. We have to talk about the credit conditions, the lending standards themselves. This is, I think, perhaps the most dangerous accelerator because it's a non-price factor that can completely change the market structure overnight.
This is the crucial driver of the market's extremes. The sources emphasize that lending standards affect the severity of booms and busts even more than interest rates alone.
So easy credit, what does that look like?
Easy credit means lax qualification standards, minimal documentation layer loans, low or zero down payments, and complex exotic loan structures like interest-only or adjustable rate mortgages. It fuels the boom by allowing marginal, highly vulnerable buyers and hyper-leveraged investors into the market. It just widens the funnel dramatically.
And when that credit tightens, the market suffers an immediate catastrophic seizure.
Precisely. Tightening credit, whether it's forced by regulatory changes or triggered by banks becoming fearful of increasing defaults, it instantly triggers the bust. Suddenly, even healthy buyers who might qualify for a loan under normal circumstances can't get financing, and the entire transaction market just stalls, regardless of what the property price index says.
If we connect this to historical cycles, not just here but globally, what's the consistent lesson we learn about that combination of cheap money and loose credit?
The historical lesson is stark, and it is unrelenting. Major real estate booms almost always coincide with prolonged periods of easy credit and historically low interest rates. But the resulting busts are typically sharp, sudden, and critically, they are associated with systemic financial instability. That combination, cheap money and loose lending standards, is the single most reliable precursor to a major financial crisis-level market correction.
Okay, so moving beyond those purely financial triggers, let's look at the more structural and, you could say, psychological factors. Driver number 2 in the sources includes demographics and expectations.
That's right. Demographics provide the underlying, long-term, non-cyclical support for demand.
What do you mean by non-cyclical?
I mean, it's independent of the business cycle. We're talking about predictable macro forces like population growth, net migration into a country or city, and the massive generational shift of people forming households for the first time.
So millennials or Gen Z moving out of their parents' basements.
Exactly. These factors define the long-run structural need for housing in a given region. So even if the economy dips into a recession, if your population is fundamentally growing, that underlying pressure for housing eventually ensures the market will recover. It sets a firm floor beneath the market.
But the ceiling, and maybe the speed at which we hit it and then blow right past it, that's defined by psychology, by expectations.
That's the speculative element. It's the ghost in the machine. Price expectations drive speculative cycles far more than any cold, hard analysis does. When buyers and investors start believing that prices will rise indefinitely, when they just project the last 5 years of 10% gains into the next 5 years, that expectation itself feeds the momentum.
It becomes a self-fulfilling prophecy.
Completely. People rush to buy today to avoid the perceived higher price of tomorrow, and in doing so, they often overlook fundamental calculations of affordability or actual investment return.
So this behavior is what pushes the market past any rational fundamentals. You are no longer buying a property based on what it's worth to you in utility or what it can generate in cash flow. You are buying based on the certainty that the next greater fool will pay even more for it.
And this momentum, this overriding of rational behavior by mass psychology, is precisely why that forecasting challenge during the peak, phase B, is so incredibly difficult. Rational fundamental models will suggest that prices should normalize, but sentiment and expectation-driven speculation just overrides that rationality, pushing the cycle further than anyone expects, right up until that financial trigger is pulled.
Okay, so for the learner, the goal here is to quickly get a handle on which data points matter most and, crucially, when they matter. We need to distinguish clearly between the signals that warn of the future and the signals that merely confirm the present. So let's talk about leading, lagging, and trigger indicators, which are just fundamental to market timing.
This separation is absolutely critical for any kind of actionable insight. First, let's talk about the leading indicator. Our sources point squarely at construction activity, specifically permits and starts as the primary early warning signal of future supply shifts.
So why are construction permits the strongest leading indicator rather than, say, unemployment or something like that?
Because they show changes in future supply and, just as importantly, developer confidence early. Permits are decisions made today based on a perceived demand 12, 18, even 24 months in the future.
It's a bet on the future.
A huge bet. A sustained sharp drop in permits today signals that less inventory is coming online down the line, which predicts a future tightening of supply and potentially a recovery in prices. Conversely, a big spike in permits signals aggressive confidence, which could potentially lead to oversupply. It essentially tells you what developers who are making massive capital bets think the market will look like when their project is finally completed.
Fascinating. Now let's talk about the lagging indicators. These are the pieces of information that confirm something has already happened, which means they help us explain the past, but they're not necessarily good at predicting the immediate future.
And the most dangerous lagging indicator, the one that fools the most people, is property prices themselves.
Really? That seems counterintuitive.
It does, but think about it. Prices may peak several months after actual economic activity has already peaked. This is because sellers are notoriously slow to accept falling demand. They have what's called sticky expectations.
Anchored to the last sale on their street.
Exactly. And prices often recover slowly after recessions because it takes so much time to absorb all that excess inventory and to rebuild buyer confidence. So when the media finally reports the housing market has peaked, that peak is often long in the rearview mirror. Smart money is already moving on, looking for opportunities in the trough phase.
And finally, we have the trigger indicator, the thing that flips the economy from a state of stability into that downward decline spiral.
Crucially, housing market stress can act as this trigger, initiating or accelerating broader economic downturns. We're talking about critical mass events here. A measurable surge in high default rates across the board, a sudden, sharp, unexpected drop in home equity, or a simultaneous freezing of the mortgage-backed securities markets.
So when that stress infects the banking system,
It triggers the necessary credit tightening that all but guarantees a recession, proving the housing market's unique macroeconomic role as both a driver and a consequence of the broader economy.
Okay, so if we want to conduct a really thorough real estate cycle analysis, what specific comprehensive data points should a professional be monitoring constantly according to the material you've provided?
To get a truly comprehensive understanding, one that separates the speculation from the fundamentals, you need a mix of metrics that cover prices, activity, and finance. The required list includes, first, housing price indices to track pure appreciation. Second, those construction permits and starts we just discussed, the key leading indicator of future supply. Third, mortgage rates and credit volumes, which is your financial fuel gauge. Fourth, vacancy rates, which are critical for measuring the supply and demand balance, especially for rental property.
And that leads to the last one.
And fifth, rental price indices, because they reflect the true operational cash flow and the utility demand for housing.
The combination of vacancy rates and rental price indices seems extremely powerful for separating speculative markets from markets with real utility value.
Oh, absolutely. If you see vacancy rates rising while rental prices are stagnant or even falling, that is a clear, undeniable sign that physical supply is catching up to or even exceeding long-run demand. And that's true irrespective of what the sales prices are doing.
Because sales prices can be juiced by cheap credit.
Exactly. Sales prices often reflect leveraged speculation and tax benefits, whereas rental prices reflect the true utility value of that asset to the end user. Monitoring both prevents an analyst from being fooled by temporary, financially engineered exuberance.
So let's shift gears to how the professionals actually try to model this incredibly complex interaction. Given all the volatility, what forecasting methodologies are commonly used and what are the limitations of each?
The sources list 4 primary structured approaches, each with a different focus. First, the most basic, we have time series models.
I'm guessing these are the entry-level models?
They're the simplest, yes. They basically analyze historical price indices and transaction volumes, and they project future trends based purely on past performance. So, for example, assuming momentum continues.
What's the problem with that?
They're useful for understanding the current trajectory and momentum, but they are fatally flawed when you're trying to predict turning points or the impacts of external shocks. They just assume the future will look exactly like the recent past.
Okay, so what's next? The more sophisticated leading indicator models.
These are significantly better for prediction because they focus on capturing the causal relationships. They use those key leading inputs we discussed, like changes in interest rates, credit growth, or employment, to project future outcomes. For instance, if credit growth accelerates significantly above GDP growth, the model flags a high probability of the market overheating 18 months later. It tries to capture the sequence of events.
The third approach sounds like the most comprehensive and technically complex, the econometric models.
These are large, complex systems designed to simulate the entire economic feedback loop. They link fundamental variables, income, employment, interest rates, all together to predict housing demand and supply responses. A crucial concept in these models is something called endogeneity.
Endogeneity, can you break that down for us?
It's the recognition that housing doesn't just respond to the economy. Housing also influences the economy. It's a two-way street. So these models use simultaneous equations to model this complex two-way relationship, allowing forecasters to estimate how changes in the housing market will ripple out into GDP, and vice versa.
That sounds like an attempt to capture that amplification effect directly within the math. But even these sophisticated models must have their limitations, right?
They do, primarily concerning the difficulty in accurately specifying all the relationships and parameters, especially the nonlinear ones. And they are still highly reliant on stable historical correlations, which, as we'll see, can be a big problem.
And finally, the essential risk management tool, scenario-based forecasting.
This is essentially stress testing. It's less about predicting what will happen and more about measuring vulnerability. It assesses the market's resilience under adverse yet plausible conditions.
So you'd model a worst-case scenario?
Exactly. For example, a stress test might model the impact of a sustained 300 basis point hike in mortgage rates combined with a 3 percentage point rise in unemployment. This exercise doesn't predict the next boom, but it is indispensable for assessing the financial stability of lenders and the systemic risk exposure of the entire market.
So we're using historical patterns, causal links, deep economic integration, and vulnerability testing to try and pin down a market that we already know is prone to irrational psychological behavior. It sounds like a constant battle between math and momentum.
It is, which brings us perfectly to our final challenge.
Yeah.
Why, despite all this sophistication, is forecasting in real estate still so notoriously difficult?
We've established that real estate is crucial, it's volatile, and it's deeply leveraged. But why is forecasting this specific sector so notoriously difficult, even when you're using these complex econometric models and comprehensive data sets?
Well, the sources outline 4 key forecasting challenges that are pretty unique to real estate, and they often relate to data or structural instability. The first one is the most damaging to historical models: structural breaks.
What exactly does a structural break entail in real estate modeling?
It refers to the difficulty of predicting sudden external events. Things like major unexpected policy changes, new mortgage regulations, sudden tax reforms, or a global financial crisis. These things fundamentally alter the rules of the market.
So when a structural break occurs,
The fundamental correlation coefficients between your key inputs like interest rates and prices, they change overnight. The historical relationships that your econometric model spent years mapping out are instantly invalidated because the governing rules of the system have shifted.
that makes the reliance on historical data inherently risky. The second major challenge relates to the highly localized nature of housing.
That's regional differences, and it's a constant headache for national analysts. Real estate markets are highly localized. National trends often mask vast and significant regional variations.
Can you give an example?
Sure. A boom in, say, Austin or San Francisco driven by a tech hiring surge might coincide with a deep, sustained stagnation in parts of the Midwest that's driven by industrial decline. So a national forecast predicting a 5% average rise might be completely accurate on paper, but it's practically irrelevant to 90% of the individual local markets that you actually care about.
You absolutely must monitor the cycle locally, not nationally. What about the physical nature of the asset itself? That must create some complexities with timing.
It does. Leads to the third challenge: long adjustment periods. Because building houses takes a significant amount of time, because the inventory of existing houses is massive and illiquid, the time it takes for supply to adjust to demand, and vice versa, means cycles can stretch out unpredictably.
So you could make the right call, but at the wrong time.
Precisely. You might correctly predict that rising rates will cause demand to drop, but the supply overhang from the peak phase keeps prices depressed for 2 full years longer than you expected. This time lag complicates short-term prediction, and it can drain capital from investors who are waiting for the trough to finally end.
And finally, there's the constant issue of data quality and measurement.
The fourth challenge is pervasive data issues. There is an inherent difficulty with data revisions and measurement issues, especially when you're trying to adjust for housing quality changes over time. Real estate is a non-standardized asset class.
So a new house today isn't the same as a new house from 1980.
Exactly. Is a higher average transaction price due to inflation, or did the mix of sold homes simply shift towards larger, newer construction? Getting clean, consistent data that truly reflects a like-for-like price change across a vast geography is surprisingly difficult, and it introduces noise and uncertainty into all of the forecasting models.
So we have unpredictable policy, localized reality, long time lags, and noisy data. Given all these hurdles, what is the key lesson, then, that forecasters must take away from historical real estate cycles?
The material reiterates this one crucial lesson over and over. Forecasts based solely on past growth trends are highly risky. The longer a market has grown exponentially, the more fragile it has become, especially in a sector that's driven so heavily by leveraged speculative expectations.
So you have to look past the momentum.
You must use the fundamentals, sustainable income growth, tight credit conditions, and a lack of supply overhang to check that momentum. Blind extrapolation of past performance is the surest route to missing the peak.
That is powerful advice. We must constantly be looking at the foundation and the mechanics, not just the facade of price growth. #Hag outro. This has been a really extensive deep dive into the architecture and, I guess, the pathology of real estate cycles. Let's briefly recap the critical takeaways for you, the listener, just to cement this new layer of understanding.
I think number one is to always remember the powerful amplification effect. Real estate is structurally engineered by leverage and illiquidity to magnify economic cycles. It makes downturns deeper and longer lasting than a general GDP recession.
Which means you have to elevate housing and credit analysis to the forefront of all your broader economic forecasting.
Absolutely.
The specific warning signs of a peak are not ambiguous, but they do require discipline to recognize. You have to look for that unholy trinity of significant overvaluation prices completely detached from incomes, high leverage, and rampant speculative buying. When prices are running far ahead of household wages, you are well into the danger territory of Phase B.
And finally, remember that the ultimate control lever is credit conditions. Monitor mortgage rates, yes, but more importantly, monitor lending standards above all else. Because easy credit is the fuel for the boom, and tightening credit, whether it's voluntary by the banks or involuntary through a crisis, is the inevitable trigger for the bust.
So what does this all mean as you consider your own regional market context? We've covered the idea that real estate downturns are deeper and longer lasting than GDP recessions, and that markets are highly regional. This raises a final, provocative thought for you to carry forward.
If localized markets have vastly different levels of supply overhang and credit stress, with one city, say, deeply in trough and another still peaking, how much longer can these regional housing markets afford to diverge before the systemic risk from the contracting areas forces the national financial economy to tighten its belt for everyone?
And remember that crucial time lag we discussed. Construction activity is a clear leading indicator, showing you future supply 18 months out. Price recovery is a lagging indicator, confirming stability only long after the economic recession has already begun. The significant gap between those 2 points, the lead time of supply and the lag time of price recovery, is where the biggest opportunities and the most persistent risks truly reside.
Thank you for joining us for this deep dive. We hope this has given you a clearer, more nuanced understanding of the profound forces that move the most valuable and most volatile asset class in the world. Okay, let's unpack this. Whenever you hear the Federal Reserve or, a major Treasury Department release a forecast, they're not just guessing.
No, not.
They're using these highly specialized tools to translate just massive amounts of data into actionable predictions about how the economy is going to behave.
Exactly.
And specifically, how sensitive is the economy to those inevitable downturns and upswings.
Right. And I think if you're listening to this, you're probably curious about the actual mechanics behind those predictions. We're trying to move past the general feeling of, things get worse in a recession and ask the real question.
Which is?
How do economists actually quantify the intensity of that worsening? I mean, how do they measure the precise vulnerability of, say, the housing market compared to something like essential utility spending when GDP growth starts to slow down?
That quantification, that's our mission for this deep dive.
Mhm.
We are diving into the dynamics of regression coefficients in economic cycles to really figure out the technical mechanism, the math, really, that turns this abstract theory of the business cycle into concrete policy recommendations.
It's the statistical backbone of modern macroeconomics. It truly is.
It really is.
And before we can even get into the coefficients themselves, we have to recognize the environment they're trying to model. I mean, all our sources are really clear on this.
Okay.
Economic cycles are not random events. They're systematic. They're recurring fluctuations in overall economic activity. They provide the necessary context for any of this analysis to make sense.
And we know the 4 phases, right? Expansion, peak, recession, and then recovery. But I think for an audience like ours, the key isn't just naming them.
No, it's understanding the dynamic pressure they place on different parts of the economy. That's the crucial point.
So what do those pressures look like?
Well, these phases generate very specific, measurable pressures. During an expansion, for example, you have demand often outstripping supply capacity. You have rising employment, and, often that comes with inflationary pressure.
And then the reverse for recessions.
The complete reverse. You have falling demand, you see increasing slack in the labor market, and often very sharp declines in investment.
And these cyclical movements, they hit the key macroeconomic variables that economists are always watching. These are the specific, measurable outcomes we're actually trying to predict with our coefficients.
We can group them into, let's say, 4 foundational categories. The first and most obvious is, of course, GDP.
Gross domestic product, the total output.
Right. And fluctuations in GDP are often used as the primary indicator of the cycle itself. Second, you have the health of the labor market.
So employment numbers and, more importantly, the unemployment rate.
Most pivotally, the unemployment rate. Then you get into the financial side of things.
The pricing mechanisms.
Precisely. That brings in inflation, which of course reflects price stability. And then perhaps the most cyclical components of all, investment and consumption. New machinery, new factories, it's notoriously volatile over the cycle. And consumption, especially what we call discretionary household spending.
Things you don't have to buy.
Yeah.
Vacations, new cars.
Exactly. That tracks the cycle very closely. Now, essential consumption, like groceries, that's more stable. So when we say we want to quantify cyclical exposure, what we're really trying to do is create a mathematical link between the movement of the overall cycle, often measured by GDP, and the resulting movement in these 4 outcome variables.
So if the 4 phases define the overall systemic movement, we need a tool that tells us how tightly linked everything else is to that movement.
Mm-hmm.
And that brings us to the statistical workhorse of econometrics, regression coefficients.
Right. And their function in this context is very, very specialized. They're there to measure the sensitivity and the co-movement of these outcome variables relative to the core cyclical drivers.
So they're quantifying how responsive, say, inflation is to a change in the output gap.
Precisely.
Yeah.
And they quantify 2 absolutely essential things for any kind of prediction.
The direction and the magnitude.
That's it. The direction tells us if the variable is pro-cyclical, so moving with the cycle, or counter-cyclical, moving against it.
Okay.
And then the magnitude. That's the true measure of intensity. It tells us whether the variable is just slightly elastic or if it's highly volatile when the cycle shifts.
And the crucial takeaway here, the thing that really dictates how policymakers design their response, is that these coefficients help economists understand just how sensitive an outcome variable is to changes in the business cycle.
Yes.
A high magnitude means high sensitivity, and that's where the policy pressure points are.
To expand on that sensitivity just for a moment, think about the difference between, say, investment in information technology versus spending on pharmaceuticals.
Very different categories.
Very different. IT investment is highly sensitive to corporate profitability, to future expectations, which are themselves highly cyclical. Pharmaceutical spending, on the other hand, is driven by inelastic health needs. It's far less sensitive.
So people need their medicine regardless of whether the economy is booming or not.
Exactly. So a properly constructed regression coefficient will generate a much, much larger magnitude for the IT investment equation than it will for the pharmaceutical spending equation. And that lets policymakers immediately see where they need to prioritize their interventions.
Let's get granular on the interpretation then. We're talking about the average change in the dependent variable, the outcome, That's associated with a one-unit change in an explanatory variable.
Right.
Let's stick with that example of wages and unemployment. It's a classic.
It's a great example. So if we model wages as our outcome variable and we use the unemployment rate as our cyclical indicator.
Which makes sense, since unemployment is a clear measure of labor market slack during a downturn.
It is. So we would expect a negative relationship. Why? Because high unemployment means a recession, and a recession means there's downward pressure on wages.
So if we estimate a coefficient and it comes out as, say, negative 0.6, what does that specific number, that magnitude, tell us?
That negative 0.6 coefficient tells us that, on average, for every 1 percentage point increase in the unemployment rate, so a worsening of the cycle wages are expected to decrease by 0.6%.
Wow.
That single number, it encapsulates the entire historical trade-off between a labor market slack and wage growth. It's the quantifiable expression of the Phillips curve dynamic over that historical period.
It's the numerical signature of the labor market's cyclical responsiveness.
Yeah.
But to get that coefficient, we need really specific, powerful inputs, these cyclical explanatory variables that define where we are in the business cycle. What are the main ones we rely on?
We use indicators that reliably capture the essence of that cyclical movement. The most common, the simplest one, is the GDP growth rate.
Just the raw percentage change.
The raw change. Its coefficient reveals the raw responsiveness of an outcome variable to those aggregate output changes.
But I've heard that using raw GDP growth can sometimes be misleading. An economy might be growing, but it could still be way below its full capacity.
And that's exactly where the second indicator comes in. It's called the output gap.
Okay, what's that?
The output gap is crucial for understanding economic slack. It's the difference between potential output, so what the economy could sustainably produce if all resources were fully utilized, and actual output.
So if the gap is negative and large,
it indicates a severe underperformance. A much deeper cyclical problem than the raw GDP growth might suggest, especially if potential output itself is growing slowly.
So central banks must love this metric.
They do. The coefficient derived from the output gap is often preferred by central banks because it speaks directly to inflationary pressures and resource utilization. It's a more refined measure.
It gives you a more accurate measure of cyclical pressure, not just cyclical movement.
Well said. Yes.
And finally, the unemployment rate. We've discussed it, but let's talk about the variations. Do economists just stick to that headline U3 number you see in the news?
Not for sophisticated cyclical analysis, not anymore. While the headline unemployment rate, the U3, is important, there's another one called the U6 rate.
And what does that include?
It includes discouraged workers, people who've stopped looking, and those who are working part-time for economic reasons but want full-time work. It often provides a much more complete picture of cyclical slack.
So if you're trying to model how quickly wages will respond to a recovery,
using a broader measure of slack like U6 can often yield a different and potentially more accurate coefficient magnitude. It captures this hidden labor capacity that becomes available during an expansion.
Okay, so by carefully selecting that cyclical variable, whether it's raw GDP, the more nuanced output gap, or a really detailed labor slack measure like U6, the resulting coefficient isolates the specific quantifiable impact of that cyclical force on whatever you're studying.
That's the key.
It's about making sure the input variable precisely represents the dynamic you're trying to measure.
That's it. This coefficient is the numerical quantification of that variable's specific exposure to cyclical risk.
Okay, so we've got our coefficients calculated. And here's where it gets really interesting, I think. Now we need to know how to trust them. We need to dive into the 3 critical rules for reading and really trusting these numbers. The need for context through isolation, the direction from the sign, and the intensity from the magnitude.
And isolation is absolutely the starting point. It's defined by a Latin phrase you hear a lot in economics. Ceteris paribus.
All other things being equal.
All other things being equal. And this condition, it's more than just a footnote. It's the entire foundation of modern econometric interpretation. It means the estimated effect of the business cycle is measured while holding other factors constant.
Why is that isolation so critical, though? Especially when you're dealing with economic time series data where, everything is moving at the same time.
Because without it, you cannot attribute the measured change solely to the business cycle. You fall into a classic trap called omitted variable bias, or OVB.
Okay, give us an example of OVB in action.
Sure. Let's say you are measuring the cyclical coefficient of business investment relative to GDP. But during your sample period, the government happens to enact massive deregulation, making it way easier to start new businesses.
Right.
If you omit that policy shift from your model, your cyclical coefficient for investment will become falsely inflated.
How so?
It will absorb the positive effect of the deregulation, and you'll incorrectly conclude that investment is more sensitive to GDP growth than it truly is. Your number is wrong because it's measuring two things at once.
So the ceteris paribus assumption is enforced through careful model specification. You try to include all the major non-cyclical drivers, like those policy variables or technological trends or demographic shifts, so that the cyclical coefficient you're left with is pure.
Precisely. We need to be confident as possible, that the effect we're measuring is truly due to the cyclical change in demand, or slack, and not some confounding event that happened at the same time.
Which must be incredibly difficult.
It is. It's why economists spend so much time modeling things like long-term trends, using special time series filters, or including what we call control variables for structural changes like, a shift in global trade agreements. If you don't enforce this isolation, the resulting coefficient is statistically, well, it's garbage, and it's dangerous for policy.
Okay, so once we trust the isolation, the first thing we look at is the sign of the coefficient, the simple plus or minus. That tells us the direction, pro-cyclical or counter-cyclical.
Right. A positive coefficient means the variable moves synchronously with the cycle. The classic example is corporate profits.
Makes sense. When the economy expands, profits rise.
Exactly. So if we use the output gap, where a positive number means an expansion as our explanatory variable, we would get a strong positive coefficient on corporate profitability. They move together. They are strongly procyclical.
And if we see a negative coefficient?
That indicates a countercyclical movement. The variable moves in the opposite direction of the cycle. We've already talked about unemployment, which rises during contractions.
Right.
But think about government safety net spending. Things like unemployment insurance payments.
Ah, okay. Those payments rise sharply during recessions, which is the down part of the cycle.
Exactly. Therefore, the cyclical coefficient on government transfer payments would be strongly negative, reflecting their countercyclical nature as what we call automatic stabilizers.
That brings us to the most practical aspect, strength, the magnitude, the absolute size of that coefficient. This moves us beyond just direction and tells us about intensity and volatility.
The magnitude is the measure of cyclical elasticity. It indicates how strongly the variable responds to cyclical changes. And this is the difference between a variable that is cyclically responsive and one that is cyclically volatile.
How does that distinction show up in the numbers?
Well, if you see a larger absolute value, it implies greater sensitivity, greater volatility. Think of durable goods consumption, car sales, for example.
Okay.
A 1% dip in forecasted GDP growth might lead to a 5% drop in car sales. Why? Because consumers immediately postpone those large discretionary purchases when uncertainty rises.
So that would result in a large negative coefficient, maybe negative 5.0.
Exactly, a big number. That variable swings wildly with the economy, and it demands immediate policy attention during a downturn.
And on the flip side, a small coefficient, something near zero, suggests stability.
Completely. Variables with small coefficients are considered relatively stable or cyclically inelastic. Basic food consumption, for example, or non-discretionary medical procedures. A coefficient of, say, 0.1 on the output gap suggests that even a significant shift in the overall cycle causes only a marginal change in that spending category.
But here's a technical challenge that I imagine requires more advanced modeling. A lot of economic relationships aren't instantaneous, right? The effect of a cyclical shock on, say, investment might take several quarters to fully materialize. How do coefficients in these dynamic models account for that lag?
That's a critical point for any deep dive into macroeconometrics. You're absolutely right. In dynamic models like vector autoregressions, we call them VARs, or structural VARs, we don't use a single static coefficient.
So what do you use instead?
Instead, we use lagged values of the cyclical variables. The model estimates a coefficient for the current period, then another coefficient for the 1-period lagged variable, a 2-period lagged variable, and so on.
So you might find that the immediate coefficient on GDP growth is small, but the coefficient on GDP growth from 3 quarters ago is actually large and significant.
Precisely. And that tells you that the cumulative cyclical effect is powerful, but there's a significant transmission lag. There's a delay in the economic plumbing, so to speak. When you sum up all of these lag coefficients, you get what's called the long-run multiplier, or the cumulative impact. And this is absolutely essential for policy, because if the effect takes 3/4 to peak, policymakers have to anticipate the shock well in advance to intervene effectively. Without examining that structure of the lags, your prediction is fundamentally incomplete.
That technical discussion on lags leads perfectly into the necessary skepticism that's required of any statistical output. While these coefficients give us excellent quantifiable averages, we always have to acknowledge the fine print, what they don't capture, which is often where policy can fail.
This is where we transition from analysis to critical assessment. And the first major limitation is what's known as the averaging property. Regression coefficients, by their very design, represent average effects calculated over a specific historical sample period.
And what does that averaging obscure when the cycle hits its extremes? The sharpest points of a boom or a bust.
It obscures nonlinearity. Economic relationships are rarely nice straight lines. At the absolute trough of a severe recession, think about the sharp drop in 2020, or the 2008 crisis behavior often shifts radically.
How so?
Well, firms that are facing an existential threat might lay off workers much faster and more severely than a linear average coefficient, which was calculated over decades of moderate cycles, would ever predict. The coefficient underestimates the risk of those extreme outcomes because it smooths out the catastrophic tail events.
So if you rely solely on that average coefficient, you might be perfectly prepared for a moderate cyclical storm, but you'd be entirely underprepared for a Category 5 hurricane.
That's a perfect analogy, exactly.
That's right.
And furthermore, the averaging property fails to capture specific, sudden structural breaks.
Meaning a fundamental change in how the economy works.
Yes. The shift from a manufacturing-heavy economy to a service-based one, the digitization of finance, a massive shift in energy dependence, these permanently change how variables correlate with the cycle.
Can you give an example?
Sure. If you calculate the cyclical sensitivity of oil consumption using data from before 1973, that coefficient becomes almost irrelevant the moment the OPEC oil crisis fundamentally changes the supply dynamic.
And the economist who is using that historical average might be completely blindsided by the new economic reality. The historical data used to calculate the coefficient may predate the most relevant structural changes.
It demands constant vigilance and re-estimation. If the rules of the game change, like the rise of the gig economy changing labor elasticity, or just-in-time inventory making supply chains more brittle, then old coefficients are not just inaccurate, they provide actively misleading signals to policymakers.
And that adds to the complexity.
What?
We have the messy reality of the system itself. Economic cycles are far too complex to be modeled perfectly by simple linear relationships.
Absolutely not.
So the reliability of the coefficient can be radically affected by external factors the model failed to account for. This brings us back to omitted variable bias, OVB, but in a real-world dynamic setting.
OVB is the bane of the applied econometrician. It really is. If something critically important is left out, like international capital flows or sudden geopolitical risks, the cyclical coefficient is distorted.
So for example,
if you are modeling the cyclical response of inflation, but you omit the impact of global currency fluctuations or a trade war, your domestic output gap coefficient will incorrectly bear the burden of explaining that international price shock.
which means the coefficient is misattributing the cause. And policymakers could misdiagnose the problem. They might try to fix a global supply issue with a domestic demand lever.
And that is the danger. The second factor is those aforementioned structural changes in the economy. We have to differentiate between temporary cyclical shocks and permanent shifts.
Like the Phillips curve relationship between unemployment and inflation.
That's the perfect example. If that relationship fundamentally flattens because of changes in, say, wage bargaining power, any coefficient calculated using data from the 1970s when the curve was steep will severely overpredict the inflationary impact of a modern boom.
And there's a third factor, which is a bit of a paradox. Policy interventions. These policies are designed to dampen the cyclical response. So if the government is successful in mitigating a recession, the observed coefficient for, say, investment sensitivity might appear smaller than the true underlying sensitivity.
Yes, because the fiscal stimulus masked the full depth of the potential fall. It creates a challenge known as the Lucas critique.
What does that critique say? in simple terms?
Simplified for our audience, it suggests that historical coefficients might not hold true when policy fundamentally changes the environment. When agents, so businesses, households, realize the central bank will always step in to stabilize the market, their behavior changes. And the historical coefficient, which assumes pre-intervention behavior, becomes obsolete.
That's a profound point. The very act of intervening changes the environment you are trying to measure.
Yes.
So we're trying to shoot at a moving target that is actively reacting to our attempts to aim.
And this leads us to the most critical caution of all: the need for restraint when drawing causal conclusions. While regression coefficients excel at measuring correlation and co-movement, proving genuine causality in a complex system like the national economy is incredibly difficult.
Why is causality so elusive when the coefficients look so precise?
The main reason is a problem called endogeneity.
Okay, break that down for us.
Endogeneity is the situation where your explanatory variable, the business cycle indicator, and your outcome variable are mutually dependent. There's a feedback loop.
Like consumer confidence and GDP growth.
The perfect example. If consumer confidence, which is an outcome variable, falls, it slows GDP growth, which is our explanatory variable. But then that slower GDP growth further reduces consumer confidence. A simple regression coefficient only captures the correlation. It can't disentangle that complex feedback loop.
So the coefficient tells you how much GDP and consumer confidence typically move together, but you can't definitively state which one is the primary driver in every instance without more complex modeling.
Exactly. To address endogeneity and try to get closer to proving causation, economists have to turn to more advanced techniques. Things like instrumental variables regression or sophisticated structural models that explicitly define the direction of influence.
I see.
What's fascinating here is the recognition that these simple coefficients are powerful analytical maps, but they require the user to have deep institutional and theoretical knowledge to understand the limits of their causal interpretation. The coefficient is the starting line, not the finish line, for economic analysis.
We've established the tool, we defined its metrics, and we have read the fine print on its limitations. So what does this all mean for the daily lives of you, the listener? We need to connect this really technical analysis back to the decisions that define economic policy, welfare, and market stability.
The practical utility of these cyclical coefficients for government decision makers is, well, it's the difference between an informed, targeted policy and a blind, broad intervention. It really centers on the ability to anticipate and design specific responses.
Okay, let's start with anticipation. If an economist predicts a cyclical slowdown, how does the coefficient translate that slowdown into practical expected damage?
It provides specificity. If the central bank forecasts GDP growth to drop by 2%, a moderate recessionary shock, they don't just guess what will happen to prices.
How do they do?
They plug that 2% drop into their regression equations. For inflation, for housing starts, for durable goods orders, for long-term bond yields. The coefficients then instantaneously predict the magnitude of the impact across the economy.
So if the coefficient on housing starts relative to GDP is, say, negative 4.0,
they anticipate an 8% collapse in housing activity, and that allows them to prepare regulatory or lending support before the collapse actually happens.
and this moves anticipation directly into design. This data is fundamental for creating effective countercyclical policies, those specific interventions designed to push back against the cycle.
Policy design is all about calibration and targeting. If your coefficients show that corporate fixed investment, spending on machinery, has a massive positive coefficient, meaning it collapses hard and fast in a downturn.
Then, a generic stimulus check won't be enough.
Exactly. You need a targeted investment tax credit or an accelerated depreciation schedule, a policy designed to specifically counteract that high sensitivity. But if another variable, like public utility spending, has a coefficient close to 0, it requires very little policy attention during a recession because it stabilizes itself.
Let's use that specific example you provided earlier, estimating how unemployment responds to GDP changes. This is often framed as Okuhn's law in policy models. This coefficient must be a core input for both fiscal and monetary decisions.
Oh, absolutely. Think about fiscal policy, particularly when the government is deciding on the size of a stimulus package. If the Okuhn's law coefficient suggests that every 1% decline in GDP causes unemployment to rise by 0.5 percentage point, and the goal is to prevent unemployment rising above a certain threshold, the government can calculate the necessary fiscal effort.
But the calculation goes even further, right?
Yeah.
You also need to estimate the fiscal multiplier.
Precisely. The policy equation isn't just about GDP and unemployment. It's about the spending and its effect on GDP. If the measured fiscal multiplier coefficient is, say, 1.2, meaning $1 of government spending generates $1.20 in economic activity,
Then you can do the math.
you can calculate exactly how many billions in spending you need to generate the X% change in GDP required to save Y number of jobs, all based on that initial cyclical coefficient. The accuracy of both the unemployment coefficient and the multiplier coefficient dictates whether the stimulus is effective or just wasteful.
Now, connecting this to the monetary side, how does this information inform interest rate decisions by the central bank?
Monetary policy relies heavily on these cyclical coefficients to manage inflation expectations. Central banks often use what are called reaction functions, like the Taylor rule, which dictates how the interest rate should react to cyclical variables.
Specifically, inflation and the output gap.
Specifically those two. If the central bank sees a coefficient indicating that a 1% positive output gap will generate 0.75% higher inflation, meaning inflation is highly responsive to the boom, they know they have to act aggressively. They have to hike rates to close that gap and prevent price instability.
And conversely, if the coefficient suggests that inflation is highly insensitive to domestic cyclical movement, maybe because the modern economy is dominated by globally priced goods, then they can afford to be more gradual.
Yes, and they can avoid unnecessary tightening that might cost jobs. It allows for that fine-tuning. The coefficients determine the weight the central bank places on each cyclical component in their decision-making calculus.
So if we connect this all to the bigger picture, the integrity and the accuracy of these coefficients directly influence the difference between successful and failed policy interventions.
That's everything.
Because if the coefficient is measured incorrectly, let's say the investment sensitivity is actually much higher than the model predicts, the policy intervention will be calibrated too weakly, and the crisis will be unnecessarily severe.
Or the opposite can happen. If the policy response is based on an inflated coefficient, the resulting stimulus might be way too strong, unnecessarily ballooning public debt and creating unwanted inflationary pressure during the recovery. That number derived from the regression model is, quite literally, the lever used to determine the necessary macroeconomic stabilization effort.
It moves policy from general principles to specific, measurable intervention targets.
That's the goal.
We have executed a thorough deep dive today. We moved from defining the systemic movement of the economic cycle expansion, peak, recession, recovery, to explaining the regression coefficient as the ultimate measure of sensitivity. It provides the direction through its sign and the intensity through its magnitude, all while satisfying that crucial ceteris paribus requirement for meaningful isolation.
And we gave significant time to the necessary limitations, recognizing that these numbers are averages that cannot perfectly predict the extremes of a crisis, and that they face constant challenges from omitted variables, from policy feedback loops, and from the complexity of endogeneity.
And that discussion on limitations, specifically the risk of structural changes, brings us perfectly to our final provocative thought for you to consider.
As we noted, coefficients rely on historical data, but the modern economy is just relentlessly dynamic.
So it raises an important question for you to mull over.
If cyclical coefficients are calculated based on these historical averages, but the economy is constantly undergoing dramatic structural shifts, think of the profound changes in energy markets, the shift to hybrid work fundamentally changing urban economies, or the massive reliance on automated supply chains. How frequently must policymakers re-estimate these coefficients to ensure their policies are even relevant?
It's a great question. If the underlying economic structure, the terrain itself, is shifting every 5 or 10 years, and your policy is based on coefficients estimated from pre-2008 or even pre-2020 data, those countercyclical policies won't just be slightly off.
No.
They could be fundamentally misaligned, chasing problems that have already evolved into something new.
It transforms the role of the macroeconomist. They move from someone who simply validates historical averages to someone who must constantly build and test entirely new structural models for an ever-changing world. It is the definition of a dynamic and, I would say, essential pursuit.
It certainly makes reading economic forecasts a much more informed exercise, understanding that behind every predicted percentage lies a highly debated, sensitive coefficient. Thank you for joining us for this deep dive into the complex dynamics that govern the business cycle.
My pleasure.
We hope you feel far more informed about the math and the technical challenges behind the economic headlines. Until next time, keep that curiosity firing.
Welcome to the Deep Dive, the place where we take the complicated stack of data and research, the stuff that determines the fate of markets and governments, and we turn it into pure, focused insight just for you. Today, we are undertaking a really crucial investigation into what you might call the secret language of economists. We're looking at economic cycles, the booms and busts, the slowdowns, the accelerations, but we're focusing on the mathematical rigor, the proof that's required to show these cycles actually matter.
Right.
The topic is, well, it's simple to state, but it's incredibly complex to master. How do analysts determine if a pattern they see in, say, corporate profits or consumer spending is real, measurable change caused by the cycle, or if it's just statistical static?
It's honestly the highest hurdle in all of empirical economics. I mean, anyone can draw a line connecting two things on a graph. That's the easy part. The challenge is showing that the economic mechanism you believe is driving the change, that underlying cycle, is actually having an effect that is absolutely measurable and not just, the luck of random data variation. We're going way beyond correlation here as we're trying to confirm the signal is real.
Our mission today, then, is to become masters of signal detection. We need to understand the difference between noise and signal when tracking the economy, and how researchers apply this mathematical proof, known as statistical significance, to move from just an observation to a really confident conclusion. This is the difference between a hunch and, well, $1 billion policy decision.
And to guide this deep dive, we're working with expert sources focusing specifically on the measurement of statistical significance, but right within economic cycle analysis. We'll break down the technical tools analysts use, the p-values and t-statistics, but, and I think this is more important, we'll explore the real-world limitations they're constantly up against.
Things like
small sample sizes, messy data, and these massive structural breaks that can invalidate decades of research overnight.
Okay, let's unpack this immediately and start right at the foundation. When we say an economic cycle is significant, what are we actually trying to prove with the numbers? I mean, if you're looking at the economy, you are just drowning in data points. You might see that when GDP growth accelerates, corporate profits generally follow suit. You see a clear pattern. But here's the problem, and you've said this before. The economy is fundamentally chaotic. 1 million unmodeled things happen every single day.
Right.
So how do you isolate that one relationship, the cycle's impact, and prove it's not just a coincidence?
That core question leads us directly to the definition of statistical significance in this field. It's a very binary question, really. Significance means that the estimated effect of an economic cycle on a specific variable, let's stick with corporate profits for now, is statistically distinguishable from zero.
I find that phrasing, distinguishable from zero, incredibly powerful because it sets a very, very high bar. It's not enough to show the cycle has a positive or a negative effect. You have to prove the effect is so clear that you can rule out the possibility that the true effect is nothing at all.
Precisely. If we run a mathematical model, a regression, and we find a coefficient of, say, 0.4 on our cycle variable, significance testing doesn't just look at the number 0.4. It asks, could this number, 0.4, have plausibly occurred if the real relationship between the cycle and profits was actually zero?
A fluke, in other words.
Exactly, a fluke. If we determine that possibility is extremely remote, then that 0.4 is significant. It indicates the patterns we're seeing are likely due to systematic economic forces, the inherent predictable mechanisms of the business cycle, and not just random market noise.
It's our radio analogy. We need proof that the sound we hear is the actual broadcast, the systematic force, and not just the background hiss, the random variation. So what's in the toolkit? What do economists rely on to provide that proof?
Okay, to measure the strength and reliability of that signal, economists rely heavily on 3 specific outputs generated by their statistical models: t-statistics, p-values, and confidence intervals. They all work together to assess the likelihood of observing our estimated effect if the cycle truly had no influence.
Those terms often feel like heavy jargon, but they really are the bedrock of translating a theory into a measurable fact. But before we define them, we have to understand the intellectual setup, which revolves around the null hypothesis. When I first heard about this, it felt backward. Why is the economist usually trying to prove that no relationship exists?
That's a common and an excellent point to raise. When an economist tests the effect of a cyclical variable, maybe the national unemployment rate on inflation, the null hypothesis, or H0, is the position they actively want to reject.
Okay.
The null hypothesis always states, the cyclical variable has no effect. Its true coefficient is 0. The economist, in effect, starts by assuming the cycle is totally irrelevant and then uses mathematics to gather enough evidence to prove that that initial assumption is false.
So if I'm testing whether the current tight labor market is driving wage inflation, My null hypothesis is that the tight labor market has zero statistical influence on wages. I'm actively looking for evidence to reject that statement. It almost feels like a scientific method designed to, I don't know, reduce bias.
That's exactly what it is. The goal is skeptical confirmation. And this is where the most famous of these tools, the p-value, comes into the picture. The p-value tells us how likely we are to get the result we just did, or a result even more extreme, if the null hypothesis of zero effect were actually true.
Wait, let's slow down on that definition because that's a huge conceptual leap. The p-value isn't telling me the probability that the cycle is having an effect. It's telling me the probability that my observation is a fluke, assuming the true effect is zero.
Precisely. You got it. If we get a p-value of, say, 0.01, it means there's only a 1% chance we would have observed this strong of an effect, this clear of a signal, if the cycle were truly irrelevant.
And if that probability is small enough?
If that probability is sufficiently small, and the standard threshold in economics is usually 5%, or a p-value less than 0.05, then we have enough evidence to reject the null hypothesis. We can confidently state that the cycle does have a measurable, non-random effect. It's the mathematical threshold for declaring the signal real.
And what about the t-statistic? How does that fit in alongside the p-value?
The t-statistic measures the precision of your estimate relative to the expected error. Think of it as a quality check on the number you've estimated. Technically, the t-statistic calculates how many standard deviations the estimated coefficient is away from zero.
So the further away from zero, the better?
The further it is from zero, the less likely it is that the true value is actually zero. In practical terms, a high absolute value of the t-statistic, typically above 2 for that 5% threshold, is directly related to a low p-value. They're really just two ways of looking at the same evidence. How strong is the effect compared to all the random variability?
And the final piece of the puzzle, the confidence interval.
The confidence interval gives you a range of values. It's a range where the true coefficient is likely to fall, based on our sample of data. Most economists use the 95% confidence interval. This means that if we were to repeat the sampling and testing process many, many times, 95% of the intervals we construct would contain the true underlying effect.
So the test for significance is just seeing if zero is in that range.
It's that elegantly simple. If that 95% confidence interval does not include zero, then we have statistical significance. Zero is ruled out as a plausible true effect.
So all three, tools, t-stats, p-values, and confidence intervals, are working in concert to rule out the possibility that the effect we see is just an accident of the numbers.
Absolutely. And this rigorous mathematical process is what allows institutions like, say, the Federal Reserve to move from economic theory, the idea that the cycle should affect inflation, to an actionable insight. The data proves the cycle has a measurable non-random effect on inflation, and therefore we can adjust policy based on that measurable relationship.
I want to spend a moment on the thing that statistical models deliberately don't measure. The error term. That's the background chaos, the static we keep talking about. What role does that background noise play in this whole significance test?
The error term is absolutely crucial because it collects all the noise. It reflects all the unobserved factors affecting economic outcomes that we haven't included in our model, or maybe can't even measure.
Like what?
I mean, this includes everything from geopolitical shocks to highly localized consumer behavior shifts, or just simple data collection errors. It's the catch-all bucket for reality's messiness.
That seems like a massive bucket of chaos. So if the error term is large, if the background static is deafening, how hard does that make it to prove significance?
It makes it significantly harder. Significance testing is, at its core, asking if the estimated cyclical effect is robust enough to rise above this combined background noise. If the variance of that error term is very large, meaning there's a huge amount of unexplained random movement in the data, that estimated cyclical coefficient might be completely swamped. It might be a tiny, clear signal, but if the overall noise level is too high, the test just can't reliably separate it.
So the economic cycle might genuinely be having an impact, but if my data is too noisy or if the overall environment is too volatile due to factors I didn't include in my model, the test will conclude the effect is insignificant, a false negative.
That is the risk. That's a type 2 error. If the coefficient is statistically insignificant, it suggests that the cyclical effect cannot be reliably separated from those random influences. The static is just too loud. The analyst can't confidently tell a policymaker, we know this economic downturn is driving down investment, because the test shows the downturn's measurable effect is indistinguishable from the background market volatility. It's the ultimate caution sign in empirical work.
Okay, we have established the math. We know what it takes to get a perfect, pristine p-value below 0.05. But here's the paradox, and I've seen economists do this all the time. They ignore perfect p-values. This is the moment we have to address the most common pitfall for anyone interpreting economic research, the paradox of small effects. Why would you throw out mathematically proven evidence?
Because statistical proof is mathematical. Economic importance is contextual. Our sources are absolutely insistent that this distinction be the first thing any researcher, any student, anyone reading the news grasps. Statistical significance does not automatically imply economic importance.
So you can have a perfect p-value.
You can have a perfect p-value that proves the effect is non-zero, and yet the finding can be utterly worthless for policy or for strategy.
Let's break down why that happens. It comes down to magnitude, right? The size of the effect.
Exactly. The statistical test merely answers the existence question. Does the cycle affect the variable? It doesn't answer the magnitude question. By how much? You could have an infinite amount of data, which mathematically guarantees you'll reject the null hypothesis if the true effect is even tiny, like 0.000001.
Right.
But that tiny, provably non-zero effect is completely irrelevant in the real world.
Give us a concrete example of this paradox in action within cyclical analysis, something we might see in the headlines.
Okay, let's use the relationship between the output gap. That's the difference between the economy's actual output and its potential in core inflation.
Oh.
We hypothesize that when the economy overheats, so there's a positive output gap, it pushes inflation up.
Makes sense.
So we run a regression, and because we have decades of data, huge sample size, we achieve a p-value of 0.00001. Statistically, the output gap is definitely moving inflation.
Highly significant. The signal is crystal clear, no doubt about it.
But then we look at the estimated coefficient, the number itself, and it tells us that a massive 1 percentage point increase in the output gap, which is a huge, painful overheating event for an economy, causes core inflation to shift by only 0.0005 percentage points. That's half a basis point over a whole year. That finding is statistically impeccable. But what does the central bank do with it?
Nothing.
Nothing.
Right. If the central bank is aiming for 2% inflation and they know the cycle is only nudging it by 0.0005%, they have to look for the other 1.99995% driver somewhere else. The finding is true, but it's trivial.
It's practically irrelevant. This is why economists must apply these crucial non-mathematical criteria when they interpret results. Statistical significance is merely the entrance ticket to the conversation. Economic importance is what determines if you stay seated at the policy table.
So when an economist looks at a statistically significant coefficient, what are the, say, 3 main qualitative questions they have to ask themselves to gauge whether the finding crosses that threshold of true importance?
The focus has to shift entirely away from the p-value and onto the actual consequences of the measurement. First, they look at the size of the estimated effect. This is the magnitude we were just talking about. We asked, is the estimated effect large enough to matter to the economy? If GDP growth accelerates by 1%, and the model predicts employment will rise by 5%, that is a massive economically important effect. If it predicts employment will rise by 0.05%, that's economically insignificant, even if the p-value is perfect.
The size of the movement matters relative to the magnitude of the driving force.
Exactly. Second, analysts have to scrutinize the units of measurement. This seems really basic, but it's a frequent source of misinterpretation. We have to contextualize the unit of the dependent variable. If the variable is measured in, say, billions of dollars, like aggregate corporate investment, then a coefficient that implies a change of a few $1,000,000, while potentially significant, may not warrant a policy change. But if the variable is something highly sensitive, like short-term market volatility, a very small percentage change might be considered highly important.
Okay, so if the cycle significantly affects the stock of national debt by 0.01%, that's a non-event. But if it significantly affects bank liquidity requirements by 0.01%, that could cause a systemic crisis. Contextualizing the units gives the finding its weight.
It does. And the final ultimate reality check is the relevance for decision-making. We have to always tie the finding back to real-world policy or business strategy. Does this mathematically proven non-zero effect actually influence decisions?
The inflation example again.
Exactly. If the statistically significant cyclical effect is minuscule, policymakers will correctly conclude that changing interest rates is an ineffective tool against this particular variable. The problem, they realize, lies somewhere else.
So significance is the math that gets you published in a journal. Importance is the size that gets you an appointment with the Treasury Secretary. It's a crucial, crucial distinction.
And it protects us from being fooled by data precision. You could have a highly sophisticated model that proves the phase of the moon has a statistically significant non-zero effect on the price of oil futures. But if that effect requires 5 decimal places to appear, no commodities trader is going to reorganize their portfolio based on lunar cycles.
Right.
Economic analysis has to lead to practical, consequential insights.
Okay, so we have our measurable signal. We know it has to be big enough to matter. But the measurement game itself is fraught with rules and limitations that define what we can actually conclude. Let's dive into rule number 1, which is maybe the most critical constraint in interpretation. Ceteris paribus.
Ceteris paribus, it means holding all else constant, is a defining feature of empirical research. The significance we've been discussing is always interpreted through this lens. If you find significance, you found it only after controlling for or holding constant every other major factor in your model.
It sounds like an artificial construct, though. I mean, it's necessary for modeling, but it's completely counter to the real economy where absolutely nothing is ever held constant.
It is artificial, but it's a necessary tool for isolating cause and effect. Economic outcomes, let's take wage growth, are driven by simultaneous interlocking forces. You have long-term demographic shifts, you have technological adoption, government debt, and the short-term business cycle, all happening at once.
Okay.
If we didn't use ceteris paribus, we would attribute the combined effect of all these forces to our one variable of interest, which would be completely inaccurate.
Right.
So the significance test is narrowly answering this question. Does the economic cycle variable have a statistically meaningful effect after we have accounted for all these other structural drivers?
Give me an example of the kind of other factors an analyst has to include to isolate the cycle.
Absolutely. Say we're studying how the business cycle affects consumer confidence. We know confidence is also affected by things like long-term interest rate trends, or inflation expectations over the next 5 years, or maybe the long-term trend of globalization.
Right, all those big background forces.
Exactly. To isolate the short-term cycle, the analyst has to include control variables for these long-term structural forces. They have to account for the effects of those variables first.
And the significance test then essentially asks, after removing the predictable impact of long-term globalization and expected long-term inflation, does the current short-term cycle still have a measurable, independent effect on confidence?
Precisely. This isolation is so critical because if an analyst just runs a simple model without any controls, they might mistakenly attribute the long-term structural decline in manufacturing employment, which is driven by automation, entirely to the current short-term recession.
Yeah.
And that would lead to flawed policy recommendations. Ceteris paribus allows the analyst to know which force is measurably dominant or measurable on its own.
So for our listener, this means when you read research that says the cycle significantly impacts X, you should always know that the significance is proven only after the researcher stripped away the influence of every other major factor they thought mattered.
Without that invisible asterisk of ceteris paribus, the finding is fundamentally misunderstood. The rigor of that test is what distinguishes serious economic research from just casual observation.
Okay, let's transition to Rule 2, which deals with a very practical, non-theoretical constraint: the sheer scarcity of economic data compared to other scientific fields.
This is the impact of limited data, or sample size. And it's maybe the most frustrating constraint for economists. In physics or biology, you can run experiments hundreds or thousands of times.
Right.
In economics, especially when you're studying cycles, we're dealing with limited time series data. If we analyze the modern U.S. business cycle using quarterly data starting in, say, 1950, we only have about 290 data points to analyze 75 years of economic history. That is a tiny sample size for statistically proving subtle yet profound effects.
And the fewer the data points, the fuzzier the measurement of the signal.
That's the technical fallout. Small sample sizes directly reduce statistical power. Statistical power is defined as the probability of correctly finding a significant effect when one truly exists. When you have low power, you are much more likely to commit a type 2 error, that false negative we discussed.
So the cycle could be having a huge effect.
The cycle might be having a profound effect, but because you only have 290 data points, the math just can't reliably confirm it.
It means that if an economic relationship is weak but real, a short data set will make it invisible. The model concludes, insignificant, even though the analyst might intuitively know the cycle matters.
That's the frustrating trade-off. Limited history reduces the precision of our estimates, which is measured by our standard errors. The standard error is essentially the measure of uncertainty around our estimated coefficient. If the standard error is large, the coefficient is less precise, making the calculated t-statistic smaller and the p-value higher.
So in simpler terms, more data generally means smaller standard errors, which means you have a stronger microscope to detect the signal.
Precisely. As your sample size increases, the precision of your estimate improves, and finding significance becomes more likely, assuming, of course, that the underlying relationship is genuinely non-zero. This is why economists are always so eager for the release of new quarterly data or for the retroactive revision of historical statistics. Every new data point is another degree of freedom that strengthens the power of the model to detect real cyclical effects.
Which brings us to Rule 3. The economic cycle isn't just one single elegant number. It's a whole basket of indicators. The output gap, unemployment, inventory levels, interest rates. How do we test the whole phenomenon rather than just isolated components?
This is where we use joint significance tests. If you were testing the overall impact of, say, financial market stress on real estate prices, you wouldn't just use one variable. You might use credit default swap spreads, the VIX index, and bank capital ratios.
A little group with them.
A group. And similarly, when assessing the economic cycle, we often use a group of related variables. If you test each of these variables individually, you might find that only the output gap is significant, but the other two, interest rates and inflation expectations, are insignificant. That seems contradictory.
Right. Logically, the cycle is operating as a collective pressure defined by all these indicators together. They should jointly influence the outcome.
Exactly. So a joint significance test, which is often performed using something called an F-test, checks whether the economic cycle variables, as a group, matter for the dependent variable. Or asking, does the overall state of the business cycle defined by this whole suite of indicators collectively exert a measurable influence on, say, investment decisions?
What if the F-test, the joint significance test, fails? What does that tell you?
If the model shows a failure to reject joint insignificance, it sends a very serious warning signal. It suggests that the cycle, defined broadly by all those indicators, has limited overall influence on the variable you're studying. This is a critical safety measure. It prevents the analyst from cherry-picking one weak but significant finding like saying, oh, the output gap matters, when the collective evidence of the cycle's effects is actually negligible.
It ensures integrity. So if you're a central bank relying on a cyclical model to predict inflation, and that model's joint significance test fails, you can't trust your predictions, even if a single component variable looks promising. It forces you to look away from the cycle and towards, permanent supply-side factors.
It forces a realization that the underlying drivers are not cyclical but structural, or that the way you've defined and measured the cycle is simply not capturing the relevant economic dynamics for that variable. It moves the conversation forward by eliminating faulty avenues of research.
Okay, we've built the theoretical framework for finding a pristine, measurable signal. But the real economy is not a laboratory. It's inherently messy, and clean statistics run into unexpected, often massive events. This is where the model's fragility comes into play. What are the key systemic elements that can completely derail these careful significance tests, rendering our perfect p-values meaningless?
The primary challenges really fall into two big buckets: systemic shocks that change the rules of the game, and technical data flaws that violate the mathematical assumptions of the tests themselves.
Let's start with the shocks.
Let's start with the shocks: structural breaks and policy interventions. A structural break is a permanent shift in the underlying economic relationship between variables.
Give me a historical example of a structural break that completely ruined significance testing for a generation of economists.
You don't have to look any further than the 1970s and the transition that followed. Before the 1970s, the relationship between unemployment and inflation, what we call the Phillips curve, was statistically significant and relatively stable. But the oil shocks and the massive inflation of that decade fundamentally altered how expectations were formed and how policymakers reacted.
Right.
Then came the Volcker shock in the early 1980s, where interest rates were aggressively raised to crush inflation.
That Volcker shock was a massive policy intervention that basically redefined the entire economic environment.
Exactly. That structural break fundamentally distorted significance tests. A model built on pre-1970 data, assuming a stable Phillips curve relationship, became completely irrelevant after Paul Volcker changed the Fed's credibility and the public's expectations about inflation management. The historical coefficient linking the cycle to inflation, which was once highly significant, ceased to hold any reliable meaning.
So, if the cycle's influence on investment was significant before the Great Moderation, That period of low volatility from the mid-80s to 2007, running the same statistical model on the post-2008 crisis data, will likely give us flawed results.
Almost certainly.
Because the fundamental risk perception of banks and consumers just changed permanently?
That's the problem. The assumption of stability, that the coefficients we estimate are constant over time, is violated. And similarly, sustained, unprecedented policy interventions, like the quantitative easing programs after 2008, can also weaken or change cyclical relationships. The mere existence of QE may dampen the cyclical sensitivity of long-term interest rates. If policy is actively aiming to neutralize the cycle's effects, past significance findings may become meaningless for predicting the future.
This means that economists studying cycles must constantly use specialized tests, like the Chow test, to check if their historical data set should be broken up into sub-periods because the rules of the game have changed.
They have to. If they don't, they're essentially combining apples and oranges. And the resulting p-value is unreliable because it's trying to find one stable relationship in 2 or 3 fundamentally different economic eras.
Beyond these high-level systemic shocks, I know there are technical flaws in the underlying data itself that can completely invalidate the results, even if the math seems perfect. What are the 2 biggest technical data flaws economists must constantly guard against?
The 2 giants are serial correlation and non-stationarity. They are foundational issues that, if you ignore them, guarantee that your standard test statistics are invalid and your conclusions are unreliable.
Let's start with serial correlation. What's the fundamental, non-technical reason why this happens so often in economic data?
Serial correlation, or autocorrelation, means that the error in one time period is related to the error in the next period. The fundamental assumption of regression analysis is that the errors, the background noise, are independent and random across time. But in economics, that's rarely true, often due to inherent system rigidities.
Like what?
Well, think about sticky prices or incomplete expectations. If prices for goods are slow to adjust, they're sticky, and my model underpredicts inflation this quarter because of a lasting supply shock, it will almost certainly underpredict inflation next quarter too, because the shock hasn't resolved. My model's errors are following a pattern over time, rather than being purely random.
So the noise itself is structured, which fools the statistical model. What is the direct statistical consequence of having structured noise or serial correlation?
Serial correlation often causes the model to think its estimates are more precise than they actually are. It makes the estimated standard errors artificially small.
And we know what that means.
We learned earlier that smaller standard errors mean higher precision, which makes achieving statistical significance easier. If you fail to account for serial correlation, you will mistakenly inflate your t-statistics and deflate your p-values. You are, in effect, getting a false signal of precision.
So, if the static is related over time, we're essentially using a broken antenna that only makes the signal look clearer than it is, giving us a false sense of certainty about the cycle's impact.
That's a perfect way to put it. Analysts correct for this using techniques like HAC standard errors, which adjust the calculation to account for that related noise.
Now for the second major flaw, non-stationarity. This sounds like something related to physics, but I've heard it's an econometric killer.
It is the single biggest source of meaningless results in time series analysis. Non-stationarity occurs when the statistical properties of the data, specifically the mean, variance, or covariance, change systematically over time.
A drifting average, for example.
Exactly. Imagine the unemployment rate. If the mean unemployment rate averaged 5% for 30 years, and then, due to structural changes, the average shifted and stabilized around 7% for the next 30 years, that data series is non-stationary in its mean. If the variance of GDP growth used to be very high, but post-1985 policy reduced volatility significantly, the data is non-stationary in its variance.
Why does a drifting mean or variance destroy our ability to test for significance?
Because if the data is non-stationary, you violate the assumption that the relationships you estimate based on the past will hold true today. This leads to the infamous problem of spurious regressions. You can find relationships that appear to be highly statistically significant, p-values near zero, perfect t-stats, but which are, in reality, completely meaningless garbage.
I remember the classic absurd example, finding a strong, significant relationship between the per capita consumption of margarine and the divorce rate in Maine.
Yes.
Just because both variables happen to trend downward simultaneously over a decade.
That is exactly the kind of nonsense a non-stationary dataset can produce. The variables are trending because of entirely different unlinked long-term forces, but the model mistakenly believes they are linked in a causal, significant way.
So the crucial warning here is that if economists fail to test for and correct non-stationarity using tools like the augmented Dickey-Fuller test to check for what they call unit roots, that perfect p-value they calculated about the economic cycle is completely unreliable.
It means the entire conclusion about the cycle's measurable effect is thrown out. The estimated coefficient is unreliable, the standard error is biased, and the confidence interval is worthless. The economist must usually difference the data look at the change in the variables rather than the levels to achieve stationarity before running the cyclical significance test. This step is absolutely non-negotiable for robust time series analysis.
We've established the incredibly high bar required to prove that an economic cycle has a measurable, reliable effect, navigating the constraints of ceteris paribus, structural breaks, and the technical dangers of non-stationarity. So now we arrive at the ultimate so what moment. When analysts achieve a result showing statistically significant cyclical coefficients, how do governments and central banks use that proof to justify spending billions or altering the interest rate trajectory?
That statistically significant finding is the necessary empirical anchor for justifying policy action. When a core cyclical measure, let's say the severity of the housing bust, shows a statistically significant coefficient in predicting consumer credit defaults, it provides the robust evidence required to support countercyclical, fiscal, or monetary policies.
In other words, the math validates the intervention.
Precisely. If the data proves that the cycle is measurably driving a target variable in an undesirable direction, policymakers are justified in intervening with stabilization measures. If recessions are proven to significantly increase long-term unemployment, then policymakers have the empirical proof to deploy targeted stimulus spending or aggressive interest rate cuts to counteract that measurable force.
And without that proof,
Without that significance, intervention becomes political guesswork. If the cyclical coefficient were insignificant, policymakers would be rightly hesitant to deploy costly and potentially risky interventions, because the data suggests the cycle isn't the primary driver of the problem.
so a finding of significance provides the mandate and the confidence that the policy lever being pulled like lower rates is actually targeting a mechanism, the cycle's measurable effect, that we know influences the outcome, like investment.
Exactly. It validates the transmission mechanism. But it's vital to stress that the opposite result, insignificant findings, is often equally, if not more, valuable,
How so?
because it compels policymakers to pivot their thinking.
Okay, so when a cyclical variable proves insignificant in affecting a key economic measure, what are the two main implications for policy focus?
The insignificant finding rules out the cycle as the cause and forces us to look elsewhere. First, it might imply weak transmission mechanisms. This means the cycle's influence is simply not efficiently communicated to the specific variable we're studying.
Can you give us an example where the transmission mechanism is proven to be weak?
Sure. Consider the era of near-zero interest rates after the 2008 crisis. The Federal Reserve aggressively cut rates, seeking a measurable, significant impact on corporate borrowing and investment. However, a lot of research showed that for many firms, investment remained statistically insignificant to those low cyclical rates.
Why?
The transmission was weak because corporations were hoarding cash, deleveraging, and facing massive uncertainty. Those are structural issues that trumped the cyclical rate environment. The policy implication. The Fed realizes that further incremental rate cuts are pointless. They must either find a different cyclical tool or accept that the problem requires structural policy to unlock corporate animal spirits.
And the second implication for an insignificant result.
It implies structural resilience. The variable itself is simply not sensitive to typical economic cycles. If we find that, say, the long-term debt-to-GDP ratio proves to be statistically insensitive to short-term cyclical growth, meaning even during a boom, the debt just keeps growing, it implies that the problem is not a temporary cyclical dip, but a permanent structural imbalance in spending and taxation.
And if the problem is proven to be structural, chasing it with short-term cyclical stimulus will be inefficient or even detrimental because you're injecting temporary cash into a permanent structural imbalance.
The significance test becomes a diagnostic tool. Cyclical policies, like temporary stimulus checks or interest rate adjustments, are designed for short-term fluctuations. If the insignificance test tells the policymaker that their problem, say, technological displacement of manufacturing jobs, is structurally resilient to those short-term fluctuations, they need to pivot entirely. They need long-term policies like vocational training, research investment, or tax code reform. The insignificant result clarifies whether the economy needs a quick correction or a long-term expensive overhaul.
It's fascinating that statistical significance isn't just about proving what matters, but about efficiently identifying what doesn't matter in the context of the business cycle, allowing policymakers to correctly allocate their limited resources and political capital.
That is the ultimate payoff. It moves economic debate away from ideology and anchors it firmly in empirical measurement.
This deep dive has pulled back the curtain on the engine room of economic analysis. We started by seeking the secret language economists use to distinguish signal from noise. We learned that finding significance is about detecting that real, non-random effect using the core tools of p-values, t-stats, and confidence intervals, proving the effect is robustly distinguishable from zero.
We spent critical time separating that statistical proof from economic importance, realizing that the sheer size and context of the effect often overrides the perfection of the p-value. And we saw how the rules of the measurement game ceteris paribus, sample size limitations, and the F-test for joint significance govern what we can and cannot reliably conclude about the cycle.
And crucially, we covered the hidden pitfalls. We detailed the dangers of relying on models that haven't accounted for data flaws like serial correlation, which gives a false sense of precision, or non-stationarity, which leads to entirely spurious conclusions. And we realized that major systemic shifts, like the Volcker shock or the global financial crisis, are structural breaks that require constant reevaluation of historical findings.
And we concluded on the crucial policy payoff. Statistically significant findings justify massive counter-cyclical interventions, while insignificant findings shift the policy focus toward diagnosing either weak transmission mechanisms or deep structural resilience. As we wrap up, I want to leave you with one final, provocative question that really haunts every econometrician. Given that policy interventions and structural breaks are constantly changing the economic landscape, if a cyclical effect was proven highly significant 20 years ago, based on data from a structurally different era, does that statistical finding hold any reliable meaning for policymakers today? Is a statistical truth valid if the underlying reality it describes has permanently changed?
That emphasizes the dynamic nature of economic research and the endless need.
If you follow the financial news, right, or you listen to a central bank governor, or even just, check a news outlet prediction for next quarter's GDP, you're always going to see something that looks like, well, our model estimates 2.5% growth with a margin of error.
Yeah.
That little phrase at the end.
That asterisk.
That's it. That little phrase is everything. And that inherent, completely unavoidable uncertainty is really the defining characteristic of macroeconomics. We're dealing with these vast, complex, highly volatile systems. I mean, they're full of human psychology, global shocks. So for an economist, the big question isn't just what is our estimate? It's how certain mathematically can we actually be about this volatile estimate? And our sources today, they really dive deep into the very core of this quantifiable doubt. Exactly. And that's our goal today. We're not here to, forecast when the next recession is going to hit or debate monetary policy. Instead, we are diving into the methodology. We're talking about how economists measure the reliability of the relationships they find within the whole economic cycle.
Yeah.
And our focus is on this crucial, but let's be honest, often overlooked measure that quantifies precision, the standard error.
Right. Our mission today is to take that abstract statistical concept, the standard error, or SE, and just transform it. Transform it into practical, actionable insight for you. We want to show precisely how this number determines the reliability of these estimated cyclical effects. And, maybe more importantly, why achieving small standard errors, why achieving precision is so incredibly challenging when you're dealing with real-world macro data.
Because it's a mess.
It's a mess. It's historically limited, it's constantly shifting, and it's massively volatile.
Okay, so let's start at the beginning, lay the foundation. What exactly is a standard error? And why do we need to treat it as so much more than just a footnote buried in some technical appendix?
At its heart, it's about precision. The textbook definition would be something like the degree of variation an estimated coefficient would exhibit if we could, in some hypothetical, perfect universe, draw different random samples from the same economic population over and over and over again.
Okay, so that's the what, but what's the so what? Why does this matter for someone just trying to understand the economy?
This is the critical so what. In the world of business cycles, where things like unemployment, inflation, investment, they're all constantly interacting, constantly fluctuating. The SEs are basically the gatekeepers. They're essential for assessing the reliability of any estimated effect. They tell us if, for instance, the observed impact of a central bank rate hike on consumption is a stable, reliable relationship that we can count on in the future, or if it was just a fluke. a product of temporary noise in the data.
So they're foundational for everything that comes after. Hypothesis testing, deciding if an effect is real, and then constructing those famous confidence intervals.
Right. Exactly, which is how policymakers translate all the statistical uncertainty into actual risk assessment.
All right, so let's unpack that. Part one, defining precision. To really get this, we need to go beyond that textbook definition.
Yeah.
If we're talking uncertainty, we have to first define what precision even looks like.
Okay, so let's get into the weeds just a little. We said standard errors measure the precision of estimated regression coefficients. So let's just imagine a classic model. An economist is looking at the relationship between, say, consumer confidence and spending on durable goods. Cars, refrigerators, that sort of thing.
Okay, simple enough.
They run the regression on the historical data, and they get a number, a coefficient. And it says for every 1 point increase in the confidence index, spending goes up by, let's say, $10 million.
That $10 million, that's the estimate of the effect.
That's the estimate. Now, the SE is the quantified wobble around that estimate. And to really internalize this, you have to run what we call the conceptual test, just as a thought experiment.
Okay.
Imagine you had a magic wand, and you could reset the last 20 years of economic history, but with a slightly different set of random observations, all drawn from the same underlying rules of how people behave.
So same economy, just a slightly different roll of the dice.
Exactly. And if you could rerun your confidence and spending analysis, say, 1,000 times on these 1,000 different histories, you would get 1,000 slightly different coefficients. Maybe one run gives you 9.8 million, the next gives you 10.1 million, another gives you 10.05 million. They'd all be clustered around a central value.
So the SE is basically a summary of all that variability.
Yeah.
Tell me how spread out that cluster of results would be.
Precisely. It is the standard deviation of that hypothetical distribution of all your coefficient estimates. And this is a critical point. It's not the dispersion of the raw data,
Which we know is huge.
which is massive. It's the dispersion of the estimate itself. So if that SE is small, say $50,000, it means in those 1,000 runs of history, all your estimated effects, they all clustered incredibly tightly around your reported value of 10 million.
And that tight cluster is the essence of precision. That gives you confidence that the $10 million figure you're reporting is extremely close to the true unknown effect out there in the real economy.
Absolutely. The smaller the standard error, the more precise the estimate. It's that simple. A small SE is the statistician's way of saying the data provided overwhelming, consistent evidence for the magnitude of that specific economic relationship.
And a large SE.
A large SE is a huge red flag. It suggests that if you had started with a slightly different set of economic observations, if the dice had rolled just a little differently, your answer could have been wildly different. Maybe 5 million. Maybe 15 million.
Which leads us to this critical relationship. You're saying if an economist just hands me the coefficient, that $10 million number on its own,
Yeah.
that actually tells me almost nothing useful until I know the SE.
That's a crucial insight that I think often gets missed outside of econometric circles. A regression coefficient by itself is just. It's incomplete. It is only meaningful when you pair it with its measure of uncertainty. So suppose our economist estimates that $10 million effect, but the standard error is, say, $20 million.
Wait, hold on. If the uncertainty, the SE, is 20 million, but the estimated effect is only 10 million, the wobble is twice as big as the thing you're trying to measure. That sounds terrifying.
It should be. It means that your result is statistically indistinguishable from zero. It suggests that if they had drawn a slightly different sample of data, the estimated effect could plausibly be zero, or it could even be negative.
So that $10 million is statistically irrelevant.
The statistical relevance of that coefficient depends entirely on its size relative to its standard error. You could have a massive sounding effect, say a $50 billion impact from some policy, but if the standard error is $100 billion, it's statistically meaningless.
So it's the relationship, it's the ratio that matters most. Because that ratio is what tells us if the signal, the coefficient, is loud enough to overcome the noise, the standard error.
That is a perfect way to put it. The signal-to-noise ratio. And this ratio gives us the fundamental measure we all rely on, the t-statistic. It's literally the estimated coefficient divided by its standard error. So in your example, 10 million divided by 20 million, your t-statistic is 0.5.
Which means the coefficient is only half a standard error away from zero. That's not very far.
Not at all. Now, what if the SE was only 2 million? Then your t-statistic is 10 divided by 2, which is 5.0. That means the coefficient is 5 full standard errors away from 0.
And we know, just from basic stats, that an estimate usually needs to be roughly 2 standard errors away from 0, so a t-stat of 2 or more, to be considered statistically significant at the standard 95% confidence level.
Exactly right. So the t-statistic acts as the statistical referee. It standardizes the measure of impact, making sure that when we look across different models or different economic metrics, whether we're measuring effects in millions or billions of dollars, we have a common yardstick.
A common way to judge if the finding is a solid, reliable signal.
A high t-statistic is the economist's proof. It's their evidence that the estimated effect is truly distinct from just random noise.
Now, okay, let's bring this back to the overwhelming complexity of the real economy. In a macro model, everything is moving. You've got interest rates, global trade, consumer sentiment, government debt. Where do SEs fit into this tangled web when we're trying to isolate the effect of just one thing, like a change in the central bank's balance sheet?
They fit within this really important principle of ceteris paribus.
Latin for all other things being equal.
Right. And our sources really emphasize that SEs measure the uncertainty holding other variables constant. When an economist builds one of these big multiple regression models, the entire purpose is to isolate the effect of one variable, like you said, the size of the Fed's balance sheet, while mathematically controlling for dozens of others, like inflation expectations or global oil prices.
So if the model successfully controls for all the other major moving parts, the coefficient they get for that balance sheet effect should be clean. It should reflect only its unique impact.
That's the goal. Ideally, yes. And the SE on that specific coefficient reflects precisely how well the model has managed to do that isolation. So think about it this way. You're trying to estimate the effect of infrastructure spending on GDP during a recession. You have to include controls for consumer confidence, the current unemployment level, business investment, all of which move with the business cycle.
They're all correlated.
Exactly. If your model controls for those factors effectively, it soaks up their explanatory power, leaving a cleaner relationship for your infrastructure spending. And so the SE on that infrastructure coefficient will be smaller because you've removed a lot of the competing noise from the equation.
But what if you miss something? What if you forget to account for a massive surge in global commodity prices that's happening at the exact same time as the infrastructure spending?
That's where the trouble starts, and that's where the SE becomes a warning signal. If a key factor is missing, the model's error term, that's the residual, the part of the outcome the model can't explain, it will absorb the effect of that missing correlated variable.
So the error term gets bigger.
It gets bigger. And since the SE is directly related to the size of that error term, if the error term swells, the standard error for your infrastructure spending coefficient swells right along with it. It's reflecting the difficulty of pinning down that single precise relationship when the model is incomplete. The larger SE is essentially the model saying, hey, I can't be sure the spending effect isn't really just the commodity price effect masquerading as infrastructure impact.
That makes perfect sense. Okay, so this idea that SEs quantify the noise leads us into the whole question of statistical significance.
Right. This is where the rigorous standards of statistics really meet the messy, complicated reality of the economy.
And this is where we get what our sources call the uncertainty paradox.
Before we get to the paradox, we just have to reiterate the critical role of the SE here. Statistical significance, that bar, an estimated effect, has to clear to be taken seriously. It depends inversely on the size of the standard error. It's just pure math built right into the t-statistic.
Meaning, the easiest way to make a coefficient look statistically insignificant is to have a huge SE, even if the effect itself is massive in the real world.
Precisely. Large SEs act as a kind of statistical brake. They automatically lead to lower t-statistics, often pushing them below that critical threshold of around 2.0. And in macroeconomics, we often confront these inherent factors, which we'll detail in a bit, that just automatically push SEs sky high.
Okay, so that brings us to this profound and honestly frustrating concept, the uncertainty paradox. Can you explain this for us? How can a policy effect be economically meaningful but statistically insignificant?
It happens all the time. Let's take a politically charged example, like the estimated impact of a specific minimum wage hike on local employment.
Okay.
An economist might run a model and find a coefficient that suggests, say, a 1% decline in employment. Now, for the workers involved, a 1% decline is a very significant economic impact.
Absolutely.
But Because the local job market data is sparse, maybe? Or perhaps the effect is just swamped by other things happening at the same time, like a global trade war or a local factory closing down. The standard error attached to that 1% decline is enormous.
So if the SE is so large that the confidence interval around that 1% decline also includes 0, meaning the model can't rule out the possibility that the wage hike had absolutely no effect at all,
Then the finding is declared statistically insignificant.
even though the best guess is a 1% drop.
Exactly. The result is insignificant, which means the economist cannot, by rigorous statistical standards, reject the null hypothesis that the effect is 0. They are left with the paradox. The model suggests a meaningful economic outcome, but the measurement tools are just too blunt, too uncertain to confirm it. The SE acts as the ultimate statistical skeptic. It forces the economist to say, look, I see this result, but I cannot rule out that it was pure chance.
Wow. So the policy could be economically critical, yet it gets statistically dismissed simply because of the sheer noise and uncertainty in the data. That's fascinating because it means policymakers sometimes have to choose between a finding that is statistically safe, but maybe economically trivial,
Right.
versus a finding that is economically massive, but statistically risky because the SE is so large.
It forces a critical judgment call on the policy side, doesn't it? Do you base your decisions on the best estimate, even if the error margin is really wide? Or do you wait for more precise evidence, which could take years to gather? The SE quantifies that exact decision risk.
And this whole problem is made worse by the very nature of the data itself.
It's compounded, yes. Economic cycle indicators, GDP, inflation, housing starts, they're not stable things. They exhibit massive high volatility. And they also suffer from what's called serial correlation, which just means that data points are heavily related to the ones that came before them.
Right. We're constantly dealing with data that just swings wildly. You have the relative stability of the 1990s, then the tech boom and bust, then the massive shock of the 2008 crisis, and then the completely unprecedented volatility of the pandemic.
And that inherent volatility directly dictates the size of the standard errors. It has to. When the underlying data points are scattered far and wide, it becomes statistically much, much harder to draw a precise, confident line that represents the relationship between them. The statistical model has to account for all that extreme movement.
It sounds like trying to estimate the average height of people at a basketball game, where your participants range from small children to 7-foot-tall professional athletes. The mean might be one number, but the variance around that mean is just enormous.
That's a perfect analogy. In statistics, the size of the sample variance is a key ingredient in the formula for calculating the SE. So, larger fluctuations in cyclical data, the statistical spread of the economic variables, they naturally lead to larger standard errors. This instantly reduces the precision of your estimated coefficient. If you run an analysis that spans a period, including a massive, unprecedented event like the Great Recession, the SE is going to expand to accommodate the largest, most uncertain volatility observed during that period. And that drags down the precision of the overall average estimate for the entire time frame.
Okay, so we've established that macroeconomists have this systemic precision problem. So let's dig into the why. Why is this struggle for a small SE so much harder in macro than it is in, say, analyzing high-frequency stock trades or running clinical trials? Our sources give a really concise but powerful list of the unique challenges.
They do, and it's not about economists being bad at their jobs. It's about the fundamental nature of the evidence they have to work with.
Let's start with the one that feels the most unfair. The unavoidable truth. The limited number of business cycles in the historical sample.
This is the tyranny of the small sample size in macroeconomics, and it is, without a doubt, the single greatest structural cause of large SEs. Think about it. If you're a social scientist studying human behavior, you might survey 10,000 individuals. If you're an environmental scientist, you might have millions of daily weather observations going back decades.
Right, you've got tons of data.
In macroeconomics, if we define the business cycle using quarterly data since World War II, we're dealing with maybe 280 to 300 data points in total.
That's not a lot.
It's not. But more importantly, the number of independent, full cycles from peak to trough back to peak is often cited as only 10 to 15.
We are trying to infer universal laws of the entire economy from a sample size of around 15. That scarcity of historical observations must absolutely crush precision.
It drastically limits it. Mathematically, the standard error is inversely proportional to the square root of the sample size. So to cut your SE in half, you need 4 times the data.
Which we don't have.
We can't invent new economic history. We can't go run a controlled experiment on the 1970s again. So our SEs are structurally large right from the start. And when we try to study very rare events like severe sovereign debt crises or episodes of hyperinflation, we might only have 3 or 4 examples across the entire historical record for all developed nations.
Any estimate you derive from 3 or 4 data points is going to be incredibly uncertain.
It will necessarily carry a massive standard error. It reflects the near impossible task of making broad inferences from so little evidence.
And compounding this scarcity is the second challenge.
Sure.
Issues with data quality. Macro variables are often, as you said, estimates of estimates.
Exactly. This isn't physics, where you can measure mass with incredible precision. A macroeconomic variable like gross domestic product or GDP or corporate profits, these are constructed figures. They're built from surveys and models.
And they get revised.
They are subject to significant measurement error. Initial estimates of GDP are notoriously noisy. They're often revised substantially, months or even years after the fact.
So when an economist uses that initial noisy flash estimate of GDP in their model, they're basically introducing statistical fuzziness right at the start of the process.
That's right. Measurement error introduces noise into the model's inputs, and that forces the statistical model to try and fit that noise. If the data quality is poor, the estimates become fuzzier, and the model compensates by increasing the SE. The model is basically recognizing that because the input data itself is uncertain, the relationship derived from it must also be uncertain.
The lack of clean, instantaneous data clarity directly feeds into the SE and lowers the overall precision.
Every time.
Okay, so we've got data limitations. But then there are errors in the models themselves.
Yes, beyond the limitations of the data we collect, the very structure of the models we build can introduce further challenges that inflate the SE.
Let's talk about challenge number 3, the missing pieces. This is the problem of omitted variables.
Omitted variable bias is the bane of econometricians. If you leave out a variable from your model that is correlated both with the business cycle and with the variable you're trying to explain, your uncertainty just balloons.
Can you give us an example?
A classic one is trying to model productivity growth. You might build a model that uses only capital investment and labor hours.
Seems reasonable.
It does, but you might get a result that looks really unstable or imprecise. And that's because you've omitted the massive confounding factor of technological innovation, which is very hard to measure, but it strongly influences productivity, and it's also correlated with investment.
So the coefficient you get for capital investment might look highly imprecise. It has a huge SE because its estimate is incorrectly soaking up the unmeasured effect of technology.
Precisely. The model's error term absorbs the massive systematic effect of that missing technology variable. And when the error term swells, the standard error on the variables you did include swells right alongside it. It happens because the model is now uncertain how much of the measured effect truly belongs to the included variable versus how much belongs to the unknown, omitted factor. That larger SE is the model waving a big red flag that says, be careful, this estimate is highly compromised by unknown factors.
And challenge 4 might be the most dramatic of all. Structural shifts. The economy isn't governed by unchanging physical laws. It changes.
No, it's not. And structural breaks, these sudden permanent changes in policy or market behavior, are absolute SE killers. Consider the period known as the Great Moderation, right? From the mid-1980s up to 2007, it was characterized by much lower macroeconomic volatility.
Things were relatively calm.
Very calm. Now, if you try to build a single model to estimate the relationship between, say, unemployment and inflation, and you use data that pools the turbulent 1970s with the stable 1990s, that model cannot succeed.
Because the underlying parameters of the economy, the way consumers and firms and even the central bank behaved, were fundamentally different after Paul Volcker changed monetary policy in the early 1980s.
Exactly. The volatility in the 70s was much higher. The stability in the 90s was much lower. Trying to force a single estimated relationship across both of those periods means the model has to find some kind of compromise that fits neither period perfectly.
And the result?
The result is that the SEs spike around the time of the break, and the overall SE for the entire period is unnecessarily inflated. It's reflecting the model's inability to cope with the fact that it's trying to measure two different economic realities at the same time.
So the SE is telling you that your entire model is likely misspecified because it's assuming stability where there is, in fact, instability. Which brings us right to challenge 5, model misspecification itself.
This is the simplest, most direct cause. If your model just poorly fits the underlying economic reality, The residual errors will be large, period. Maybe the effect of interest rates on investment is nonlinear. Maybe it's small when rates are low, but it becomes huge when rates are high. If you insist on using a simple linear model, it's going to fail to capture those nonlinear dynamics.
And the error term will just capture all that unexplained nonlinearity.
Right. And large systematic errors mean large standard errors. The model fails to account for a significant portion of the outcome, and so it declares that portion uncertain. If the model is misspecified, if the timing, the lags are wrong, or the functional form is wrong, it guarantees large SEs and low precision. The SE here is a direct diagnostic tool. It's telling the economist, go back to the drawing board and fix your assumptions about how the economy actually works.
Okay, so we've established that macro data is just intrinsically prone to large standard errors. Historical limitations, economic complexity, it's a perfect storm. But economists don't just throw up their hands. They employ these advanced techniques not to magically shrink the SE, but to ensure that the SE they report is accurate, that it reflects the true uncertainty even when the data violates those ideal textbook statistical assumptions.
This is the critical adjustment phase. This is where we move from the simplistic world of classical regression to the necessary complexities of modern econometrics. And if you don't make these corrections, you risk falsely believing your results are precise when they're not, and that is perhaps the most dangerous form of uncertainty there is.
So let's start with the first big assumption that needs correcting: homoscedasticity.
Right. So classical regression analysis assumes what are called homoscedastic errors. It's a Greek term. It just means same scatter. It assumes that the variance of the error, the level of that unpredictable noise, is constant across all of your observations. In our economic context, it assumes the noise level in the data was the same in a quiet year like 1995 as it was in a crisis year like 2008.
And given everything we've talked about, the volatility differences between the quiet Great Moderation expansion and the massive Great Recession collapse, that assumption is clearly dangerously wrong.
It is a profound violation of the assumptions. Economic cycle data is almost always heteroscedastic. Different scatter. The error variance changes dramatically over time. During an expansionary boom, economic variables tend to be relatively stable and predictable. The errors are small. During a crisis or a severe recession, the data swings wildly. The errors are huge.
So what happens if the model just uses a simple formula to calculate the average error across that entire period, ignoring the difference?
The standard errors become fundamentally incorrect. They're biased. If you average the small, tight errors of the 1990s with the colossal errors of the 2008-2009 period, the reported SE for the whole sample will be distorted. Specifically, the standard error for the stable period will be overestimated, and the standard error for the volatile period will be underestimated.
And that distortion leads directly to misleading statistical inference. If you underestimate the SE for the crisis period, you might falsely declare an estimated effect during that time to be significant, when in reality the true uncertainty was much, much higher.
Absolutely. The simple model fails to correctly assign the uncertainty where it actually occurred. If you ignore heteroscedasticity, you are introducing systematic error into your measure of uncertainty. You need a tool that allows the error variance to be much larger during known turbulent periods and smaller during calm ones without forcing them all to be equal.
Which is why, in almost every serious macroeconomic paper I've ever seen, you see that little footnote mentioning the use of robust standard errors.
Yes. Economists universally rely on heteroscedasticity robust standard errors. They were popularized by people like Hal White. And the goal here is computational flexibility. These robust SEs, they don't change the estimated coefficient. Your $10 million value remains $10 million, but they correct the estimate of its precision by acknowledging that non-constant volatility.
How does the calculation actually do that? How does it account for the varying volatility?
Well, conceptually, you can imagine the model is running on a bumpy road. In a standard model, every bump is treated the same. A robust SE calculation is smarter. It essentially assigns a different weight to each observation based on how noisy it is. So the observations from the incredibly volatile 2008 period are given less influence in the overall calculation of the standard error than the calm, stable observations from, say, 2005.
So robust SEs prevent a few extremely noisy outliers, like the stock market movements right after a major shock from disproportionately inflating the SE for the rest of the sample.
Or, conversely, they prevent the stable periods from masking the true risk of the volatile periods. It's a very clean way to frame it. They ensure that the SEU report is a far more reliable measure of uncertainty, even when the assumption of constant error variance is violated.
which in macro analysis
is almost always the case.
Yeah.
Robust standard errors are not a luxury in cyclical analysis. They are an absolutely necessary correction to avoid fundamental statistical errors.
Okay, but there's another statistical killer out there, unique to time series data. Serial correlation, or autocorrelation. If you're using data collected over time, like quarterly GDP, those data points are not independent events.
No, not at all. Today's economic condition is a direct consequence of yesterday's condition. If inflation was high last quarter, it's highly likely to be high this quarter as well. The observations are dependent on prior observations.
Yeah.
That dependence is the very definition of a cyclical economy.
So if we ignore that fact, if we treat 200 quarters of GDP data as if they are 200 independent coin flips, what's the statistical danger?
The danger is that we systematically underestimate our standard errors. And critically, we will falsely overstate our statistical significance.
How does that happen?
By ignoring the serial correlation, we are implicitly overstating our effective sample size. We're pretending we have 200 unique independent pieces of information, when in reality, the high correlation might mean we only have the equivalent of, say, 50 independent pieces of information.
And if you pretend your sample size is 4 times larger than it truly is, the math for the standard error will automatically shrink it down way too far.
Exactly. And when the SE is artificially small, the resulting t-statistic becomes artificially high. And then effects that are actually just tenuous random noise will appear to be highly statistically significant. This is a classic historical trap in time series econometrics. You see it in older papers all the time. Results look much more certain and precise than reality dictates. An economist might report a t-statistic of 3.0, suggesting overwhelming significance, when the correct adjusted SE would pull that t-statistic down to 1.5.
Which means the result is statistically meaningless.
Totally meaningless.
So the fix has to account for both things at once: the changing error variance, the heteroscedasticity, and the time dependence, the autocorrelation.
Correct. For any serious macroeconomic cycle analysis, we must use adjusted standard errors. You'll often see them referred to as HAC standard errors. That stands for heteroscedasticity and autocorrelation consistent.
HAC standard errors.
These are the gold standard for time series data. They combine the robustness you need for varying volatility with the clustering adjustments you need for time dependence. They effectively correct the degrees of freedom downward to reflect the true, smaller, effective sample size. And that gives a more conservative but infinitely more accurate measure of uncertainty.
So when a central bank invents a model, and you see that they've used HAC standard errors, they are essentially telling the world, we have taken all the available steps to account for the inherent messiness and time dependency of this economic cycle data.
They're saying, this measure of uncertainty is the most honest quantification possible given the limitations of history. It's a statement of statistical rigor. And it's designed to provide the most reliable basis possible for making policy decisions.
Okay, let's pull all this technical discussion into the real world. Why should you, the listener, who isn't running regressions, care about the difference between a simple SE and a robust HAC SE? Well, because these concepts directly frame the risk tolerance of central banks and governments.
That's where it all comes home.
So, policymakers fundamentally rely on standard errors to judge the certainty of an estimated effect before they pull any levers. If the SE is large, what is the immediate psychological or, practical consequence for that decision maker?
The large SE quantifies the level of uncertainty, which translates directly into risk. It's that simple. Imagine a government is considering a massive, immediate infrastructure investment to combat a recession. They run their models to estimate the fiscal multiplier, how many dollars of GDP growth they'll get for every dollar they spend. The model estimates a multiplier of 1.5.
That looks great.
Yeah.
$1 in gets you $1.50 out.
Seems like a no-brainer. But then they look at the SE. And if the standard error is so large that the uncertainty, the confidence interval, suggests the true multiplier could plausibly be anywhere from 0.2 to 2.8.
Oh, wow. That changes the decision completely.
It forces intense caution. A multiplier of 0.2 means the spending is mostly ineffective. You're potentially adding enormous debt for a minimal return. A multiplier of 2.8 means the policy is hyper-effective and you might overheat the economy. The policy decision becomes a high-stakes bet against that wide standard error. High SEs on key policy multipliers, whether they're fiscal or monetary, they mandate caution. and they usually result in slower, more measured policy responses.
Or they rely on tools that have historically shown smaller SEs.
Exactly. Conversely, if an effect has a tiny SE, it gives policymakers the confidence to act aggressively because they know the outcome is very likely to be close to the estimate.
So the SE isn't just about statistics, it's the quantified measure of political and economic risk.
Absolutely. It's the risk management metric. It informs the policymaker's assessment of the probability of unintended consequences. If the model suggests a desired outcome, but the SE is large, they have to seriously factor in the risk that the true outcome is substantially delayed, much smaller, or even negative.
And the most transparent way to communicate this is through confidence intervals.
Yes, the SE's utility is most clearly seen there. This is the plus or minus y we started with. It's the tangible representation of that statistical wobble.
So if the SE is the standard deviation of the estimate, the confidence interval is the resulting range, usually 2 standard errors in either direction. We believe the true effect lies 95% of the time.
That's right. A 95% confidence interval is built directly from the SE, and this interval is the signal that policymakers have to interpret. When you see wide confidence intervals, that is the market's or the model's way of signaling extreme uncertainty in the estimated cyclical response.
Let's go back to the Great Recession. There are huge debates raging over the size of the fiscal multiplier for the stimulus packages.
Huge debates.
And some of the estimates, even from very respected sources, had 95% confidence intervals that stretch from, say, -0.5 all the way up to 2.0.
And that wide range is a massive political and economic warning sign. A negative multiplier suggests the spending actually harms the economy. A 2.0 multiplier suggests wildly successful. If a central bank or a government is relying on an estimate with an interval that wide, the implication for you, the listener, is crystal clear. The policy is inherently a high-risk gamble. The data simply has not delivered the precision needed for certainty.
So, relying on a wide confidence interval forces policymakers to manage the potential for those extreme outcomes. The low end, which is policy failure, and the high end, potential overheating represented by the edges of that interval. It shifts their focus from predicting a single point to mitigating the full spectrum of risk.
It does. It means they have to employ policy hedges. If the SE is large, a policy decision has to be flexible. It has to be capable of being reversed or adjusted quickly because the potential for the true effect to be far from the expectation is very, very real. The SE ensures that uncertainty is at the forefront of the decision-making process, not just relegated to a footnote in an appendix.
This has been a really profound journey into the quantification of economic doubt. We started by defining the standard error as the critical measure of precision. We showed how a coefficient is basically meaningless without it, and how their ratio, the t-statistic, serves as the ultimate statistical gatekeeper.
We then explored all those structural realities that just conspire against precision in macroeconomics. The tyranny of limited sample sizes, pervasive data quality issues, the shadow of omitted variables, and the SC inflating chaos of structural breaks like major financial crises.
And finally, we detailed the necessary statistical defenses. The indispensable use of robust standard errors to correct for that changing error variance, the heteroscedasticity between booms and busts,
and the necessary adoption of clustered or HAC errors to prevent serial correlation from falsely overstating statistical significance, from making us think we're more certain than we really are.
The final synthesis here seems crucial.
I think it is. In economic cycle analysis, uncertainty is not a sign of poor modeling. It's an inherent characteristic of studying a complex system with a limited history. The job of the econometrician isn't to eliminate uncertainty, that's impossible. It's to measure it accurately, vigilantly, so that policymakers can judge the true risk associated with their interventions.
And that leads to a provocative thought for you to carry forward with you. When policymakers use the best, most technically robust statistical methods, HAC errors, proper controls, everything done by the book, but the resulting analysis still yields these wide confidence intervals on key policies, it fundamentally changes the nature of governance. It means the policy decision is not rooted in mathematical certainty, but in philosophical judgment.
So does robust statistics truly inform policy when the SCs are that large?
Or does that high, quantifiable uncertainty simply force policymakers to rely more heavily on their non-statistical experience, their intuition, their political belief system, to choose which end of that wide confidence interval they're willing to gamble on?
It really raises a question of where the science ends and where the art begins.
A perfect distinction. Thank you for joining us for this deep dive into the precision and the necessary imperfection of economic cycle analysis. We'll see you next time. Welcome back to the Deep Dive, where we take your stack of sources and turn the most complex topics into the clearest, most actionable insights. Today, we are opening up the hood of economic modeling. We're going to look at something that's really fundamental to how we understand economic reality. It's this idea that an inherent memory that's built right into the system.
That's a great way to put it. It's this memory, this persistence that is, I think, the silent killer of policy confidence.
The silent killer.
Absolutely. We're talking about the reason a recession or, a big economic boom never just stops on a dime. There's this momentum. And if analysts ignore that momentum, well, they do so at their absolute peril. The statistics they rely on end up lying to them, specifically about their own certainty.
And that's the core tension, isn't it? If you're reading an economic forecast or maybe a policy paper and it claims we are 99% certain about this outcome, you, as the listener, need to understand the statistical tripwire that can make that certainty a complete illusion. So our mission today is to do a deep dive into something called serial correlation.
Sometimes called autocorrelation, same thing.
Right. Autocorrelation.
Mm-hmm.
We're going to find out why it's not just common, but, well, nearly unavoidable in time series economics. And we're going to reveal this incredible paradox. It doesn't actually bias your estimated relationships, but it completely destroys your ability to trust how strong or how precise those relationships are. We're really aiming for that critical aha moment.
Yeah.
The moment you realize why simply being right about a trend isn't enough.
Yeah.
You have to be honest about your uncertainty.
Exactly.
Okay, so let's unpack this. And to do that, I think we have to start at the absolute foundation. If you're running an econometric study, a classical regression model, you begin with this bedrock assumption. It's like a statistical dream world where all the messy, unexplained factors in your model are just purely random.
That is the crucial starting point. You're talking about the standard ordinary least squares approach, or OLS, and it operates on a set of assumptions that we sometimes call the Gauss-Markov conditions. Right. And the one we really care about today is the one about the error terms, the little bits left over. They're usually denoted as U sub t.
Okay.
And the assumption is that these errors, these heights, have to be completely independent of one another.
So, just to be super clear, other OLS is all the stuff we didn't include in our model. Or maybe the randomness we just couldn't measure. It's the residual, the unexplained part.
Precisely.
And the model just assumes that the reason we missed our prediction last month has absolutely no connection to the reason we might miss our prediction this month.
None whatsoever. In a perfect, ideal world, if you miss predicting GDP growth this quarter by, say, 1 percentage point because of some unexpected political spat, that's your error, your old dollars. That specific event should have zero statistical bearing on why you miss your prediction next quarter.
They should just be like flipping a coin every period. Totally random.
Totally random. They should be independent draws from a statistical distribution. But of course, the real world isn't like that.
Especially not the economic world.
Yeah.
It's rarely that tidy. Things are connected.
They are. And when that independence assumption is violated, we have our problem. We have serial correlation.
Okay, so the definition.
Serial correlation occurs when those error terms in a regression model are statistically correlated over time. The error from time t is linked to the error from time t1 or t2 and so on. It has a memory.
This sounds almost philosophical, but you're saying it has really concrete statistical consequences. If the error term represents all these unobserved factors, then serial correlation must mean that the unobserved stuff from the past is still knocking around, creating a systematic influence on the present that our model failed to account for.
That's it, exactly. And the magnitude of this violation, it really matters. We even categorize it. So most frequently in macroeconomic data, you see what's called positive serial correlation.
Positive, meaning?
Meaning a positive error today is likely to be followed by another positive error tomorrow, and a negative error is likely followed by another negative error.
So if my model is consistently underestimating growth, that's a positive residual, it will probably just keep underestimating it for a little while.
For a while, yes. The errors will cluster together.
Okay, so we've moved from this ideal world where errors are just independent noise to the reality, where errors actually form a systematic, persistent pattern. And that is the fundamental assumption violation we have to deal with.
That's the core of the problem.
Now let's dig into why. Why is this problem so ubiquitous in economics? Why is it basically unavoidable? I mean, if we were studying, I don't know, the trajectory of a bullet, maybe the errors would just be true measurement noise.
Right.
But In economics, it feels like it's inherent to the subject.
It is. And what's fascinating here is that the problem isn't usually the statistician's fault. It's, as you say, baked into the nature of the beast. Economic cycles are, by their very nature, persistent and dynamic.
They have inertia.
Exactly. Economics is governed by inertia, by lag structures, and by these very slow-moving institutional or even behavioral factors.
Inertia is the key word there. Why does the economy resist changing instantly? What's holding it back?
Well, because the inputs themselves are slow to move. Just think about the time it takes for, say, the Federal Reserve to change an interest rate. That change has to permeate through the entire lending market. Then it has to influence big investment decisions. Then those decisions affect hiring. And only then, way down the line, does it alter consumer prices.
We're talking about a process that takes, what, many quarters?
Yeah.
Maybe even years?
Sometimes years, yes. That's the structural rigidity of the system.
Okay.
And the source material highlights this part beautifully. The shocks to the economy are themselves persistent, whether it's a major recession, a pandemic, a boom driven by a new technology, or big policy shift. These things are not single-period isolated events.
They have aftershocks.
Big ones. When the COVID-19 pandemic hit, the supply chain shock didn't just vanish in a month. It created bottlenecks and labor shortages that persisted for years. It fundamentally affected future outcomes.
So, if the shock itself is persistent, and a big portion of that shock is captured in our unexplained error term, our TSURE, because we didn't, say, explicitly model the full complexity of the supply chain,
Then what happens?
then the error term itself must be persistent over time. It has to be.
That is the exact mechanism that generates correlated errors. If our model is even slightly misspecified, and they all are, if we fail to include a key variable that moves slowly, like consumer confidence, or if there are inherent lags in the true relationship, that unobserved, slow-moving influence, it doesn't just disappear, it bleeds into the subsequent error terms.
It's like trying to model a boat sailing in a river. You model the wind and the engine, but you completely forget about the current.
Good analogy.
That unmodeled current is your error term, and that current doesn't just reverse direction every 5 seconds. It keeps pushing the boat in the same direction for a long, long time.
A perfect analogy. So our regression errors today are often systematically related to the errors we had in the previous periods because of these slow-moving currents. And this makes serial correlation a near inevitability in macroeconomic time series. If you ignore it, you're effectively ignoring the fundamental persistence of economic activity itself. And to really drive this home, to show its economic relevance, we should look at how this persistence actually shows up in the data we analyze. It's what the sources call the clustering effect.
The clustering effect.
Serial correlation really just reflects the dynamic nature of business cycles, where you see these expansionary or contractionary phases, and they tend to cluster together over time.
They aren't just isolated incidents. They produce this systematic dependence across the observations. Okay, so let's dive into the classic examples the sources mentioned. Let's start with the big one, GDP growth.
GDP growth is the ultimate indicator of economic momentum. If an economy is expanding at a robust 4% rate this quarter, it's not going to suddenly contract by 2% next quarter, not under normal circumstances. Of course not. The capital stock is already in motion, hiring is already underway, confidence is high. There's a whole machine that's already running.
Yes. So if we run a regression trying to predict current GDP growth using variables like, say, current interest rates or government spending, and our model misses the mark. Let's say actual growth is higher than we predicted.
We get a positive error.
We get a positive error. And that positive error is carrying forward the momentum of all the unobserved factors. What could those be?
I mean, it could be anything, right? An unexpected wave of technological diffusion, a sudden unmeasured surge in what Keynes called animal spirits like entrepreneurial optimism.
Exactly. And these aren't switches you can just flip on and off. They require investment cycles, hiring cycles, production adjustments. These things take several periods to play out. And because GDP growth tends to remain high for a while or remain low for a while, if our model fails to capture the start of a new trend, it will likely keep failing to capture it until that trend fundamentally changes direction, which leads to a long run of correlated positive residuals or correlated negative residuals.
Precisely.
That's clear for physical activity like production. Okay, so now let's look at labor markets. Unemployment. This feels like it moves even slower.
Oh, it does. Unemployment rates adjust perhaps the most gradually of all the major macroeconomic indicators. They reflect a profound inertia.
So when a downturn begins, companies don't just fire everyone on day one.
No, of course not. They start with hiring freezes, they reduce overtime, and only then, slowly, do they start the layoff process. It's costly and disruptive.
And there are significant search frictions in the market too, aren't there? I mean, people don't find new jobs instantly. It takes time, maybe retraining, matching skills to jobs.
Absolutely. The time it takes for a firm to create a vacancy, for a person to search for a job, and for that match to actually stabilize, it creates immense persistence. So a rise in unemployment today almost guarantees high unemployment tomorrow, just because the frictional structure of the labor market means the process cannot adjust instantly. The sources call this deep inertia.
So if your regression model underestimates the severity of a recessionary shock in 1 month, that residual shock is carried forward because the labor market physically cannot clear instantly. The unemployment rate is sticky.
Therefore, the error term you're using to predict it will also be sticky.
It all connects.
Okay.
And finally, inflation. This is maybe the most behavioral example, which is, why it's so critical right now. The sources say inflation often shows inertia. So why is current inflation so heavily dependent on past inflation?
This is where economic theory gives us a perfect justification for serial correlation. We can look conceptually at something like the new Keynesian-Phillips curve, the NKPC.
Okay.
This model explicitly incorporates expectations into its structure.
People's beliefs about the future.
Yes. If consumers and businesses expect prices to rise, maybe because they saw high inflation last year, they bake those expectations into their behavior. They demand higher wages. They write different supply contracts. They change their pricing strategies.
So the memory isn't just structural, like with factories and hiring.
Yeah.
It's psychological.
It is entirely psychological and behavioral. And those ingrained expectations create a very sticky inflation dynamic.
Okay.
So if a central bank model misses its inflation prediction this month, say, it fails to capture a sudden rise in inflation expectations, that unexplained expectation component from the error term will persist. It doesn't just vanish.
It influences next month's pricing decisions.
Which leads to a correlated error term. You have to explicitly model expectations, or that persistent expectation effect just hides out in your error, causing autocorrelation.
Wow. So in all three of these crucial macroeconomic indicators, GDP, unemployment, and inflation, we are basically guaranteed to find this systematic dependence. It's because the underlying economic structure dictates gradual change, and that's driven by physical inertia, institutional lag times, and these really sticky human expectations.
It's unavoidable. Now we have to zoom out from the economy for a moment and look at the mathematical formula again. We have to be really clear about where this persistence actually lives in the model. So we start with the basic linear regression framework. YT paid of beta plus beta 1 XD plus E.
Okay, so $2 is what we're trying to predict, like inflation. Seek dollars in our variable of interest, our policy lever, like interest rates, and $2 is the residual, the remainder, the part we got wrong.
Right. And serial correlation specifically implies that the correlation between the current error term, $2, and the previous period's error term, $2, is not zero.
Correct at UT1 $2.
Correct. That non-zero correlation is the mathematical definition of memory.
So instead of being pure white noise, just random static, the error term is actually following its own internal dynamics. It has a life of its own.
It does, exactly. And we can conceptualize this internal dynamic using what's called an autoregressive process of order 1, or AR1. Now, we don't need to run the full math here, but the conceptual understanding is really key. In this case, our error term $2 isn't just random noise. It's determined by a specific structure. That structure is 2 dro UT1 plus $T.
Okay, let's pause on that formula for a minute. $2 UT1 plus $C. Let's break that down. What are $2 and 2?
So think of PET as the genuinely new random shock. That's the pure, unpredictable noise we wanted all along, the truly random part.
The coin flip.
The coin flip, yes. The crucial part of that equation is 2, which is the Greek letter rho. 2 is the persistence coefficient.
The persistence coefficient.
If 2 is 0, then we have no serial correlation. The equation becomes 2 equals 8. And 2 is just random noise. We're back in our ideal world.
But it's usually not 0.
No. If 2 is, say, close to 1, like 0.9, it means that 90% of the previous period's error is carried forward and directly influences the current period's error.
So poor is literally quantifying the memory of the system. If 2 is positive and large, it means past unobserved shocks are significantly influencing current outcomes. It's like a secret hidden variable that your model failed to capture, but that variable is slow moving and it just drags its influence along, maybe indefinitely until it finally dissipates.
That is the most important conceptual connection to make. If we see serial correlation in our data, we haven't just violated some obscure statistical rule. We have failed to adequately model the persistence that is inherent in the economic structure. We are allowing that persistent economic information to hide in our residuals.
And that sounds like a big problem.
It is. And it leads us directly into the danger zone. Because even if the relationship we're measuring is structurally correct, we are now lying to ourselves about how well we actually measured it.
Okay, this brings us to what is, for me, the most counterintuitive and I think arguably the most destructive consequence of serial correlation.
Yes.
This is where the math really leads us down a false path of confidence.
Yes. This section requires critical attention because the consequences are so subtle, yet they are devastating for anyone relying on time series analysis for decision-making. We have to start with the paradox.
The paradox. Okay, let's tackle that critical fact first. The sources say that serial correlation does not bias the OLS coefficient estimates.
Right.
So the calculated relationship, how much a 1% change in interest rates affects GDP growth, that number is still, on average, centered around the true value.
This is the one statistical gift we get from OLS, provided the other assumptions, like exogeneity, hold up. The coefficient estimates are still considered unbiased. If you could run the same regression an infinite number of times on different samples, the average of all your estimates would equal the true underlying relationship.
So OLS still works in identifying the central tendency of the relationship.
It does.
Okay, wait. If my estimate is, say, 0.51, and the true effect is 0.50, and my model keeps giving me answers that are pretty close to 0.50, then why should I, as a policymaker or just as a learner, care if my standard error is a little bit off? Can't I just trust the number?
That is the crucial question, and it's what distinguishes a layperson's interpretation from an economist's. You care because reliability is everything.
Explain that.
An estimate of 0.5 is completely useless without knowing the range of possible true values around it. What if the true range is actually between, say, 0.1 and 0.9? If you're going to base massive policy decisions on that, maybe a multi-billion-dollar infrastructure plan on a factor that might have almost no effect at all, you've just wasted a huge amount of resources.
I see. So the coefficient itself is unbiased, but the reliability of that coefficient is completely destroyed. It's like we know where we're aiming, but we have absolutely no idea how wide our target spread is.
Exactly. The problem isn't where you aim. The problem is the measure you use to determine how precise your shot was. And serial correlation destroys that precision measure. So the core destructive consequence here is that serial correlation causes incorrect standard errors.
That's standard error.
Standard error is our statistical yardstick. It's the measure of uncertainty or precision around that coefficient estimate. It tells us how much we expect that estimate to fluctuate if we were to rerun the experiment with a new data sample.
And in the presence of the kind of serial correlation that's common in economics.
Right.
So positive serial correlation, where the errors cluster together, what happens to that yardstick?
It shrinks artificially. When you have positive serial correlation, the calculated OLS standard errors are typically too small.
Too small.
They make the coefficient look far more precise than it actually is. It creates this statistical illusion of sharpness where, in reality, everything is fuzzy.
But why? Why does the error calculation shrink? I mean, this is the technical detail that separates a summary from a real deep dive. Why does the math fail in this specific way?
It's because the OLS formula is built on that assumption we talked about, that every observation is an independent new piece of information. So if you have 100 periods of data, 100 months, OLS assumes you have 100 unique observations, and each of those 100 observations contributes to reducing the uncertainty.
But we know that's not true if there's serial correlation.
Right. When serial correlation is present, the effective number of independent observations is actually much, much smaller than the actual number of data points you have.
Because month two's observation isn't truly new information. It's mostly just a reflection of month one's lingering shock.
Precisely. If month two's error is 90% correlated with month one's error, you are not getting a full, new, independent piece of information. The model, the OLS formula, It sees these highly correlated data points, and it essentially confuses that noise with a real signal.
So it's double counting in a way.
In a way, yes. It calculates the variance based on n, the physical number of data points, when it really should be calculating it based on a much smaller effective n.
So the model sees, I don't know, 100 observations that all look very close together. It assumes there are 100 independent pieces of evidence, and so it concludes, wow, this coefficient estimate is incredibly stable and precise.
Yes.
But in reality, those 100 points were only maybe like 20 independent pieces of information. So the standard errors get artificially compressed.
That is a danger. And from there, the domino effect kicks in. If the standard errors are incorrect and they're too small, they directly lead to two major statistical failures: invalid t-statistics and invalid confidence intervals.
Right, because the t-statistic is calculated by dividing the coefficient estimate by the standard error.
So if you're dividing by an artificially small number,
You get an artificially large t-statistic.
an artificially huge one, which means we are far more likely to declare a variable statistically significant when it's not.
Okay, this is it. This is the big one.
This is the most significant real-world consequence. Economists might conclude, with this hugely inflated statistical confidence, 99% certainty, that variable X affects variable Y, when the true uncertainty might only allow for, say, 80% confidence. We run a massive risk of a type I error. That's rejecting the null hypothesis, the idea that there is no relationship, when we shouldn't have. We are confusing the persistence of our own unobserved shock for the precision of our variables.
And this failure to accurately assess precision, it also undermines our ability to interpret the results in a nuanced way, particularly when we try to isolate the effect of one single policy tool. And this is what the sources call the ceteris paribus trap.
Right, ceteris paribus, it means all else being equal, and it is the foundational assumption of any kind of causal inference in economics. When the Federal Reserve Chairman says a quarter-point hike in the federal funds rate will cause X change in lending, they are making a ceteris paribus statement.
They're assuming every other factor that influences lending remains stable.
Exactly.
But if serial correlation is present, we have these lingering, unobserved shocks that aren't being held constant. They're being carried forward across time, just like we saw with that AR1 model.
That is the trap. The error term itself is now acting like an uncontrolled, slow-moving, systematic variable. It's part of the all else that's not equal.
I see.
So if we try to isolate the effect of a policy variable, R16, but the error term $2 is highly correlated with 1T well, then that 2 is effectively contaminating the relationship. The systematic movement in the error term is kind of stealing credit. It's making the policy variable appear to have a sharper, more precise effect than it truly does.
Or maybe it's confusing the policy's effect with just the natural persistence of the cycle itself.
That's a huge risk.
So if I see high inflation and I, as a policymaker, raise interest rates, that's my 6 Yen, but high inflation is already persistent because of behavioral expectations, which are currently hidden in my error term.
Right.
Then the model might attribute the slowing of inflation to my interest rate hike, when in fact a big part of that slowing might have just been the natural, gradual dissipation of that expectation shock, which is still hiding in the error term.
You've hit the nail on the head. You cannot confidently draw valid ceteris paribus conclusions about the pure, isolated effect of one factor, when the all else, which is your error term, has a persistent systematic structure linking the past to the present. You lose the ability to distinguish between the effect of your policy and the effect of the ongoing momentum that you failed to model in the first place.
So to make any robust claim of causality, or to claim a precise effect size in business cycle analysis, you just have to deal with this problem first.
You have to.
So let's move this now from statistical theory to where the rubber really meets the road, the actual decisions that are made by governments and central banks. Because if our models are overconfident, the policy outcomes can be, well, they can be disastrous.
The illusion of precision. It sounds like the perfect recipe for overconfidence in public policy. I mean, if you can present a model to Congress or to a central bank board and show them our proposed stimulus has an impact factor of 1.7 and we are 99.9% certain of this estimate, it becomes incredibly hard to argue against that policy.
That's the inherent political hazard. Ignoring serial correlation drastically overstates the precision of these estimated cyclical effects. Since those standard errors are artificially compressed, specific policy variables, like the fiscal multiplier for government spending or the immediate impact of interest rates, they appear much more influential and statistically powerful than they truly are.
So we're systematically confusing a tight fit in the data, a low standard error, with the true accuracy of the estimate. We're making things look bigger and sharper than they really are. And this leads directly to reckless policy choices. Consider a central bank during a period of, high volatility. If their model tells them with extremely high but false confidence that a 50 basis point rate hike will reduce inflation by precisely 0.2% in 6 months, they're much more likely to act aggressively to try and fine-tune their interventions.
But if the true confidence interval is huge, if that 50 basis point hike could actually result in anything from a 0.05% drop all the way to a 0.4% drop, then acting so aggressively is incredibly risky. You don't know what you're going to get.
It is the difference between firing a sniper rifle and firing a shotgun. If you think you have a precise instrument, which is the inflated confidence, you aim for the exact target. But if you know you have a blunt instrument, which is the reality after you correct for serial correlation, you might be much more cautious. You might aim for a broader target or just wait for more confirming data.
So false confidence leads to this overestimation of control.
Overestimation of control over incredibly complex economic phenomena. It makes policy aggressive when caution is actually what's warranted.
And crucially, this overstatement of certainty must affect who gets funding, who gets published, which theories end up dominating the policy debates. I mean, if I can publish a paper that shows a highly significant relationship, it's going to gain far more traction than a paper showing the exact same effect size, but with wide, honest confidence intervals.
The incentive structure in academia and policy, sadly, favors the illusion of precision. It makes policy look scientific when, in fact, the policies that are built on these overconfident estimates will inevitably miss their mark. And that directly undermines the credibility of the entire economic management apparatus. So the ultimate outcome here is unreliable policy decisions. And business cycle analysis is used for two critical, very public purposes.
Okay, the first one has to be forecasting macroeconomic variables.
Yes. And if your model fails to account for the persistence that's captured by serial correlation, your forecasts will be consistently wrong in a predictable way. Well, for example, if we're in a recession, the model will see that initial negative shock as just a temporary deviation. It'll predict a rapid return to the long-term trend because it's failing to account for all that structural inertia we discussed.
So it will overshoot the reality of the slow, painful recovery.
Every time. It essentially models the economy as having amnesia. No memory.
And when the forecast fails, whether it's the government budget office predicting tax revenue or the central bank predicting inflation, that failure just erodes public and market trust.
And if the initial projection was based on statistically unreliable standard errors, that failure was baked in from the very start.
Okay, and the second purpose, designing stabilization policies. These are the tools used to smooth out the business cycle.
Stabilization policies have to be timely, and they have to be appropriately sized. If the models that are guiding these policies are flawed, if they overstate the significance of a single policy tool or underestimate the duration of a shock, policymakers might make huge errors. For example, they might wait too long to intervene because their model told them the shock would dissipate quickly on its own. Or they might intervene too aggressively because their model told them they had this razor-sharp control that they didn't really have.
We see this historically, don't we? If a central bank acts on the belief that their interest rate changes have a quick, highly precise effect, when that precision is just an illusion created by serial correlation, they risk either tightening too fast and triggering an unnecessary recession,
or loosening too late and letting inflationary expectations become entrenched.
The result is policy whiplash.
Exactly. So the need for accuracy here is not merely academic. It is existential for economic management. You have to account for serial correlation. It's necessary to improve both forecast accuracy and, crucially, the credibility of policy evaluation.
So if the underlying models are inherently unstable or overconfident,
the stabilization policies that are built on top of them will struggle, and that leads to policy effectiveness that is far lower than advertised.
It's about intellectual honesty.
The economists must be intellectually honest about the certainty of their findings before any policy is implemented.
Okay, so the problem is widespread, it's destructive, and it's subtle. We're left with these unbiased results that we fundamentally cannot trust. How does an economist looking at a big stack of time series data begin to approach this problem? Where do they even look first?
Well, the first step is, thankfully, pretty low-tech and highly intuitive. It's just visual inspection.
Visual inspection of what exactly?
After you run your initial OLS regression, the economist captures the regression residuals, those calculated errors, the tildes we've been talking about, and then they just plot these residuals against time. And visual inspection often provides the first and the clearest indication of correlation long before any formal math is done.
Okay, so what would a good plot look like? A non-correlated error plot, the ideal scenario.
If the errors were truly independent and truly random, what we call white noise, the residual plot would look like a random shotgun blast. It would just be a scatter of dots around the zero line.
A fuzzy band.
A noisy, fuzzy band with no predictable pattern at all. You'd see a positive error followed by a negative error, followed by another positive, with zero discernible pattern or tendency to bunch up. That is the statistical ideal.
But with serial correlation, that scatter would show that clustering we mentioned. It would look wavy.
Exactly. With positive serial correlation, which is the standard macroeconomic problem, you would see these long, persistent runs of positive residuals followed by long runs of negative residuals. If the model underestimated GDP growth in January, a positive error, it's highly likely to underestimate it again in February and March.
So the plot would look wavy or cyclical. It will almost mimic the slow-moving nature of the economic variable itself instead of being randomly scattered.
It often does, which is a dead giveaway.
This makes the diagnosis immediately accessible then, even to a beginner. You don't need advanced math yet. You just need to spot the pattern. You need to see the waves instead of the noise.
Right. And if that visual inspection confirms a suspicious pattern, then the economist moves on to the formal statistical tests. These are used later in more advanced econometrics. Tests like the Durbin-Watson statistic or the Breisch-Godfrey test.
And what do?
They quantify the degree of correlation between tut dollars and OT dollar and even $22 and so on. And they determine if that correlation is statistically significant, if it's meaningfully different from zero.
So it just confirms the visual diagnosis and tells you how serious the persistence problem really is.
That's the idea.
Okay, so once we've definitively detected the problem, we know our OLS coefficient estimate is probably fine, but the standard error is lying to us. The goal then is to restore valid statistical inference. We need to fix the standard errors without altering that core estimated relationship. So what are the main conceptual solutions?
The source material outlines two primary conceptual paths you can take. The first is what I'd call non-structural. That means we accept the persistence in the error term, but we adjust our statistical calculation for the uncertainty. The second path is structural. That means we try to rewrite the model itself to eliminate the persistence from the error term entirely.
Let's start with the non-structural fix.
Yeah.
You said solution one is using robust or auto-correlation consistent standard errors.
Yes. This is a highly common and computationally powerful method. You'll often hear them referred to as HAC standard errors.
HAC.
Heteroskedasticity and autocorrelation consistent. A common type is Newey-West standard errors. So instead of letting the standard regression formulas calculate the standard errors, which, remember, assumes independence and gives you those small, overconfident numbers, we use a much more sophisticated iterative calculation that accounts for the observed correlation structure in the errors.
And so we're basically mathematically telling the standard error calculation, hey, don't assume these 100 observations are independent. Assume they have a memory of up to, say, 4 periods.
Precisely. These robust standard errors essentially inflate that measure of uncertainty back to its truthful, larger size by adjusting for the correlated information structure. They fix the denominator of the t-statistic.
So our coefficient stays at 0.51, but the calculated standard error jumps from maybe 0.02, the misleading OLS result, to, say, 0.15, which is the robust, truthful result.
Exactly.
And the result of that. Suddenly, those beautiful, highly significant coefficients that the analysts were so proud of, they might just disappear entirely. They become statistically insignificant once you apply the true measure of uncertainty.
And that is the intellectual honesty that's required. This method restores valid statistical inference, and it forces analysts to confront the true precision of their estimates, even when there are correlated errors. And this is crucial for hedging strategies, for policy design, and just for academic honesty.
Okay. And the second solution moves beyond just correcting the error term. It tries to incorporate the dynamics into the model itself. It tries to fix the underlying structural issue.
That's right. That's dynamic modeling. The issue of serial correlation auction rises because the underlying economic process is inherently dynamic. It has those lags and that inertia, and we haven't adequately modeled that dynamic.
So the logic is, If the shock from the past is bleeding into the present's error term.
Then you should explicitly include the past in your explanatory variables.
Like using last quarter's GDP growth to help predict this quarter's GDP growth. Or maybe using the average unemployment rate from the past year as a predictor.
Absolutely. You explicitly model the dynamic structure right inside the regression equation. A common method is using lagged values of the dependent variable itself, like T7, as an explanatory variable. This creates what's known as an autoregressive distributed lag model, or an ADL model. By including IT1 and maybe other lagged variables, you capture that persistence directly in a coefficient.
So instead of the persistence hiding out in two talks, it's now explicitly captured by the coefficient on YTAT.
That's the goal. Once that persistence is captured by an explicit variable, we can call it the inertia coefficient. The remaining error term, our new take dolls, should ideally revert to being truly independent. Pure white noise.
So you've successfully modeled the memory rather than letting it hide in the residuals.
Exactly. And this method is often preferred when your goal is a deeper structural understanding of the economic process, because it lets you separate the short-term impact of your policy variable, $6, from the long-term inertia of the system.
Okay, so these two methods, robust standard errors to fix the uncertainty, or dynamic modeling to fix the underlying structural representation of the economy, these are the conceptual tools economists have to use to make sure their conclusions about business cycles are reliable, and not just statistical illusions created by the economy's inherent memory.
They're essential.
Wow. We have covered a tremendous amount of ground today, moving from a simple statistical requirement all the way to the profound implications for global policy design.
We have. And to recap our journey, serial correlation is really the statistical fingerprint of economic memory. It's the evidence that past unobserved shocks are still active. And it's defined mathematically by that condition, Coret, OUT1, where that persistence coefficient, Coret, tells us exactly how strong that memory is.
And while this persistence is just inevitable in dynamic economic data, from slow-moving unemployment to sticky inflation, its big statistical crime is not biasing the coefficients. It's destroying the standard errors. It tricks the model into thinking it has more independent information than it truly does. And that leads to dangerously overstating precision and generating statistical conclusions that are simply not credible.
And the real-world cost of that is unreliable policy. Business cycle analysis is used for these vital tasks, forecasting and stabilization. And if the underlying models are overconfident because of ignored serial correlation, policy credibility is threatened. We risk making aggressive, ill-timed decisions based on a false sense of precision.
The value for you, the listener, then, is really clear. Understanding this concept is absolutely key to critically evaluating any time series analysis that's presented in the news, especially when it's about cyclical economic reports. If an analyst claims high significance for some relationship involving GDP or inflation, your first critical question has to be, did you use robust standard errors, or did you properly model the autocorrelation? You have to challenge the claim's certainty, not just the estimated number.
And that leads to a final provocative thought, which is built on this understanding of persistence. If the serial correlation we observe is fundamentally tied to human behavior and policy lag times, if today's error really is tomorrow's constraint, then we have to ask ourselves, how much of the future economic trajectory is actually already locked in by the unobserved errors and the persistent shocks of the past? If the inertia of expectations and these structural lags mean that most of the next 2 quarters are already determined by momentum, are we truly ever navigating the present? Or are policymakers constantly just playing catch-up, merely reacting to the long shadow cast by yesterday's missed predictions? This concept of economic memory, it fundamentally limits our short-run policy options.
A profound thought on momentum and constraint. Thank you for joining us for this deep dive into the dynamics of serial correlation. We hope this gives you a much sharper and hopefully a more skeptical lens for viewing the precision claims in economic reporting.
Welcome back to the deep dive. Today, we're really trying to move past the headlines. You see all those economic reports, GDP numbers, housing starts, consumer sentiment, but you're left wondering about the critical how.
The how is everything.
Exactly. How do the economists, the analysts behind those big reports, take this just sprawling mass of complex data and numbers and filter it all down into one single reliable conclusion that can guide policy?
And that's our mission for today. We're going to take a deep dive into the analytical frameworks that they use to interpret the results of these big economic cycle studies. It's really the sophisticated scaffolding that supports all of modern macroeconomics.
Scaffolding, I like that.
Yeah, the whole process is designed to turn these raw numerical estimates, and we're talking about, dense regression output, into genuine, useful, and most importantly, actionable economic insight.
And that transformation, right? Going from a number on a computer screen to a fact that might inform a trillion-dollar policy decision, that's where the real expertise is.
It really is.
I mean, almost anyone can run a regression model these days, but understanding whether that cyclical effect you've just found is truly meaningful, if it's reliable and relevant, that's the hard part.
That's the difference between just identifying statistical noise and, uncovering a structural truth that maybe the government or the central bank really needs to act on.
Right. So that's what we're doing today.
Exactly. We're going to walk you through the structured approach that analysts take. We'll start with the statistical fundamentals that kind of act as the gatekeepers, like, does this finding even really exist? And then we'll move through the more critical judgment calls, things like magnitude, model trustworthiness, and historical context.
Okay, let's unpack that. And let's start at the very beginning, decoding the coefficients. An economist runs a model, they get this estimated coefficient back. How do we even start to interpret that number?
Right. So the estimated coefficient is the core output. It's the number you're looking for. If you run a model predicting, say, inflation based on something like unemployment.
The classic Phillips curve idea.
The classic example. The coefficient is what tells you the direction and the strength of that relationship, on average, over the entire period you studied.
And I'm guessing the very first, most fundamental check, before we even worry about how big that number is, has to be the sign.
Absolutely. The immediate focus is always on the sign. Is it a positive number or a negative number?
Just a plus or a minus.
A plus or a minus. This is the quickest, most essential validation step because it forces you to immediately check if your finding aligns with established economic theory. If the sign is wrong, the result is probably useless.
Okay, let's use a concrete example to make that really clear. Suppose we're building a model focused on the business cycle, and we're trying to predict the unemployment rate. We include a variable for, say, current GDP growth.
Right.
What sign must the coefficient on GDP growth have?
Oh, it has to be negative, unequivocally.
Right.
This aligns perfectly with basic business cycle theory.
Yeah.
I mean, you might have heard of it as Okune's law. When GDP growth accelerates, when the economy is expanding, unemployment should fall. They move in opposite directions.
Yeah. So if your model spits out a positive coefficient,
A huge alarm bell goes off.
meaning that as GDP grows, unemployment paradoxically goes up.
It would suggest a massive contradiction. Either one of the core tenets of macroeconomics is being violated, or, much more likely something is fundamentally wrong with your model.
It's a huge red flag then.
It is. It forces the analyst to just stop the whole process. A positive sign there tells you that either the theory is contradicted, the data itself is flawed somehow, or the model is just massively misspecified. Maybe you're missing a crucial control variable.
You can't even move forward.
You can't. You have to figure that out before you do anything else. It really highlights that these coefficients aren't just mathematical results. They're theoretical statements.
And we should probably remember that these coefficients, even if the sign is right and the magnitude seems compelling, they only represent the average cyclical effects, right, across the whole sample period.
That's an incredibly important distinction, that average. The coefficient doesn't tell you what happened in, say, 2008 specifically, or back in 1975.
It's the 50-year average or whatever the period is.
It gives you the average behavioral response of the economy over, say, the last 50 years. And when economic relationships are volatile, just relying on that single average can be really misleading, which is why we have to move on pretty quickly to the statistical checks.
Okay, so we've confirmed the sign is correct. The direction aligns with what theory tells us it should be. Now we have to deal with the problem of noise. I might find that negative coefficient on GDP growth, but maybe that finding just showed up because of, I don't know, random statistical luck.
Right.
How do economists figure out if the effects they're seeing are actually reliable?
Well, that brings us to the gatekeepers, assessing what we call statistical significance. The raw coefficients are, intellectually interesting, but they're analytically meaningless if they can't pass this test.
This is where we get into the stuff that often intimidates people, the tools like t-statistics, p-values, confidence intervals.
We can demystify those a bit.
Please.
Think of statistical significance as your filter. The t-statistic, for instance, just measures how many standard deviations your estimated coefficient is away from zero. A high T statistic suggests your estimate is strong enough to stand on its own, that it's not zero.
And that leads us to the p-value, which I think is probably the most misunderstood metric of them all.
It really is. The p-value answers a critical question. It asks, okay, let's assume for a second that there's actually no relationship between these variables in the real world.
The null hypothesis, right? That the true effect is zero.
The null hypothesis, exactly. Assuming that's true,
Yeah.
what is the probability that we would have observed this result that we just got purely by random chance?
Okay, so if the p-value is, say, 0.01, that means there's only a 1% chance we found this result by accident.
Right.
So we can be 99% confident that the relationship we modeled is actually real.
Precisely.
Yep.
And that confidence level is the key. Statistical significance is just the check that confirms whether your observed effects are truly distinguishable from random noise.
And there's a convention, right? The 5% rule.
There is. By convention, in many economic studies, we look for a p-value below 5%, or p less than 0.05. And if we find that, it means we can reject the null hypothesis that the relationship is just zero.
But that 5% threshold, it's kind of arbitrary, isn't it? I mean, if a finding comes in with a p-value of 0.06, it's technically insignificant, but it still feels highly suggestive of a real relationship.
That's a powerful point, and it's where judgment really comes into play. The 5% rule is a useful convention, a line in the sand, but analysts have to be careful not to treat it as some kind of sacred boundary.
But on the other hand,
if a coefficient is wildly insignificant, let's say the p-value is 0.40, that result is a massive warning sign. It's strongly suggesting that the cyclical relationship you're studying is either incredibly weak or unstable, or maybe it's just not there at all.
and you definitely can't base policy on that.
You can't reliably base major policy decisions on statistically insignificant results, no matter how strong the economic theory might feel.
Okay, so statistical significance establishes existence. It confirms the effect isn't just noise, but existence isn't quite enough. We also need to know how reliably we measured that existence, which I think brings us to standard errors.
Standard errors, yes. They're crucial because they directly tell you about the precision of your estimated cyclical effects.
Okay, how so?
Think of it this way. The coefficient is the dart you threw at the dartboard. The standard error is like the size of the target around where that dart landed.
I like that analogy.
If the target is really small, your estimate is precise. If the target is huge, your estimate is fuzzy, very uncertain.
That makes sense. If I tell you the effect of a policy change is 2.0, that sounds very certain. But if the standard error is large, say 1.5,
Then the real effect could be anywhere in a huge range.
right, with 95% confidence, it could be as low as 0.5 or as high as 3.5. And those two extremes have wildly different policy implications.
It introduces an unacceptable level of ambiguity. That massive margin of error signals very high uncertainty. And what those large standard errors really imply is that your estimates are highly sensitive to sample variation.
Meaning if you'd just chosen a slightly different time period for your study.
The results could have flipped completely. If the researchers had started their analysis a year earlier or ended it a year later, the coefficient might have shifted dramatically, maybe even changed sign.
Okay, let's translate this directly into policy risk. If a policymaker relies on that 2.0 estimate, they might set their interest rate based on a high expected impact.
Right.
But if the actual effect is closer to the bottom of that range, like 0.5, they've just drastically over-intervened and maybe caused an unnecessary economic contraction.
Precisely. And this is why standard errors are never just a footnote in a table. They directly dictate the policy risk. Low precision, which means high standard errors, makes it much harder to achieve statistical significance in the first place.
It all connects.
It all connects. And even if you do meet that significance threshold, a wide confidence interval can render the estimate practically useless for any kind of finely tuned policy. You can't hit a specific target with a wide beam flashlight when what you really need is a laser pointer.
Okay, so we've established the foundation. You need the correct theoretical sign, you need statistical significance so it's not just noise, and you need small standard errors for precision. But here's the twist. You can nail all three of those statistical checks, and the result could still be totally irrelevant to the real economy.
And that takes us to our next section, which is where we have to leave the pure math behind and start introducing some real economic judgment.
Right, we have to confront this critical difference between a finding that is statistically undeniable and one that is practically important. This is the leap from statistical significance to what you call economic significance.
This is where that economic judgment really truly comes into play. We're moving past the objective statistical tests. Did it pass the p-value threshold? To assess the practical relevance. We're looking at the sheer magnitude of the effect, especially relative to the size of the economy.
Let's talk about the policy conundrum, because this feels like where a lot of purely academic findings might fail to cross over into real-world relevance.
It happens all the time.
An economist might find a cyclical effect that's statistically significant at the 99.9% level. They're absolutely certain it's real. But the effect size is minuscule.
Imagine, for instance, a reliable finding that shows a 10% change in consumer confidence affects durable goods consumption by, say, $500,000 annually.
Okay.
Across the entire United States. That effect is real, it's not noise, but relative to a $25 trillion economy.
It's an invisible blip. It's a rounding error.
It's statistically significant, but completely, utterly economically trivial.
So if you're a policymaker, you might have to implement some large, politically costly intervention, like a new tax credit, to try and influence consumer confidence.
Right.
All in the hopes of generating an effect that's too small to even register in the GDP figures.
The cost of the intervention versus the size of the impact. That's the key trade-off. A small but statistically sound effect might have severely limited importance for a central bank or a fiscal authority that's trying to stabilize the entire economy.
They're looking for leverage.
They're looking for leverage for big, reliable multipliers.
This reminds me of the whole debate around fiscal multipliers after the 2008 crisis.
Oh, absolutely.
Analysts were desperately trying to find statistically robust estimates of how much $1 of government spending would actually stimulate the economy, if the multiplier was only, say, 0.5.
Meaning a dollar of spending only generated 50 cents of economic activity.
Right. It might be a reliable estimate, but the policy cost makes it a pretty poor choice for stimulus.
That's a perfect illustration. Economic significance requires that expert economic judgment to interpret the results and decide if the findings are large enough to warrant action and, justify the political and economic cost of that action.
It takes the analysis out of the abstract.
And places it firmly in the real world of limited resources and competing priorities.
Okay, so we have a finding that is now statistically reliable and economically significant. But before we can really trust it, we have to look under the hood at the data itself. Economic cycle data is notoriously messy.
It is. It rarely adheres to those neat statistical assumptions that models prefer.
And what are the big problems?
It's an unavoidable challenge. Economic data, especially time series data, is anything but clean. Analysts have to directly address two really common issues that can undermine the validity of their results. One is serial correlation, and the other is changing volatility.
Let's take serial correlation first. That's the idea that today's observation is strongly related to yesterday's, right? Which is just common sense in economics.
Total common sense. If the unemployment rate was 4% yesterday, it's not going to be 10% today.
Right. If the stock market was up yesterday, it's probably more likely to be up today than down.
Exactly. So serial correlation, or you might hear it called autocorrelation, means the observations in your data are not independent. Standard statistical modeling often assumes they are independent, and when that assumption is violated, something bad happens.
Which is what?
The model doesn't necessarily generate biased coefficients, so the average estimate might still be correct, but it drastically miscalculates the standard errors.
Wait. If the standard errors are wrong, then our whole precision check from before is useless, isn't it?
It's worse than useless. It's dangerously misleading.
How so?
If there's high serial correlation in your data, you don't account for it, the standard errors tend to be underestimated. The model thinks it has found a very precise, very reliable result, when in reality, the estimate is extremely fuzzy.
So the researcher ends up concluding that their result is statistically significant when it might not be.
That's the false confidence problem. It's a critical validity crisis. You've passed the significance test on paper, but the underlying structure of your data is basically lying to you about your true level of precision.
Okay, that's a huge problem. What about the second one, changing volatility?
Right, or heteroscedasticity, if you want the technical term. The variance of economic data often changes significantly depending on where you are in the cycle.
So recessions are wild, expansions are calm.
Generally, yes. Recessions are typically characterized by massive swings, high volatility in everything from corporate earnings to job losses. Expansions are usually much calmer, more predictable.
So if your model assumes that the variance is stable across the entire sample period, from, say, the calm of the 1990s all the way through the turmoil of 2008.
You are fundamentally misrepresenting reality. You are. And failing to account for that means the standard errors you calculate during the low volatility periods are totally inappropriate for the high volatility periods.
But what's the fix?
The analyst has to use specific econometric techniques, things like heteroscedasticity consistent standard errors, to make sure that their measures of precision are valid no matter where the economy is in the cycle.
Yeah.
It's just part of the rigorous self-scrutiny every analyst has to perform.
Okay, so we've handled the data issues. Now we have to turn the lens back onto the analysts themselves and the actual model they chose to build, the model specification. That's like the recipe they use, right?
Exactly. And you have to view the results critically through the lens of that recipe, because every choice an analyst makes is a potential source of error. You assess, first, the explanatory variables they included. Second, the functional form they chose. And third, the potential for things they left out.
Let's start with functional form. What's the risk of assuming a relationship is just a straight line when it's actually nonlinear?
A huge risk, especially in cyclical analysis. Economic relationships are rarely perfect straight lines. For example, during a deep recession, monetary stimulus might be incredibly effective at stopping a collapse. You get a steep, immediate response.
But during a normal expansion?
That same stimulus might have very little effect. So if the analyst just assumes a simple linear relationship across both of those phases, the model is fundamentally misrepresenting how the economy actually reacts.
The linear average is hiding the important dynamic.
It's masking the crucial nonlinear dynamic of crisis response.
And then there's what might be the biggest threat to any model, the danger of omitted variables, that hidden factor that's actually driving the relationship you think you found.
This is the classic pitfall. It often leads to what we call biased coefficients. Imagine you're studying the relationship between interest rates and investment spending,
Okay.
and you find a strong, reliable negative coefficient. When rates go up, investment goes down. Sounds correct, right?
Sounds like Econ 101.
It does. But what if you forgot to include inflation expectations in your model?
Because inflation expectations would affect both the interest rate the central bank sets and the decision a company makes about whether to invest.
Exactly. That missing variable, inflation expectations, is highly correlated with both of the variables in your model. And by leaving it out, its effect contaminates your finding. It biases your estimate of the interest rate's impact, potentially leading you to overstate or understate its true effect.
So how does an analyst defend against this? The suspicion of omitted variable bias, of model misspecification. They have to run a stress test, right? Robustness checks.
Robustness checks are absolutely non-negotiable. They are designed to determine if your findings are durable and not just, an artifact of the analyst's initial preferred setup.
So you have to rerun your core analysis using a bunch of alternative specifications.
A whole battery of them.
What are some examples of these stress tests? Is it just swapping one variable for another?
It's a lot more than that. An analyst might, 1, change the sample period. Does the result still hold if we drop the pre-1970 data?
Okay.
2, change the proxy variable. If they use the Consumer Price Index, or CPI, for inflation, they might swap it out for the PCE price index, which the Fed prefers.
Makes sense.
3, change the functional form. Rerun the model using logs instead of linear levels to see if the relationship is proportional instead of additive. And 4, the big one, add potential omitted variables. Include a new control for, say, market uncertainty or global trade volume, and see if your core finding disappears.
But what about the risk? I mean, if an economist knows their preferred model works, the one that confirms their hypothesis, isn't there a risk they only run the robustness checks that also confirm their finding?
That is the risk, and it really speaks to the integrity of the analyst. In high-quality, transparent research, the analyst has to report all the relevant checks, especially ones that weaken their main finding.
The purpose isn't just to validate.
The purpose of the check is not validation. It's confirmation that the result persists, even when the testing environment changes. If your finding vanishes or flips sign under a slightly different but still equally reasonable model specification,
And it's fragile.
it's highly fragile. It's likely driven by the model choice itself, not by some fundamental economic relationship. A robust finding, on the other hand, is one that stands up under tremendous scrutiny.
That feels like a deep lesson in scientific humility. Okay, so we've established statistical reliability, economic magnitude, and now model integrity. Now we have to connect this isolated finding to the broader economic universe.
Right. We have to remember that the economy is this massive, interconnected organism. We can't just look at one isolated coefficient and declare victory. We need to see how this one piece fits into the larger puzzle of history and established theory.
And the economic cycle is a multifaceted thing. It's not just GDP changing, it's unemployment, it's housing starts, inventory levels, trade, consumer sentiment. They all act together.
Exactly. Analyzing one isolated coefficient is like examining a single tile and trying to guess what the whole mosaic looks like. It only tells you a part of the story. So analysts have to assess whether the entire system of cyclical variables they've put in their model is jointly significant.
What does that mean in practical terms? Does it just mean checking if the model as a whole explains a lot of what's going on?
It's a bit more nuanced than that. It means using a joint statistical test, like an F-test, to confirm that all of those cyclical indicators together contribute significant explanatory power.
Okay, so maybe individually they're not that strong.
That can happen. You might find that housing starts, on its own, is only marginally significant, and consumer expectations on its own is also just marginally significant. But when you test them as a package, together, they might be highly jointly significant.
The intuition there is really compelling. The whole package gives you a more complete, holistic picture.
Right.
The combined, synchronized movement of all these variables is what provides the definitive signal of a business cycle effect, a signal that might be too weak to read if you only look at one variable in isolation.
And this joint interpretation is vital because it validates the whole framework. It shows that the model, as an integrated system, is accurately capturing the collective cyclical momentum. It stops the analyst from making the mistake of drawing big policy conclusions based on a single, isolated statistical observation that might just be a coincidence.
You need to know the overall structure is working.
I do.
Now we get to the historian's part of the analysis. Economic relationships are not fixed laws of nature. They evolve, often dramatically. I mean, the relationship between inflation and unemployment today is fundamentally different than it was 50 years ago.
That recognition is paramount. An analyst has to recognize that their results can differ dramatically depending on the specific time period they study. Economic systems evolve because of technology, shifts in institutions, policy priorities.
Which means you have to look at results across key periods. When an analyst presents a finding, they should always be asking, does this hold true across the major economic eras?
Yes. Absolutely essential breakpoints to check would be the pre- and post-Volcker era in the early 1980s, which marked a huge shift in how central banks thought about inflation.
Right.
Also, the Great Moderation from the mid-80s to 2007, which was a period of unusually low volatility. And critically, the post-global financial crisis era. The world looks different now.
Let's elaborate on those structural changes because they're the engine driving this historical difference. Globalization, for example, must have fundamentally altered the relationship between, say, domestic factory usage and inflation.
That's a powerful example. Before globalization really took hold in the 1990s, if domestic capacity utilization was high, factories were running close to full, domestic inflation was a near certainty.
You're running out of stuff, prices go up.
Simple as that. But with the rise of cheap global manufacturing and supply chains, high domestic utilization no longer guaranteed those price pressures. Producers could just import goods or components from cheaper locations.
So the structural link was broken?
Or at least weakened dramatically. And if an analyst runs a model using data from 1950 to 2020 and finds a weak coefficient linking utilization and inflation, that weak result doesn't mean the theory is wrong.
It means the structural change of globalization fundamentally altered that cyclical relationship after 1990.
That is precisely the insight. Proper interpretation requires situating the results within that specific historical and institutional context. If your analysis ignores these huge institutional shifts, like the move from fixed exchange rates to floating or the rise of independent central banks, the resulting coefficients will be misread.
You'd think the model was failing when really it was just commenting on how the world had evolved.
Exactly.
Yeah.
It transforms the analysis into a form of historical detective work.
It seems incredibly complex. It's not enough to just verify the math. You need the historical context to accurately interpret the economic meaning of that math.
It absolutely is detective work. And that detective work serves the ultimate goal, which is contextualizing your empirical results against established economic theory.
Okay, so we have a robust finding. It's correctly measured, economically relevant, and it's been validated across historical subperiods. Now, the final check is to confirm its place in the established body of knowledge. Consistency is key here.
Yes, consistency with the consensus view and with prior empirical evidence. If your model confirms what generations of economists have observed, for example, that fiscal stimulus is generally more effective when there's a lot of slack in the economy, it strengthens confidence. not just in your model, but in the whole theoretical framework. It's a confirmation.
But what happens when the results surprise you? This is where the investigation really deepens and, possibly where a new theory is born.
Unexpected results are the most challenging, and often they're the most valuable. They aren't necessarily wrong, but they immediately require further investigation and a much higher burden of proof. You can't just dismiss a result that contradicts decades of theory.
Can you give us an example of a shock finding that forced a massive reassessment in economics?
The great example is the breakdown of the original Phillips curve after the 1970s. The established theory held that there was this stable inverse trade-off between inflation and unemployment. But then the 1970s brought stagflation, high inflation and high unemployment at the same time.
So if an economist running an older model during that period found that their coefficients suddenly suggested a positive relationship, more inflation, more unemployment, that would have been shocking.
It was world-changing for macroeconomics. It forced economists to realize that a core structural assumption they were making, that people's expectations of inflation were static, was just wrong.
People started anticipating inflation.
They did, which rendered the old trade-off obsolete. That unexpected empirical finding triggered a massive theoretical shift, leading to the development of expectations-augmented models and rational expectations theory. The empirical surprise forced a refinement of the model.
So unexpected results often send you back to the drawing board. They suggest a need for model refinement, maybe adding a variable you hadn't thought of, like inflation expectations, or changing the assumed dynamic to account for this new surprise.
It's a critical feedback loop. Theory informs the model, and then the model's results come back and refine the theory. It ensures that the field makes progress.
And it stops the whole interpretation process from becoming circular. The results either validate what you currently understand, or they force a critical reassessment that advances the field.
That's the goal.
We've taken this dense numerical output through 5 major filters: theoretical consistency, statistical reliability, economic magnitude, model robustness, and historical context. So what is the ultimate payoff? Why go through all of this meticulous, painstaking analysis?
The payoff is what we're talking about next.
Yeah.
The ability to make informed, evidence-based policy decisions that can guide these complex economies through very uncertain cyclical waters.
This is the so what moment. Let's summarize how these thoroughly analyzed results directly inform critical macroeconomic decisions, starting with, say, fiscal policy.
Well, policymakers are constantly operating under immense uncertainty. When recession hits, governments need to know, and they need to know quickly and reliably, how effective their counter-cyclical measures are going to be. That requires trustworthy empirical estimates.
Let's drill down on fiscal multipliers. Designing an effective countercyclical policy like deciding to spend $500 billion on infrastructure, that whole decision hinges entirely on having a reliable coefficient estimate of that spending's impact.
It does. If robust analysis shows that the fiscal multiplier is high, let's say it's 1.5, that means every dollar of government spending generates $1.50 of economic activity. That justifies an aggressive stimulus.
But if the analysis suggests the multiplier is low or unstable,
then the policy recommendation shifts dramatically toward caution. Maybe you favor tax cuts instead, or you just wait for automatic stabilizers to kick in. Policymakers rely so heavily on both the direction. Is the stimulus actually expansive? And the reliability, how robust is that multiplier estimate of these effects?
and for central banks, their monetary stabilization efforts are equally dependent on this kind of analysis. They have to know the reliable effect of changing interest rates on inflation and employment.
Absolutely. If a central bank believes a 50 basis point rate hike will reliably cool inflation by X amount, that belief has to be grounded in robust, meticulously checked empirical analysis, an analysis that has accounted for structural shifts and model integrity. Weak estimates create policy paralysis or, even worse, risky overreactions.
This brings us back to that crucial caveat we talked about earlier, the reliability factor. If the findings, even after all this work, are weak or unstable, that has called for extreme caution in applying them to policy.
That is the ultimate ethical and practical imperative of this entire process. Governments and central banks cannot risk deploying major policy tools which have high political and economic costs, based on findings that might not hold up when tested rigorously.
The risk is too high.
The risk of a type I error acting aggressively on a finding that turns out to be spurious is just too high.
It sounds like the entire framework we've discussed, from checking a t-statistic all the way to running historical robustness tests, is ultimately designed to do one thing: minimize policy risk. The analyst provides the necessary confidence for policymakers to act,
That's right.
ensuring their decisions are based on evidence that is statistically sound, economically meaningful, contextually grounded, and demonstrably robust.
That is the highest purpose of this analysis. It's the constant, rigorous quest to make sure policy is informed by structural truth rather than by statistical coincidence.
So, what does this all mean for you as you encounter the economic news? We've traced this path from raw, dense regression output all the way through these layers of statistical checks, model scrutinies, and historical context to produce one thing, an actionable number that policymakers can trust.
We covered the need for theoretical consistency, the importance of precision, those small standard errors, the critical difference between statistical existence and real economic relevance, and the need to situate every finding within the messy, non-static reality of economic history.
And that brings us to our final provocative thought for you today. We spent a good amount of time discussing how structural changes, things like globalization, major financial crises, new technologies, are perpetually altering these cyclical relationships, forcing analysts back to the drawing board.
Yes, the economy is a perpetually moving target.
So, if that's true, if structural changes are always altering cyclical relationships, how far back can economists reliably look at historical data to inform future policy? Is the quest for truly stable cyclical relationships an eternal chase in economics? When we find a robust finding today, how long do we have until the next structural shift comes along and renders it unreliable?
That is a fascinating tension between the need for historical evidence and the reality of future applicability.
It's something for you to mull over next time you read an economic report arguing for or against a major policy intervention.
Thank you for joining us on this deep dive into interpreting the results of economic cycle studies.
We hope this gave you the analytical framework you need to understand the how and the why behind economic conclusions. Until next time. Welcome back to the Deep Dive. So you came to us with a stack of source material that I have to say looks pretty intimidatingly technical.
It can be, yeah.
This is a really serious, high-level look into, well, the engine room of modern economic trend forecasting.
That's a good way to put it.
We're talking panel data, we're talking deeply specific statistical models, and our aim here today is to get you the core insights, without you needing a statistics textbook.
That's right. And the core subject for this deep dive is something economists rely on, when they need to see clearly through all that statistical fog.
Yeah.
We're talking about fixed effects regressions.
FE regressions.
Or FE for short. The term, I know, sounds incredibly dry, like something only a statistician could love.
Right.
But this technique is, and I don't think this is an overstatement, arguably the most essential tool in macroeconomics and financial analysis today.
I really like that idea of a filter. Because when you look at these massive data sets, I'm thinking, 30 years of economic activity across 50 different countries, you realize very quickly that the data is just inherently messy.
It's incredibly messy.
Every single unit is different. So our mission today is to understand how these fixed effects models, how they act as the ultimate statistical scalpel.
A scalpel, I like that.
Giving us a shortcut to reliable forecasts by, I guess, forcing the data to talk about change, not just about its current status.
Precisely. And we need to frame this not as a math problem, but as an act of really intellectual honesty.
Okay.
When analysts are trying to predict major economic trends like the growth path of global GDP or shifts in unemployment across really diverse regions, they just cannot afford to use simple methods.
Because they'll get it wrong.
They will get it wrong.
Mm-hmm.
The necessity of the FE model, it comes from this fundamental truth that structural complexity dictates the outcome.
And if the model doesn't account for those structural differences, then the results are, they're essentially worthless.
They become actively misleading. So the goal of this deep dive is to isolate the genuine dynamic economic trends, the true drivers what's coming next, from these persistent, often invisible structural differences that just permeate every large data set. Right. By the end of this, you should be able to look at an economic research paper and immediately grasp the foundation of its forecast's reliability, or, its lack of reliability.
Okay, so to tackle this complexity, we first need to define the fundamental flaw in the data that fixed effects is even designed to solve. So let's start with the basics of unobserved heterogeneity.
Right. When we dive into the world of forecasting, we're almost always dealing with what we call panel data.
Panel data.
It just means we're tracking the same entities or units over a span of time. We use the letter I to denote the unit, so that could be a specific country, a firm, or a region.
So I is the who?
And it is the when. the time period, a specific year or quarter.
So if we're tracking, say, 30 multinational corporations across 50 quarters, then each company is an I, and each one of those quarters is a T. And those 30 companies, even if they're all in the same industry, they're just fundamentally distinct from each other.
They absolutely are. And this longitudinal structure, tracking them over time, it's a massive advantage for data analysis, but it also creates this huge problem of heterogeneity.
Heterogeneity just meaning difference.
Difference. And it's not just simple random differences. We're dealing with what we call unobserved heterogeneity. This is the fixed effect itself.
So let's define what a fixed effect is conceptually. It's an unseen influencer, right? A hidden factor.
It is. The definition is pretty clear. They are unobserved, time-invariant factors that are specific to each unit.
Time invariant meaning they don't change over time.
They don't change. Think of them as the unchanging foundational DNA of that entity. These are structural characteristics that either never change across the study period, or they change so slowly, over centuries, that we can confidently treat them as constant for the 30 years we're studying.
So it's the unique indelible fingerprint of that unit, of that I.
That's it, exactly.
That immediately makes sense when you think about countries. Every country has a unique background, a history, a default institutional setting that just profoundly dictates how it's going to react to a new tax policy or some global shock.
Of course.
So if country A always seems to do better than country B, but we can't fully explain why with the variables we can measure, that gap, that's the fixed effect.
That gap is the fixed effect. And because these factors are unobserved, they become statistically dangerous if we ignore them.
Why dangerous?
They're dangerous because they are not random. They influence the very economic outcome you are trying to forecast. And they're very likely correlated with the variables you can measure. But you can't just plug them into your model because you have no way to quantify them reliably.
Okay, so what are some of the classic real-world examples that economists are always citing in the source material?
Let's start with countries, because it's the easiest to see. A prime example is the institutional quality of a country.
Okay, what does that include?
Oh, it's immense. It includes the deeply rooted legal frameworks, the perceived stability of the government, how well property rights are enforced, the level of bureaucratic red tape.
All things that, don't really change substantially from Tuesday to Wednesday.
Exactly. They're constants over a 20-year panel study, but they profoundly affect investment potential, how easy it is to start a business, and ultimately GDP growth.
So the institutional strength of, say, Germany is a constant that is vastly different from the institutional strength of Brazil.
Worlds apart. And if you compare the two directly in a simple model, you'll end up falsely attributing Germany's long-term success to whatever variable you did manage to measure, when in reality it's that stable, superior institutional quality that provided the whole foundation. That is alpha I in action.
That makes perfect sense. The foundation is different. What about cultural things?
Another powerful constant difference is deep cultural factors affecting consumption and savings habits. Just think about a society where high savings rates are a matter of national pride or cultural mandate versus a society that relies heavily on consumer debt and spending for its growth.
Those are cultural constants?
Yes, specific to that unit. They determine the overall velocity of money, the elasticity of consumption. But you can't just plug a culture score into your equation. It's all bundled up in that fixed effect.
And if we zoom in to the firm level, the sources also talk about firm-specific managerial constants.
Yes. So consider two firms in the same industry. They face the same market, the same tax rates, but one consistently outperforms the other. Why?
It could be the management.
It might be due to firm-specific consistent management practices, maybe a flat, responsive corporate structure that was established decades ago, or an intrinsic culture of innovation that's just hardwired into its operations.
And these things are constant.
They remain constant, influencing productivity and investment decisions. But you can't easily quantify them with standard financial metrics. They are, again, the unobserved alpha.
Wait a second. If these factors are so obviously powerful, institutional quality, culture, management style, why don't we just find a proxy variable for them and measure them? Why do we just accept that they're unobserved?
That is a crucial question. And it really speaks to the limitations of data collection. First, a lot of these concepts are just subjective and multidimensional. How do you assign a single, consistent numerical score to institutional quality across 30 very different countries that truly captures its complexity?
It seems impossible.
Second, even if you did, the measurement error would probably be enormous, and that could do more harm than good. And finally, and this is the most important part, in a fixed effects model, The researcher realizes that the exact value of that institutional quality is actually less important than just ensuring that its constant influence doesn't contaminate the variables we do care about.
So the key realization is that these time-invariant factors, they influence the outcomes, and since they are impossible to measure directly, running a simple regression is it's like comparing a finely tuned racing engine, country A, to a sputtering tractor engine, country B,
Yes.
and then trying to figure out the effect of a specific brand of fuel additive, which is your X variable. Your results are just going to be completely skewed by the engine's baseline difference.
Precisely. That is the statistical confusion. The whole purpose of the solution, therefore, is to bypass this entire problem. FE models are specifically designed to allow researchers to isolate the internal dynamics, the movement and change within unit AUI.
So we stop comparing the racing engine to the tractor engine entirely.
We stop comparing their fixed structural specifications. Instead, we only focus on how things change inside that specific country or firm over time.
So the question becomes,
The only question we ask is, when country A implemented that specific policy, did its performance improve or decline relative to its own historical average? And when country B did the same thing, how did it change relative to its own history?
this shift in focus is absolutely crucial. It's moving from a cross-sectional analysis, which is comparing across units, to a time series analysis, comparing within units over time.
Right.
It removes that stationary structural noise, which, as you said, is necessary for reliable trend forecasting.
And that strategic removal of baseline differences is what leads us right into the model structure itself.
So if the problem is realizing that every unit is different, how does the map actually build that difference into the formula? That takes us neatly into section 2, building the model decoding the fixed effect.
Yeah.
And you don't need a math degree for this, but the formula gives us a perfect map.
Indeed. We'll use the notation as a framework for understanding the functional components. The standard fixed effects regression model is conceptually built like this. Beta 1 exit plus beta 2 zit plus alpha plus u.
Okay, let's break down the cast of characters here. We can start with the exciting parts, the elements we are actually trying to forecast and the factors that drive those forecasts.
Right, so Y is our dependent variable. That's
Mhm.
the outcome we're interested in predicting. This is the GDP, the unemployment rate, or the firm's stock value for unit I at time t.
And the X's and the Z's.
The 6's and C are our time-varying explanatory variables. These are the dynamic drivers, the factors we think are causing the change in Y,
Like a new interest rate hike.
or a new government subsidy, or changes in global oil prices. These variables change over time and across different units, and the beta coefficients attached to them, those are what we are ultimately trying to estimate, the true dynamic effect of that change.
These beta values are the coefficients that tell the story. If beta 1 is 0.5, it means a 1 unit change in X causes a 0.5 unit change in Y.
That's the goal.
Now, let's get to the components that make this model special, starting with those two non-moving components at the end.
Okay, so we have unitellers, that's the idiosyncratic error term. This is just the random, unpredictable noise.
The statistical, I don't know.
Pretty much, it encompasses truly random shocks that hit a specific unit at a specific time that no model could reasonably predict. A sudden local natural disaster, for example. It's purely stochastic.
Okay, so that's the pure randomness. But the most critical component, the thing that separates FE from every other model, is that alpha I.
Alpha I, the unobserved fixed effect. We absolutely need to underscore that this term acts like a personalized intercept for every single unit I.
A personalized intercept, could we call it the constant structural load for that unit?
That's a fantastic way to put it. It captures the combined, accumulated influence of all those time invariant factors, the institutional quality, the culture, the geographic advantages, the stable management structure, all of it.
Okay.
By including alpha I, the model is forced to recognize that country A's baseline outcome is naturally higher or lower than country B's baseline, and that difference is constant and structural.
So we're telling the model.
We're telling the model, do not confuse country A's high structural baseline with the impact of the policy we just implemented.
So instead of having one single 0 point for everyone, one starting line for the race, we have 50 different starting lines for 50 different countries.
Exactly.
This flexibility doesn't just improve the model's realism, it seems like it fundamentally changes the nature of the relationship being measured.
It completely does. It absorbs that constant, unmeasurable structural component, and it removes it from the relationship between your X variable and your E variable. Without alpha I, the effect of X would be polluted by the effect of that constant structural difference. With alpha I, we can isolate the dynamic change.
Let's revisit that classroom analogy to really lock in how this fixed effect functions. We talked about a classroom study, testing a new teaching policy, our X variable. The fixed effect, alpha I, is the student's starting score based on their fixed, unmeasurable background factors.
Right, and we can extend that to see how the model actually works to filter it out. Because alpha is constant for that student, for that unit, across the whole study period. The model can estimate its value mathematically by just looking at the average score that student achieved over the entire period.
Wait, hold on. So the model essentially calculates the student's average performance over time, attributes that average to their fixed effect, and then it just focuses on the deviation from that average.
That is the mechanical genius of the fixed effects estimator. It uses what's often called the within transformation or demeaning transformation.
Demeaning.
For every single variable in the equation, your y, your x, your z, subtracts the average value of that variable for that specific unit across all the time periods.
So if a student's average score across 10 years was 80%, the model subtracts 80% from all their scores. The student's new scores are now just deviations from their own historical average.
Exactly.
And this automatically eliminates the student's personalized starting score, the alpha I, because alpha I is constant, so subtracting its mean just makes it 0.
It vanishes from the equation. You are left only with the movement around the mean. So now, when you measure the success of the teaching policy, your X variable, you are purely measuring the success based on how much each student's score improves or declines from their own specific historical baseline. You are isolating the pure effect of the policy itself.
But if we use that demeaning transformation, aren't we kind of admitting defeat? We've basically given up on trying to measure why some units, some countries start ahead or behind, right? We're throwing out all the information about the structural differences.
We are absolutely admitting defeat on measuring the effect of time invariant variables like institutional quality. And that is the fundamental trade-off.
But it's a necessary one.
It is a necessary one for our goal, which is reliable trend forecasting. We prioritize causal inference on the dynamic variables, the x's, over understanding the determinants of the static differences, the alpha i's.
Yeah.
If you want to know if a new policy works now, you have to remove the static noise that would otherwise just confuse the results.
And that challenge brings us directly to Section 3, why fixed effects deliver better forecasts. Because, at the end of the day, the value is in the predictive power, and the risk of just ignoring that alpha is, well, it sounds severe.
It is the single most critical point. The danger of running a standard regression and just leaving out that personalized intercept. If we ignore alpha I, we immediately introduce what's called omitted variable bias, OVB.
OVB. It sounds like complex academic jargon, but it's really just statistical confusion about cause and effect.
It's more than confusion. It's an error that can lead to some truly disastrous policy decisions. OVB happens when a variable that fundamentally influences your outcome, in this case the fixed structural advantage, alpha is also correlated with the variables you do include, your x's, but you leave it out of the model.
So its effect gets absorbed somewhere else.
When you omit it, the effect of alpha I gets improperly bundled into the coefficient of x.
Let's use a vivid, high-stakes example here to show the real-world policy cost of this. Imagine we're studying the effect of a new infrastructure spending bill, our X variable on economic growth, our E variable, across 20 different American states.
Perfect example.
Mm-hmm.
So let's say the states that have the strongest underlying institutional quality, the lowest corruption, the best regulatory consistency, the highest public trust.
They're alpha.
They're alpha. Let's say those are also the states that are most efficient and fastest at implementing and spending the new infrastructure money.
So their alpha I and their X variable are correlated.
They're correlated. So if we run a pooled OLS model, which ignores alpha I, the states that are already fundamentally better are going to see better outcomes from the infrastructure bill.
And the model will see that correlation and mistakenly calculate a huge positive beta coefficient for the infrastructure bill, making it look like a massive success.
Overwhelmingly successful. The results are fundamentally muddied. So other states, the ones with weaker institutional quality, might look at that research and adopt the exact same spending bill, only to see minimal results because they lack that strong alpha I foundation that was necessary for success in the first place.
So OBB doesn't just produce bad statistics. It causes policymakers to enact ineffective, wasted laws based on confusing correlation with true cause.
It does.
And the FE regression, by explicitly removing the influence of alpha I, ensures the forecast is based on the true economic dynamics.
Yes. It forces the model to ask the right question. When that specific state, regardless of its institutional baseline, increased its infrastructure spending relative to its own past, what was the resulting change in economic growth? This shift is what provides the clean, reliable forecast.
This brings us to the fundamental disagreement between the two main ways of analyzing panel data: fixed effects versus pooled regression. Let's really hammer home this contrast. What is the flawed, simplistic assumption that just ruins pooled models?
Pooled ordinary least squares, or pooled OLS, it treats all your data like a giant, homogeneous blob. The core assumption is that all units, all countries, all firms are interchangeable.
Wow.
They're assumed to share the exact same overall intercept. It forces one single relationship to apply everywhere, ignoring all those structural, constant differences we've been talking about.
Which is just an incredible oversimplification in complex economic data. It's like trying to find one average growth rate for a seedling and a redwood tree combined.
Exactly. Pooled OLS is forced to find a single average effect, and if the structural differences, the alphis, are correlated with your variables of interest, that average effect is inherently biased and misleading for any kind of trend forecasting.
But the fixed effects approach, it just rejects homogeneity completely.
It does. FE is inherently a more realistic approach. It allows each unit to have its own personalized intercept, its own alpha I. This flexibility drastically improves the model's realism. When heterogeneity is present, and in economics, it always is, FE boosts forecast accuracy significantly because it's no longer trying to average these completely disparate starting points.
And here's where it gets really interesting for me. The unique interpretation of the coefficients you get from an FE model. It's not just a statistical trick, it gives us a kind of philosophical clarity on causation.
The interpretation is the model's ultimate value. The estimated coefficients measure the effect of relative movement, the changes within the same unit over time.
We are focusing purely on the internal dynamic changes in policy or market conditions.
Think of it this way. When you look at a pooled OLS result, you're interpreting the effect across units. The conclusion is countries with more X tend to have more Y.
Which is correlation.
It is, but the FE interpretation is purely temporal. It's when country X increased its level of X, country X's Y increased. This isolates the cause and effect of the change itself.
Let's use that investment example from the source material to really crystallize this.
Okay. If we study investment using pooled OLS, the model might conclude something like countries with high investment levels have, on average, high GDP.
Which sounds reasonable, but
it's correlation, and it's very likely just picking up on the fact that rich countries, countries with a high alpha I, simply have more money to invest to begin with.
But if we use fixed effects instead?
The coefficient shows how changes in investment within a single country affect that country's GDP growth, while holding that country's stable traits, like its culture, its political stability, its geography, all constant.
So it asks,
did increasing investment this year actually move the needle for this country?
That distinction is just profound, because if you rely on a pooled model, you might mistakenly believe investment is a primary driver, when in fact investment is just a symptom of a powerful, stable foundation that the model completely failed to account for.
That's right.
So FE ensures we are forecasting the true dynamic effect of the variable change on the economic trend.
It's the move from descriptive correlation to dynamic causal inference. And that's what makes the resulting forecasts much more actionable and trustworthy for policymakers who are looking for levers they can actually pull.
Absolutely. Okay, so we've spent a lot of time on these unit-specific fixed effects, the alpha I, which filter out differences across countries. But as we all know, the economic world is interconnected, and global events often throw simultaneous curveballs at everyone. How do we filter that noise?
That leads us perfectly into Section 4, refining the forecast time fixed effects and trend drivers. Remember, long-run economic trends are fundamentally driven by time-varying factors: technological progress, demographic shifts, global political events.
Right.
The alpha I model already gives us clarity on those drivers by filtering out the constant noise.
But that clarity is incomplete if a massive event affects everyone at the same time. If there's a global shock, country A's GDP drops, country B's GDP drops, even if they implemented completely different policies.
Precisely. That synchronized movement needs to be controlled for separately. And that's why we introduce the time-fixed effect. You'll often see it denoted as lambda, and it acts like a common shock absorber.
So we add another personalized intercept, but this one is personalized by time. not by country. It applies a uniform adjustment for an entire year across all the units in the sample.
That's the key functionality. Time-fixed effects capture common shocks and events that impact the entire economy or sample group simultaneously, regardless of their individual structure. It accounts for those big macroeconomic events that are external to your specific X variables and external to the individual alphas.
What are the classic examples of these common shocks? I'm guessing the 2008 financial crisis is a perfect fit.
The 2008 financial crisis is the absolute textbook example. The massive synchronized decline in global demand affected nearly every country, irrespective of their local tax policies or their management quality.
It hit everyone.
A global recession or, more recently, a worldwide pandemic, these things drastically alter consumption and supply chains everywhere. Or a simultaneous worldwide surge in key commodity prices like oil or microchips affects every importing country's input costs all at the same time.
So without a time-fixed effect, if the 2008 financial crash hits, the researcher sees every country's GDP just plummets in 2009.
Right.
And if that researcher happened to be studying, say, the effect of manufacturing subsidies, the model might mistakenly conclude that the subsidies caused the GDP to drop just because the two things happened at the same time.
The contamination of the estimate would be massive. The time-fixed effect acts as a kind of global mood adjustment for that year. It absorbs that common year-specific effect, isolating the remaining variation that is truly attributable to the unit's specific actions. Its X variable, or its unique structural baseline, is alpha.
So it tells the model.
It tells the model. We know 2009 was a terrible year for everyone. Now let's see if country A's policy made its terrible outcome slightly better or slightly worse than the global average.
The benefit of including both unit-fixed effects and times-fixed effects seems overwhelming for forecasting accuracy. You're separating three completely distinct layers of influence.
That's a really powerful insight. You are separating, one, the constant unit-specific structure, the alpha, the country's stable foundation.
Okay.
Two, the universal time-specific shock, the lambda, the global wave that lifts or sinks all boats equally.
Wait, then three.
And three, the true dynamic change, the X variable, the specific local action or policy that we actually care about.
By isolating that dynamic change, you're left with the cleanest possible estimate of your beta coefficients, which are the very things you need to forecast future trends.
Precisely. This allows us to connect the past behavior of a unit to its future potential. And the source material notes that FE models are strongest when past internal dynamics are informative about future trends.
What does that mean in practice?
It means if a firm consistently shows an increase in productivity, its Y variable, following an increase in R&D spending, its X variable, the FE model is incredibly adept at capturing that predictable pattern within that specific firm.
This inherent reliance on the stability of internal dynamics, it suggests a limitation on the forecasting horizon, doesn't it?
It absolutely does. These models are not designed for predicting 50 years into the future. They excel at short to medium-term forecasting.
So they're tactical.
They are tactical trend analysis tools. They are phenomenal at predicting the near-term consequence of a policy change because they leverage the fact that the underlying structure is assumed to be stable during that short period.
So if you, the listener, see an economic analysis that's using an FE model to forecast, say, 4 decades of climate impact or demographic shifts, you should immediately recognize that the model might be fundamentally inadequate for that task.
Right.
Because it relies on the stability of the very system it's trying to forecast.
It's a critical warning signal. The power of the model is conditional on the assumption that the economic machine, while changing its speed, your X variable, retains the same basic gears and chassis, your alpha.
That knowledge provides an immense critical advantage. Let's shift now to Section 5, Applied Uses and Critical Limitations. Where is this filtering technology actually being deployed in the real world to inform policy and markets?
The applications are broad and, I would say, foundational for government and financial analysis. Policymakers and analysts rely on FE results because they offer high-confidence evidence of dynamic impact, separated from all that background noise that just dominates simple data comparisons.
Can you detail some of those common real-world applications for us?
A primary use is forecasting GDP growth across diverse countries or regions. When large international organizations like the World Bank or the IMF assess regional growth forecasts, they're constantly trying to untangle the impact of global trade shifts from the local indigenous factors of a country's unique economic structure.
And FE lets them do that.
FE allows them to predict how a global trade liberalization agreement will affect, say, the Philippines versus France, even though their structural baselines are entirely different.
And what about within a country like the US or within the EU?
They're used extensively for predicting unemployment trends across various regions or states. Think about regional labor markets. The drivers of unemployment in a former coal mining region are structurally different from those in a booming tech metropolis.
Totally different worlds.
Though FE models can separate those regional baselines, allowing analysts to forecast the true impact of a new federal education spending program by comparing the post-program unemployment rate to that region's own historical structural rate.
And the evaluation of policy impacts. That seems to be the most critical political application, really enabling evidence-based governance.
It is the ultimate goal. FE models are the gold standard for evaluating how a specific tax change affected multiple states over time. This is where the political value is just immense. FE results help policymakers confidently separate structural advantages from genuine, policy-driven trends.
So when a state sees economic growth,
They want to know, was it because of the new tax incentive we passed, the X variable? Or was it because we already possessed superior ports and a stable local government, our LFI? Only FE provides that separation.
that clarity is what allows smart policy to be exported. If the growth was purely due to the structural advantage, then exporting that tax incentive to a structurally disadvantaged region will likely fail.
Exactly. FE results help governments avoid making policies based on a correlation that only rich or stable units can actually benefit from.
Now we have to acknowledge the trade-off. This statistical scalpel is powerful, but it's not without its costs. Let's delve into the constraints, because the well-informed learner has to recognize when the model has reached its limits.
Right. In the pursuit of eliminating this time invariant bias, FE models sacrifice the ability to study everything that is constant.
So the first and most profound limitation relates directly to the core mechanism. The model cannot estimate the impact of time-invariant variables.
This is the Faustian bargain of FE. Since the model works by essentially differencing out that alpha I term, any factor that is constant for a unit over time, like a country's average temperature, its geography, its initial institutional quality, or whether it's a monarchy,
It can't be tested.
it cannot be tested for its effect on the outcome.
That means the cross-sectional information, the differences between units, is entirely eliminated. So if I wanted to know, does having a coastline generally boost a country's GDP? I cannot use a fixed effects model to answer that question.
No, you can't.
Because coastal axis is a constant, and it just gets absorbed into alpha.
You are 100% correct. You are sacrificing the ability to study the determinants of levels, why one country is inherently richer than another, in favor of studying the determinants of change, how a policy intervention alters the trajectory of a country.
It's a necessary trade-off for trend forecasting.
It is, but for research into the fundamental drivers of long-term development, it's a major, major limitation.
So if the learner sees a paper using an FE model to argue that countries with greater democracy grow faster and democracy hasn't changed in those countries over the sample period, they should be highly skeptical.
They should be extremely skeptical. That effect is simply absorbed into the fixed effect. That researcher would need a different model, maybe a random effects model or a different research design entirely to estimate those time invariant effects. FE simply cannot do it.
What about the stability of the economic relationships themselves?
That is the second major constraint. FE models assume that the relationships between the dynamic variables, those beta coefficients linking x and z to y, remain stable over time and across units.
So if the way investment affects GDP changed fundamentally between the 1980s and the 2020s,
Then the FE model, in its basic form, might just give you a single average beta that completely masks that important change over time.
and this assumption of stability leads us directly to the biggest challenge for long-term forecasting, structural breaks.
Indeed. Forecasting outside your sample period becomes extremely unreliable if a structural break occurs. And a structural break is not a recession or a temporary shock. It's a fundamental, permanent change in the underlying economic or political reality.
Can you give us a clear example of a structural break that would just invalidate an FE forecast?
Sure. Think about the collapse of the Soviet Union. A massive political change that fundamentally altered the institutional quality and the entire economic mechanism of 15 countries almost overnight.
Right.
Or something more subtle, like the mass adoption of the internet in the late 1990s, which fundamentally changed productivity functions and communication across all firms.
So if the model relies on the consistency of that underlying economic structure, the gears and chassis we mentioned, and that structure breaks, the model's predictive power for the future period just evaporates.
It's gone. The past internal dynamics are no longer informative about the new, broken, or reformed structure.
So researchers must be constantly testing for these breaks.
They have to. The power of FE is conditional on the fact that the underlying mechanism connecting the dynamic factors to the outcome remains consistent. If you are forecasting outside that period of consistency, you're just using yesterday's rules to predict today's game.
This has been an incredibly rigorous and detailed look at a tool that is just absolutely fundamental to modern economic insight. We've defined the problem of unobserved heterogeneity, we've understood the elegance of the personalized intercept, and we've assessed the critical trade-off that provides causal clarity in exchange for that cross-sectional information.
It's a necessary sophistication. It really highlights how analysts have to move beyond simple averages to get to any kind of baseline of reliable data. The goal is always to find the truth that's hidden beneath the noise.
So what does this all mean? To summarize the journey for you, the learner, we started with the chaos of panel data, realizing that simple methods just confuse structural status with dynamic economic change.
And we learned that the fixed effects model is the necessary tool for moving past that confusion. By introducing that personalized intercept, alpha I, we filter out the constant structural noise, and we derive insights based on the pure dynamic changes, the internal movements of the unit over time.
The value of FE lies entirely in its ability to focus on change, the short to medium-term drivers of trends, by filtering out those constant structural factors like institutional quality or geography. And this is how you, the listener, can quickly become well-informed on reliable economic analysis. Knowing the difference between a real policy-driven trend and just a mere structural correlation.
It allows you to trust those beta coefficients that are driving the forecasts because you know they are clean of constant bias.
Now for our final provocative thought, and this builds directly on the most difficult limitation we discussed, the model's inability to estimate time-invariant variables.
This is the ultimate philosophical hurdle for policymakers using these tools.
If fixed effects models are powerful because they filter out stable factors, like a country's ingrained low institutional quality, how do economists and policymakers responsibly evaluate whether a deeply long-term policy, I'm thinking investing in massive judicial or governance reform over 20 years, has successfully shifted that very fundamental structural aspect of the economy? When that structural aspect, the alpha I, cannot be directly measured or tested within the FE framework itself.
Wow.
In essence, how do you prove you fixed the chassis when the model is designed to ignore the chassis?
That forces the analyst to adopt a multi-model approach, perhaps looking for evidence that the policy has not just changed the growth rate, but has permanently altered the unit's responsiveness to other variables, the heterogeneity of the effects rather than just the intercepts.
It's a huge challenge.
It's the ultimate paradox. FE controls for structure by eliminating it, but structure is often the ultimate target of long-term governance and reform.
A tough but essential question to mull over as you encounter complex economic analysis. Thank you for guiding us through this deep dive.
My pleasure.
We'll catch you next time for the next deep dive.